of consensus opinion, and proving a stop clock is right twice a day. I managed to get one right, and you ask about taking it off. Well, the reality is I haven't taken it off, and that's kind of the sort of trade that the really long ones I hang with for a long time, and I'm not sure when I'm going to take that off. I'm going to wait for the kind of the conditions to change. But in the meantime, they continue to print, and just like when the U.S. we've been climbing this wall of worry. They printed, and the stock market kept going up, and I suspect it'll be the same in Europe.
Do you find that's the case with quite a few of your longer term macro trades, is that you are actually going against general consensus for the most part?
Generally, I'm a little bit of a knife catcher, especially when it comes, on my day trading, I'm not a knife catcher, and I'm more of a trend follower and going with it there. But on my macro positions, my longer term positions, I'm definitely often putting it on when people are going the other way, or at the very least when nobody cares. And I'm actually struggling. If you had to kind of ask me my weaknesses, one of my biggest weaknesses is that when people start to agree with me on a long-term basis, like on those trades, I start to get nervous. And I've often taken trades off too quickly because I've kind of thought, oh, they're crowded now.
This place feels like a haunted maze.
That's like something I'm working on, is to hang tough with the trade.
I bet you have a brilliant strategy
even as everyone starts to agree with me. I just end up being such a contrarian on those trades that as when it finally starts to go my way, I'm kind of, it makes me feel uncomfortable.
Right. And how do you manage risk on these positions, on these macro positions? And I guess also, what signals to you that you might be wrong on a position?
So in terms of what signals me is my P&L. And then, I'm used to some pain going against me. Like if you're going to be catching bottoms and taking the other side, it's not like you put these trades on and you're going to time it and it's instantly going to be on side. It's not that kind of thing. So, I'm usually, I usually I'm prepared for some pain when I put on a macro position, and I definitely will let it go against me for a bit. And in terms of how I manage risk, I try to figure out ways to make my portfolio as a whole less risky. And so, for example, if I got in a situation like, where I was long one kind of stock market, or I was long one bond market, I might look for other bond markets or stock markets to hedge a little bit on the other side, or I might kind of think about how it interplays. So if I'm long gold and then long currencies, which will traditionally go together, it might be something I'll think about, and I might reduce one a little bit more, or I might be more prone to take a trade that is, I know, kind of a diversifying trade. So if I'm long, let's say I'm long gold, I really believe in gold, and then I get bearish on a currency, I might be more apt to take that because I know that naturally that's something, gold and currencies will go together. So if I'm long one and short the other, it'll be generally something that'll make it so my portfolio as a whole has less risk.
Okay, got it. As we were talking a little bit earlier, you made a point, and it's certainly not a unique point, but you said that people need to find a way of trading that suits their type of personality. It's something we hear all the time. As someone who is a macro trader, what type of personality or type of trader do you think is well suited to be a macro trader?
Well, that's a great question. So with my letter, I've come to know, actually, I've gotten some great context in terms of people that I've come to meet, and generally these guys are much more traditional macro traders than I. And the one thing that I guess where I'm a little different is I'm sitting around banging S&Ps around all day. They're actually reading, and they're doing things in what I would consider much more slow motion, and that makes sense because if you think about that part of my book, it's actually much slower and less active. So I would say that on the whole, the macro traders end up being a little more cerebral. They end up being somebody who wants to read something, go home, think about it for a day or two, and then put the trade on. It's a little less high paced. They often, I find them going to conferences, and I'm like, where do you find, like, I'm always kind of shocked at the amount of conferences that they'll be away from the screens way more than I would ever feel comfortable being away from the screens. And it's somebody that kind of just enjoys a puzzle that's a little bit bigger, and it's a little bit has a lot more pieces in it. And that's kind of what if, in terms of somebody that would want to trade macro, somebody maybe that might be a little more kind of academically inclined. You put your guys that were the kind of the jocks that put them in charge of banging back and forth S&Ps or scalping Intel for ticks and stuff like that, and then you put your generally I would say that they might be more inclined to have the geeky guys trading the macro. That's just my impression. Who knows? I might be completely wrong, and I might have just offended a whole bunch of people. But that's kind of I don't think that the macro traders are generally the cool guys. Apart from the occasional guys like Paul Tudor Jones or stuff, but on the whole, it's kind of the guys that are a little more slow paced.
Sure. Okay. I think you're safe with that. All right, Kevin. Well, we're getting on a bit. While I have you here, I do want you to share one last story, and it's about what encapsulates a great trader. And you have a story that has something to do with the discovery of oil in Norway. And I'd love if you could share this, because I think it will kind of expand people's minds a little further, or at least help in some ways. So yeah, would you like to share that story?
Yeah, sure. No problems. Great. Yeah, it's one of my favorite stories. And I don't know if it's true, but I've never let the truth get in the way of a good story. And it has to do with the Norway, their discovery of oil in the North Sea. And it happened in the late 60s. In 1969, there was basically an oil driller called Ocean Viking that struck oil in the North Sea, and very quickly the markets and Norwegians realized that they had hit a lot of oil. And there was a frenzy, and it's a frenzy of like 1998 kind of .com proportion, and all of a sudden everyone wanted to buy oil. There was people making fortunes because of the amount of oil that they could see that they were going to all of a sudden be pumping, and there was kind of just an epic bubble. And into this bubble, kind of the hero of our story kind of wanders in, and he realizes that the market is very quickly priced in kind of the best scenario, that there's very little money to be made trying to compete, buying all these inflated oil assets, because, the moment that the government started auctioning off the next block of land, speculators were busy, or underwater land, but the next block of drilling rights, the speculators were busy ramping up the price of this, and the frenzy was kind of all over the place, and everybody was busy doing this, and except our speculator, this wise old guy, he kind of had a look at the situation and sized it up, and instead of trying to compete with all those other people, he kind of thought about things for a little bit, and he then started to go and he started to buy all the Norwegian art. And the thing you have to realize about the art market is that the art market is very local. Like, yeah, there's the Picassos and all those, the international, the few guys that kind of transcend all the different international, like everyone wants to own a Picasso and stuff. But let's face it, there's not a lot of demand for Norwegian art, except for by locals. And this kind of wise speculator, he figured out that once these new millionaires, because don't forget, this is 1969 when $1 million was actually a lot of money. Once these millionaires after they kind of had made their fortune and bought some land and maybe bought a boat or two and, gone and done all this stuff, they would start to look for ways to spend their money, and they would buy art, and they would buy local art. And so while nobody was looking, this guy basically bought all the Norwegian local art that he could find, and he bought all the best pieces. And then kind of, couple years later, when all of these millionaires, started looking for excuses to spend their money, something to spend their money on, they started coming. And what do you know? They started bidding up the price of Norwegian art. And sure enough, our speculator was there once it had been bid up to show them a great offering. And that to me kind of just encapsulates what a great speculator is about. It's somebody that's looking, for that edge, or that kind of thing that everybody's missing, taking it to the next level and figuring out kind of what the next move will be, or what the next couple moves will be down the road. And you know what? When I think about my trading, I always try to, be just like that Norwegian, speculator.
Yeah, I love it, man. It's such a great story. I guess it's the pinnacle of a great macro trade. Am I right?
Yeah, you're absolutely right.
Cool. And I know you wrote about that on your blog, so I'll be sure to include a link to that particular story or article, post, whatever you want to call it, in the show notes as well. Now, your blog or your website is, of course, themacrotourist.com. I want to ask you, Kevin, what made you decide to start writing?
Well, that's funny, because actually it originally started as a journal, and it started as a journal to myself. And, I think writing for yourself is a great tool for traders. 90% of trading is mental, and let's face it, you're battling yourself as much as anybody else. And journaling is just such a helpful technique. And so it started as a journal, but then it kind of moved on, and I started to write about the markets just to put my kind of thoughts onto paper. And then I started letting the guys I work with read it. And then every now and then kind of a buddy would phone up and he would say, "What do you think of the market?" And I would let him read it. And eventually I just kind of stuck it on the web and started writing it on kind of pseudo-regular basis. And I was kind of surprised when some people started reading it, and they started emailing me and stuff. And I just kind of stuck with it. And I started doing it more and more, and I started to make more contacts, and I really enjoyed it. And you know what? Like, somebody said something to the effect that if you want to really know a subject, teach it. And I can't tell you the number of times that writing a piece has made me kind of formulate exactly what I think. And I don't get away with being kind of wishy-washy and having half-baked ideas, although I guess you might argue some of them are half-baked. But at the very least, it kind of forces me to articulate it. And when you're forced to articulate it, you're really forced to kind of try to wrap your head around it. And so I started writing it kind of on a more serious basis. And since then, it's been great. It's enabled me to meet a lot of people, and it's offered a lot of opportunity to learn from other people. And I've really enjoyed it. So it's just something, I do for free, and you're welcome to go sign up, and you're never going to be spammed, and I'm not selling anything. And my tagline is, all I bring to the party is 25 years of mistakes. And it's kind of just, that's what you're going to get. Cause as much as everyone thinks that there's somebody out there that's the guru that's going to give them all the answers. The reality is that those guys are making mistakes all the time as well. And it's continually, everybody's always learning, and everybody's always being forced to adapt. And it's something that we have to all realize is that nobody else has the answer for us. You have to find it yourself. But by reading and listening to other people's opinions or not opinions, kind of experiences, you start to learn. And actually, while we're talking about this, I just want to take a moment to thank you for this podcast. I've long admired it, and I can't tell you how many of those podcasts I've sat down and listened to other people's kind of processes, and I've learned tons. And even kind of, after 25 or 30 years trading, I find I go and I listen to a different trader and I'm like, oh, that's a great point. And it's something that I learn. And you're to be commended for this because it's a great resource you're offering to traders. And, I was lucky enough to sit on on an institutional trading desk and learn from a lot of great traders. But, a lot of other people in my day and age didn't have that opportunity. Well, now you're offering it, and you're actually offering it even better because you got 130 interviews up there, and they're all terrific, and people can learn from each and every one of them. So you're like, I just want to say thanks, Aaron, because it's a terrific thing you're doing for the whole trading community.
Thank you very much. I greatly appreciate it, Kevin. It means a lot. Thank you. And I'm glad that you threw in your tagline there. I was hoping we would hear that at some point. So if anyone wants to find your blog, it's themacrotourist.com. And you're also on Twitter. What is your Twitter handle, Kevin?
So my Twitter handle is at Kevin Muir, Muir. And and you can feel free to, shoot me a message there, or you can also sign up for the letter, and you can get my email from there.
Very good. Well, once again, Kevin, I do want to say I really appreciate you coming on the podcast. It's been an absolute blast. Thank you very much.
It's been my pleasure. Thanks for having me.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome, team. Aaron Fifield speaking, and it's great to have you here. Just before I introduce you to my guest on this episode, I would like to give a quick reminder that I'll be hosting a live podcast in Sydney on Tuesday, the 29th of August. So if you're in the area, please make sure you're there. I mean, what better way to spend your Tuesday evening, right? Live podcast, beers, pizza, hanging out with more than 100 other traders. It's going to be a really great evening. And of course, shout out to Trading Technologies for sponsoring and supporting the event. To get yourself a ticket, simply visit chatwithtraders.com/Sydney. Right. Now, on this episode, I have a very special guest, Bobby Cho, who is a cryptocurrency trader at Cumberland Mining, which is a company of DRW Trading. Ever since getting involved in financial markets during 2008, Bobby has gravitated towards mostly illiquid, difficult to trade products. So in some ways, it was almost inevitable that he would begin to explore Bitcoin and other cryptocurrencies. And this was around 2013, while Bobby was vice president at Second Market. In 2014, Bobby became director at Bitcoin exchange ItBit, and then, of course, joining Cumberland Mining in 2016, who are one of the largest institutional liquidity providers in cryptocurrencies. During the episode, Bobby and I got speaking about some pretty interesting things, which ranged from the infrastructure of crypto markets to the curiosity and entrepreneurial mindset which powers DRW, and the challenges of exchange arbitrage to the real-world value of blockchain technology. So without any further delay, here is Bobby Cho for episode 139.
No, let's rock and roll.
Cool. All right, we'll start off by talking a little bit about your background. So, Bobby, I think it would be interesting to hear about some of the things you did before getting into cryptos, because I think in many ways that kind of actually shaped the path, and it makes sense that you've wound up in crypto markets in some ways. So, yeah, tell us a little bit about your background and where you very first got started, essentially.
Yeah, sure. So my background's always been in trading, mostly on the liquid side of things. So when I first graduated college, I went to a firm called Restricted Stock Partners, which then became a company called Second Market, which that business was then bought by NASDAQ. But at my time at Second Market, I was basically on the trading desk for about 6 years, always looking at illiquid securities, products, and assets. So illiquid meaning hard to value, hard to assess, hard to trade, and kind of these unique opportunities. And it's really there where we first got introduced to Bitcoin and the idea of trading Bitcoin. It kind of fell into the same types of products and securities we were trading, aside that it was just Bitcoin. But it was an opaque market. We had to figure out who was trading this thing, what institutions were involved, what it looked like, and really frame out the marketplace, which we did for a number of asset classes previously. But Bitcoin was just kind of a different animal at that time, right? This is back in 2013 or so, when there just wasn't much information as there is today. But that was effectively kind of how I got started. And so after spending a number of years there, helping to build their trading desk, which is now called Genesis Trading, which is a part of Digital Currency Group. And so I moved from there to a company called ItBit. The main kind of catalyst was when we first started looking into the crypto markets. The first thing that shouted out to me right away was, for any professional or institutional trader looking to trade these markets, they need infrastructure, mainly in the form of an exchange that they can rely on, trust, can trade on, and really feel comfortable, sending monies there, holding assets there, holding balances and things of that nature. That's why I decided to go to ItBit. ItBit was, at the time, an exchange that was domiciled in Singapore. They had ideas of breaking into the U.S. markets, and that's kind of where I came into play. So I was the first business hire for ItBit here in the States. They had a few tech guys, but really the idea was, how do we launch a regulated exchange that can service the United States? Whereas the international side of things was up and running, but it was really trying to crack into the U.S. side of things. And so we started thinking about a bunch of ideas of how can we do this. We looked at, all different types of structures, and that's when we landed on something called a trust charter, right? So a financial institution that's regulated at the state level by New York's Department of Financial Services. Other companies that are structured that way are ICE and some other exchanges. And so we ended up getting the first, we'll call it the first digital currency trust company charter, which made us a financial institution. We were subject to all the same things that any kind of bank would be, Basel III capital requirements and things like that. And so that was a huge win, I think, for the industry, because we were trying to do things the right way and try to build a model that now other exchanges, most notably Gemini, has followed and gone down that path as well. And then that led me to DRW, or Cumberland Mining. So way back when, let's go back to 2013, 2014, when I was first looking into these markets, we stumbled upon Cumberland Mining and the guys at DRW. And it was really through that discovery that we realized, wow, there are other institutional traders that are either looking at these markets or trading these markets. And so that's when I decided to join Cumberland after about a little over 2 years at ITBIT. And today Cumberland is one of the largest institutional liquidity providers in the broader cryptocurrency space, but mostly focused on Bitcoin and Ethereum. We might make markets and other things as well, but kind of the lion's share of our volume is Bitcoin and Ethereum. And so we work with a number of, whether they're miners, retailers, exchanges, investors, funds, you name them. We are probably dealing with them. And the big part of our business comes from OTC trading. So that basically means anyone looking to trade large institutional size, we have high minimum thresholds, is generally going to come through our desk because, one, the exchanges can't handle that type of liquidity, and two, we just have enough flow throughout the day that we're able to facilitate these transactions relatively close to where market prices are.
Okay, well, let me jump in here, Bobby. Let's just go back a little bit to the point where you were talking about when you came across Bitcoin and you had the realization that if any professional traders and larger institutions were to get involved in this market, there would be a need for some form of a better infrastructure. At the time, I mean, I don't know what year this was. I presume it was probably somewhere around 2012, 2013, but whatever it was, Bitcoin was nowhere near what it is today. Why did you think it would be something that institutions would even be interested in?
Yeah, that's a good question. I think when you actually, well, one, right, the price was much lower back then, right? I want to say somewhere around, maybe $50 to $100, somewhere in that range. So it wasn't the price that was super interesting, although leading up to that point, right, Bitcoin did come from pennies, right, all the way up to that valuation. I think for me personally, it was this idea that my whole career I've spent looking at these esoteric deals, whether it's looking at prospectuses of fixed income deals that were first issued in the early 90s, and trying to find and then dig through all that material and finding the value and being able to trade it. That was super interesting to me at a very early stage of my career. So then when I looked at Bitcoin, right, I think like I always say to people who say, well, what's Bitcoin? I always encourage them, well, the first thing you do is read the white paper. I think I had to read the white paper about 8 times over the course of the first 2 years I was introduced to it, just to continue to familiarize myself with what does this thing do, how does it work, and what is the concept behind it. And it really wasn't, that aha moment really didn't come about until I started using it. Through application, that's when it really hit me, the tremendous potential behind Bitcoin at that time. And then just continuing to read about it, you fully understand the potential of it, but at the same time, the utility is not there yet. But obviously, there are tons of folks, hundreds, if not thousands of people working on Bitcoin and other types of cryptocurrencies, trying to figure out some utility behind it and different use cases.
That white paper you mentioned, whereabouts can someone find that?
You can just Google Bitcoin white paper, and it'd probably be one of the first links that pop up. That is probably the first place I would send anybody who is looking to understand Bitcoin, because it definitely gets into kind of the nitty gritty. But at the same time, I think a lot of the original vision of Satoshi has changed. But at the same time, I think that's the best place to start, to actually get kind of where the genesis of this idea came from, and then kind of broaden your search from there. I think today, as opposed to 5 years ago or whenever you want to call it, there's a lot more information out there that's readily available to anybody that's looking to get into the space. Yet still, people have this similar issue where it's almost like too much information. Some information is misleading. Some information they don't know, how to validate it. So even though there's more information out there today, there are a lot of contradicting things that are going on. But I always say start with the white paper.
Okay, and then going back to, was it around 2013 when you first started getting into Bitcoin?
Yeah, I think it was like end of 2013, beginning of 2014, if I remember correctly.
Okay. So like you mentioned, you started out with the white paper. That was really helpful. There was certainly a lot less information, like we just established, around Bitcoin back then. I mean, where else were you getting your information from? Were you talking to certain figures in Bitcoin? Like, how were you trying to feel out this market?
Yeah, I think that was probably the most challenging thing, right? Unlike anything else in other markets, right? So let's take, for example, hey, I'm a new firm and I need to figure out, who's trading, this particular fixed income product. Well, you look it up on Bloomberg, see who the holders are, or maybe you talk with the issuer or things like that. There's like a natural path to being able to frame out certain markets. Bitcoin's different. The reason why it's different is that it's a product that's worked on 24/7 globally, right? So there is not this one niche place where you go to figure out, well, who trades Bitcoin? I think that's the unique and kind of opportunistic part about it. But going back to your question, it really was just scouring blogs, forums. At that time, there wasn't really a big Reddit Bitcoin presence or anything like that. It was literally bitcointalk.org and other types of forums that people were talking about it. And then from there, you start meeting more people and expanding your network. And really, that's how I kind of started out figuring out, well, what's this market look like? And then the more and more you dig, obviously, the more and more people kind of get introduced to you. And that's kind of what happened with the folks at Cumberland DRW. I think we were introduced to them on an email just because at that time, not many people were trading Bitcoin. If you were and people knew about it, they were going to connect you with someone else. And I think people saw that as a natural kind of connection with us.
Yeah. I mean, it's kind of funny to think about in some ways that, here you've got, I guess, quite large professional traders and organizations who are scouring internet forums looking for information. I mean, it's quite ironic in some ways. So that's a little bit about Cumberland Mining. I guess one of the things I'm really interested to hear a little bit more about is why are crypto markets interesting to DRW? Like, DRW is obviously a very successful firm in traditional markets. Why have they decided to expand into cryptos as well? Like, what's the attraction there?
Yeah, I think just a broad look at DRW, at least in my mind, is you have a number of verticals of businesses, right? And these businesses, whether it's like the core trading business, there's a real estate arm, there's a venture capital arm, and then there's like this cryptocurrency arm, which is Cumberland Mining. I think a lot of it stems from this idea of people here are curious. They're looking to solve problems. And take aside the traditional business, all that other stuff. If you really look at the crypto markets, I mean, that is, for the curious person, that is a marketplace that really just attracts you. And I'll kind of give you a reason why here. So I often get the question, well, why does the price of Bitcoin move the way it does? Obviously, there's a degree of volatility and things like that. But at the same time, just the sheer amount of variables and inputs related to the Bitcoin market is fascinating to me. And what I mean by that is going back to the example or the thought that, look, this product, right, from our perspective, yes, we are trading this cryptocurrency, but other people look at it as, well, we're trying to build on top of this infrastructure, right? So you have a developer aspect to it. Other people, like retailers, are trying to capture some sort of market share away from whether it's, credit card companies or something like that, right? So that's like another segment. Then you have like the regulatory side of things that, different pieces from all parts of the world are affecting the price of Bitcoin. That's super fascinating to me. That really is something that drives my curiosity, because it's not just 1 + 1 = 2, right? You really have to figure out all these different inputs that are causing different movements in the price of Bitcoin. But yeah, I'd say that kind of what drove the idea here is that, one, I think it kind of fits nicely into the way that DRW and Cumberland kind of position themselves related to the middle of finance and kind of technology, or I guess fintech as people are calling it now, and then just broader understanding different niche, unique markets, trying to solve a problem within it.
And just as you mentioned at the beginning there that Cumberland Mining kind of came out of a sense of curiosity, do you think, just stepping back and looking at the big picture, that that's one of the driving forces of why DRW as a whole is so successful, is because of the curiosity that...
Yeah, absolutely. I think if you don't have that, right, and then you couple that with like some sort of entrepreneurial kind of mindset, right, then you're a in the box thinker. To be honest, I think when I look at our business, let's just take Cumberland, for example, right? This isn't the business itself. There's no cookie cutter recipe to how to build the business, right? And so for me, personally, the unique opportunity to help build a small business within a much larger one helps as well. And to be honest, I think it really comes from the top, right? I think Don Wilson, as the founder, exemplifies that kind of that mantra, or that principle of being curious about different markets, investigating different markets, and looking at it from an entrepreneurial perspective, whereas other people may not look at it so.
So let's zoom in a little bit. Cumberland Mining, you kind of described briefly what it is a little earlier. Can we just go into that a little deeper? Like, what's the role of Cumberland Mining in crypto markets? And I mean, I'm sure you feel as though it's quite an important role. Can you just sort of flesh that out for us and make it very clear?
Sure. So Cumberland Mining is one of the largest liquidity providers in the cryptocurrency space. And what I mean by that is that anybody that is looking to get into cryptocurrencies, or maybe trade cryptocurrencies, but in a large institutional fashion, would generally want to face us on trades. All the trades that we do here are on a principal basis, so we use our own monies and our own capital for our own risk. We have no investors, shareholders, or clients. Everything we do here is for our own book. And so, whether we play an important market or important role in the markets, that's, I guess, someone's opinion. But I will say that I think we provide a level of, whether it's just institutional, service or something along those lines, that obviously you notice in what DRW does broader in other markets, that we try to kind of replicate in the crypto markets. But really the way we try to position the business is and again, Cumberland officially was started in 2014. And I think the original vision is that, look, we see this marketplace going somewhere over the next 5-10 years. Well, how are we going to position ourselves? We need to position ourselves where we sit in between the highway of the crypto markets, which at that time obviously was really kind of a closed place, and also the financial markets, right? So people will say, well, why isn't there more correlation between equities and Bitcoin? Well, because there isn't this natural way to go across both assets, right? I think that's happening. I think you're like kind of seeing it with gold. You're kind of seeing it with other assets. But we really kind of positioned ourselves in the middle there, right? Because we know the financial world very, very well. We have the systems, the technology, the infrastructure in-house to help also facilitate what we've learned, what we've done in the financial world with the crypto world. That goes all the way to just creating best practices in the crypto world, because the infrastructure is just so new and so young that we're trying to help shape that, along with obviously other folks that are working in the industry.
So it would be accurate to say Cumberland Mining is essentially a market-making operation, yeah?
That's correct. Yep. So we provide markets.
Okay. So how does what you do differ from market making in, let's say, equity markets?
Yeah, I think like the main thing is a large part of our business is this OTC business, right? So this large institutional size trading that the exchanges cannot handle, or just the sheer amount of liquidity just isn't there, or the exchange the books can't handle that. And so we kind of created this little niche area where we're trading in and out of in terms of these large block transactions. And that's just how the business is. Obviously, we're going to continue to kind of expand on that and see what the future holds.
Okay, and how do the wide spreads in Bitcoin, and I'm sure some of the other cryptocurrencies as well, I mean, how do these wide spreads work to your advantage, if it is an advantage?
Yeah, so just really quickly going back to what you said earlier, one thing I just want to touch on is the difference between the equity markets and what we're doing today is there's a lot more risk management that comes into play when you trade crypto. Risk management comes from general KYC, general due diligence on the exchanges you're trading on, and just general awareness of the product that you're trading. Because if you think about Bitcoin, right, Bitcoin is a push function. Right? You can't, after you send Bitcoin, it's gone. You can't claw that back or anything like that. So that's why obviously risk management is, I think, a large part of our business. Obviously along with trading, but it goes hand in hand. And then touching on what you mentioned in terms of like wide spreads, advantages or disadvantages, it can play into both parts. Let me go into the disadvantages first. If you were to ask someone what the price of Bitcoin is to 10 different people, they'd all have 10 different answers. So price discovery is still happening. There are a lot of different indices. There are a lot of different prices, a lot of different exchanges. I think like the latest stat I had was like over 200 exchanges worldwide. And I mean, that's a lot for the current market cap of Bitcoin. But yes, does it present opportunities in the marketplace? Absolutely. But at the same time, it's factoring in everything that we just talked about into being able to provide those markets, right? How are we able to provide those markets? Because we've done our due diligence. We've done our homework leading up to the point of obviously trading. So all those things play huge factors into what we do.
Okay, and if spreads were to become tighter, as I'm sure is inevitable, I mean, is that something that would be beneficial? Like, is that something that would help you guys?
I think that's a sign of the maturation of the industry. I think that is, in my mind, somewhere where the marketplace is going. And there will be some formality around it and uniformness. So I welcome that day. And obviously, I think we're still a little bit away from that time. But at the same time, I think most would agree that we are the people working in the Bitcoin industry, whether you're trading, developing a product, running an exchange, doing any number of things. That sign is a general positive sign for the overall industry.
Okay, yeah.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, you said just before that managing risk is a huge part of what you do, essentially on a day-to-day basis. Can you also talk to us about how you guys are managing some of the security risks? Because as we know, sometimes Bitcoin exchanges are hacked, different sort of things go on. How do you manage security risks?
We have our own principles for custody and security of our assets. I can't go into the nitty-gritty details, but at the same time, we employ all the best security practices that one could. But I guess touching on kind of the industry and what's happening there are a number of, let's call them custodians out there that are trying to solve for that. And that's honestly the number one question we get from potential counterparties. And this conversation is happening. I've probably had more of these conversations with, fast money institutional guys in the last 6 months than I have my whole time in Bitcoin. In terms of, well, I want to trade this thing, and you say, okay, great. Obviously, we can help with that. But at the same time, it always gets to the point of custody. So we don't custody anything for anyone, obviously, because we're trading on a principal basis. And then their natural next step is, well, where should we go custody? And so that is the kind of like the big question when you're first starting out in Bitcoin. But we've been able to kind of navigate that and solve for that at a very, very early stage of our discovery of the company.
Yeah. I mean, I think that's a question that's in the back of everyone's mind when they are new to cryptocurrencies and they're thinking about getting involved in it. Bobby, one of the things I'd like to talk to you about, or ask you about, is the misconceptions that regular people or even some traders have about cryptocurrencies.
Sure. Which one? Which ones? There are. I think there are a lot. Yeah. So I guess which ones?
What did we speak about the other day? So we spoke a little bit, I think, about, I guess, the wide spreads. People feel as though that there's arbitrage opportunities which are quite hard to capture. I don't know. Do you maybe want to start with something like that?
Yeah, I think we can all agree that markets are efficient and spreads exist for a reason. And so when people first look at these markets, they say they look at the price discrepancy and they just kind of are amazed at them. But it's really when you start doing your homework behind kind of the exact calculations of why it exists, that's when things start to kind of fall in place. So I'll give you an example. So one, you have to understand that, again, there are hundreds of exchanges out there, right? But let's just take like the top 10 or whatever it is. Those top 10 are probably domiciled in different jurisdictions. So that immediately starts to fragment out liquidity. So fine, you start from there. Then those top 10 exchanges probably have different KYC structures and different regulatory structures. So that further starts to bucket people who want to trade into different areas, right? So maybe one guy in Europe's able to trade on X exchange, but he can't trade on Y exchange. So the spread or let's go back to the profile of the trader. The profile of the trader is different for every single exchange. So the mentality is going to be different there, right? So the characteristics and makeup of the exchange are different. So that can cause one reason why things trade differently on one exchange as opposed to another. And then also you have to start going into trading fees, right? So certain exchanges will have flat fees. Certain exchanges will have, tiered structures based off different percentages or basis points. So that's another point of discrepancy. And then the other thing is depositing and withdrawing dollars or different types of fiat currencies is going to be different for every single exchange. Let's take, for example, that I want to trade. I'm a retail person. I want to trade. I want to buy IBM stock. Well, my options are probably go to Merrill Edge, Fidelity, Vanguard, wherever you name it. And it's probably just a cheap ACH fee that I pay or that I don't pay, that I send money into my exchange or my account. In Bitcoin land, it's very, very different. Some exchanges charge flat dollar-based fees, right? So let's say I'm wiring $1 million to the exchange. They may just take $100 right off the top. Then my bank's probably going to take, $20 to $40, and then their bank's probably going to take another $20 to $40. Then you come to exchanges that charge percentages based off the amount that you're wiring in or out, right? So all these things you start to calculate and start looking at, and you say, well, okay, now I see why, certain exchanges are trading at a premium as opposed to others, because maybe it's harder to get money out than it is to get money in, and vice versa. So I'd say that's like a misconception in terms of like, hey, these opportunities exist. But when you actually start to delineate out the reasons why, that's when you actually start to see why that spread exists.
So do you think that's true even like once you've got past that initial hurdle, or if it is an initial hurdle, it might be an ongoing hurdle. Once you've kind of learnt the environment like that and who takes what fees and how each exchange is different, is it still very hard to capture those sort of price discrepancies?
I think what the misconception is that there are, no one's really trading Bitcoin, no one's really arbitraging or anything like that. That's why it exists. No, people are certainly trading Bitcoin and arbitraging between different exchanges and figuring out different ways to do so. But that, in my mind, if you just took a snapshot of the exchanges and you look at the spreads between the exchanges, right? Like, in my mind, it's pretty much all the same because everything's already been priced in.
I think another misconception that probably a lot of people have, and you might be able to shine some light on this, is actually the real world value of cryptocurrencies. I mean, do you want to speak about that a little bit?
Sure. I think everybody, and this is kind of the really interesting thing about Bitcoin. I think Bitcoin means, or, if you ask people what Bitcoin is or means to them, it vary wildly. So the way I kind of look at like valuations of Bitcoin or anything like that is simply that I kind of look at it as, and again, this isn't going to be the answer for everybody, but going back to what I said about just, hundreds and hundreds of different variables and inputs causing the price to move in certain ways, shape, or form. My background having been involved with a number of venture-backed companies, startups to begin with that have grown. I kind of look at the Bitcoin price as a snapshot every second of whether you call it the health or the growth or whatever the status of Bitcoin, right? So very early on, you'd see Bitcoin move wildly off of headline risk. So news would come out and the market would react accordingly. I think that's less and less so now. But it's still affected by these things that are happening in the market, whether it's regulatory things, whether it's different types of announcements that come out. So when I look at like a private company, and let's take like Facebook, for example, before it went public, if someone had a view into the second by second valuation of Facebook, well, that is going to change wildly throughout the day, right? So on a partnership that they struck, right, the price should go up. Right? Or if a key employee had left, well, then the price may drop a little bit. That's the kind of way I look at the valuation of Bitcoin and the prices. Obviously, for us, we're looking at them every second. But I guess I would say that's how I look at the price of Bitcoin and the influence of Bitcoin and how things shift. I don't know if that's what you were going for.
Yeah, in your answer there, are you kind of hinting at the technology which underlies Bitcoin, like the blockchain technology? Are you referencing that in some way?
Yeah, I definitely am. I think, I think at first, for people today, what draws them to Bitcoin is just the general price action and volatility, which is fine, right? Fine. You go and look at the price, super interesting, right? Over the last year, over the last 5 years, whatever it is, it's hockey stick growth. But then you start really, in my mind, that's kind of the first magnet to Bitcoin. And then you start looking at, well, why is it like that? Why is the price going up like that? Sure, I'm sure there's a level of just general kind of herd mentality of wanting to buy Bitcoin and hold Bitcoin and speculate on it. But then there definitely is this core amount of investors who actually understand technology and understand that. And again, I had to learn this through application utility. Just the general ease of use and the potential for Bitcoin. I think that there is a level of valuation that is applied to people who kind of understand that side of things.
Well, this is actually something I wanted to ask you about. You know, we see these cryptocurrencies which go up like 50x or however much in a very short period of time, like in the space of just a month, 6 weeks, whatever it might be. They move very quickly. Some of them, they go from a few cents to, dollars and dollars. Are there fundamental reasons for why some of these cryptos move that way? Or, do participants actually value something fundamentally different about those cryptos? Or is it just pure momentum? Because there's also so many cryptocurrencies which just sort of splutter around and don't really do much. And then there's some which just take off. I mean, why does that happen?
Yeah, it's tough to say, right? And I'd be lying if I said that we trade every single cryptocurrency under the sun, but we don't. But a lot of that goes back to risk management, right? Being able to, right, for every single cryptocurrency out there, you have to set up wallet structure, security, all sorts of things that a firm like DRW, it's very difficult for us to move like that. And to be honest, we take a very kind of whether it's just general kind of wait and see approach, simply because there are a lot of projects out there now and a lot of things to investigate. But having said that, I would say that I don't know the exact reasoning of why certain things, kind of go up to, 100x or whatever the price is. But I will say that we look at things over a longer time duration or horizon than maybe most traders. And so while, something may be up on one day, let's see how it looks over the next week or month or so. And then let's see what the utility behind it is. And then let's also research it, right? So there's kind of like a 3-pronged approach to looking at these markets. I think for certain folks, yes, can you get into these markets and make, a very quick dollar? I'm sure you can. We really try to take a look at a long-term approach with all the markets we kind of look at and make.
Now, Bobby, I want to ask you this one last question. I don't know how you'll feel about it. It's purely just asking for your opinion on this. And, that's all it is an opinion. But what's your take on cryptos as a long-term investment? Because a lot of people have the idea that they might be able to buy some of these altcoins while they're just a few cents, hold on to them. In 10 years' time, they might be the next Bitcoin, ideal scenario. Do you think that thought is flawed in some ways, or do you think it very well could be a worthwhile bet?
I'll just preface and say that I'm not an advisor. We don't provide advisory services or anything like that. But having said that, I'll just concentrate on what we do and what we know. In terms of Bitcoin, I think we're just scratching the surface here. And I'm not even talking about just valuations. I'm talking about technology as well. And I think we look at the general cryptocurrency markets as super interesting. To zero in on one project, I think is very, very difficult. And to be honest, a lot of folks that may be looking at a lot of these projects, ICOs, other different types of cryptocurrencies, a lot of them are tied to, I believe, Ethereum, if it's an ERC20 token. And to be honest, I think if instead of betting on one, then you're probably going to invest in Ethereum as a whole instead of just these individual projects. But look, certain people have convictions on certain technologies and certain projects, and so they're left to their own opinion. But at the same time, for us, we just look at these markets and really try to provide value and just the liquidity we're providing.
Of course. Good answer. All right, Bobby. Well, let's leave it at that. I know you're on Twitter. Do you want to share your Twitter handle so anyone listening can follow along?
Sure. It's at Robert J as in Jersey Cho. I don't have many followers, but I welcome new ones.
Good stuff, man. And the Cumberland Mining website, do you want to share that if anyone wants to maybe take a look?
Sure. It's www.cumberlandmining.com. Feel free to look. There's not too much out there, but we're just busy traders.
Excellent, man. Well, I really appreciate you taking the time to do the podcast. I'm glad we could make it happen. So, yeah, thank you very much for doing this.
Awesome. Thanks so much for making time, and look forward to chatting soon.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's good, everyone? Welcome back to another episode. I know I just said welcome back, but actually I have a feeling this episode is probably going to attract a few first-time listeners. If you're one of those listeners, then thank you very much for joining me. I am your host, Aaron Fifield. So my guest on this episode is Jimmy Soni. Jimmy, along with his co-author Rob Goodman, recently wrote the biography of Claude Shannon, which is titled A Mind at Play, How Claude Shannon Invented the Information Age. Shannon was a brilliant mind, plain and simple. He was born in 1916 and he passed away in 2001. He was a mathematician, a scientist, an inventor, and also a stock market investor. Although he's widely unknown by the general public, Shannon is responsible for coming up with what's known as information theory. This is a way of measuring information which stands behind much of the technology we use all day, every day. You may recall Shannon's name has come up on a previous episode, and that was the episode with Edward Thorpe, because Thorpe and Shannon together beat roulette after inventing the world's first wearable computer. I promise you this could easily become a very long intro by taking you through Shannon's long list of achievements, discoveries, and inventions, which do range from artificial intelligence to cryptography to fire-breathing trumpets and chess-playing machines. But instead, keep listening and enjoy a few surprises along the way. I will say you're unlikely to get any trading tactics as such from this episode, even though we do discuss Shannon's investments, but what you will get is perhaps some inspiration for how to become more curious and explore new ideas. Now let's hear from the man who spent literally thousands of hours researching the playful mind of one of the foremost intellects of the 20th century, Claude Shannon. Here is Jimmy Soni. So what's the general response been like for the book? Pretty good?
Oh, it's been great. I think just a couple things. One is, I don't think Rob and I, because we're not engineers or mathematicians, I don't think we fully understood how much of an appetite there was for his story. I think both of us came at this from very different backgrounds. And so we didn't realize that there was a whole community of people, including computer scientists, who see him as this kind of legendary figure. I mean, we knew he was important, but I don't think we understood just how much enthusiasm there would be for his story. So that's been great. The press has been great, and we've got a review in the Wall Street Journal, a review in Nature, Fortune magazine reviewed it, both online and in print. So it's been pretty great, man. I mean, it's been exciting because you put so much time into these things, and seeing one of these take off is really, really great.
Very nice, man. Oh, you must be stoked.
Yeah, it's a lot of fun.
I think I read somewhere that you'd been working on this for close to 5 years. Did I read that correctly?
5 years, and honestly, it might even be a little bit longer than that, but just for a conservative estimate, is 5 years. The truth is, it just takes that long, in part, just to kind of understand the stuff that he did. And then you've got to add to that, sort of making it relevant for readers, digging through a lot of archival information. We tracked down all of the family members that we could find. We tracked down, an ex-girlfriend, ex-wife, a lot of friends. And so that interviewing that time took a while.
Yeah, I can imagine. So what were you doing prior to writing the book? What is your background?
So my background is, I've done a little bit of everything, but I kind of started my career in consulting and ended up becoming an author. And in between, I've had the chance to do everything from media to politics to speech writing to ghostwriting. And, I think like a lot of people, I always sort of grew up, I was just a real bookworm and always wanted the chance to write books and to kind of if I'm in someone's house and there's a bookshelf, I sort of forget that there are other people in the room and I kind of gravitate to the bookshelf and I sort of cock my head to the side and see what people are reading. And then, I make judgments about them. And so for me, I mean, books are sort of like this, I think about books the way that other people probably think about sort of like baseball or football or like sports they're into. I get into individual authors and I learn everything I can about them and then I buy all their books. And so I feel really privileged to have the chance to write books, and it's a lot of work. And financially, it may not be the most sensible thing to do in a way, but it works for me. And I think if you're lucky enough to do it, you should take the chance to do it.
Yeah. So why did you feel compelled to write this book on Claude Shannon?
Yeah, it's a great question. So I read a book called The Idea Factory by John Gertner. And for your listeners who are interested in how innovation works and how innovative organizations work, I would really recommend that, in addition to picking up the Claude Shannon biography, which is a story of how an innovative mind works, I'd really recommend that they pick up this book, The Idea Factory, because it's the story of a company called Bell Laboratories, which, if you can imagine tomorrow, Google, Apple, and Facebook decide that they're announcing a merger and that they're going to become one super company, that is roughly how I like to think about where Bell Labs was in the 20th century for Americans, because it was the second largest employer in the United States. Behind the federal government. It ran the phone system of the United States, so it had essentially a federally guaranteed monopoly, and it was a huge warehouse of innovation. They developed laser, touch tone dialing, long distance phone calls. synchronized the sounds and images in movies. They took home 6 Nobel Prizes, invented the transistor. So, I mean, so much of modern life was built at Bell Laboratories. And I was reading this book, and it's all about how that company kind of came to be. And one of the figures in the book is Claude Shannon. So I went on Amazon looking for a biography, and I was sort of naive. I just assumed, like, given how important he was, surely there was a biography available. And it turned out nothing came up. There were some books about him, actually a really fantastic book called The Information by James Glick, which is, it's an imposing read, but it's a really good read. But it's about the kind of development and sort of development of the ideas of information and how information has progressed through history. And Shannon's a central figure in that book, but it's not a strict biography, so it doesn't go end to end. And I just kept, like, it's one of those ideas, Aaron, I'm sure you have these ideas where, like, you'll think of something and then it just, like, stays with you, and you wake up and you're thinking about it, and you go to bed and you're thinking about it, and, like, you just walk around with this thing for weeks. And for weeks, all I thought I could think of was, it really is, it's really disappointing that someone so impressive doesn't have a biography of him. And I think when I was gifted the book by a friend of mine, he actually kind of casually threw in the suggestion. He was like, you should really look at this Claude Shannon guy as your next biography. I think that's what led me to look on Amazon. But again, I assumed that somebody had already done it. When I found out no one did, I went to Rob, who I'd been co-writing with for a while. We were both old friends from Duke, and we were debate partners, and then wrote a different book together and worked on things together. And Rob and I together approached Simon & Schuster through the help of our agent. And we were fortunate enough, and I'm sorry if the story is going on a bit, but I think people like to know how books are come to be. So cut me off if I'm...
No, you're totally fine. Keep going, man.
So basically what happened is our agent took us to a meeting with a woman named Alice Mayhew. And that name isn't a famous name, but she's then the editor behind books like A Beautiful Mind, which became the movie with Russell Crowe. She's the editor behind Steve Jobs by Walter Isaacson and all of Walter Isaacson's other books. David Brooks, she's his editor. She's, the editor to The Stars. But Jimmy Carter had a book out, and she was the editor. I think she once bumped me on a phone call because she needed to speak to Ruth Bader Ginsburg. And I was like, okay, yeah, totally. You can bump me for Ruth Bader Ginsburg, a Supreme Court justice. I feel fine, And so we sat down with her, and we sort of made the pitch that this was a book that was going to be a lot like A Beautiful Mind. And if for people who haven't read that book, what's wonderful about it is in the movie, you sort of, the heavy emphasis is on the dementia and on the story of John Nash's decline. And it's an extraordinary, story. In the book, the author, Sylvia Nasser, does a really wonderful job of not just going into the dementia and the decline of this Nobel Prize winning mathematician and mind, but she goes into what made his ideas about game theory so revolutionary. And so our contention was that this book, the Claude Shannon biography, would be about the man, but it would also be about the ideas. How did information theory come to pass? How did Claude Shannon think about early efforts at artificial intelligence? What did he think about the stock market? What did he think about money? How did someone like this live his life, basically? But then also kind of intellectually, how did he think? So that was the idea. And Simon & Schuster seemed to, they wanted to take a chance on it. Walter Isaacson had actually written about Claude Shannon in a different book called The Innovators. And so our editor had some familiarity with the topic. And then after we signed the paperwork, we were off to the races.
Right. So why do you think someone had not written his biography sooner?
That's a really, really good question. And it's one that I kind of still wonder about, because if you were looking at the people who are most qualified to do this, Rob and I are probably last on the list, right? The last math class either of us took was in high school. And we're not engineers. I think there are a few reasons. The first is, Shannon himself didn't chase fame, so he didn't really want to be famous. And a lot of people can say that, like it's really easy to sit back and say, well, I don't want all that trouble. Shannon was actually, famous in the 1950s. So he was profiled in Vogue magazine. Some of his work was included in Time magazine. He was on TV. He traveled around the country giving talks. So he had his moment in the kind of mid 1950s where he became a celebrity scientist. And this is in the post-war period. So scientists as a kind of collective, people have a different view of scientists after the war and after the development of the bomb, and after the development of a lot of technology that people thought helped to contribute to the war effort. And so he is this celebrity scientist like Richard Feynman or Albert Einstein, and people are starting to know who he is. And it's right at this time that he just kind of walks off the stage and decides not to become famous. And it's a pretty powerful moment, particularly in like our culture, because if you think about like everyone's trying to become a overnight YouTube star or Instagram celebrity or whatever. But Shannon just decides that it's not for him. He's not going to do those things. Requests keep coming, but he just kind of steadily ignores requests to do various things. He isn't too keen to speak to journalists. He, doesn't give all the talks that he's invited to. That's one reason. He didn't want to be famous. The second reason is, in a way, in order to write a biography, one kind of biography, you need to have a lot of drama in someone's life, right? Like it helps. Actually, I shouldn't say that. It helps to have a lot of drama. It's why so many biographies are written about politicians or about generals or they've got a lot of activity that you can point to. You can create a story out of it. In Shannon's life, there are some moments that are difficult and some moments that are complicated, but for the most part, the drama in his life is embedded within the discovery of these ideas. And so you have to really want to dive into those ideas and kind of explain how he thought and came up with things in order to tell the story. And so that's part of it. Is I think Shannon can be a bit of an intimidating figure. And then the last reason is just honestly a kind of practical one, which is the Venn diagram, I think, of people who know about Claude Shannon on the sort of one circle and who write books and biographies. That's a thin area in the middle there, right? And so you kind of have to want to dive into fields like mathematics and engineering, and a lot of the people who write biographies either aren't going to do that or aren't willing to do that or just are sort of intimidated by it. And so you have to, it's sort of almost like, the sort of opposite would be like, there's a reason that there's a lot of writers who write about politics, and subsequently there's a lot of political biographies. It's terrain they're familiar with, right? But writing a biography of a mathematician or an engineer, it's a little bit difficult terrain. That's the other reason I think there wasn't a biography at the time.
Yeah, I mean, that totally makes sense. And what were some of the challenges for you in actually putting together this biography? Because like you said earlier, you don't come from a background in mathematics or science or anything in that field. What were some of the challenges for you in actually putting this book together? Because some of the ideas and some of the research that Claude Shannon's responsible for are fairly complex type of things.
Yeah, I mean, I could talk your ear off about the challenges. I'll go into a couple of them just to spare your listeners the grief and the heartache that we went through. But I would say a couple things. One is it is really difficult to kind of get someone's personality on paper. I think like I'm trying to think about this, describing this in a way that makes sense. It's hard to even describe with a ton of accuracy, like your best friend, right? Like you could write about your best friend, and what shows up on the page, might be a good approximation, but there are probably things you're going to miss or little biases that you have, things like that. And so just becoming kind of literate in anyone's life is a hard thing. So I would say sort of the challenge from the beginning is like kind of developing literacy enough in someone else's life to write about it and make sure that it's accurate, right? That's sort of challenge number one. Challenge number two is he is a brilliant guy. This was somebody who, as we learned more about him, every time we peeled another layer of the onion and we thought we had gotten down and finished it, we'd find some other thing that he was involved in or some other fact that came up. I can give you the best example of this. We were in the final proofing pages of the book, like the book's about to be sent off to the publisher, and we discovered a plan for his funeral that he had written. It was a kind of like tongue-in-cheek plan that he had written for his funeral. And it was like sort of, he didn't want his funeral to be a sad occasion. He wanted it to be like the Macy's Day Parade. And he had actually imagined what the parade would look like. And so you discover this like at the 11th hour of writing the book, and you're like, well, I can't write a biography and not include the plan that he had for the funeral that he wanted, even though it was a sort of ridiculous, over the top joke. And so every stage of the biography, we learn more about the things that interested him. This was somebody who built a chess playing computer decades before Deep Blue ever beat Garry Kasparov. He built a computer that could play the last 6 moves in a game of chess. He built a machine to solve Rubik's cubes. He gave famous lectures at MIT, and I'm sure we'll get into it a bit, about stock picking and about stocks in general. He was an early investor in several Silicon Valley companies, and when Silicon Valley was just not what it is today. In addition to the obvious, invention of information theory, which is now a field with thousands of people who write papers, and there's conferences and all the rest. So he was somebody who was so multifaceted that you almost like didn't know what direction to go in some ways. Like, one of the challenges of the biography is we could have written it at 800 pages, but it was going to be compelling. It was going to be hard enough to get people to read it at 300 and whatever pages, 375 pages. And so taking all of that and finding ways to kind of pare it down was one of the other challenges. And then the final thing I would say is, we had to spend about 3 years convincing his family that we weren't crazy and that we weren't going to ruin their dad's legacy and that we weren't kind of imposters. It took a really long time to get the family to warm up to us, because this was a family that, like their father, didn't want fame, didn't search it out, didn't trade on the family name. And so they were very skeptical, and they'd been, I think, burned in the past by some people who had been writing some things that weren't 100% accurate. And so it took a lot of engaging and gentle emails and, hey, we found this, think you'd really cool. Like, you may not have seen this about your dad before. That took about 3 years of just patient calls and emails and messages and communicating. And so that's the last part, was sort of getting the family on board. But honestly, Aaron, the second half of the book, we couldn't have written without the family's participation. So it was so important to play that kind of long game with it.
Now, you've made an interesting point about how Claude Shannon wasn't someone who was chasing fame. Of course, he was very deserving of fame considering his achievements and the things he had discovered and invented, etc. Why was he not looking for the spotlight? Like, why did he shy away from it, I guess, is a better way of asking the question.
Yeah, no, it's a really good question. So a couple of things. One is Claude Shannon was one of these people who basically never did anything that he didn't want to do. There was a brief period in his life where he had to do some things, get his PhD, his master's. He had to work for Bell Labs and do some cryptographic analysis. And after his information theory paper, once he's sort of established as like a scientific, brilliant person, he basically just pursues whatever he wants to pursue. And what I mean by that isn't that he got lazy. It's that he would go where his mind led him. He didn't have to go where the money led him or where fame led him. It just wasn't, A, it wasn't a motivator, but B, he just didn't need it. He could kind of do what he wanted. And so he was privileged in a sense. Obviously, the privilege came as a result of very hard work on information theory. But he was privileged to be able to basically do whatever he wanted to do. And what he wanted to do was pursue puzzles. It was to build things. It was to write new mathematics. It was to take the field that he developed and bring it to maturity. He had private interests that just occupied him. And the idea of giving paid lectures or of going on TV to talk about things just did not fit in that schema, right? And so what's interesting is this is somebody who, I think for most of us, if we had the opportunity to be on TV and to be in magazines and all the rest, we would run to that opportunity because it would help us do all of these other things that we wanted to do, right? There's a sort of instrumental quality. Like you can use all of that to do these other things. For Claude Shannon, those things were an interference with the stuff that he actually wanted to do. In his house later in life, he builds a 2-story workshop, and journalists dubbed it the toy room. His kids don't really like that. They called it Dad's room. And if you can imagine a 2-story workshop where this kind of brilliant mind comes in and just builds and compiles things and is, soldering things and, just constructing crazy contraptions. He built a trumpet that could breathe fire, just to give you an example. So when you played it, fire would shoot out of the bell of the trumpet. There's no reason for this. There's no great, innovation award or anything. It was just what he wanted to do. And so he had this space, and I think he was at his happiest in that room, building contraptions and making things and puzzling over things that he thought about. I don't think, even in the interviews with journalists later, he's pretty snarky. Like somebody once asked him, they say, "Did you ever find fame to be a burden?" And he responds, "Well, the only burden is having people like you come and having to talk to people like you." And he's sort of doing it with a smile, but he's there's a little bit of snark there because he's saying that like he has zero interest in, kind of engaging in this way. And I think that was it. I think the long answer to your question is he just didn't see the value in it, and he didn't want to do it. And he was the kind of person who had earned the right to do and to study and to focus on the things that he wanted to do, which were, math and artificial intelligence, computing, additional theoretical work, engaging with people who are kind of at the intersection of all of those fields. That's where his interests were.
Yeah, the little bits I've read about Claude Shannon, I kind of got that impression. I kind of got that vibe that he was someone who really just did whatever he really wanted to do. If he lost interest in something, he'd just push that aside and move on to the next thing, which was of interest to him. I really kind of got that sense.
It's actually one of I think the most powerful lessons I took from studying his life, which is it's okay to dabble. He was a famous dabbler. I mean, he tried everything. He was a jazz clarinetist. He built machines, played chess at a very high level, went to Vegas with a wearable computer he built to try to beat the roulette tables. He, obviously did a ton of work on math. He gave speeches about early computing. He was involved in artificial. I mean, I could go on and on. The point is, he did not think that everything that he did had some kind of specific end goal or end result. He was a dabbler. He would pick things up, get interested in them for a little while, finish them, and by the way, finish them to usually an obscenely high degree, and then all of a sudden just shift his interest to something else. And so I think there's something to be said for that kind of mind, that kind of engagement, just because I think that a lot of us feel pressure to really specialize and to get really good at one thing. Shannon's a useful reminder that dabbling's okay, and that you can actually learn a lot by becoming a kind of by just becoming broadly curious. One of the things that Shannon did, he was interested in poetry. He was interested in philosophy. So I do think that there's something, you're absolutely right to nail that part of his character. He was somebody who picked things up and set them aside just based on his satisfaction. I think there's actually a lot of value in that for people who are doing anything, whether it's, trading stocks or, driving trucks. I think there's value in that kind of generalist thinking.
And I guess that's one of the reasons why you appropriately titled the book, A Mind at Play.
That's right. And part of it too is, he was playful. I mean, the guy had a lot of fun. There's this great moment. He has a really good time sort of poking fun at serious institutions. So one of the things he does is he gets all these honorary degrees from universities. So he'll get the hood and the whatever. And for most people, an honorary degree is a really big deal, and they can get it framed or put it up on get the hood and the thing framed or whatever. And and they treat these things as really as a significant moment in life. And Shannon, he saw their significance and he was respectful, but he won so many of them that he built a sort of one of these rotating tie racks. And the honorary degrees the hoods were just placed on a rotating tie rack. And when he would push a button, the tie rack would just rotate. So he'd be able to see all of them. He got an award from the American Philosophical Society once, and it was just an invitation to join the society. And the society was started by Ben Franklin, so it goes back a couple hundred years. And it's for famous thinkers and scientists and that. And they sent him an invitation, and the invitation was, what he could tell was it was a facsimile of calligraphy. So it wasn't real calligraphy. It was like somebody had, copied it or done it from a computer. And so he hired an actual calligrapher to write back his letter of acceptance, just as a joke. And actually, the American Philosophical Society still has his hand calligraphed acceptance of their fake calligraphed invitation. So he had all these moments where he was just very playful and joking. He gets a fellowship to go to Oxford, and the only remaining record from that period is that he's so upset as an American to have to drive on the wrong side of the road that he writes a 3,000 word paper where he designs a system of mirrors and levers so that if you sat in the car, the British car, and you drove down the left side of the road, it would feel like you were on the right side of the road. And this was like an elaborate paper with diagrams and math and all the rest. But this is what he spent his time thinking about. He was very playful, and I hope it comes across in the book. But I think there's something to learn from that too, because he was one of these people who, we tend to think of geniuses as these like tortured, dark figures. And Shannon was almost the exact opposite. He was much more Richard Feynman than John Nash.
Okay. In saying that, though, were there some moments in his life where things were a little bit dark? I'm not sure why, but I feel like I've read Fortune's Formula, which I know speaks about Shannon quite a bit, and I don't know if maybe I'm getting him confused with someone else, but were there some periods in his life where he was a little bit unhappy? Oh, yeah. There was a pretty deeply dark episode, a couple of them, but really centered around his 20s. So, I just was to set the scene a bit. He has graduated from MIT with his PhD. He wins a fellowship to go to Princeton's Institute for Advanced Study, and he's just gotten married, and his marriage is on the rocks. He and his later ex-wife they don't have a lot in common. She's very social and gregarious, and she's interested in politics, and he's not so into that. That's not his thing. And he's kind of morose, and she thinks he's depressed. A couple of other people have indicated that he might have been depressed. So that's happening. His marriage is on the rocks. He doesn't quite know what he wants to do professionally, so he's sort of struggling with that like mid-20s anxiety of like, well, how you're going to spend your life. And then the last thing, and probably the thing that most affected him, is World War II is underway. The American involvement in World War II is underway. And the draft is about to be announced. And then once it is announced, this is a huge source of anxiety for men of his generation. It's a particular source of anxiety for Claude Shannon because he does not want to join the military. He knows he's frail. He doesn't think he's fit for combat. He also knows he's a loner, so he doesn't think he's fit for kind of the close quarters of Army life. And so all of these things combined to kind of to really put him down in the dumps in a pretty serious way that people kind of still remember. Those who were around then still remember to this day. And it's the period that where we would say if Shannon had was sort of one great challenge among the great challenges in his life, that was certainly kind of the greatest challenge, was that moment right then and there. He is able, so his marriage ends, unfortunately. But he is able to secure some funding from the National Defense Research Council, the NRDC, and he is able to go to Bell Laboratories to work on research for the war. So Bell Labs is subcontracted by the government to do a lot of research for the war on a lot of different topics. And he's one of the folks who manages to win a research grant. So it kind of gets him out of where he is into Bell Labs. He manages to avoid the draft, and that kind of gets him out of that period of his life. There's still some bumpy things that happen in New York. He has some different things happen over time, but there's that period is probably the darkest period in his life. And it's not just him. I mean, it was an entire generation of men who faced the pressure
of the war and had to contend with it in different ways. And for Shannon, he was really fortunate in being able to get that time.
Right. Okay.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Well, I think what might be interesting is if we hear a little bit about where Claude Shannon actually came from and like what was life like for him growing up? Where did he come from?
Yeah, so he was born in a town called Petoskey, Michigan, in sort of the upper part of Michigan. He grows up primarily in a town called Gaylord, Michigan, and Gaylord is a kind of classic small town. I mean, it's I think at its biggest when Claude Shannon is young is like 3,000 people. Just to give your listeners a sense of kind of how small and what time. When the first electric light is installed on a sign in Gaylord, it becomes front page news, and like the town comes out to celebrate. When we were looking at the papers from that era, the Shannon's parents' wedding makes the front page, and they weren't, his parents were important in the town, but not important enough, It goes to show how small this town was that his parents' wedding makes front page news. Other headlines were things like "Woman kills wolf with mop stick." There's things like that pepper the papers from that period. So he grows up in this town, Gaylord, and he's the son of Claude Elwood Shannon Sr. And Mabel Wolfe. Mabel is his second wife of Claude's dad, and we don't know the circumstances around his first marriage, but he was older when Shannon was born, and so he remains a kind of distant figure in Shannon's life. He's not super engaged with his son's life. Even later, Shannon didn't really have much to say about him. His dad is one of these people in one of these small towns who does a little bit of everything. He's the undertaker, he's a lawyer, he's a judge, he sort of participates in all aspects of life, and he's most famous for his time kind of serving as a judge. It's where he earns the name Judge Shannon. Claude Shannon's mom is a teacher, and she's a sort of musician locally, and he lives a fairly standard life. I mean, I think in a lot of lives of geniuses, you sort of see these overbearing parents or like dads who are convinced that they're going to turn their kids into geniuses. You see this with Beethoven or with John Stuart Mill. Shannon's life is really ordinary. We sort of joke it's like what you would call now like free range parenting. His parents kind of let him do whatever he would like to do. So he goes and he builds radios, he tinkers, he builds a barn elevator with a friend in their backyard that works. And they both live to tell about it. He's in the Boy Scouts and he does things like that. And so he's got this life that's very rich and varied. He's good at school. He definitely shows some acumen for some things. It sounds like from what we can gather that the reason he became interested in mathematics mathematics is partly because his sister was interested in mathematics. And so he sort of has this little bit of like sibling rivalry, and it leads him into math. And he has this very ordinary childhood. The couple things that are a little bit extraordinary about it. One is he, at a very early age, becomes interested in codes and kind of cryptographic analysis. So he's like always playing with codes. There's a famous Edgar Allan Poe story called The Gold Bug, and that becomes Claude Shannon's favorite story as a boy. It's the only Edgar Allan Poe story with this gigantic code that's supposed to help unlock a treasure within the story. And you know, I think it's fitting that it becomes Claude Shannon's favorite story. So he's got that interest, and then he's also he manages to find his way to the University of Michigan. So that's the second kind of important thing from his childhood. So he applies to the University of Michigan. It's really quaint. I mean, the application is I think 3 pages, fill in the blank, and he makes some spelling errors, and he just crosses out the spelling errors. It's not nearly as stressful as applying for colleges today. The reason it's important that he ends up there is because the engineering school at the University of Michigan has exploded in the kind of 10 years prior to his getting there. And so he's arriving at a time when the engineering school is big and growing and powerful. And so he's exposed to a lot of very cutting edge engineering research as a result. And it's probably the kind of second kind of consequential thing in his life, at least his early life.
Yeah, I mean, one of the things I found really incredible about his childhood was even the things he was inventing and creating at such a young age. Like, I've read in a couple places that he built some sort of wireless telegraph system between his house and his friend's house, which it wasn't overly close either. Like how did he have the know-how to create these sort of things? Like, was he just a smart mind from the get-go?
Yeah, it's a great question. And I'll be honest that I think even after writing his biography, I think these are the kinds of questions that you can sort of speculate at, but not necessarily pin down for sure. I would offer a couple things. One is he did always have a gift for building and making things. So even as a boy, the network you're describing is this kind of barbed wire network that connects a friend's house, which is about a half mile away, to his house. And that doesn't like seem all that remarkable to us because like I pick up my iPhone and text my friends, right? But this is the early 1900s. And so you're talking about a time when this kind of technology is farmers use it to communicate with each other, but then you have this boy who builds this network and is able to communicate with his buddy at a time when the phone system is still relatively immature in the United States, and that not everybody has a phone. And so it's sort of, yes, in a way he had the kind of sense to do this. The other thing is like he came of age in a town. The thing that Gaylord is famous for is making things. So they're like a lumber town. They become they become at the intersection of some major railroads because there's a lot of wood that's in the area and it's being harvested. And so Gaylord, it's a very practical, hard-headed Midwestern town. People build things. They make sleighs and they make 10 pins and they make all these things. And so you're sort of thinking, contrast that, for example, with like a more cosmopolitan upbringing in New York or in Boston, even in that era. And Shannon would have turned out to be a very different person because he wouldn't have built things, right? He would have been riding the early subway and he would have been, seeing people go into offices. But his dad is a furniture maker. So one of the things that we found was actually the ads that his dad took out in the local paper that were furniture ads for a variety of things. And so his dad is making things. Shannon has a grandfather who's actually an inventor as well, who has a patent for an early washing machine. So this is it's in the gene pool. It turns out later that Shannon discovers he's a distant relative of Thomas Edison. So he's actually got the sort of like inspiration from that family connection. But I think more precisely, it's that he grows up in a town where if you needed something, you made it. You didn't buy it. And, it's a spirit I would love to recapture. I just don't have any sense of how I'm going to do that. Because right now, if I take apart my iPhone, I'll violate Apple's terms of service. So it's not like it's something we can all redo. But for Shannon, that that was a part of how he grew up. And you combined it, I imagine, with some natural intelligence, which he obviously had, and then some training in places like the University of Michigan and later MIT and Princeton. And I think it creates the kind of mind that does that. But I do think that growing up in that kind of small town, making the kinds of things he did, playing with broken radios and having to figure them out, building networks to communicate with your friends, all of this was a big part of why he became the person he became.
Yeah, I mean, it's incredible. Like, you've got to remember that this was in the early 1900s. Like, he was born, was it 1913? 1916.
1916, yeah.
Yeah. Like, you know, if we want to know how to do something now, it's as simple as pulling up your browser and typing it into the search box, where back then, I mean, you know, it was just an entirely different world.
Well, and if you think about it, like, one of the inventions that most struck us was that he and this friend Rodney, one of his best friends growing up was this guy named Rodney, and he and Rodney, there was a barn in the back of Rodney's house, and they built an elevator, right? These are kids. And like, if someone, I'm an adult, and if somebody asked me to build an elevator today, I would not know where to start. Like,
exactly, that's honestly, what I mean.
I'd have to go to Google, and even then, even with Google, I wouldn't trust any elevator that I built, right? Like, it just wouldn't turn out well for anyone. He builds an elevator and it works. And we know it works because later, Rodney's sister, decades later in the 1980s, she gives an interview where she talks about how she took the ride on the elevator and lives to tell about it and tells his paper about it. But he's in this kind of community, and it's a really practical Midwestern small town community.
So one of the breakthrough discoveries or things which those who know Claude Shannon best know him for is coming up with the information theory. Do you just want to start this off by telling us what is information theory? I know it can be a very complex subject, but is there a way you can explain it in somewhat simple terms?
Absolutely. Or at least I'll do my best with it. The basic idea is, until Claude Shannon, people thought that there was nothing in common between, let's say, a telegraph signal, a telephone signal, a tweet, and this call that we're having, that they had no properties in common, right? Shannon shows, one thing he shows is actually all kinds of communication are reducible to the same basic things. So he provides a framework that's 6 boxes. People can look it up online, thanks to Shannon. But it's 6 boxes, and it sort of shows you how a message gets from point A to point B, and that all messages, regardless of the length, the medium, the kind of message, what you're saying, how you're saying it, they're all reducible to these same essential ingredients. So that's kind of essential insight number 1. Essential insight number 2 is, you can, once you can do that, you can encode or quantify. You can quantify messages. So he invents the bit. Actually, the bit has a great origin story. He was going to refer to it as the binary digit, but he's trading ideas with people at the lunch table at Bell Labs, and they're like, well, binary digit's 2 words, it's too long. You should take them and combine them and make them into bit. So he comes up with bits. That's the measure of information can be credited to Claude Shannon. So the thing about that is, like, it doesn't seem like a big deal to us, but there was no way to measure information prior to this. There were attempts, and he had worked with a couple of people who had tried to come up with a kind of quantification for information. But Claude Shannon is the one who sort of lays it down in its clearest form and says, this is how you measure information. The final sort of set of things that he comes around, and again, this paper is very dense, and like you said, we could go on for a while, is once you can measure something, you can encode it and you can compress it. So the fact that you can watch a YouTube video and it doesn't take a couple weeks to load is because of compression. And the idea of compression algorithms, of being able to take out pieces of things to be able to compress something down to its essential size, that is credited to Claude Shannon. And so one of the things that, for example, he shows is that in a basic sentence, if you took out the vowels from most of the words, most people would have not too much difficulty interpreting what you said, right? So like, if you were to write a sentence out, take out the vowels, for the most part, people will be able to read a sentence and sort of stumble their way through it. Well, what he's showing there is that a lot of language is redundant, that there's redundancy in language. And if you pull out the redundancies, you can do two things. One is you can make a message smaller so you can compress information. But the other is that you can actually encode information to make sure that when you send a message from point A to point B, that you can repeat certain letters or certain statements to make sure that it gets there accurately. So Claude Shannon and the theory of information is basically the science of how do you quantify information, how do you encode information, and how do you compress information.
Now, was this something Shannon came up with deliberately? Like, did he set out to research this sort of thing, or did he kind of discover it through a spin-off of something else? Like, what inspired him to look into this?
Right. So it's a long process, and it's worth getting into it a little bit because I think it's actually kind of inspiring for those of us who work on nights and weekends, because this is a nights and weekends project. So in the late 1930s, it's the first record we have. He sends a note to his graduate school advisor where he basically tells him, I've been thinking about some of the fundamental properties across all messages and all kinds of communications, right? And the reason that he can even say a statement like that is because from boyhood until that time, he has played around with barbed wire networks. He has, studied engineering at the University of Michigan. He has worked on cryptography and code breaking for the U.S. war effort at Bell Labs. He's worked at the phone company, so he's seen how those messages travel. So he's been exposed to all these different kinds of messages and forms of communication, and he starts to see that there are these ingredients that are common to all of them, right? So that basically percolates from 1939, 1938 until 1948. So roughly a period of 10 years. And what he does when he's not working at Bell Labs during the latter part of that time is he's writing this paper, and he's working away at it. As best as we can tell, he's basically working at it away on the side. And then in 1948, he publishes it in the academic journal that Bell Labs runs called the Bell Systems Technical Journal. And just a brief aside, it's sort of extraordinary that this private sector company runs this academic journal where they publish these sorts of papers. It's a kind of amazing thing. But he publishes this 77-page paper, and as someone put it, it came like a bomb because he hadn't discussed it with anyone. He had not talked about it. He had sort of made passing references to things, but it wasn't the kind of paper that he was bouncing off a lot of people, publishing early versions, etc. He had sort of dropped it like a bomb, and it invented an entire field and solved most of that field's central questions, at least the kind of broad outlines of those questions. And so you have a situation in which, this kind of comes out of nowhere, but it's really been in his head and he's been working over it for 10 years. And there's a lot baked into it. It's studies in linguistics, and it's studies in mathematics, and it's studies in engineering. And it's, he was a jazz musician, so there's probably even some elements of that in there. So all of this is baked into that paper, and that's how it comes to be. And when it lands, people know almost immediately, they know this is something significant. And then papers start to be derived from it, which is really important in academic circles. So people use it as a jumping off point for their own work. And then over the next, I would say 5 years, the most important moment actually is a year later when he initially publishes the paper, and he titles it a mathematical theory of communication, just a mathematical theory. By the following year, it's referred to as the mathematical theory of communication. So people recognize that it's definitive.
Just so everyone listening really can get a grasp on this and just how important information theory has been to the sorts of technology that we almost take for granted these days. Like, where would we be today if it wasn't for information theory? Like, what sort of things would we potentially not have?
Yeah, it's a really, really good question. It's one of these things that it's kind of hard to say exactly because so a good way to think about it is there are sort of like Copernicus, right? Would we have discovered at some point that the Earth revolves around the sun instead of the other way around? Yes, in time, somebody other than Copernicus would have come along and found that out, and I suspect the same sort of thing would happen, and we would refer to that person's name, and it might be called, if it was you, Aaron, it'd be the Fifield Revolution, right? The Copernican Revolution. We'd call it the Fifield Revolution, and we'd credit Aaron Fifield with discovering that in fact the Earth revolves around the sun, not the other way around. So, is it possible that someone would have come around and discovered exactly what Shannon did 10 years after, 5 years after, 2 decades after? Yes. And there were other people in the space working around these ideas. Norbert Wiener is a famous example. And he and Shannon are actually at one point kind of in a sprint to get their papers out, because Wiener has many of these same ideas. There are some important differences that we go into in the book, but he is also working in these fields. Shannon also had a couple of important predecessors who began the process of quantifying information, turning it from this idea into this sort of very hard science. So do I think that eventually somebody would have figured this out? Yes. I will say that I think Shannon's work, in a way, gave engineers the practical tools to bring many of the technologies we have to pass more quickly. So the codes that Shannon comes up with are really not used at the time, because remember, he's doing this in 1948. So the world is still analog. Computers are still the size of rooms. Nobody has phone. Nobody has an iPhone. The satellites don't exist, all that. What the first time his codes are used is in the 1980s. And so the question is, would that have happened eventually? Probably, but maybe it would have been the 1990s when those codes are first used instead of the 1980s. But after his work comes into use, it's basically the gold standard, and it's used for all kinds of engineering applications. And many people who follow Shannon take his work and develop it further. And there are a lot of famous technologists and technologies that people that build and grow from that. I think I'll offer a couple more thoughts, because I know this is a little bit all over the place, because I think it's just a hard question to answer, right? It is like saying, well, if Charles Darwin hadn't been around, would we have, when would we have discovered evolution? I think that there are certain discoveries that can seem trivial, but they're only trivial after the fact. Right. So they're only trivial once someone's come around and done them. And then it's like, oh, of course evolution exists. I know it's still debated today, but let's just, for the sake of argument, just accept certain premises. Well, of course it exists. And so you've got this situation in which it's like, well, of course information is transmitted this way. And of course bits can be used to quantify information. But I think it's one of those things where you can only say, of course, because someone like Claude Shannon spent 10 years writing this 77-page paper that essentially defined this field. And what that field leads to is our ability to have this call over Skype while you are in Australia and I am here, because the messages that you're sending and that I'm sending are able to be encoded and compressed and transmitted. And yes, there are other people who developed Skype and the laptops you and I are talking on and the microphones we're using, but the underlying architecture for how that communication happens belongs to Claude Shannon.
Yeah. Now, is it true that Shannon almost, I don't know what the right word is, but almost discarded the idea after a while? He, as you described, he kind of dropped this bomb. He's responsible for introducing information theory. But after a few years, he kind of stopped working on it, or kind of left it for other people to develop the idea further. Is there some truth to that?
There is. I don't think it's as true as people think, but there is definitely some truth to it. So, one of the things to get back, this actually is a good sort of, gets us back to where we started, which is Shannon was somebody who picked things up, did them to whatever satisfaction he thought was necessary, and then moved on. And in the same way, information theory kind of became like that. He could have traded on information theory and just became an information theorist whole hog for the rest of his life. But he had a lot of other things that interested him, and he wanted to pursue them. And so he did. And so what happens is once he publishes the paper, he does write a lot for the next decade and a half. And he co-authors papers with people like Bob Fano and Bob Gallagher, who are kind of two of his acolytes who end up picking up the mantle where he leaves it. But he's not. There comes a point when he's a professor at MIT, and we spoke to a lot of people who were there, and they basically said, like, he was supposed to be this kind of world-class information theorist who was going to help our department get to its next great level. And then it turns out like he'd kind of lost interest in it and just didn't want to participate in that. And I think part of it is that he had found other interests. He became interested in juggling and in chess and in AI and in computers. And so his interest moved on. And so there is some truth to it. Now, the thing I would object to, people will say things like, well, after 1948, he doesn't do anything significant on information theory. And I don't think that's true, because we do have a record and some decent both published and unpublished papers in the field that do contribute to the body of knowledge. But probably the most important thing he did was he published this paper that led all of these other very intelligent people into this field, who then developed the things and took it further. So I do think there's some truth to it, but I'm not sure that I'd go as far as some people have.
Okay, got it. Well, let's speak a little bit about Claude Shannon's interest in the stock market. So at what point did Shannon actually turn his attention to investing?
Right. So there's some dispute about it, but as best as we can tell, it starts in the kind of 1960s and the 1970s. And actually, it's important to correct the record on one thing, which is people think that like this brilliant mathematician picked up the Wall Street Journal and came up with all these theories and made a lot of money. And it's actually not Claude Shannon who becomes first interested in the stock market. It's his wife, his second wife, Betty Shannon. And Betty is this kind of extraordinary figure who deserves a lot more credit than she's gotten. And I hope the book starts to correct some of that. I hate to say this, but she passed away just 3 or 4 months ago, before the book was published. But we managed to secure an interview with her before she died. And one of the things that both she and her daughter talk about is how the stock market actually was not an interest of his until his wife becomes intrigued by it. And so they start buying books. They buy Adam Smith's Wealth of Nations. They buy books by people like Benjamin Graham. They buy all these. There's a title. I haven't read this book, but there's a title of a book that I thought was pretty funny, which is why don't the customers have yachts?
Right.
Something like something like that. So they read books like that. They become intrigued by the literature on the market. Then they start doing some early investing. They kind of day trade. They play around with things, and as mathematicians, and Betty, by the way, his wife, was also a trained mathematician, they kind of get intrigued. For Shannon, the market was this extraordinary puzzle of money moving here and there. And so he just wanted to understand the puzzle in the same way that he wanted to understand how to build a computer that could play chess. So in the 1960s and 70s, they start becoming intrigued, and it's in the 1970s in which he gives a few famous lectures at MIT about some of his investing theories and what would make sense and what doesn't, and what's worked for him and what hasn't. And we can go into those if you like. I mean, that he himself knows that they are exercises in kind of theoretically understanding the stock market. They're not the most practical investing strategies, but the upshot of all of his work in the market is his most successful investments are instances in which he befriends somebody who is going to start a company and manages to get in on the ground floor of it. And so he gets in on the ground floor of a company called Teledyne. He gets in on the ground floor of a company called Harrison Technologies that is later acquired by Hewlett Packard. So because of his role in information theory, he gets to know all these guys who are early Silicon Valley people, and they obviously want someone like Claude Shannon to be, on the board and to own stock and all the rest. And so that's how it happens for him, and that's a lot of where his stock market wealth comes from. Is not necessarily active trading; it is getting it on the ground floor and then just holding on for a very long time.
Right? Yeah, because he was very much a fundamentalist, right? Like, is someone who's a very intelligent mathematician, you would kind of presume that they would be doing something other than obviously trading off or investing off fundamentals. But that was like his whole thing, wasn't it? Is knowing the company fundamentals.
It's so interesting, right? Because you would think that he's this genius mathematician. He's working on all the complicated equations and everything else. And at the end of it all, like when asked later in life, kind of what sort of things do you look for in a stock, or how do you pick stocks? He just says, look, you look for good management, a good product, all the basics that people will tell you, people like Warren Buffett. By the end of his life, Claude Shannon sounds a lot more like Warren Buffett, than a kind of active trader. He has one thing that he does do, which is he imagines a scenario that challenges what's sort of called the kind of random walk on Wall Street, right? He challenges the view that there's no way to make money off of the fluctuations in a stock, right? And so what he does is he sort of describes how if a price goes kind of up and down, you can actually, through a strategy of kind of creative rebalancing of your portfolio, make money from that. And then he kind of charts it out. Now, ironically, once he finishes this long lecture, everyone's paying attention. Someone asks him, well, do you use this strategy in your own investments? And his response is, no, the commissions would kill you. And so it's what he basically shows is that you can use this rebalanced portfolio to create less volatility than the volatility of the stock, and therefore give yourself a higher return over time, and including a sort of higher risk-adjusted return too. And so he does that, but then his actual investing strategy, when he and his wife are thinking about investing in KFC, they have a bunch of friends over and they buy a bunch of buckets of chicken and they eat the chicken to see if they like it. And that's what he's thinking about. He's not plotting out crazy curves and studying dips and all the rest. But he does make an attempt to kind of harvest this volatility to see if you can do anything with it. And his theories now, from what I can gather, would be what people sort of call a kind of constant proportion rebalanced portfolio. And the idea that you can rebalance between your cash and your investments in a way that enables you to take advantage of some volatility. There are people who have done later work on this. It's one of those classic cases where Shannon's unpublished work, if he had taken it a few steps further, probably would have given these people the insights they had later. There have been market theorists that have played around with this, and economists who have played around with this later, but that's what he was playing around with, was portfolio rebalancing as a way to basically deal with volatility.
Yeah, I mean, you've got to think, like when he was giving this lecture at, I think it was MIT, you mentioned, about this particular strategy, which worked, except for when you factored in commissions. I mean, commissions back then were extremely high. I mean, now you can get them, I mean, commissions are very dirt cheap, so it's possible there's probably some merit to what he was saying. I mean, is that research of his, can you find that anywhere?
Well, so you can find part of it, some of it in our book. We're actually going to publish, and I'll share the link with you once it's live. We're going to publish a longer piece on some of his market theories and some of his trading theories. But no, it's actually, one of the things about Shannon is he had so much work that he did that he just never published. And this stuff is buried in the Library of Congress. We went through 21 boxes of papers at the Library of Congress. And this is just a handful of notes from that lecture, an interview he gave with a couple people about it. But honestly, it's not there. And the truth is, like, he himself acknowledged that part of what was happening was he was modeling a stock which would lose half its value on the first day, regain its value the second day, then flip and reverse. And he was making money off of those changes, but those are hard things to predict. So there were some assumptions baked into his model that I'm not sure reflect kind of how the market actually operates. In addition to the question about commissions, I will say it was at the time, people believed the idea of the random walk on Wall Street. They didn't think you could make money off of volatility. And I think a lot of what we've seen in our time is, let's say, how do we put this generously? People take advantage of volatility using things like high frequency trading. But Shannon there was some thought there that you could actually challenge the conventional view. So even in this, he was unwilling to kind of accept what was the norm, to say, okay, what if we could find a way to take people's cash as soon as the stock value went down, pour the right balance back in, and he managed to at least plot out the idea that you could make some money doing this. But no, it's not an easily accessible thing. We have a little bit about it in our books, and we have a little bit about it it's investing in our books. And we're going to plan to publish a nice piece on it to dive into it a little bit more deeply. I think the thing again to know is that, like, at the end of the day, the theory was what the theory was. What he was a good fundamentalist.
So did he become wealthy through his investments in the stock market, or did he build a lot of his wealth through other things which he'd done in his life?
He did become wealthy through the investments. And there are, some of this is legend, some of it is true, some of it is just exaggeration, but they made some, part of what happened was that, I think over time, their portfolio achieved a compound interest of 24%, over that period, which is significant. And part of that, though, was that it was basically 3 stocks that accounted, and they managed to get it on the ground floor. The stocks would grow, companies would get acquired, the values would shoot up, they would hold on for the ride. And so he had wealth. It was paper wealth. So they could have sold, they could have done some things, but he was more than happy, as he put it. He said, "I am willing to borrow on our investments if necessary, rather than sell our stocks and convert them to interest-bearing instruments." Right, and so he was more than happy, for a variety of tax and other reasons, to just use that. The Shannons were also not very lavish people. They purchased a nice home in a kind of community 8 miles north of MIT. Lived out their days, and they weren't flashy people, so they didn't necessarily need all of this wealth that they had accrued. But they had done pretty well through their investments, particularly in Teledyne. They had an investment in Motorola, and in their notes in those 21 pages, there's a table that he printed out of the stocks that he owned, and it has a few columns: how many shares, the purchase price, and what the price was in 1981 when he makes this table. And so, for example, with Motorola, he buys these shares at $1.13, and when he's looking at the price in 1981, it's $65. He gets Teledyne for $1, and in 1981, it's at $194. And so he's managing to kind of place these bets and get in early, but the most important thing he does is hold on, and it does give him some wealth toward the later part of his life.
Okay, right. And that 21 pages, which has this printout of his stock holdings, whereabouts can we find that?
Oh, I'm sorry, I wasn't clear. So the Library of Congress has 21 boxes of his papers,
okay.
and the printout is actually just one of the pages in that 21 boxes, and it's actually kind of amazing. They were early subscribers to a stock price service, like a ticker service, and they printed this out on an Apple II, like one of the earliest Apple IIs, which was actually hand assembled by Steve Jobs, and so they have access to all these like early technologies. They use it to print out things like stock quotes. And so there are all these like pieces of paper with stock quotes floating around the house, which is what his daughter told us. I think it's one of these things. If we just take a step back to bring the conversation around full circle, the stock market wasn't an end in itself for Shannon. He wasn't, like I said, he wasn't a flashy guy. There were stories of these kind of uncashed checks that he had. He like left money sitting in a checking account that didn't bear any interest or do anything. Money was a game. It was a puzzle. It was like, how do I come to understand the market? What can I use to understand the market? So he actually builds a machine that simulates money going in and out of the market. So he does all these things that are just amusing to him. And the market is not this kind of, it's a serious thing in as much as he's playing with live ammunition, but it is also just a way for him to have fun and to sort of talk about things he enjoys. And so that's kind of how I tend to think about it, is that this is just another puzzle for him to understand.
Right, yeah. Like you said, he likes the challenge of it and likes the problem-solving aspect.
And another thing that he did, which was really probably the smartest thing he did, is anytime they'd make an investment, they would either try to dive very deeply into the product, like in the case of KFC and eating it, or they would try to meet the founders. So they always made an effort to use his sort of stature within the scientific community to get meetings with founders to see if they liked them, to sort of kind of understand what made them tick. And that's part of what drives a lot of their investing, is actually meeting these people in person, shaking their hands, getting to know them, and then making investments. And to the extent that like he cares about how a company is going to do, their metrics weren't complicated algorithms. Their metrics were, what is the product like and what's the leadership like?
Yeah, very much like a value investing sort of approach, isn't it?
Well, and they held on to the stocks for 20 plus, 30 plus years. So yeah, it's exactly, I mean, it is very much like a value investing approach. And there are some estimates that show that their portfolio, skewed though it was one of the best performing portfolios, of their day, just because they would get in, they would hold on. He bought, this is like one of those that always makes you jealous. He got Hewlett Packard because he was involved in this company, Harrison Technologies, which was acquired by HP. So he gets HP at 13 cents. And in 1981, it's at $82. And I'm just like, oh my God, that's unbelievable. What a return. And so the appreciation was pretty significant, but it's partly just because they would get in and then hold on.
Yeah. Wow. All right, Jimmy, well, let's do one last question. I'd just like to ask you, as you know, Claude Shannon is a brilliant mind. Was there anything he did in particular to try and keep a sharp mind or to help good thoughts or anything like that? Like, did he have any sort of strange sleeping patterns? Did he have a strange diet? Did he have a big focus on meditation and exercise? Like, was there anything like that which he did to keep his mind active? And I think you know what I'm getting at.
Yeah, absolutely. Like, what was his sort of Tim Ferriss secret?
Exactly. Yeah.
You know, it's a great question, and I wrote a long piece with Rob on Medium called sort of 10,000 Hours with Claude Shannon, which is where we wrote kind of what we learned about him, kind of like what are the habits that you can pick apart from this genius. If I had to say there's one thing that I think stands out, it's that he was spending a lot of time later, particularly later in life, taking things apart and putting them back together and trying to improve upon them. And so a good example is even when he's in the nursing home and he's suffering from Alzheimer's, is a very hard time in his life and the family's life. He actually a report has it that he took apart his walker and tried to like reconstruct it and see if he could make it work a little bit better. Right. And I think based on, there's a couple books about this concept, that the idea that like working with your hands can help you cognitively. One is Shop Classes, Soulcraft by an author named Matthew Crawford. But I really took that to heart from doing the research on this book, which is there's something really powerful about working with your hands and building things and then kind of taking things apart and trying to rebuild them and put them back together. And I think like there was an era in which, people would tinker on their cars. And like now, God, if I try to work on my car, I'd ruin it, right? The same way that if I try to open up my Mac laptop, I'd wreck it somehow, right? And we have all these devices that are very clean and very polished and very intuitive, but I wonder if we're not missing something from that there's not value in kind of the shop class, like in building things, because I do think that cognitively it places different demands on you. In that book, Matthew Crawford talks about how he has this line, and I'm not going to get it exactly right, but it's something like, he's like, I did more hard thinking in an afternoon working on motorcycles than I did in 4 years of getting a philosophy degree, right? And I think we have this tendency to sort of poo-poo the manual trades or sort of look down on working with your hands as something that's, for other people. I think that for Claude Shannon, working with his hands is partly what led to his brilliance. And I think it kept him cognitively sharp. I think it placed demands on his brain to think about how machines were built that led to a lot of the theoretical mathematics that he did. And so I do think that, like, I look back and I say to myself, like, how am I going to incorporate that in my life? And I do think that, there's something to that, even if we can't quite pin down what it is.
Sure. Yeah, that's a brilliant answer, man. That's very good. And I just want to mention also that article that you wrote on Medium is very well written, and I'd really encourage everyone listening to this to read that also. So I'll put a link to that in the show notes on the website.
Thank you. I appreciate that. It was one of these things like you do. We write in the article, you kind of live with these people, like they become your roommates essentially for 5 years. So we had this weird tinkering genius mathematician who was sort of kept to his own as a roommate for 5 years. And we like to think some of that stuff rubs off and you pick things up. And this article hopefully is for people who don't know him, hopefully this article is a good introduction to who he was.
Absolutely. No, I'm sure it will be. So, Jimmy, let me say thank you very much for coming on the podcast. If anyone wants to find out more about the book or pick up a copy. It's called A Mind at Play, and I'll set up a link, chatwithtraders.com/Shannon, and that'll take you directly to the book on Amazon, so you can find out much more about it there. Jimmy, you're also on Twitter as well. What's your Twitter handle?
Yeah, I'm just at Jimmy A. Sony at Twitter, and would love to hear from your listeners and your audience. I'm happy to talk about Shannon, all day long, and hopefully what I'm going to try to do too, just to open the kimono a little on research, is we're just going to start putting stuff out there. We put up a document that he wrote called Creative Thinking, which you can also find on Medium under my name, and it's essentially like a speech he gave on how to think more creatively. So we'll start putting that stuff out there, and the stock market stuff. And I really appreciate the chance that you've given to share this with your audience. I think his story is amazing. I think a lot of people can learn a lot from it. So thank you for taking the time to do this.
Pleasure is all mine. This was a lot of fun. Do you just want to spell out your Twitter handle?
Yeah. JIMMYASONI.
Good stuff, man. Once again, I really appreciate you doing the podcast. Like I said, it was a lot of fun. So yeah, thanks very much.
Thank you, Aaron. I really appreciate it.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey, what's up? What's going on, everyone? Now, this is the first intro I'm recording since getting back from Sydney last week. So I'm back in Brisbane now after a fairly short, but a very busy few days in Sydney. Yeah, so while I was down there, I hosted a live podcast, which you probably heard me hyping up on the past few episodes. But anyway, that's all over and done with now. And I would like to give a big shout out to everyone who came along and attended. The evening was a lot of fun. It was a sellout event. I think we had about something like 160 people there, many of which were professional traders. There were several past guests from the podcast. There was a few brokers in the room. There was even some of the higher ups from a couple of the prop firms in Sydney. all in all, it was just a really great group of people. So thanks everyone for coming out. Of course, a thank you to Trading Technologies for getting behind and supporting the event. And a big thank you to WeWork for allowing us to use their space and drink a lot of their beer. All right. Now, let me tell you about what's coming up on this episode. My featured guest is hedge fund manager Eric Townsend. So I'm sure some of you will already be quite familiar with Eric, in particular the macro investing crowd, because Eric hosts the Macro Voices podcast. That's right, Eric is a budding podcaster. Eric has a pretty interesting story and some interesting experiences about what's led him to where he is now. You'll hear all about this in just a moment. But other big talking points we cross off include how Eric uses the concept of the fourth turning and major cycles to guide his macro outlook, and one possible scenario for the future of cryptocurrencies. I'm sure some of you won't like what you hear, but I think it's well worth listening to. You know, macro's not really my thing, as I expressed a couple weeks ago, but to be honest, I found this conversation with Eric to be really fascinating. So I hope you'll agree with me and get something out of this also. In case you are wondering, this conversation was recorded on the 17th of August, 2017. All right, well, I'm going to end this right here. Here is my guest, Eric Townsend, for episode 141.
Microphone is good. And 1, 2, 3, Mark, I'm rolling.
Okay, cool. Anyway, Eric, what were you doing before you got into trading? Let's hear a little bit about that.
Well, I was an entrepreneur in the software business. I spent most of my career designing distributed software systems. If there's any IT geeks in the audience, the idea that's now known as this is funny. I almost forgot what it's now known as service-oriented architecture. And it wasn't called that when I started doing it in the 1980s, but I'm one of the guys that co-invented that idea. And I've never been credited as the guy who invented that idea, but we were doing it before anybody else. And I actually sold the company in 98 before, I think it was Gartman Group, coined that term. But it's basically getting figuring out how to get a bunch of large enterprise information systems talking to one another and communicating with each other. And I sold that business in 98 because it was obvious to me that tech was in a bubble. And so I come from that background, and what I thought I wanted to do in life was to learn to run my own money, because I'd always been fascinated with investing and finance. I watched Wall Street Week with Louis Rukeyser when I was a kid in high school, and I thought that's what I wanted to do. And very much to my regret, as I look back on it, it was the M&A lawyer that handled the acquisition of my software company that talked me out of it. And he just said, Eric, you are a software guy. You're not a finance guy. You've got millions of dollars now. You are not qualified to manage your own money, and it would be reckless and irresponsible of you to try to do so. You are at a wealth level where you can attract the services of the world's most prestigious investment bank and have their private client group manage your money. You should do that. Don't try to do this yourself. You need professionals. That is the single worst advice that anybody has ever received, I think. And, as I look back at it, the part of that he was right about is I was not qualified to run my own money at that time. I was a software guy. I didn't know a lot about investing, and I would have needed to invest in learning. That's what I should have done. Instead, I got talked out of it. So I went off and lived on a yacht and tried to be retired in my early 30s, which never works, and wasted what really was the worst chapter of my life. Believe it or not, living on a mega yacht, 87-foot motor yacht, touring around the Caribbean is the worst experience that I've ever had in my life. I was bored. I hated it. I thought that's what I was supposed to do because I had money, and it was miserable. And what happened was the world world's most prestigious investment bank, lost about half of my net worth in the course of 6 or 7 years. And out of necessity, I finally did what I should have done in 98, which is to learn about markets and do what I always wanted to do, which is to be a full-time private investor. And so that was probably the end of 2006, beginning of 2007. That I kind of reinvented myself as a full-time private investor. By then, I had sold the yacht and tried to figure out what I was going to do next in life. And I thought that what I wanted to do next was some kind of fintech business. I figure, okay, I'm a software entrepreneur. I know how to run a software company. There's a lot of opportunity in algorithmic trading and so forth. Now, I must be some opportunity for me. I'll go do that. And what happened was I had a whole bunch of faulty assumptions about the investment business. I knew about Graham and Dodd's style of, analyze balance sheets, figure out, expense ratios, and decide which company to buy in a buy and hold stock portfolio. I knew about that stuff, and it didn't sound fun to me. And when I think it was probably reading Jim Rogers' work that really got my attention, I said, wait a minute, learning about macro, learning about what the interactions are between governments and trends and global trends in the economy, learning all these fascinating things. Why is it that when there's an earthquake in Chile, the price of copper is likely to go up? Or what if this Ketla volcano in Iceland erupts? What's downwind of that? How many people spend time thinking about that? Well, the Russian wheat crop is downwind of that. So as I figured out that you can learn about the most fascinating and interesting puzzle in the history of the world, which is how all of the global macroeconomic connections relate to one another and how currencies, currency exchange rates relate to the relative productivity and interest rates that are being offered in different countries and so forth. You can actually learn about all these fascinating things and make money by knowing about this stuff. And that's called macro. And I didn't know that existed. So as I was researching what kind of fintech software company I might launch, leveraging my software experience, I learned about macro and I just fell in love with it. And so I reinvented myself as a full-time private investor, tried to learn as much as I possibly could. And eventually I got pretty good at it. I'm a very collaborative kind of guy. So when I was living full-time in Hong Kong, I established a traders group, and we had a bunch of mostly hedge fund guys that got together every couple of weeks. We rented the Canadian Chamber of Commerce in Hong Kong, and basically just had a traders lunch meeting every couple of weeks. And these guys I got to know said, Eric, we've met private investors in air quotes before, guys that take their iPhone to the golf course with them and check their stock quotes. You're sitting in front of 9 computer monitors and you're there for 14 hours a day. You're doing all of the work of, running a hedge fund except for calling a lawyer and turning it into a hedge fund. You should do that. And I said, what are you, crazy? I'm not in this business. I'm a software guy. And they said, well, look, you're doing this. And I resisted that advice for several years because I didn't really want to be in the finance business. I hadn't had very good experiences with the world's most prestigious investment bank and their very elite private client group that lost half of my net worth. So I didn't want anything to do with it. And it was really not till 2013 that I finally launched a fund. And it's fascinating to me that it went down this way. The business about making lots of money, running other people's money and making lots of fees on it. I'm a small guy. I don't have the ability to raise institutional capital. It never really made sense from a fee standpoint. But what's happened for me is I'm running a business again. When I was a private investor, I was not engaged. I wasn't waking up and feeling like I've got a mission in life. And what's happened is my trading returns have improved dramatically because I've got a mission. So I don't really have very many investors in my fund. I'm mostly running my own money, but I'm better at it now and I'm much more committed to it now that it's organized this way. So it's kind of a weird story, but that got me to this point of basically running my own money, but it's organized now as a fund and it's been fun. I've met some interesting people and have learned about all sorts of things that I never knew about before. So it's been a real journey for me.
It certainly sounds like a real journey, and there's a few interesting things which you've mentioned, and I'd love if we could go into them a little further. One of those being the fact that you said that you'd retired from the software business, at least by when you were 30-something. You had millions of dollars in the bank, and you were in the Caribbean living on a great big yacht. I mean, for many people, that sounds like the dream. I mean, why was that not the dream for you? Why was that not the best time of your life?
Well, I certainly thought it was going to be the dream. It sounded like the dream to me. What happens is this: everybody who's interesting, everybody who is intellectually engaging has a job. I mean, I guess there's 80-year-olds that are interesting and retired and don't have a job. But anybody in my age, I retired when I was 33. Anybody in my age group who was interesting is at work. And the people, a yacht especially, it's not something you can enjoy by yourself. It's a group activity. Now, there's every imaginable kind of scumbag, sleazeball, and, parasite that wants to hang out with the guy that has the yacht. So there's no shortage of people in your life, but they're all the wrong people. And all the right people are busy because they've got jobs, they've got careers, they're doing interesting, intellectually stimulating things. And I found that I went from having a career in the software business where I had about 40 people working for me, all of them six-figure income, very, very smart people. My interactions every day were dealing with the smartest people on earth, because my whole strategy in the software business was basically every time I meet somebody smarter than me, just figure out how to hire them. And that was what led to my success. And I was surrounded by very smart people. And now all of a sudden, I'm a multimillionaire. And the only people that I know, the personal network that I have, are waiters and bartenders in restaurants, because I eat out a lot and I don't know anybody who's interesting anymore. And, is amazing as a Caribbean beach and a scene on a yacht seems like it ought to be, it gets old fast. And the food sucks in the Caribbean. The responsibility of running the boat is very serious. Hurricanes and stuff, you've got to constantly move the boat around. And as much as it looks like fun, it's not. And so I very quickly tired of that. It also takes a lot longer to sell these things than it does to buy them. And so getting rid of the yacht was probably the best thing that ever happened in my life. And it was from there that I wasn't sure what I was going to do next. And I thought I would get back into entrepreneurship as a software guy because it seemed like the natural thing. And it was really discovering macro that changed my life.
So while you were living on this yacht, that was the point where you had put some of your money with this prestigious firm, which you've spoken about, and they were managing your money, right?
Oh, and it was just I got so completely screwed over by these people. The worst advice that I've ever gotten was this lawyer who told me you cannot go wrong having the world's most prestigious investment bank run your money for you. Look, what the big investment banks are good at is making money for themselves and ripping off their clients along the way. And what they did is they saw me coming. They basically, told me, you're the kind of guy at your age, you can afford to take some risk. You ought to really invest in private equity, because they were supposedly the best of the best at private equity. And they recommended that I should put about 2/3 of my net worth into a single fund of funds, a private equity fund of funds that this outfit was offering, and it would invest in some of their own deals as well as other managers. And what that really means is it was the highest fee structure product they could think of to sell me. And at that point, I was not an investment professional by any stretch of the imagination, but I knew the basics. I said, wait a minute, put 2/3 of my money into just one investment? What about diversification? They said, oh, well, it's inherently diversified because it's a fund of funds and it invests in a whole basket of different sub-investments, and it's diversified. Well, of course, that's nonsense. It's all private equity. It's all the same asset class. It made no sense whatsoever. But most importantly, Private equity is structured as a long-term, it's a 10-year limited partnership agreement, and you can't get out of the thing. So I had a $10 million commitment to this thing, and at the time that I agreed to that, which was a mistake, I had a little over $15 million in total investments. And, 2000 hit, and the stock market took a dive, and all of a sudden $15 million turned into $13 million, and I'm immediately on the phone calling my private banker, the esteemed Harvard MBA private banker that knew everything. And I said, hey, I'm getting concerned. I've got this huge commitment of $10 million that I forfeit the money if I miss the capital calls. The $15 million turned into $13 million. Should we go to cash? Should we reduce exposure? What should we do? He says, oh, no, you want to stay with the investment. Don't make the mistake of panicking and getting out on a bottom. You want to keep all of your money invested. Well, what that really meant is they want all of my money invested in their high fee structure S&P type of fund, which is basically an index fund with a very high fee structure. And all of a sudden, a couple months go by, I get another statement, and the 13 million is turned into 12 million and then 11 million. I'm calling them up in a panic saying, hey, guys, we're down to just barely over what I'm committed to in this investment that hadn't really started yet, because I agreed to this at the beginning of 99, and it was a 10-year limited partnership where over the course of those 10 years, you get all of these capital calls and have to, put $10 million into the thing. And they said, no, don't worry, because, sure, you're only at 11 million right now, but, that'll turn around. And more importantly, these things, they never really draw down all of the money until they start distributing. There's an overlap there. You're not going to have the full 10 million drawn down at the same time. You've got absolutely nothing to worry about, were the words that they told me. And I said, boy, this does not feel good to me, but they're the experts. My lawyer told me I cannot go wrong with the world's most prestigious investment bank. Well, another year or so goes by, and they call me up one day and say, hey, you don't have enough money in your account to cover this capital call. What do you want to do? I said, what do you mean? What do I want to do? You're running my money on a discretionary basis. I agreed to let you guys do this because my lawyer talked me out of doing it myself. I never would have gotten into this. I've called you 5 times and said, why are we not going to cash with my remaining investments so that we have enough money to fund this? You told me, quote, you have absolutely nothing to worry about. And my private banker, the Harvard MBA, said, oh, well, we don't have that in our notes. And one thing these people are very good at is they keep very, very detailed notes that may or may not reflect what really happened in the conversation, but they're very well equipped to defend themselves in a lawsuit. So, who knows what their notes said, but it did not reflect the actual reality. And they're basically saying, this is your problem. And so now all of a sudden, fire sale the yacht. I wanted to get rid of the yacht anyway. I'm, gone from supposedly being comfortably retired and set for life to scrambling to sell off assets to meet capital calls. And I was forced to sell 20% of that $10 million commitment at pennies on the dollar because it was the only way to meet the capital calls, and took a huge loss on that. There was absolutely no reason to have gotten into this investment in the first place. I knew better. Shame on me for having been talked into it. As my available assets that were still liquid were decaying, I knew, and I called them over and over again and said, hey, guys, but I stuck for some reason. The fact that the guy was a very expensive M&A lawyer seemed to be so sure that he'd seen so many entrepreneurs make the mistake of trying to run their own money, and he was so convinced it was a bad idea that I should let the professionals do it, that I trusted their judgment. And eventually it ended up costing me about half of my net worth. And the other thing that was amazing, it's a 10-year private equity fund from 1999 to 2009. That's 10 years. Well, as of this day in 2017, I still haven't gotten all my money back out of this stupid thing, because as a result, supposedly, of 2009, which admittedly was not a good time to be liquidating that kind of investment, they extended the 10 years. I didn't see in the fine print that they don't really have to give the money back when the 10 years is up. And maybe that made sense for a couple of years, but they tried to just stretch it as far as they could to make more fees out of it. And to this day, it is still not fully closed out. And I didn't make anything, especially after having to liquidate 20% of it at pennies on the dollar. The whole pitch that I had gotten was supposedly they were anticipating a 21% annualized return, and supposedly never in the 150-year history of the world's most prestigious investment bank had they ever underperformed their estimated returns for one of their special investments. And well, they certainly did in this case. So, my message to anyone is, if someone is telling you you shouldn't be running your own money because you're not qualified to do it, they're probably right. You're probably not qualified, but you're better off learning to do it and qualifying yourself than trusting the private wealth management business, certainly the private wealth management business of the major investment banks. I think that the good guys in the private wealth business are running smaller shops. They're not the big investment banks.
Yeah, that's an interesting comment, and I can only imagine how frustrating that must have been for you. I mean, I can't believe you still don't have all your money out of that, considering you first entered into the arrangement in 99. I mean, you're not wrong. They certainly are trying to drag that out. It's an interesting comment you make because, you've taken responsibility for your own money now and you are managing your net worth yourself. You're also taking it very seriously. Like, this has become your full-time job now. For someone else who might not want to make it their full-time job, but would like to do something, let's say they have a bit of cash in the bank and they'd like to do something with that instead of having it just sit there. I don't really know how to best word this question, but what do you suggest in that situation where someone wants to do something, but they're maybe not prepared to make it their full-time job? Is that still a viable thing to do?
It is viable, but I think that the immutable rule is what I call the Schwager doctrine. And I call it that for just Jack Schwager, who's written a lot about it in his books, which is you've got to find your passion. You cannot do this investing stuff as a job you don't like, but you've got to do it for money because you will fail at it. You've got to figure out what makes you passionate. And, if you're the Graham and Dodd style guy that's just turned on by balance sheet ratios, good for you. I couldn't do it all day. If I tried to, I would fail at it. Figuring out macro, understanding the interactions between nations and what makes the world tick is so fascinating to me that I just can't get enough of it. And there are certain themes, which we can talk about if you want, that really have captivated my attention. And those major themes that have to do with what the world is going to be like and how the rest of what I expect to occur in the world for the rest of my lifetime is so fascinating to me that I don't do this because I need to make the money. I've gotten back to where I started, where I'm comfortable enough to be retired, and I've got enough money to get back to where I was before I met the Harvard MBA at the world's most prestigious investment bank in 1998. So I don't have to do this. I do it because it is so much more fun than living on a mega yacht in the Caribbean. It is so interesting to just be on top of markets and to see what's going on, and particularly to see how this fourth turning is playing out. I just interviewed Neil Howe myself last week, the author of the book, The Fourth Turning, which is one of my favorite investing books of all time. And it is so interesting to me just to wake up every day and think about where we are at this moment in history and what's coming next. You've got to figure out what you're passionate about. And I don't think it makes sense, regardless of whether you've got millions of dollars or hundreds of dollars, it doesn't make sense to risk it on something that you're not committed to, that you can't do with passion, so that you are just attracted to it for the sake of doing it, regardless of making money at it.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Okay, now we're going to speak about the fourth turning very shortly, but just before we get into that sort of thing, I feel as though I really need to ask you, like, how did you begin to come to grips with understanding macro? Like, how did you start learning about this stuff? Because, you were a software guy, you retired from that business, you kind of took a hiatus for a while, and then you've decided that you're going to get into managing your own money. The macro approach has really appealed to you. How did you actually start learning how to implement and properly do the research and that sort of thing, which is involved with global macro trading?
I think that reading Jack Schwager's Market Wizards books was probably a turning point. I had for a while been trying to figure it out. And remember, at first, the mission I thought I was on was to go learn about the investment business so I could figure out what kind of software company I might start in the investment business, because I figured I'm a software entrepreneur. That's what I know. That's where my skill is. That's what I got to do next. And so I was going to finance conferences. I was going to institutional investor conferences, trying to learn about the business, figure out what a Bloomberg terminal is, one of the most mal-engineered software systems in the history of the world. Could I give them a run for their money? Well, it would take a lot of capital to do that, although there's plenty of opportunity. Bloomberg is a very, very poorly designed system from a technical standpoint, but they've definitely got the market captured. I didn't have enough capital to take them on. I'm thinking about the world in terms of a software company. So I start reading the Market Wizards books from the standpoint of thinking about, okay, I need to learn about different styles of investing so that I can see what needs to be automated with computers, what I could do using my skills. And I'm reading about different traders, different famous traders, thinking about what do they do manually that might be a ripe opportunity for automating with software systems in some way. That's how I started reading those books. And I think it was probably the Jim Rogers chapter in the first book that just captivated me. And it's, hearing Jim through Jack Schwager's interview talk about how he was a student of history and was just fascinated with the world. And that led him to, be successful, fantastically successful, just because he got interested in things like what happens if there's an earthquake in Chile? Why does that make the price of copper go up? That was so fascinating for me to read about that I was just enthralled with it. And I started thinking, well, maybe I should try to learn about that. And macro is something that I think that the downside to it is it's one of the hardest strategies. It's not something, if you want to do, momentum trading or, trend following or something. You can read a book like the Turtle book. I forget the name of the guy, Michael Koval or something. It's a 120-page book. You read the thing cover to cover and you know how to do the strategy that he embraces. Macro is really learning a whole lot about what makes the economy work. It's lots and lots of books about economics. I don't think it makes any sense for anybody to invest the time and energy to learn all about it, unless, as was the case for me, every time you pick up the next book, you're so fascinated you can't put it down. And so I think it really is a question of finding what's that thing that resonates with your personality that says, this is what I got to do. And I don't know of any better way of finding that than reading all 4 of Jack Schwager's Market Wizards books. And I'd say the first read, if it's somebody who's new to this and they're not sure what they want to do, don't worry if you understand the details. You're reading about merger arb or something and you don't know what that means. It's not important. Listen to the style that each one of these traders that Jack interviews exhibits, how they describe the way they do things, and figure out what resonates with your personality. Once you figure that part out, and for me, it was guys like Jim Rogers that I really felt a connection to. And once you figured that out, then you start going and reading more about how to do that strategy and what's involved and so forth.
So essentially, a lot of what you know about macro today is being very much self-taught in some ways. Like, of course, you've got the information through books and doing your own research and that sort of thing, but it's not like you've had someone kind of holding your hand or guiding you through the things. A lot of it's kind of been very, self-discovered, right?
Yeah, it's self-discovered, and I think you've got to have an addiction to reading about it. I don't think anybody has enough energy to go read enough every day to be competent in macro unless they have some personal satisfaction from that reading. I couldn't possibly do what I do if it was a job that I was doing just because I make money at it. I do it because I can't wait to read the next article that teaches me something fascinating about the world that I never knew before. And there are aspects, to really take a classical definition of global macro. You've got to trade currencies. You've got to trade interest rate swaps. There's sort of a list of things that make up macro. I really give it a broader definition. To me, what macro means is understanding as much as I can about what makes the world work and what major trends are going to affect the future. So I get interested in things like fourth turnings and peak cheap oil and the international monetary system because I see that they're going to play a really important role in economic history in coming years. And that makes it fascinating for me. So, it probably is not the most strict interpretation of the phrase global macro, but frankly, I don't think anybody has a strict interpretation. The way to be successful in investing is figure out what you're good at and what relates to your personality or resonates for your personality and what you enjoy doing, because you've got to have, the only way you can have edge is to work harder at this than the next guy does. And the only way that you can, as far as I'm concerned, have the drive and determination to do that is if you truly find it enjoyable and rewarding and fascinating every step of the way.
Now, you've mentioned fourth turning a couple times. So fourth turning capital management, I believe that's the name of your fund, and I believe it's, of course, not just some arbitrary name. What's the significance of this? Would you mind just telling us a little bit about this concept of the fourth turning?
Sure. Well, I guess as I first started learning about long wave business cycles, and this was after I got interested in macro in general, I was reading about Nikolai Kondratiev, who was a Russian economist, who was, I think, the first guy to figure out that there's a long wave business cycle. A lot of people know about the 5 to 7 year business cycle that people talk about, where you kind of go through a boom and bust. Well, think about those as little waves on the ocean. Little waves are occurring on the surface of much larger swells, and the swells in this case are about an 80-year long wave cycle. And Kondratiev wrote a lot about it. This was, it was 40 or 50 years ago, I think, that Kondratiev wrote about this. The guy that really modernized it is Neil Howe, who wrote the book The Fourth Turning, and it was actually co-written by Howe and William Strauss. Strauss is now deceased, so I think of it as Howe as the author just because he's the guy who's still alive. I had the pleasure of interviewing him recently. So essentially what he's figured out is that history comes in about 80 year cycle. That's the period of the wave. waves. And those waves can be broken into roughly 4 different seasons. So think of it like seasons of the year. You know what a winter is like, you know what a summer is like, you know what a spring and a fall are like. History comes in these seasons that Howe calls turnings. And there are very clear patterns in American history as well as history of other countries that these seasons kind of drive everything. So there is, each one of them has a number and a name in Howe's book, but the one that we're in right now is called a fourth turning. And the fourth turnings are the crisis periods. The Spanish Revolution was one. The next one after that was the American Revolution. The next one after that was the Civil War. The next one after that was the Great Depression and World War II. The next one after that is the one that we're experiencing currently. And Howe wrote about how these things are all predictable. They happen about every 80 years. And a fourth turning is where you have the really difficult times where major institutions break down and get replaced. And that was the case of the pound sterling being defeated as the previous de facto world currency, being replaced after World War II with the U.S. dollar. Of course, the Great Depression, World War II were the major events of the last fourth turning. And then in second turnings, which are about 40 years off, that's when you have the major awakenings, which are cultural and spiritual. So in this current cycle, the last fourth turning was World War II and the Great Depression. The second turning would have been the 60s and, free love and the whole changing of social attitudes that occurred around the 60s and early 70s. Well, we're now, ever since 2008, which is when Howe figures that this present fourth turning started, they last about 22, 23 years. So this one will continue until about 2030. And this is the crisis period. And unfortunately, one of the things that we learn from studying history is that these things tend to start with something that seems like the big deal. So, for example, the last fourth turning started with the stock market crash and the Great Depression. And everybody said, well, yeah, fourth turnings are times when there's really bad stuff going on. We're having the Great Depression. That's really bad stuff. So we know what the bad stuff is for this fourth turning. Well, of course, what they didn't know at the time is that the Great Depression was the opening act and that actually World War II was yet to come. And that was going to be the really difficult experience that the world went through in the last fourth turning. And unfortunately, that probably means that the great financial crisis that began in 2008 was the opening act. That's the thing that's equivalent in this fourth turning to the role that the Great Depression played in the last fourth turning. That means that, World War II or its analog has yet to come yet. Now, I absolutely am not predicting World War III because I think that in this age of nuclear weapons, world war is pretty much an impossibility. If it does happen, it goes nuclear, civilization ends, and everybody's dead. So hopefully that doesn't happen. But I think that if you look at economic things that happened as a result of World War II, changing the world's, major hegemonic power was still Great Britain before World War II. Everybody thought that was forever. Everybody thought that the pound sterling was forever. These were things that were just ingrained in people's mindset that could not change. Well, of course, the Great War was such a big deal that it did change it. And you had Bretton Woods in 1944. And this is what happens the last couple of years of every fourth turning is there's a phase which Howe calls the resolution. And that's where old systems are torn down and new institutions are created. So at the end of the last fourth turning, which would have been around 1943 to 45, you had the creation of the World Bank and the IMF, United Nations, the Bretton Woods Conference establishing the U.S. dollar as the world's reserve currency. These are all the things that happen at the end of a fourth turning. So sometime in the late 2020s, coming into 2030, is when we should expect to see the new institutions being created that really define the economic backdrop going forward for the next 75 years or so. And I think that the U.S. dollar probably will be replaced. There's an economist called Robert Triffin, who wrote quite extensively about what he called what's become known as Triffin's paradox or Triffin's dilemma, which is he said, look, how do you choose what's going to be the reserve currency? Well, you choose the best credit. What is the result of being the reserve currency? Well, the issuing nation is almost forced to run massive massive current account deficits in order to supply a sufficient quantity of the reserve currency to the rest of the world. So they're borrowing and spending beyond their means and getting away with it for decades. Eventually, that gets you to the point where you're not the world's best credit anymore. So look at the U.S. dollar. In 1944, the U.S. was a creditor nation. It had no external obligations. Now we are not only not a creditor nation, but we're the greatest debtor nation in the history of the world. This all has to come to a head at some point, Triffin predicted. And he said any country that becomes the issuer of the reserve currency will eventually lose that status, because having that status causes you to do things that make your currency no longer suitable. So, if you look at all of the things that are likely to go on, if you have an understanding that where we are in history is in a fourth turning, we're only about halfway through it. It ends around 2030. And a lot of really major things will probably be reset and redefined by 2030. Well, what are the likely candidates? It's very easy to see. Is the U.S. dollar going to stay the world's reserve currency forever? Is the U.S. Treasury bond still going to be the safest investment on earth, as it's perceived by almost everyone in institutional finance to be today? Probably not. If you look at the massive, massive debt that the United States Treasury has accumulated, we continue to get away with it because we're the reserve currency, and that creates such an external demand for U.S. dollars that there's something that was actually French finance minister at the time, later president of France, Valéry Giscard d'Estaing, said back in the 1960s, which is the U.S. has this exorbitant privilege, he called it. And the exorbitant privilege was referring to the U.S. having the ability to basically just borrow as much money as it wants and go into debt almost for free, because where other countries that were not reserve currency issuer would pay a penalty for that excessive borrowing, as reserve currency issuer, there's so much external demand for U.S. dollars, the U.S. could get away with it. Well, if we have been able to get away with $20 trillion of treasury debt without anything going broken in the night, and we get away with that because we are the reserve currency issuer, what happens when we're not the reserve currency issuer anymore? And at the same time, look at something like $200 and something trillion of unfunded liabilities in the form of Social Security and Medicare and so forth. We've been able to get away with having these systems that it's been known for 30 years that Social Security would go broke in the 2020s sometime. Well, of course, it's no coincidence that that is toward the end of a fourth turning. So at some point, if you look at the most important social contracts that we have in society, it's pensions and entitlement programs. We tell all of the hardworking people of the world, look, you've just got to work hard, pay your taxes, and don't worry, because there's this retirement system, a pension system, and don't worry, there's really smart finance guys like us who are in charge of it. You can trust us, really. We're going to make sure that you're going to be able to enjoy your retirement and everything's going to be fine because you're going to be taken care of. But what's happened is because we don't think about demographics and the fact that there's this worldwide baby boom. It's biggest in the United States, but the baby boom exists in other countries around the world in roughly the same decades. We've got this huge demographic overhang of, it used to be that all of these systems, there were far more people of working age paying into them than there were people of retirement age that were drawing down from them. We're going into a time frame right now. The baby boomers are hitting 70 and retiring. We're right now transitioning to where there will be more and more retiring baby boomers drawing down from Social Security, and a smaller number of millennials who are paying into the system in order to finance it. So we've got these systems like Social Security and a lot of defined benefit pension systems that are basically Ponzi schemes. They have to fall apart And those promises that have been made to all the hardworking people of the world that they were going to have all these defined benefits and everything's going to be great, those promises will be broken. There's no way around it. Well, what happens when those promises are broken? People are going to be pissed off. They're going to revolt. How is that going to happen? It will probably be violent in a lot of places. Eventually, sometime by about 2030, we've got to get through this as a civilization and figure out what we're going to do. Are we going to, super tax the people that are still working so we can take care of paying out the benefits to the people who are retiring? Are we going to tell the people who are retiring, hey, it was on your watch, guys, that, you might be 70 now, but you were 40 when the 60 Minutes TV show first broadcast the special about how Social Security was going to go broke by 2020. And you didn't do anything about it because you thought that was forever and you didn't have to be worried about it. Well, now the piper has to be paid, and so you're not going to get your benefits. There's going to be huge, huge social divides. And you're already seeing it, with what's going on now in the United States, how the political left and right, which used to be able to air their differences and, go to a cocktail party and you could disagree with the guy who was in the other party, but you could still be civilized. Now we've got riots in Charlottesville and all these crazy things going on. It's going to get much worse. And the reason it's going to get worse is because these institutions like Social Security are not going to be able to make good on their commitments. Meanwhile, the Treasury debt is going to reach a point. For the last 3 presidents, we've had this plan of basically the United States in every presidential cycle over the course of 8 years doubles the national debt. You cannot exponentially double the national debt every 8 years indefinitely. Eventually, it blows up. When do these kinds of things blow up? History teaches us in the second half of a fourth turning, and that's the next 10 years. So it's going to be a really interesting ride. One of the things I want to just end this point on fourth turnings about that Howe emphasizes, it's not necessarily a bad thing. It's a necessary thing. It's going to be a really unpleasant ride for the world, I think, for the next 10 years. But this is how history takes major injustices, like the fact that we've got way too much debt and that we have these unfunded systems, and basically they all culminate together into a really big problem, and then it gets solved. And that solution paves the way for prosperity for the next several decades. So we're going to go through some really difficult things over the next 12 years. And eventually, hopefully, as we go into the 2030s, we will have solved our problems and we'll have a new era of prosperity ahead of us. But right now, we're in the home stretch for what's going to be some really hard times.
Wow.
Glad you asked.
Yeah, absolutely. So I have a few questions. Obviously, I've just been sitting here patiently. 80 years, where does that number come from? Like, why 80-year cycles?
The theory that Howe has, and I don't think Kondratiev had an answer. He came up with about the same number, and he didn't know why. Howe has the theory that it has to do with, it's basically a long human life cycle. And the idea is we learn from our mistakes. We also learn from our parents' mistakes because we saw them being made when we were kids. But we tend not to learn from our grandparents' mistakes because we were either not old enough or not around or whatever. And certainly our great-grandparents' mistakes, that's so far behind us that, we end up repeating all of those mistakes because we didn't learn anything. He has a theory that each generation, he has this idea that the seasons in the economy are really driven by generations of people, and that each generation has a personality. And he has archetypes that he defines, and he says, there's a prophet archetype, which is what the baby boomers fall into. And they have certain characteristics because they were, if you look at the baby boomers, they didn't live through World War II and the Great Depression. So each generation is defined by what it just missed. The baby boomers didn't go through all of that hardship, whereas the silent generation that came before them, they grew up during World War II and they knew what it was like. So I look at my father, who's of the silent generation. I think the guy is just so conservative. He was a little kid through the Great Depression. He saw what debt could do to people. He refused to go into debt, and for his entire life, he was just paranoid about having to save no matter what. The baby boomers, on the other hand, they were fortunate enough to miss the Great Depression and World War II. They never experienced that. All they remember is growing up in the American high in the 1950s and 60s and how great it was. So they're the ones that are much more inclined to go deep into debt because they haven't seen firsthand what can happen when you get over indebted, the way my father's generation has seen. The Generation Xers, they don't remember the American high and all the good times. They were, came up as kids through the 60s and 70s when the American family was falling apart. All of a sudden, kids were kind of bringing themselves up. You didn't have a nuclear family to anything close to the degree it existed in society previously. They learned to fend for themselves, so they were very much individualists. The millennials, on the other hand, were the overprotected kids. They were born in the 1980s when, the baby on board signs were in the back of the car, and they had bicycle helmets, and they were very, very protected by their parents. So they have this attitude of being very, comfortable with sharing with other people. They're very community oriented, whereas the Xers that came before them were much more individualist and were not nearly as comfortable with the so-called sharing economy that the millennials embrace. And then Howe goes on to describe another generation, which is just coming of age, which he calls the Homelanders. And they have the most in common with the silent generation, with my father's generation, because what they don't remember is anything that happened before 9/11 and the great financial crisis. Maybe if they were born in 2004 or something, they were around before the financial crisis, but they weren't old enough to remember it. And so their whole experience in life has been what the GFC and subsequent has been. So he basically says that the major events in history define the personality of these generations. And I just interviewed him on my podcast last week. So for anybody who's interested, there's a full hour-long interview with Neil Howe where he does a much better job than I do of explaining these concepts.
Okay, I can kind of see how that might make sense. One thing I'd like to put forward is the things which drove the markets, hundreds of years ago. Have they fundamentally changed from what drives the markets now, though? Like, wouldn't that throw off the 80-year cycle?
Well, I think it's a totally different game. A mistake you don't want to make is to say, oh, well, it was a Great Depression, financial crisis, followed by a world war, so that has to happen again. That's not the point of the fourth turning. The point is, this is the time when people lose faith in institutions, major institutions that were never questioned before, like the pound sterling being the reserve currency, or Great Britain being the world's largest hegemonic power. The idea that everybody assumes the United States will forever be the strongest military force on the planet and the strongest economy in the world, those are the size things that tend to change in fourth turnings. I don't know what's going to change. So it's not at all that the same stuff that happened last time will happen this time, but things of the same magnitude are likely to happen this time. The things that I look at specifically is really the whole pension crisis. What's going to happen demographically with entitlement programs and government pensions and so forth. You've got one set of problems in the United States. The welfare system in Europe exposes European governments to a huge amount of vulnerability. It's different in different places, but the same theme exists around the world. Another one that I look at a lot is energy, and a concept that I call peak cheap oil, which has to do with, where we're going to get energy in coming years. And, the world's not running out of oil. We're not going to not have any more. But what happens is you end up, the days of just drill a hole in the ground and oil comes out and it's simple, those are gone. We've already found and exploited those energy resources. Right now, shale is the big thing. At some point, shale will play out, and probably deep water will be the next thing after that. At some point, that'll play out, and who knows what's next, whether it's tar sands or deeper water or Arctic deep water, I don't know. But we'll go through waves of new technology being required in order to produce energy. And each new wave of technology comes at cost, and that means that the cost of energy in the economy becomes greater. At the same time, that's being offset with the advancement of technology because, you don't have to travel as much, and a lot of things can happen online, and a lot of collaborative technologies, video conferencing and so forth, reduces the necessity of business travel. So there's a lot of different trends that need to kind of be resolved as we go through this fourth turning and figure out what the next era is going to look like after this. So I think that it's not a question of the same thing happening. It's I think Mark Twain said, history doesn't repeat, but it rhymes. It's not at all that we're going to have the financial crisis followed by the World War. It's that we're going to have major institutions that people assume are never going to change do get changed, and they get changed in ways that nobody ever predicted, and it paves the way to a new form of society. The other thing that I do think is, again, just as every person has their own personality, every generation has its own personality. It's not going to be the same as last time. But what we do see is the individualism that I was brought up with. I was born in the 1960s, and, it's all about freedom and peace movements and so forth. And people were rejecting authority. What's happening now, probably because we're afraid of terrorism or whatever, is the new generation that's coming up, which Howe calls the Homelanders. They're very, very accepting of more government control, more authority. Millennials tend to be just as comfortable, if not more comfortable, with socialism than they are with capitalism. Whereas if you go back 40 or 50 years, if you even mentioned socialism in a favorable context in the McCarthyism era, you could get thrown in jail for that in the United States. These days, Bernie Sanders almost had the nomination for president, and a lot of millennials really think that socialism is a better system of government. So assumptions that we had on the level of whether or not a liberal democracy is the right way to run a government are subject to change. And I think that we're going to see a whole new world in the next 20 years. And at the same time, technology is advancing very quickly, and it's going to create a tremendous amount of investment opportunity. But I think what you've got to do is just be cognizant of where we are. One of the things that just to me is like the sound of fingernails scratching on a chalkboard is when somebody says to me, well, Eric, if you look at every post-war recession, I'm like, wait a minute. If your definition of economic history is what happened post-World War II, maybe that made sense before we got into this fourth turning. But you've got to start looking at a longer cycle of history, because assuming that history, everything changed after World War II and everything's going to stay the same as it's been since World War II. No, we're in the next major change where things that have been stable since World War II are going to start to change in ways that they haven't changed since before World War II. So don't think about every post-war recession. Think about what happened leading up to and going into 1929 and from World War I to World War II and what happened in that period of history. That kind of change, that magnitude of change is possible now. And it doesn't mean I can predict what's going to happen. It doesn't mean that what happened last time is going to happen this time. It just means that we're in for what could be some pretty big changes.
Now, as a trader, how do these cycles drive your investing decisions?
They don't directly drive trades, because if you think about something like, okay, it's a certainty that over the next 10 years, the demographic change is going to put huge pressure on the pension system. I guess you could translate that to a trading strategy, but I don't know how to make a profit next month on that. What it does for me, at least, is it causes me to focus on the things that I think are going to be important. So I've become extremely focused on crude oil because I see what's going to happen with this peak cheap oil phenomenon that I described earlier. Ironically, the fact that I'm definitely a peak cheap oil guy, I'm very, very fascinated by the theory of peak oil. It doesn't mean that I think oil prices are going up. I'm bearish on oil prices right now because what's happened is post the great financial crisis, we've had so much easy money in the system that it's led to a malinvestment of overproduction capacity in the shale patch in the United States. So it doesn't mean that maybe the thing you might logically assume is the long-term outcome is what you want to bet on. But the reason that I understand what's going on with the shale patch in the United States and why now is a good time to be actually, I think, bearish on crude oil prices, it's because I have this longer term view and this fascination with the big picture. Whether or not we're going to see another test of, sub $30 oil prices like we had a little over a year ago, I don't know. But if we do, it's going to be a buying opportunity of a lifetime, I think, especially if the longer dated futures contracts come down to a lower level. Last time we got to $26 oil, it was a little bit of an illusion because the long dated futures were still above $50. If we see long dated futures come below $40 or even below $30, it's going to be a fantastic long-term buying opportunity, because I don't know what the next year or two is going to look like. But I can tell you, as we get into the early 2020s, 2021, 2022, we are so not investing in capex right now in oil. Right now, we are oversupplied with shale. Well, shale is going to play out. There's only so many rock formations that are capable of producing this shale oil, and they have very rapid decline rates. So once all those shale oils get drilled and those resources are exploited and we start to go into deep decline, we're going to be hurting, and we're going to be hurting in a big way. Well, why do I know that that's coming? And it's really from the fourth turning concept where I get these big themes. As I learn in detail about those big themes, it oftentimes gives me a reverse trade. I'm right now I'm bearish on oil prices because of what I see going on in the energy markets now. How did I get so interested in the energy markets? Why do I pay so much attention to them? Because I can see that a really big move in the other direction is coming eventually. A similar analog to that would be something like the U.S. dollar. I have a view based on my long-term fourth turning view of where the world is headed, that the U.S. dollar will eventually lose its reserve currency status, and the U.S. Treasury market will be in really big trouble. So does that mean that I'm short the dollar and I'm in this dollar is going to crash camp? No, actually, right now, I think that we're probably looking at a buy the dip opportunity in the dollar. I'm not quite sure that it's over yet, but it's got to be pretty close. And I think the dollar is going to appreciate dramatically. Well, why do I think that? Isn't that opposite of what I just said my long-term view is? Well, it is opposite of the long-term view, but my long-term view causes me to get really fascinated with this and to understand that for now, there is no viable alternative to the U.S. Treasury bond market for central bank reserve assets. There's a lot of people around the world that want there to be one. Russia and China are working pretty hard to try to figure out how to create one, but it doesn't exist yet. And what that means is that as we come into some of these hard times that I see on the horizon, and we're very much overdue for a recession now. This bull market that we've had since 2009 is way long in the tooth. I don't know when it's coming, but you can't go forever without a recession. When we get to a recession and there's flight capital, there's so much structural problems in Europe and in Japan that distressed capital in Europe and Japan is going to experience a flight to safety trade. And I predict that it's going to push the US dollar into probably all-time highs. So, on the one hand, I have a long-term view that the US dollar will lose its reserve currency status, but I can also see that that cannot possibly happen right now. And what that means is that what will likely happen next is as we run into problems around the world, more and more flight capital will flow into U.S. dollars, appreciating the U.S. dollar to the point where it causes more problems in the global economy, probably another emerging markets crisis as we had in the late 90s. And that may lead to another Plaza Accord type of deal where governments agree to conspire to do what they can to suppress the dollar. And certainly President Trump has expressed a view that he wants to prevent the U.S. dollar from appreciating too much farther than it already had. So, these things don't necessarily mean that the trade right now is determined by the long-term view. But the long-term view is what tells me which markets are fascinating and which markets are most important to pay attention to. And then as I get into learning more and more about those markets, I develop where's the trading strategy. And so my macro view now is bullish U.S. dollars, although we've been in I was long U.S. dollar index futures. I've gotten out of that trade just because we've had this big downdraft. I'm not sure if it's over yet. At some point, I'll get back into long U.S. dollars. Someday I'll be long crude oil, but right now I'm short crude oil. So I learn about the markets that are most interesting from my long-term fourth turning view, but what I learn about them teaches me which way to place my bets, and that's something that is in a much shorter time cycle than the long-term view.
Got it. Okay. No, that makes sense. I see where you're coming from. Eric, I would like to speak with you about your views and your outlook on cryptocurrencies. So how do you feel about cryptocurrencies? How do you see them coming into play in the future?
Oh boy, well, we're in trouble now because I'm afraid I'm going to offend your cryptocurrency fans in the audience. So I've got to first preface this, Aaron, by saying this is not what I want, people. I have predictions about cryptocurrencies that you're not going to like, and I don't like it either, but it's what I think is going to happen. Everybody's so excited about whether it's Bitcoin or Ethereum or whatever, these wonderful innovations and inventions that technologists have come up with to say, look, here's a way to design a currency which is basically government interference proof. You can have secure payments online with Bitcoin. It's completely anonymous. Nobody knows who owns these Bitcoins. The government can't possibly manage it or track it or seize it or control it. And, as long as you have this ability to transact in Bitcoins, it all occurs online. It's anonymous and it's fantastic. It's great. I love those concepts. So please don't think, listeners, that I don't like the idea. I just don't think that it's going to be allowed to exist. And my prediction, unfortunately, I stress, unfortunately, I don't like this, is I think that governments are going to hijack all of the best technological innovations from the first generation cryptocurrencies like Bitcoin. So the whole blockchain idea, which is absolutely brilliant from a software engineer's perspective, I mean, really genius level stuff that's going on there. I think it's going to be hijacked by governments to design a government-backed cryptocurrency that will have exactly the opposite set of design criteria, where Bitcoin is completely tamper-proof and the government can't interfere with it. The government can't monitor your transactions and so forth. I think that governments, and I'm not sure which government, it'll probably be kind of an arms race between governments to see who can control this. But one of the potential ways that the US dollar might be displaced as the world's reserve currency is by a government-backed cryptocurrency. And by the way, this is not just fantasy science fiction stuff. People's Bank of China is hiring blockchain engineers right now to work on the digital RMB and designing what it will be. And I don't know what it's going to be. What I fear is that some government is going to come up with a design for a cryptocurrency, which is the antithesis of Bitcoin. It guarantees that the government can always track and know exactly who has every penny of worth anywhere in the financial system. There is no cash. Cash gets outlawed. First generation cryptocurrencies like Bitcoin get outlawed. And furthermore, governments enact laws that say anybody caught having first generation cryptocurrencies, such as Bitcoins, will be subject to forfeiting them. You get caught with them, the government confiscates them, and you forfeit their value. That's the way governments do things. And unfortunately, what in this environment, in this social environment we're in, all that governments have to do is say, this is necessary to fight terrorism. Bitcoin is the tool of terrorists. It's a way to transact and finance terrorism internationally and anonymously. And the only people that would ever want to have anything to do with it are bad guys that are either terrorists or trying to finance terrorists. The good currency is the government-backed cryptocurrency, which stole all of its technical innovations from the Bitcoin and other first-generation cryptocurrencies. But what it does is it says in order to have a wallet, that wallet has to be registered with a government someplace, and any wallet that's not registered is subject to forfeiture, and the government knows exactly how much you've got, exactly when you got it, who you got it from, and they might even have the ability to claw back transactions. So imagine that news story that came out a couple of years ago where the guy in Texas sells his pickup truck to a car dealer, perfectly innocent transaction. It's got his plumbing, the guy was a plumber, and it's got the advertising for his plumbing business on the door of the pickup truck. Somehow, some way, that pickup truck finds its way to Iraq, and there is ISIS fighters with a machine gun mounted on the back of this thing, and they're going around and killing people with this guy's pickup truck. Imagine the government saying, okay, we want to punish ISIS. We're going to unwind that transaction. And now all of a sudden, the poor guy in Texas doesn't have the money in his bank account anymore because they've decided that pickup truck never should have been in the hands of ISIS fighters. Well, he didn't do anything wrong. My prediction is he would have to fight to get the money back, because just the way the chargeback system works for anybody who's a MasterCard or Visa merchant, first the money is gone from your merchant account, and then you get to contest it and try to fight to get it back if you're willing to put the effort into doing it. So this whole business of IRS, having to chase you down and figure out where your offshore bank accounts are, they won't have to do it anymore. It'll all be online. They'll be able to seize your bank account, freeze your accounts with a click of a mouse, probably without a court order. I don't like any of this, folks, but if I think about what's likely to really happen, governments will figure out that Bitcoin is every bit as much of a threat to them as it was designed to be. And it was designed to be a threat to them. It was designed to give people the financial freedom and independence of not being subject to the overreach of government. Government doesn't see it as overreach. They see it as their calling, as their mission, as their duty. And they, in this social environment, can very easily get away with just about anything by saying it's necessary in order to fight terrorism, to outlaw Bitcoin, outlaw Ethereum, and instead have a cryptocurrency which is designed and built by governments for governments to give the government complete and total control over everything. And anybody who doesn't like it is automatically assumed to be a tax cheat or a terrorist or someone who wants to finance terrorists or something. I don't like any part of that story, but I think that is far more likely to play out in real life than this pipe dream that libertarians have, that, Bitcoin's going to change everything and everybody's going to go to Bitcoin and we'll be able to have all of this free commerce occur online and the government won't be able to tamper with or interfere or tax it. That's not going to happen. The government's going to outlaw this stuff because it's not in their interest. It's in the people's interest. Government doesn't do what's in the people's interest. Government does what's in the government's interest. And I fear that the best innovations of Bitcoin will be stolen and hijacked by governments to build something. I call this new cryptocurrency the Orwell, because that's really what it is.
Now, you obviously speak to a lot more macro traders than I do. Has anyone you've spoken to share a similar view on this subject?
On cryptocurrencies specifically, since I espoused that view on my podcast, I've heard from several people who are blockchain engineers who have said, we basically resigned ourselves to this idea at least a couple of years ago. A lot of people in the cryptocurrency space have a similar view, but they see it differently than I do. I fear that what I just described could be inevitable. The way that a lot of people in the cryptocurrency space see it is they say, okay, we know this is coming. We're going to have to think about competing. If the government introduces the official cryptocurrency, which is government backed, and they're telling people that only bad guys would ever want to deal with Bitcoin, how do we, if we're the Bitcoin side of this, position ourselves to compete? And they think of it in terms of, if you are selling the benefits, if it was a free choice of, do you want to put you got to get out of US dollars because there's not going to be cash anymore? Are you going to get into Bitcoin, or are you going to get into the Orwell, which is what the government's telling you to get into? Here's why you should get into Bitcoin. So I think there are a lot of people in the cryptocurrency space who see the threat of a government-backed cryptocurrency that has all of these features that are designed to control and tax people, as opposed to features that are designed to protect people from excessive government control. They see it coming. They see it as a threat, but they're thinking about it in terms of how they compete with it. What I fear is they won't be able to compete with it because it will be just outlawed by government. And unfortunately, if you look at everything that's going on in society, when the government announces that something is bad and it's the tool of terrorists, it gets outlawed and very few people push back on it. So I think that if there is a chance to not have the Orwell take over as the government imposed cryptocurrency, it has to be through some kind of marketing campaign where the Bitcoins and Ethereums of the world sell the message to people that, look, we don't need the government to control our lives and to be able to tax everything. It's better to have free commerce. It's better to have a Bitcoin type of currency than an Orwell type of currency. I hope they can be successful enough, but you've got to win over enough people to overcome the government's ability to just outlaw the other currencies. I hope that they can succeed at doing that, but that's the place where I've heard about it from other people, is people in the cryptocurrency space thinking about how they're going to organize their messaging to sell the general public on the idea that a government-controlled cryptocurrency is a bad idea and a private cryptocurrency is the right thing.
Sounds pretty frightening.
It is frightening, and unfortunately, this is what happens with these cycles in history. Is the time, and you've got to be careful to. If there's any lesson I've learned, I was born in 1965. My generation was brought up in public school to think that our job was to question authority and to not let the government push us around and abuse our rights. That's not what they're teaching in grade school today. And you've got to understand, even if you feel, I'm 52, if you are my age and you feel like that would never happen because the people would never tolerate it. Well, wait a minute. You and I and the rest of our generation might not want to tolerate it, but younger generations are starting to be brought up to really believe that, socialism is better, greater government control. It's more important to do something about enforcing on and dealing with tax cheats and bringing people who cheat their taxes to account than it is to have financial freedom. That mindset is not something that resonates naturally to my generation, but we're not going to always be in charge. And there are other generations that feel very differently. So my message to anyone is don't just think about how you feel about these things. Talk to other people in other generations and how would they vote if the government is saying that in order to cope with tax cheats, in order to deal with these filthy rich 1%ers who are not paying their fair share, we've got to eliminate cash, eliminate first-generation cryptocurrencies like Bitcoin, outlaw them, and instead have a government-sponsored cryptocurrency which allows the government to make sure that those nasty 1%ers are not getting away with cheating on their taxes the way they have been for too long. You and I might say, wait a minute, that's BS. A lot of people would say, hey, that's welcome. Let's get the government going on that so that we can do something about those nasty 1%ers, whoever they are. And it's really not 1%ers. The true 1%ers, which are really about 1/10 of 1%, know how to game the system. They're going to be taken care of no matter what. In terms of economic freedom for the rest of us, I'm afraid that we're in a generational period where the government will likely be able to put an end to things like Bitcoin. Right now, it's not big enough to cause any problems, but I'm afraid that it's going to be outlawed eventually.
So when you talk about a government-backed cryptocurrency, are you talking about, just as an example, just the US government has like the equivalent of US dollars as a cryptocurrency, or are you talking about government-backed in the forms of like, I don't know, several countries involved in this, having one like maybe not global, but kind of universal?
Well, the prediction that I make about this is there's going to be an arms race. And if you think about the Cold War arms race, it's who can get control of space and who can get control of intercontinental ballistic missile capability and so on and so forth, who can get it first. I think that the arms race will be between the private cryptocurrencies and government backed, and it will also be consortiums of multiple nations. I think that China and Russia are probably already working together on this because China and Russia have been working together on this de-dollarization idea that Sergei Glaziev, who's a Russian scholar and an advisor to Vladimir Putin, have espoused, that they need to try to use whatever influence they have to get people to stop transacting in U.S. dollars so that the U.S. stops having this exorbitant privilege of being able to go into debt for free. I think that the outcome is unknowable, but it just as the outcome of the arms race was unknowable. But there's going to be an arms race. It's going to be a realization, just as at some point somebody figured out, wait a minute, if you've got control of space, which means that you've got satellites in orbit that could drop a warhead on any spot any minute. You've got total, okay, suddenly there's a space race, and supposedly it was about landing a man on the moon for the sake of humanity. It was really about let's develop space technology for military benefit, and both the U.S. and the Russians were doing it. I think that what people are going to figure out, both the private cryptocurrencies as well as governments around the world, is they're going to say, wait a minute, the U.S. dollar cannot go on forever. Robert Triffin was right in the 1960s when he said that eventually the U.S. dollar had to be displaced by something else as the world's reserve currency. At the same time, you've got a lot of pressure from governments around the world right now that they want to ban cash. And they want to ban cash for one reason, which is, not fighting terrorism and so forth. That's the one that sells well to the public. The one that they really want to ban cash for is it enables negative interest rates as a monetary policy tool. The reason for that is if you have cash, you try to go to deeply negative interest rates, it creates a financial incentive for people to hoard cash, which could cause a run on the fractional reserve banking system. You can overcome that problem by outlawing cash. So governments want to outlaw cash. They see this as the future. What's going to happen is, just as there was that aha moment where somebody said, wait a minute, whoever controls space is basically top dog military. They've got unlimited power over everybody else. They're going to say, wait a minute, whoever figures out the cryptocurrency that could replace the U.S. dollar as the world's reserve currency, whoever that is just in an incredible position of advantage. We've got to figure out how to make it be us. So I think that whether it's, the Ethereum people from a private cryptocurrency standpoint, or Russia and China working together, U.S. government seems to be slow to get to the game here, but eventually they'll figure it out. And they'll say, no, the U.S. dollar has to be the world's reserve currency forever. We just need to turn it into the digital dollar, which will have this new feature of being completely trackable for the sake of fighting terrorists and tax cheats, because those are the bad guys that the public will resonate with and want to help the government to fight. The fact that it's really to be able to monitor and control all of your financial transactions, they're not going to tell you that. But it has to be the U.S. dollar because, the U.S. dollar is the center of the world. This is going to be an arms race. And I think that you'll see competing technologies. The U.S. government looks like it's going to be slow to join the game in terms of trying to develop a government-sponsored cryptocurrency. At the same time, they have more money than anybody else. So once they figure out that they're late to the game, they'll probably spend a whole lot trying to develop it. The private cryptocurrencies are going to make the very good argument, the very valid argument, that it makes much more sense to put your faith in something like Bitcoin, which is mathematically safe. It's not controlled and governed by anybody. It's designed in a way with open source software where you can independently verify that it is safe, and it's a way to transact business that is immune from any government's interference. That if you're a libertarian, you're just loving that story. The thing is, libertarians are considered nut jobs by most of society. The idea that the government should be able to monitor and control everything for the greater good of humanity in order to fight terrorism and tax cheats, that resonates with the majority of the population. That's what they're going to vote for. And I think the private cryptocurrencies are going to do everything they can to educate people to see it a different way. I wouldn't be surprised if Russia and China, one of the angles I've thought about, I haven't really figured out the details, is Russia and China collectively have enough gold between them that they could do a government-sponsored cryptocurrency that differentiates itself from other cryptocurrencies by having some kind of gold backing behind it. So it's a combination of a gold-backed currency and a cryptocurrency that enables a cashless society and online transactions and so forth. Another question that you have to ask yourself is, suppose you're not the U.S. government, but you're one of the smaller governments, let's say Russia and China. Do you go down the whole path that I described of the Orwell, the currency which is totally controllable by governments? Or do you say, wait a minute, if we're Russia and China and we try to do that, the U.S. is going to do one that's probably going to beat us? What if we take if you can't beat them, join them approach? What if we partner with the Ethereum guys? And by the way, Putin already met with the Ethereum guys. So stuff's happening in this space. What if we partnered with them and it was government backed, and so that kind of gives it credibility. But rather than fight the private guys, at least for now in the first generation, we'll go ahead and get on board with this privacy thing so we can sell it to the people who respond to that message. And we'll try to assert it that way. Are they going to do that, or are they going to go the approach of monitor and control everything for giving the government more control? I don't know. There's an argument that clearly governments always want control if they can get it. But if they perceive that government control is going to be an objection to whatever the U.S. comes up with, maybe what Russia and China do avoids that kind of control and looks more like Bitcoin in order to appeal to a different audience. At some point, I think before this fourth turning is over, by 2030, we're going to have a showdown, and we're going to get to figuring out what the cashless could even turn into a global currency, but the replacement for the U.S. dollar as reserve currency is going to look like. And I think it's a completely open game. The arms race has just begun.
Just to close this out here, can you actually speak about the real dangers of becoming a cashless society? Like, what are the implications of that?
Well, there's a lot of dangers. I mean, the first one is, the Orwellian reference. You're getting to a point where you could have abuses of human rights by governments, which is something that a lot of people don't worry too much about. I worry a lot about it. You definitely get to a problem that almost nobody thinks about anymore, which is, things break. We do have power outages. If you had a truly cashless society, and imagine you've got a world where everything, your cell phone has an RFID chip in it or anything, you can just swipe it and use your thumbprint to authenticate yourself and pay for anything instantaneously online with this system. It probably has credit integrated with it too, so you can pay with borrowed money if you want to, and it's all integrated. Sounds really cool. Well, what happens when the power's out and the thing's not working and there is no cash anymore? So there has to be cash, at least small amounts of cash, just so you can deal with situations where you're offline, you're not in, there's no Wi-Fi. What do you do on a boat to pay for, you're on a cruise someplace and you're out of range of internet connectivity? How do you pay for a beer? There has to be some kind of cash. How does that get resolved? That's got to be part of this. I think that it has a lot of complexities, and the other thing is that no matter how hack-proof anything supposedly is. I was a hacker when I was in high school. It's a question of just the hackers figuring out a way to think outside the box and figure out a way to do something that couldn't be done before. Cryptocurrencies do rely on encryption to some extent. Quantum computing potentially has the ability in coming years to just orders of magnitude change in how long it takes to factor a key. And this is a computer science thing, but when you have all these big encrypted systems, it's always possible to crack that code by a process called factoring, which is you figure out all of the prime numbers that eventually got multiplied together to come up with that encryption key. It's a very, very compute-centric cycle. So the way they design these things is say, okay, how long would it take the world's fastest computer to factor this key that we're designing? Well, 250 years. Okay, it's safe because we're going to expire the key every 20 minutes. So there's no possible way anybody could ever crack it. Well, until somebody figures out some massively parallel computing solution that can crack it in that amount of time. So, there's always a way for things to get hacked. And if you have everything on a cashless system, there is, and even if somebody can't steal the money, if they can just shut it down so that it stops working, and that causes society to grind to a halt. Imagine somebody ransoming governments of the world, saying, give me $1 billion to turn the power back on, basically, to your cashless society system because they found a way to defeat it somehow. There's all kinds of risks. And what always happens, especially with governments, is they assume that based on current assumptions about available technology, about available computing horsepower, that it's going to be impossible to crack something. And what happens is, it's the old mistake of every, every generation of software engineers. There's no reason to accommodate more than 640K bytes of memory because it's impossible that anybody would ever want to write a program bigger than that. That was the limitation of MS-DOS. And of course, memory got cheaper. And all of a sudden, these days, 640K is nothing. But that was the big limitation for years and years because somebody made the assumption that nobody would ever want it. Somebody will make the assumption that, a key of a certain strength can never be cracked. And it won't be crackable for a while until it is. And then it will be. And then what happens? So there's all kinds of risk to this. But I think the biggest ones really are that we get to a point, and this is just my personal political view. Some people, certainly can have the opposite view. But it's the George Orwell prediction. I think that if you get to the point where the government can monitor all financial transactions of all people on the planet, that's a really, really bad thing, not a good thing. It doesn't make us safer. It makes the world more dangerous, not less dangerous. And, I'm not going to get into, a philosophical thing about my personal political beliefs. I know a lot of people feel the opposite way. I guess I'd say look at history.
I don't know. It's very interesting to me, and it's also very frightening at the same time. Like, I can see how things could very easily go wrong. But anyway, let's save the rest of that for another day. I mean, I'm sure we could very easily turn this into a 3-hour podcast. But Eric, it's been an absolute pleasure having you on the podcast. Now, I know you also have your own podcast, Macro Voices. If someone wants to tune into that podcast and check it out, where's the best place to go?
It's macrovoices.com is the website, or you can just put Macro Voices into iTunes and subscribe for free. Similar to your show, it's always free, and it's a different format. What I tend to focus on, you've got, well, actually, between Kevin Muir last week and me, maybe we're going to have a little macro takeover of Chat with Traders. But, where your heritage has been very focused on traders and technical analysis and so forth, my podcast is all about these longer term views and getting macro experts on the show. So it's macrovoices.com, or find us on iTunes, and it's a free subscription.
Okay, and you're also on Twitter as well. If someone wants to follow you, what's the best handle?
Sure. At Eric S. Townsend, ERIKS, as in Scott Townsend, TOWNSEND, or at Macro Voices, either one.
Very good. Cool, man. We'll have to do this again sometime, eh? I've really enjoyed it. Thank you.
I have too. I've very much enjoyed it. And, the things that I predict in terms of, what could happen, that's one scenario. I'm not necessarily saying that's going to happen. What I am predicting very strongly, though, is governments are not going to stand by and let the libertarian features of cryptocurrencies just blossom. There's going to be resistance. Exactly how it plays out, I don't know. Nobody knows. But it's going to be an arms race, and it's going to be very interesting to see what happens.
Have you done some episodes about this on your podcast?
We've talked, I think I probably talked more about it in this podcast than I have on my own podcast, which is interesting. I think it was the end, Pippa Malmgren, who's a fantastic interview if you want to do more macro stuff, had her on the program recently. She's a geopolitical analyst. She's been an advisor to several U.S. presidents. She brought up cryptocurrencies, and it was in the post-game segment after her interview that Patrick, my co-host, and I talked a bit about crypto. But I think that's the only time we covered it on the show.
Okay. Well, I'll dig up a link to that episode, and I'll make sure to include it in the show notes. So, yeah, once again, Eric, thank you very much for doing this.
My pleasure.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey guys, what's good? Right now you're plugged into episode 142, and I have a little fun fact for you, and this was totally unintentional, I promise. But exactly 100 episodes ago, I had Bert Moeller on the podcast for episode 42. This week, 100 episodes on, he joins us once again. Bert is an algorithmic trader with a serious focus on machine learning. His trading decisions are driven purely by data, and he goes to great lengths to remove human flaws and human bias through the use of automation. So coming up over the next 60 minutes or so, you'll hear about Bert's increasing efforts to automate as many decisions as possible, the attraction of markets and areas with less sophisticated participants, other potential sources of edge beyond alpha, a peek into Bert's high-frequency market-making strategy, and that's certainly not all. Now, I thought I should just throw this in there, but I can understand if some of Bert's ideas might seem a little abstract at first to some listeners, but one thing I would really like to encourage is that you do listen through this episode with an open mind, because that's what I like about Bert, his willingness to think differently and get creative. And once you get to the end, if you have a question, you're welcome to post that question in the comments area on the website at chatwithtraders.com/142. And Bert will do his best to respond with an answer for you, which is nice of him to offer. Anyway, ladies and gents, for a second time, here is Bert Moeller. You know, Bert, good to be speaking with you, man. You were first on the podcast. I think it was October 2015. Let me ask, how have you been? How's things tracking?
Absolutely super. Everything's been going really well. Been applying the same stuff we talked about back then. Learned many, many new things as well. And yeah.
And whereabouts are you living these days? I know you've sort of been bouncing back and forth between San Francisco and Russia and probably a couple other places. Whereabouts are you mainly set up now?
In SF right now, just kind of focusing my time over here because there's so many opportunities just in general in the trading world and, in blockchain world. And actually a lot of different markets opening up. I think there's a couple of things in the world going on that are kind of changing the fabric of reality, as I like to call it.
Yeah, I mean, if we have a bit of time at the end, I'd love to talk to you about some of those things. But to start with, let's focus in on your trading, most important. So, last time you were on, I think it was the first time we really kind of got into machine learning on the podcast. I think that was episode 42. So there's since been a few episodes where we've discussed machine learning at length as well. I want to ask, is machine learning still a key part of how you're developing your strategies today?
Absolutely. I think when we spoke last, I was still maybe, let's say, picking some instruments myself, picking maybe some features myself, doing certain stuff myself. I mean, it's either someone on my team or me doing it, but we've moved almost entirely away from any human decision making. The only thing that we decide is the kind of, if we're trading equities, the sector that we're trading maybe. So that we, don't end up randomly picking like 10 stocks that are all in the silver mining space.
So how do you even begin to do that type of thing?
You got to lay out your process. I mean, actually, the process is laid out for like a single ticker system in many books. There's different processes, obviously, but you just write down your process for alpha generation, then your process for money management, for everything, and you just see where you can automate, where you're making decisions as a human being, and which one of those steps you can remove from yourself, so the computer will do it instead.
So what's been the driving factor for wanting to remove as much human decision as possible? I mean, I understand it to a large extent, but why do you even want to remove the type of symbols that you're picking?
It's just because there's so much bias, and it's on a lot of it is on a completely subconscious level. I'm sure you have the experience where all of a sudden you learn a new word, right? And you start seeing it everywhere. And a lot of people would say that it's because you're now recognizing the familiar, right? But that stuff definitely exists, those kind of phenomena. And that kind of thing can, for example, today for the first time in the restaurant, they asked you what kind of ketchup you want, Heinz or something else. And you're like, shit, the word Heinz, the company name could just get stuck in the back of your mind. And when you're picking equities, maybe it seems random out of 60, but you saw the Heinz sticker, and you pick that. You don't know that that's not happening. And that's a bias. I mean, it could be bad or good in that sense. It's, the problem is, I was going to say, that it's maybe harmless, but in my experience, there's very few things that go wrong and are harmless. It's better to take something random than something biased. Does that make any sense?
It does, yeah. So ultimately, you're just trying to remove as much bias as possible, yeah?
Yeah, it's just no outside information. Because look, you're still a person, right? You're talking to different people. You're going out socializing, maybe not even with trading people. I give you an example. I was speaking to my mother recently, and Bitcoin was down, and she's like, "You have to buy it. It's gonna go up. You have to buy it. It's gonna go up. Don't be afraid. Just buy it. And I'm like, that's crazy. And obviously I sold it. But still, it's hard to use those things properly. So very disciplined people, I guess, are kind of curating their human bias sources can do what I told you I did, like, systematically. But I don't think I could, that bias still kind of creeps in my head. Maybe one day I will buy, because so many people told me I should. So it's tough, and the problem is you don't answer it systematically yourself. Like, it would be okay if you had a biased, input, and then you always had a, way to answer it in a very specific way, given it's, biased in a certain way. But you don't, sometimes you're tired and you give up to the bias. And sometimes you're not tired at all and you're, really vigilant about the way you're thinking. But, you can't bet on that.
Okay. So, I guess there must be a point where you have to define the universe of either stocks or various products or certain markets which you are going to look at. Let's say you're trying to develop a single stock strategy, okay, just for argument's sake. There must be a point where you actually define from a very high level the type of universe to look through to feed into your machine learning algorithms, essentially. Does that make sense?
It does, absolutely. And it's going to touch on a topic that I hope we'll cover later. But I look at it like this. Every single person every market, has different players, right? So every market is a different game, right? And you have different, different things that kind of go for you and against you in playing this game, right? So, for example, you could be are really, you could be really good at programming FPGAs, right? But you're not that good at trading. But there's arbitrage opportunities that exist, right? So going to the US and trading on the US markets would be difficult, because a lot of people there are trading, a lot of capital, a lot of smart people. They have teams with people like you that just do the programming for the FPGA, and then tons of PhDs that do all the other stuff, the alpha generation. But you know what? Maybe in India, where not 50% of the trades are electronically executed, right? Or submitted, I guess. Maybe there is no such competition over there. Maybe just being fast enough would allow you to do certain types of arbitrage, right? So you have to kind of evaluate your position, right? And the positions that the exchanges, the venues, the games that you can play. And that includes, what is your commission structure? Is it, for example, if you're comfortable holding overnight, that could be a source of huge return because you're comfortable taking the overnight risk, right? So your position does include your risk profile. And so, maybe it's the case that, you have access to, Australian and Indian equities. And yeah, their market size is not the same as the SPY, but unless I'm trying to manage, $10 billion, does it really matter? And don't you want to go to the place with the, highest risk reward? So you have to look at it like that. Maybe there's some other places that, maybe it's not so hard to earn money, or as hard as it is in other markets. I mean, I've definitely found that to be the case. I mean, there are markets that are easier or more difficult, depending on what you're doing, right? For example, if you enter any of the US indices randomly and hold for 3 months, or hold for even a random number of bars, all on a long-term kind of scale, let's say a month and above, you're going to be pretty positive on every equity curve because they're almost always, go back up no matter what. If you get a little smarter and say, at a X% drawdown, randomly buy, you're also going to be doing pretty well. On the short side, it's going to be the opposite because it's, long biased. You got to think about this stuff, right? Maybe you don't want that. Maybe you're selling freaking, straddles and options and you actually want something that doesn't move at all. Or you want something that moves a ton, but in a range, so you gotta, and of course these are assumptions and there's no guarantee that any of these, characteristics of any market that we're just, talking about are going to last into the future. However, it's fair to say that, there's so people will take this to the extreme and say, you can't conclude anything, but you have to conclude something to play, right? So you gotta pick the conclusions and the biases that are least detrimental, right? So I can expect volatility in general to go to be low, to fall with time, because that's how it works, as in if I short the VXX, right? So if I hold an option and all else is equal, it'll fall. I mean, that's a structure of the instrument, the price.
Sure. So just before we move too far away from what we're talking about initially, I just have another question around that. That's right. Okay. So you are using computers and algos to go as far as pick the certain symbols that you are trading certain strategies with. Is there any human intervention before that strategy is actually live trading that symbol?
Well, yeah, we still look through I think it's important. So we can automate everything and we have automated everything, yet I still personally look through the equity curve of every single strategy that we trade. And I don't, I do that because of course, from a risk perspective is, what I should be saying, but unfortunately you have no freaking clue, right? So people that tell you they look over it, but with their eyes because they, they can tell what's kind of BS, what's not. They can't. And if they could, why are they using computers and machine learning, right? But it does help you learn, right? And what it helps you learn is, holy shit, I've on all U.S. equities, right? Buying when there's, when 90% of all equities post a down day is a good day, holding for a day, right? Because you saw that that's a feature that's in every single system that you've been generating in the past month as you've been focusing on equities, for example, right? I mean, you got to learn what it is that moves markets. And it's very often, it's very often people talk about the truth. And it's another thing. This all ties together. what's the truth, right? Are we really looking for the truth? Imagine a analyst, right? He's a bad guy, right? And he shorted Apple, and then he sent out a rumor that, Apple is bankrupt, let's say. I mean, whatever. And that's not true, right? And by efficient market hypothesis and whatnot, right? It should basically not be priced into the market, it should have minimal impact because, well, it's just bullshit. Some guy just talking, right? It's the same thing as some guy in a forum saying something. But the price on many equities actually would move down in these cases, even on a rumor of some totally false information, right? So to me, that's reality because that's all I care about. Even though the information, in the way that we would just, talk about it in our world, it's not legitimate. It's not real. It's fake, but it's very real because it moved the price. And, you got to distinguish between these two things. People really talk about the stuff that they know as in, gold and silver will be co-integrated, right? But, that doesn't necessarily hold, I know these are outlandish scenarios, but let's say they found out how to, extract silver for free, or let's say a big meteorite of gold fell somewhere else, in the world, from space, we talked about this a little bit before, but all those things should kind of, or have the potential to break these, relationships of correlation and co-integration that, been around. Look at LTCM. There you go. They also thought that all their relationships would hold until they didn't. Right. So it's all about risk management in that respect, because you never know.
Okay. So ultimately, before any strategy is live traded, you do decide whether that's a symbol you want to be participating in or not. Yeah.
So I don't decide, right? The only thing I decide on is basically if I feel the times I would reject is if I feel, and because we trade many, many strategies, this isn't that big of a deal. It is still introducing bias, but, let's say I feel that this strategy is a little lacking on the trade to parameter ratio, right? Maybe it's not, I don't feel like it has as much, it doesn't have as many trades out of sample. I'm not as confident in the results that I'm going to get. So maybe I don't necessarily want to be, trading that. And maybe let's say, I don't know. For example, Stericycle is a stock that went up and 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 then got sued or something like that. And it just goes down, 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 down. It may happen because we don't look at the instruments that we're kind of working with beforehand. It may happen that became a really good candidate for a long only system, right? Because the entire in sample for 30 years, it was just going up. But then the past 5 years, it literally has just been going straight down. And it has legal troubles once you look at it. So that kind of stuff I'd like to remove, if that's a long only system. If it's a long short system, no problem.
Now, you mentioned in your answer there, trade to parameter ratio.
Mm-hmm.
What sort of ratio do you look for ideally?
I don't know, 30, probably, 20, 30 minimal. I'd like to see 50 out of sample trades to a number of parameters. That's a lot. But, yeah, it's, I don't know. Most people I consult, so I do some consulting for some startups and some hedge funds, and most of them, obviously their stuff doesn't work, right? But, they're using sometimes 3 trades in the out of sample, for, 20 parameters, for example, which is crazy. It's just the more the better, right? Because if you have 100 strategies with Sharpe 0.1, right, you can make a really high Sharpe strategy, portfolio of strategies out of that. So you're actually should be worried again, and we discussed this on our last time we spoke. You should be worried not about highest performance in the out of sample, not about highest performance in the in sample, but about the highest so that the in sample and the out of sample always match as much as possible. As in the out of sample matches the in sample as much as possible.
Right. Yeah, that's actually a really good point. And that's something that you don't actually hear many people talking about. It is because you really want that consistency, right?
Yeah, it doesn't make any sense to me. It's complete. Most people that I speak to, I feel like they're not even working. They're never going to find the solution because they're trying to solve not the right problem. Right. It's pretty crazy. I never see that. I never see I tested all my machine learning by going back, let's say, and taking I don't know, 1990 to 2000 and kind of seeing what works from 2000 to 2015 or 2010, right? Just seeing what works. What were like the instruments that were reasonable to trade with using the methods that I'm using? What were the, the features that were kind of reasonable to include? What kind of performance degradation can I expect? And I don't really see studies of that like anywhere. It kind of blows my mind.
So if you were to see something that performed well in sample, and then you ran it out of sample and it performed spectacularly better, that would be a slight red flag for you?
So not usually. And usually those things are associated with like infrastructure changes. So let's say we're going back to that stair cycle example when it went up for a long time and then it just started going down, down, down. So like it's very likely there was like a structural change in the instrument, right? Or on the, in the trading environment of the instrument. So basically like there's a huge lawsuit. Everyone's afraid, went from holy shit, the company is going to be the number one, ecological company in the world to, oh my God, we're about to go bankrupt because we're going to get sued. And then if you were trading a short system, let's say all the way up while it was going up and up and up and up, but it was, it was short term. So I was making money. And then once it starts going down like crazy, obviously the short system is going to really excel. And in fact, so I do introduce a little bit of bias like this, but it's a bias that, so for example, getting a system to work short only on like, let's say you trade, let's say the ES, it's an easier example. Everyone knows what the ES looks like, right? So you get it to work short only, on, let's say 1980 to 1999, right? And then you test it during QE, right? And it still does really well, right? So that's something that I wouldn't really discount, right? That's because it's trading against the trend. You just basically have to see what, is your strategy trading long breakouts, right? Of AMD? Well, yeah, AMD is up 400%. You're going to do really well, right? You got to see like what it is you're trying to catch. What's the inefficiency?
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, just going back to that trade to parameter ratio. I just want to make sure we didn't lose anyone on that point. So an example of that might be if you, let's say you just, for argument's sake, a very basic strategy. Let's say you want price to be above the 200-day moving average. That's one parameter. And then you also want today's close to be the highest close of the last 10 days. that's a second parameter. So for something like that, if you wanted 50 trades per parameter, then you'd want 100 trades as an absolute minimum in your in-sample testing. Did I understand that right?
Out of sample. You want it out of sample. So 50 is pretty hard to get out of sample, but my out of samples are very large. So I only use about 40% of my data in sample and 60% out of sample, which is also something that other people don't do. I think like there are systems, as I said, that work over decades. And that's what I'm looking for. I'm not looking for those ones that you have to re-optimize every month to maybe get some, good sharp. I'd rather trade like 1% of the time. This is another thing, right? Most people try to predict like all the time, long or short, but we're not running a business in the sense like we're not like hedging crude oil. So we always need we're always pumping crude oil. So we always need an estimate of where it's going to be. We can say that like, I don't know how to trade on any day but Chinese New Year, And on Chinese New Year, I know that I need to buy the closes of every Chinese equity and then just sell the next day's open. If that's what you need to do, that's what you should do. And just don't trade for the rest of the year. That's fine. I don't see a problem with that. Right. And people do weird stuff. I don't understand why to make these continuous bets. Right. And I was also just discussing this, in Forex and in futures, right? It's very common to do single ticker systems, right? Single time series, systems, whereas in trading one asset. And then in equities, it's very common to do a portfolio of assets, right? And so I don't understand why, they like don't mix. Why wouldn't you do a single stock, single asset systems in equities? It's, because if you say that they're all correlated, right? Then there's no reason to be playing the portfolio, because that means you're saying they're all correlated. The diversification of portfolio is not going to do anything for you. And if you're saying they're all uncorrelated, right, which is the reason you would be doing a portfolio, then if they're all uncorrelated, they're all different. You should get your idiosyncratic returns by trading each asset with a system that's suited for it. No?
So a lot of people, I guess, have an issue with single symbol strategies because it's easier to over-optimize and curve fit to those strategies. So I think by trading a portfolio, it's probably an easier way for them to avoid those types of complications.
Yeah, but are they making money, right? Then I have a question. Why don't you, what's the difference then if you like rank all your system? Let's say you're doing a long only portfolio, right? On like 100 equities. Well, if you rank all the equities by performance and remove the bottom quartile, almost always your performance will get better, right? Even on a rolling basis, because, systems get kind of fit for the regime of the market. And and then at which point do you stop? And then what is your point? Like if the point's to make money, right? But look, again, if you believe, right, that the markets are uncorrelated, like they're moving, the equity markets are not correlated with each other, right? Then you should try to get that's where the money is. Now, don't you think? Not trading one system for everything.
Yeah. I mean, I'm not disagreeing with you, just to be clear. I'm just throwing a counter argument because I myself, I'm trading I'm trading single ETF strategies.
Yeah, which is fine. That's diversified. That's much better. I agree with that, And the thing is, I look at these things and I think they are like this. It's every single one of these markets is a game. Say it's like poker. It's a zero-sum game and with its own players. Okay. And yes, there are major players that trade let's say the SPY, right? And because, if any of the ETFs get misaligned with their equities, there's arbitrageurs that will come up and make everything work properly, but be efficient, that is. But that doesn't mean that there's still different people. People trading AMD are not the same people. There are some of the same people that are trading NVIDIA, but it's not all the same people, right? And you don't need to be the smartest guy in the room. You just need to be smarter than X amount of people. You need to take money from somebody, right? It's not, you should be doing everything to maximize your possibility of being the smartest guy at the game that you're playing, which kind of leads me to my next point, which is 2 points, I guess, a twofold approach, right? It's a two-pronged approach. It's making synthetic instruments and trading outside of the U.S., most people are not managing $1 billion. And in fact, $1 billion is, for other people, it's not that much, but, the point is, you can go to Israel, for example, or go to India, or go to Singapore, and maybe there's dumber money out there. I mean, in India, as from the statistics I've seen, in the US, it's like something like 90% now, or even more, of all the trades are electronic, right? In India, it's not. I mean, there are certain structural inefficiencies that come out of that. If there's people sitting there market making by hand, you can go and do it with a computer and just be faster and already be better than them, right? You can do that. You can't do it in the US because there's a lot of people spending a lot of money to do that here, and you're not going to outspend them or outcompete them, right?
You make it sound very simple.
It actually is, to be honest. Like, the stuff that I do, the systems that work now, you would not believe how simple they are. I mean, they're just so stupid. And couple that with literally the fact that not a single person I'm consulting in like machine learning for trading. I mean, these people have some of them have tens, if not $100 million invested, and they have nothing. They don't have a single thing that will work out a sample. That's crazy. They've written so much code, and I tell them, like, look, dude, what if you just buy on Monday, sell on Tuesday? And they're like, that would never work. I'm like, okay, well, you're done right there. You're basically saying that I know how the market will act. Well, if you know how the market will act and you don't need to test stuff, then, first of all, what am I doing here? And second of all, why aren't you a billionaire yet? You don't know. That's the point. And so you have to see what is the stuff that you really, 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 truly know. There's not that many things, assets that cost the same, or assets that are the same asset on different venues should cost the same price. There's put call parity, because if there wasn't, you could make a synthetic position with a put and a call to mimic another position and short that one. And then you would have risk-free profit, but even that stuff isn't a given. That's the crazy thing. If you look at, some of these other markets, even in Russia, right? I heard of a team in Ukraine that did something like this. They had options on futures, and they bought the option, and then they bid up the future like a minute before settlement, and took like an out of the money option up to like, obviously an in the money one made like 10,000% in like a minute. That's of course illegal in market manipulation. However, you have no idea that's not going on. So you got to really see what you know, and it's very, very little.
So what markets are you trading? Like, what countries are you trading most of your volume in?
I'm still trading mostly in the US, right? But I'm trying to explore, as I said, India. I'm doing some stuff in China. I'm going to be going into South Korea soon. There really is an insane amount of opportunity. I mean, like even stuff that you would never think you could do, like, I don't know, futures spot arbitrage, right? Like that's a strategy that literally has like tons of literature about it. I mean, you could just look up on the internet how to do it. Most of that stuff is just taken up by other people. Or triangular arbitrage, right? In Forex, right? So that's like when you can buy the JPY euro, right? And then sell the JPY USD and buy the Euro USD, right? Something like that. I need to write it out to tell you the right stuff. But basically you have a net zero position, and it's a risk-free profit. I mean, you have legging risk, I guess, but, it's a profit between the synthetic or the native, spread, the native inter country or whatever, not inter commodity, the native spread between like, I don't know, GBP, JPY, right? And the GBP USD and USD JPY. Does that make sense?
Sort of. I'd have to re-listen to that bit.
Well, basically, sometimes it happens that there are certain more complex instruments, or even there are certain instruments and positions that can be made with other instruments and positions, right? So, for example, a exchange traded calendar spread in the VIX, right, can be made by selling one futures and buying one future, right? But there's also an exchange traded one like that. Does that make any sense?
Okay, sure, yeah.
So if those things are priced differently, you can buy one and sell the other, and you have lock in a risk-free profit.
Okay.
Because it's the same exact instrument. So it's just, okay, so like take the very simple example of, an ounce of gold, right? Let's say an ounce of gold is trading in London for $100 and trading in New York for $102. You can sell the one in New York, buy the one in London, you're net plus $2, you have no risk, right?
Yeah.
Okay, so now imagine doing the same thing, except for instead of gold and gold, which is really simple, you can have a long position in equities and a corresponding options position or a futures position. Basically, these things that will make them identical. And you got to look up the relationships. But there's certain relationships that are, for example, exchange traded calendar spread. Let's say, long March, short September will be the exact same instrument as if you just bought the March futures and sold the September futures. Except you would do that in two executions, but buying the exchange traded calendar spread, you would do it in one. But it's like, what if there's a mispricing between those,
Now, just going back to an earlier comment you made about trading in, or you yourself are looking at opportunities in India, China, I think you also mentioned South Korea. Are there any complications for you to actually be able to trade those markets? How easy is it for you to open an international equities account?
Well, first of all, IB gives you access to a lot of stuff. So anything we could do through IB, we do through them. But, it all depends on, now there's so much data available, for example, Quandl or whatever. You can test before kind of getting in there. But yes, there are some difficulties in opening accounts. It depends on, where what accounts and where, right? So, I don't know. Probably easier to open in London than it is in China, let's say, right? But again, there's providers in the US that give you access to some international markets, and there are lawyers on the ground if you do have the capital to do something like that that can help you in any of these countries. And plus, you gotta realize, right? Like, if we're talking about making, I don't know, let's say we're talking about spot futures arbitrage, and we're going to be making 0.1% on our capital per day, right? So in that case, you can pretty much, you can tell how much you're going to make more or less within some range, because it's like an arbitrage trade, right? And so you can say, I can spend 20% of that lawyer's fees and I'll be okay. So that's another point another thing that I realized, kind of getting a little bit, scaling my business a little bit, growing, is there's a lot of kind of outside of smarts alpha out there. Like, obviously there's speed, right? There's also special relationships. There's geographical kind of considerations, right? Maybe there's special resources that you have, right? Maybe you can short, let's say, for example, there's a strategy you can do and it'll make you, X%, right? But, it involves being short this whole time, and the fees will like basically also equal X%. What if you could, short for 0.01 of X%? Would that change your ability to do that strategy, right? And in fact, these kind of things prevent other entrants from coming in. And if you can kind of secure a environment that allows you to do to execute some of these strategies, it's going to be much more difficult for people to come and push you out.
Let me put a question to you. You might laugh at this question, but really what you're looking at is you're looking at markets where there's less competition, okay? So where your competitors, for the most part, are less sophisticated, okay? Mm-hmm. How about US penny stocks?
Yeah, I was just, I bet there's a bunch of stuff like, look, the US penny stocks are nice just because of the movement, right? So the minimum movement is significant, which is really nice for you if you are a scalper or like a market maker, right? So, if your minimum tick is enough for you to eat, that's real good, right? So, and they also have kind of implied bottom, depending, of course, what you're trading. You don't even need to go to penny stocks as in like OTC stuff, just, cheap equities, right? Like just equities under $5. They're not touched by institutional players very often, right? So they're less efficient. Obviously penny stocks are not like OTC stuff is like really not played with in the institutional world. I mean, relative to, the more high grade investments. But I think there's a lot to be done there, and it's all about the risk, right? I mean, if you're not trading on margin, and if you put in $10, then the most you can lose is $10. Like, that's a truth, you don't know where the price is going to be, but, and actually on that point, think about, making money off stuff that you do know, as in, like, maybe you can make money regardless of price, right?
What do you mean by that?
Well, I don't know. For example, we just launched a market making program that's just killing it. Like, we're trading, I don't even want to say it, but in the multiples of 10 sharp, right? And so it makes more money when there's more volatility, right? So its profits basically depend not on the direction of the market, but literally on the volatility. And that's it. So I'm not in any way tied to the directionality of the market. Although, right, if it goes down a lot, it becomes more liquid, right? Because the tick size becomes a larger portion of the instrument size, which is what we were talking about with the penny stocks. And if it goes up very high, then the spread becomes very wide. And that also will actually increase my profits. So it's a market making algorithm.
Well, I did want to ask you about that. So this could essentially be categorized as a high frequency trading strategy, yeah?
Definitely.
So typically when we hear about high frequency trading, we think that's something which is for the big boys with deep pockets, right? How is someone like you able to pull this off?
I mean, well, first of all, has there ever been anything that has really truly been for the big boys with the deep pockets? Obviously not, because that basically would mean that, like, whoever makes their money would always be there. And it's never like that. Literally, it's always the opposite. There's always someone up and coming that's going to kick your ass later. That's just the truth. Like, that's progress, right? So that, that assumption in general is not so accurate. And that's my first point. And my second point is, what I realized is, like, you know why it's untouchable? Because what they're doing is, like, just absolutely ridiculously simple. Okay. And the only way to maintain their edge is to make it faster, let's say. Right. But you can be smarter in the same business, right? There's, you just got to see what, for example, there's some options exchanges that will give you rebates when trading certain options, maybe that's where you should be trading and just basically trying to trade those options, market make those. I mean, there's literally infinity markets, right? Especially if you consider the fact that you can trade, like, synthetic instruments, right? So yeah, you could always find a place that, like, you just stop playing the games that everybody else is playing, right? Like, maybe you want to trade all the time in one short, your instrument will be one share of Johnson & Johnson and, long, and one share of ExxonMobil short or something like that. I don't know, but.
Well, you say stop playing the games that everyone else is playing, but there's a lot of people playing the high frequency game, isn't there?
But there's actually there's actually not that many people, right? The players are actually pretty concentrated. They do account for a good amount of the volume, but the number of individuals actually doing this is much less than almost every other business or every other part of the market, right? So there's a lot of more people running mutual funds than there are people doing HFT.
So for you to be able to participate in that space, I mean, how much of an issue has infrastructure and speed been for you?
I mean, right, it's not like turn on TradeStation, code up your algo and press play, right? But if right, so if I ask most people, and I didn't realize this because I didn't know the opportunities basically are out there, just like everybody else, because everyone was just telling me they're not. But if someone came and told me, like, yeah, you're trading, like, let's say 2 to 5 sharp right now, and you could be trading 30 sharp, all you have to do is spend like 20% of your time building infrastructure, I would be like, hell yeah, no problem. That's a worth it enough increase in trading performance. So it's all a trade-off. I mean, let me give you an example of something concrete, right? So there are right now, a very, very simple example. You can go on the internet and find derivatives platforms for cryptocurrencies, for example, right? Their liquidity is not high. Don't get me wrong. But for retail traders, you can make money literally doing regular arbitrage. buying and selling options and futures, at the same time for different prices. Pure arb. That shouldn't exist. And when I say retail traders, I mean, like, you can do a good amount of volume through this, right? You can do, you can make, $5 million a year on a $1 million account if you want. That's pretty good. And even if you do it for 1 year, it's not a problem. I mean, like, as long as, if you have like truly, not like statistical opportunities, but more deterministic opportunities, which exist. Like, we're working with some spot futures arbitrage in India and some other places.
What are deterministic opportunities?
Well, let's say you're actually looking at, the spot, the call, a call on Apple, $100 call costs $10. And in another place, $100 call on Apple costs $8. And if you hit the market on both sides, right, you are basically like, you're going to make money if you get filled. That's it. The second you execute, you're in the money. You're profitable. Not in the money, but profitable. Does that make sense? So there's like flow traders, flow traders, they say their models are deterministic. I think they're trading like super high frequency in the ETFs and Forex space. So like, imagine, like, think about this, right? There's like 5 equities venues in the US or more. I don't remember. There's a ton of them. And some of them trade the same equities. You obviously have seen, if you've ever traded, that your execution price, if you ever traded with like a, IB or like any like more serious broker that allows you to kind of route trades to different exchanges, you can see that your pricing is actually different. Not only your pricing, but the actual price, the quote, is different in different exchanges. Like, that doesn't make any sense. And basically, if that delta becomes more than your commissions, right, it's very reasonable to go ahead and take advantage of that for risk-free profit. Again, risk-free is very, there's exchange risk, there's all this other risk, but compared to like trading where you bet money and then the time goes by and then you either make money or you don't, before basically what price you will close your trade at and what price you will open the trade at and approximately how long it's going to take to do both. Real fast. Sorry. You had a guy, I forget, I listened to his, he's a very energetic guy. He's a hand trader. And in his podcast, on your podcast, in his interview, he said something about he was trading Forex and there was a broker that had like a couple second lag against his other broker. And that's how he first started to make money. You know what I'm talking about?
Yeah, that was Tom Dante.
Yeah, exactly. And you think about that, like, that's crazy. Like, how is that true? How is that possible? Also, if you think about, like, basically that makes you realize that there are people making the market efficient. You get what I'm saying? And they also have limited capital and limited time. And like, it takes a while to be a guy that like really makes the market more efficient, right? Like, you have to make this your like business in your life. So there's a bunch of markets where there is not enough people making it efficient, maximally efficient, whatever way that is.
This strategy that you're trading, this high frequency strategy, which we're focusing on at the moment, which markets is that trading? Is that in equities or is that in futures? And also, second question, how frequently does it trade?
It's in equities and futures. Although I'm doing similar things, as I said, I'm doing the options thing that I was telling you, the arbitrage. So, I mean, there's a variety of different strategies, but how frequently it trades? It probably trades, let's say, I don't know, probably like, let me see how many trades there are right now. So there were 3,212 trades in the past 2 hours and 50 minutes.
Wow, that's a lot.
Yeah.
How much profit is it trying to take on each trade?
So I bet about $1,000 a trade, and I try to take like, I don't know, like $1.
$1
right?
Profit.
Yeah, $1 profit. I try to go for 0.1% is probably like the highest that it'll go. But if you trade a lot, it's okay.
And what sort of broker are you running with?
Oh, it depends for who you're working with, or what you're trying to do. But, I'm running with, IB on special commissions through a relationship. And, I have some other brokers I'm about to start working with in South Korea and in India, but those relationships haven't been set up yet. But basically, or finalized. Basically, I just shop the brokers to see who's going to give me the best rates and the best connectivity and the best opportunities, right? So maybe one costs 10 times more than the other one, but it's going to allow you to trade, 20 times more. And, speaking of that, there's people there's ECNs of all types, Forex, non-Forex, that offer rebates, which means if you're good enough, you can basically make zero money and just trade, just if you can determine, this is the time where markets will not move almost ever, right? Maybe it's good to make markets then, right? Overnight sessions when I was, a long time ago, in the US futures was it was one of the best times for me, in the ES or, the Euro futures, there's less people trading. The price doesn't really move wildly. I mean, that's an assumption that you got to test what I just said, and it has to be quantified. But the price doesn't move wildly. Maybe you could just kind of sit on the bid and ask and try to collect the spread, which if it's a tick, can be significant.
There was a couple of things I did want to speak with you about, Bert. One of those being other sources of edge, which I think you just touched on one of those there, and you may have actually mentioned a couple others since we've been speaking, but do you want to just speak to us about that? Because I know you've got a couple of thoughts around how, us as traders should be thinking about other sources of edge beyond simply thinking about alpha.
Yeah, absolutely. Right. So, I think I read somewhere that Renaissance Tech, one of the first things they started doing was just arbitrage in the equities markets, and they got a agreement with the exchange to basically trade for free. Now, I don't know whether that's true or not, but that's definitely something that you can do, 100%. An exchange is also a business, and especially since most of these exchanges nowadays are private, so it's still a business. It still needs to make money. So if you bring if you just go to an exchange, a broker or an exchange and say, look, you guys charge me 10 cents. I trade $100 million a day, right? I generate, $100,000 in commissions, right? If you charge me, 5 cents, I'll be able to trade 300,000 times a day and generate you 150,000 in commissions, right? Or something like that. They're just in it to make money. So if you just literally prove to them, it's very simple, depending on what you're doing, right? But if commissions is the problem, right? We're getting into the HFT space, of course. You can, you can, maybe get preferential treatment somewhere and which allows you a structural edge against other people. I mean, if your commissions are zero, basically, right? You can do a lot of stuff that, you wouldn't be able to do in the regular markets, because basically transacting to zero will have a cost, right? And in other markets, it doesn't.
But I mean, even, these things you mentioned, that's maybe something you can chat about with an exchange when you're trading $100 million. I mean, most people listening to this certainly aren't trading that type of money. Some people certainly are, don't get me wrong, but for the most part, most of us aren't. But I think even as you bring that up, I think a lot of people forget that it is possible still to negotiate better commission rates with your broker, regardless of how much capital you have. I'm sure that probably plays a part in it, but you do have some negotiating power when you're talking with your own broker, even with a small account. True?
Absolutely. Well, look, it's not real. It's a personal thing, right? So some people I know can go into kind of negotiations with nothing and come out with, $10 million business. Other people they have the largest account on the exchange and they're the number one trader, but they can't do it. They're too afraid, or they're not comfortable asking for a discount or whatever. I don't know. But these are the same inefficiencies that we're discussing, just in a more human form.
Now, one of the other things I wanted to bring up with you is, I'm not sure the best way to phrase this question, but we were speaking a little bit beforehand off air. Actually, no, it was the other day, wasn't it? And you were talking about how everyone's looking at the same types of data. So everyone's looking at the same time series. You want to, and we've spoken about this already, you want to try and look where other people aren't. And I think this is where you start thinking about synthetic instruments. Using data from other instruments to trade different instruments and getting signals from different time series to trade different markets. And I don't know if I'm making any sense right now, but I think you probably get where I'm going with this.
Absolutely. Yeah. I mean, look, almost everything we trade looks at other markets, and which comes back to the point. I discuss this now all the time. Like, people think machine learning, I mean, that's great, right? Like, you can learn, kind of more stationary stuff with a lot of examples pretty well, right? But I don't see, like, we don't have enough data for machine learning to just learn from scratch, in my opinion. Depends on what you're doing, okay? But let's say you're doing daily equities trading, right? You don't want machine learning to like, learn what is a trader. You just want the machine learning to do what a trader does, just like faster, better all the time, right? So you should go and like, who are the people making money? Like prop traders, they trade relative value. They don't say like, I mean, not all of them, obviously, but the more successful ones I know are looking at all the kind of, not all the assets, but a collection of assets that basically, they can tell, they say stuff like this. I don't know, like, these three assets are strong, which means these three assets should be weak because they have like usually an inverse relationship. But out of these three, this one actually wasn't that weak. So maybe it's a good idea to buy it because it's showing strength when it should show weakness. I don't know. But the point is, like, you should just thinking even about the informational content of a time series, right? So like a lot of work by like John Ehlers has a lot of good stuff about this, right? So like filtering and we're reducing the noise, but we're also reducing the signal. And how much signal is there, and is there any way to supplement that signal, right? And if you think about equities, for example, right? And you realize that most equities are still really correlated. That means they still move together. Maybe it's a good idea. Why are they correlated? Because you would think like, oh, they're correlated because everything kind of moves for us in the same kind of at the same time. But what's possible is like, someone bids up the SPY, right? And because more people are trading the SPY, and the SPY starts going up. But then if you think about it, like, oh, the SPY like is up, but the other equities that are making, they're constituents of the SPY are not, which means like there's arbitrage opportunity, let's say, right? So that means that all those equities will follow the SPY. And yeah, you're not going to notice that. The lag is like, I think, milliseconds, if not nanoseconds. But there's a flow of how things work. People move money from place to place, right? And you can't look at anything, on its own. I mean, there's, if you're trading equities, because there's a like long bias, you can say like basically anytime the U.S. market is down 50% is a good buy, right? Sure. Okay. But, it's maybe there's a relationship between, there's definitely relationships between like, U.S. equities and foreign exchange and U.S. bonds, right? Why not try to quantify them? I mean, that stuff is also way more robust and works in the out of sample extremely well compared to just like single asset, single data series trading systems.
Are you ever concerned about some of your strategies might be built upon spurious correlations? Like the signals are coming from spurious correlations?
Absolutely not. And you know why? I mean, they are for sure. But what is a spurious correlation, right? Like, again, we're discussing the problem with the bad analyst, right? That spread some bad rumors about a stock, right? Like, so like you can say that a spurious correlation is every time this guy releases a report, the stock goes down, like, but he's lying. But like, is he? Right? And who do you care about? Like, what if Bangladeshi butter prices, affected, Indian GDP, and India happened to be the biggest buyer of U.S. equities during that time. So there was a big correlation between Bangladeshi butter prices and, U.S. equities. So like, you don't know what the relationships are, right? And you don't know that the ones that you think are there, like gold and silver, like we discussed, are going to last. So I think it's, again, you're like, people say this is spurious because what they do is all they're saying is it doesn't make sense given their like logical apparatus and informational base. However, if you could evaluate opportunities based on your logical apparatus and informational base, then you should be a billionaire. And then why are you doing algorithmic trading? You get what I'm saying? Like you contradict yourself when you say some of these, not you, like people, when they say some of this stuff, right? Like, if you work from the platform that like we don't know anything, right? See how you can make money. Like you write down on a piece of paper what you know. I mean, it's crazy. You don't really know that much. I mean, we know like, even as humans, right? Like I know that, like there's gravity, right? There's like death, right? And, there you can make babies if you don't wear protection. Like that's pretty much it for all humans, I know that's oversimplifying it, but if you work from that frame of reference, it really helps you kind of view the financial markets in a more objective manner, in my opinion.
I see where you're going with this. But let's change gears for a moment just to take us out here. And I was actually, I thought I'd ask you about this considering I read a write-up on you in the Huffington Post, must have been a couple of weeks back. And I thought it was pretty interesting actually, and probably something that a lot of us I'm sure we can take something from it. You spoke a lot about your routine and how you structure your day and that sort of thing. So I'd be keen to hear you, or keen to have you share that with listeners. So can you tell us a bit about how you structure your day? You've obviously got a lot going on.
So it depends how much work I'm doing with who I'm doing it with, right? So there's times where I'm doing a lot of work internationally, so I have to be up for the other side of the world. So I'll usually do sleep, like I'll do a twice a day sleep wake cycle, if that makes any sense. So like, let's say there's 24 hours in a day and I need to sleep, 10 hours, then I sleep for 5 hours, and then I do stuff for however hours makes it to 12, 7, right? And then I sleep for another 5 hours and do it again, right? And that way I can kind of get the morning of each place or something like that, maybe the evening, I don't know. I try to kind of keep everything structured, keep everything is on lists, everything is organized. I mean, right now we're managing, a good amount of money. I'm managing overall in my office, overseas about $1,000 of assets. And, it's basically me and a couple guys that are just, they just program for me more or less. So I have to be very, 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 very organized. I have to have systems for pretty much everything. I mean, from, what I read to what I eat. But having said that, it's really, I found, and I've read also, but I found for myself, it's very important for creativity to kind of have like unstructured time. So, very often I'll have just, I'll finish a big push on a project, and for 3 days, I'll just kind of do whatever, walk my dog like 4 times as much, or just go explore a different, a different restaurant, or different, just something different, go to the museum. It's always good to kind of, the structure is really good for kind of powering through things, but for creativity, you need to kind of remove have less structured time.
Absolutely. And that sleeping pattern of yours, did that take a bit of getting used to?
To be honest, it just happened. Like, cause like I'm trading all day now. And for some of this high frequency stuff, the way I look at it, and again, this is silly, I don't recommend people doing this, but I just program it and let it go live. Right. And I can do that because it's basically like I'm the main guy doing, writing the code. So I know what it is. There would be no chance for someone else to have added like something that I don't know about. It's still dangerous. And I've lost money doing it. But at the point, it's like, you just go, because if you're not trading, you're basically like missing out on making money. So it's more, I found that it's your net wealth will be higher if you just kind of start than if you wait and start and test. And also obviously the bugs would be, you fix them much faster when you lost money because of something.
That's a good point. Now, you've mentioned it a couple of times and you referenced it just then, like you have a team, like you have a few people working with you now. How has that come about? Like, how have you met these people and how did you start working together?
To be honest, I hired like not a ton, but like, I don't know, probably like 20 different people, and people hit me up from like Google and Facebook, saying that like to work for me for free just to learn. And I found that like, people just don't like think properly. Like they refuse to think properly. I don't know how to explain it. Like I'll come to people and I ask, they don't, they'll hire me, for example, and I'll ask them like, okay, how are you validating your systems? And like 99% of the answers I get is like, what do you mean? I just like graduated Harvard in computer science. What is that? what do you, like, are you like, just like, that person is like really stupid because they basically didn't even understand the question I asked them. Like, I just, and this is the kind of stuff I hear all the time. They're like, I've been doing math for, I've been a math professor for 40 years. Like, and that, like, people come to me and they're like, I want to make more money in my business. I'm like, okay, so what did you do in the past 3 months? He's like, well, what do you mean? I hired 50 people. I'm like, cool, dude. Like, do you not see that, like, you're like, I want to make more money, so I went out and I spent all this money. Like, does that not make any sense? Like, what, come on, man. Correlate the things that you're saying. Like, literally, they don't, there's no plan. They don't write, like, if you write stuff down and look at it yourself, it's really useful. When you write down, I would like to make more money in my business, you go and like, go through your business. What makes money that I do? Which of those makes the most money for the least amount of time spent? Maybe I should focus there. It's almost never let me hire more people. Right? So you got to just be clear about, like, what is your objective? Where you're going. I have a dog, and I like, sometimes I wish he could just talk and I would just hire him, shit. It's like, if he needs to go somewhere, he'll go somewhere. If he needs that piece of food, like, he will just, he's like a genius, he'll open this and go through there and whatever. And it's just very clear. I can tell that he's just they have like one thing on their mind. And then when it switches to another thing, they just focus 100% on that thing and they just go. And that's like what you need.
That's very true. That's very true.
Yeah, I mean, because like, you're competing with some really smart people. I mean, there's tons and tons of people like way smarter than me in this field, right? The problem is, smart and making money have nothing to do with each other. Not nothing, but it's like, you have to be you have to be like X amount, you have an IQ of 120 or, X kind of like, you have to know how to do basic linear algebra, let's say, or something like that. But beyond that, it's not really, no one knows. No one knows what they're doing. I had the chance, when doing some more just work in business, I had the chance to meet, some pretty serious people, from presidents of countries, people that work, up high in the world, a different world, different worlds, political world, business world, whatever. And you just realize, like, shit, dude, no one knows anything. Like, no one knows anything. They're like, everyone's just guessing. There's so little, like, objective process. It's like insane. You never think, like, you always think like the president, right? Oh, he became the president. What a boss. You have no idea that it wasn't like, oh shit, like elections are soon, right? Like, fuck, someone needs to be a president, right? Like, who's like the guy that everyone thinks is going to be least damaging to the country? Well, let's go with him. You don't know that that's like the process they're using, right? Like, I mean, you think it's, I'm reading a book that my brother recommended to me, and he does consumer products, an awesome book. I think, I forget what it's called. It's by Ryan Holiday, something. It's Yeah.
What is it?
Yeah, it's Thank You for Lying or something like that. What is it? No, that's Thank You for Smoking. That's a different movie, but it's something about lying, but it talks about the media and how it works. And it's crazy. I mean, like, it talks about like, political blogs. They need like information to post so that they have stuff, viewers. So they just pick like a candidate and like say like, oh, look at this guy's obviously like getting ready to be president. But he's right. Like, sometimes that stuff will make the person like a legitimate presidential candidate. Because if everyone is thinking, basically that all the media is showing him as a candidate, then everyone will treat him seriously. It's crazy.
Yeah. For sure, man. Well, let's wrap things up here. As we're talking about books and that type of thing, I know you're a big reader yourself. Do you want to just, for the fun of it, recommend a title that someone should check out?
Karl Popper is someone that people should be reading, I think, a little bit. I think it's important. It's a good kind of, what is information, what is science and whatnot. I just made a list of books, and let's see. Yeah, Thinking Fast and Slow by Kahneman, Black Swan. I don't know if I recommend this before. Drunkard's Walk, How Randomness Rules Our Lives by Leonard Mlodinow. That's kind of like a less sciencey, more pop science book about randomness. It's really nice. In terms of more, focused on trading stuff, David Aronson is good for the kind of the process of viewing results and extracting useful kind of the validation process, let's say. Ralph Vince for position sizing. That's about it. Obviously, the market was there's books, which I recommended before and everyone's recommended again. But all they show you basically is that money can be made like you can make money however you want to make money, essentially.
Exactly. Yeah. Yeah. I appreciate you saying that. Like I say that to a lot of people all the time as well. Like you just need to think about the sort of trader you want to become and then almost like reverse engineer it in some ways. So if anyone listening wants to follow along with you, Bert, or find out more about you, whereabouts can they go?
I'm on LinkedIn, Bert Moeller, my Twitter, and you put the links in the bottom of the page, I guess, and my website, profluentcapital.com. I was going to say, we've been doing some consulting. So we've been like designing trading systems for people, for money, which is another thing. Like people tell you like, oh, that's so like, you run a fund. How can you do that? That's like beneath you. But like we have, I don't know, millions of systems, and so providing that to other people, if we're not using them, I don't see that's a problem. Like they're being made in the process anyway. But the thing is, the demand for that has actually been so high that the pricing we have to charge now is probably unreasonable for retail traders.
Sure. Okay. And just because a lot of people are probably listening to this not on the website, iTunes, Spotify, SoundCloud, etc., what is your Twitter handle?
It's BMOULER, like my first initial and my last name. M like Mary.
Appreciate it, man. Thank you very much for coming on the podcast for round 2. I hope to have you back again sometime soon.
Thanks. Yeah, thanks for having me. It was an awesome time.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey crew, what's up? Thanks very much for joining me. Coming up on this episode, I'm excited to share with you a first-hand account from someone who's been on a wild ride through the US justice system. Michael Kimmelman is my guest. He was convicted and served time for insider trading. Throughout our conversation, you'll hear everything from how Michael ignited his prop trading career at the renowned firm Daytech Securities and the bizarre antics which took place there, the moment the FBI stormed his home in a pre-dawn raid, and what happened to his $250 million hedge fund over the few hours which followed, how his trial played out, the twists and the revelation of a rogue judge. And you'll also hear about what life was like behind bars. But before you write Michael off as a bad man, please listen to his recollection of these events, as I'm sure some parts of his story will legitimately shock you. If you get through this episode and you're curious to know more, then you might be pleased to know Michael has actually written a book. The title, Confessions of a Wall Street Insider, a cautionary tale of rats, feds, and banksters. I've set up a direct link to make your life easier. So if you go to chatwithtraders.com/confessions, that will take you straight to the book on Amazon. chatwithtraders.com/confessions. I'd also like to point out some of the events Michael talks about during this episode overlap with the events of ex-Galleon trader Tony Duff spoke about on episode 106. So be sure to check out that episode as well if you haven't already. chatwithtraders.com/106. Right, on with the show. Here is my conversation with Michael Kimmelman.
Did I send you a copy of the book, or did James send you?
You did.
Okay.
Yeah, I asked for it. You sent me through a PDF, and I was skimming through it yesterday afternoon, actually, and that's all I intend to do was just skim through it, but I found myself reading like quite a few pages.
All right, good.
It was really good, man. But then I didn't want to read too much of it because I wanted, I didn't want to know everything you were about to say.
Questions and, right.
Exactly. So anyway, let's start right at the get-go. You didn't start out as a trader. If I'm not mistaken, you were a lawyer initially. Is that right?
I was. I took a job out of law school. I went to law school at USC, which is in Los Angeles, and did very well in school, and sort of had my pick of jobs, and took a job with Sullivan & Cromwell, which is one of the bigger New York firms out there with a very storied past, and wanted to be in the New York office because obviously that's where the center of power was, or, where most of the deal action was. And being an M&A lawyer, you wanted to see deals. So I moved to New York, practiced law for about 2.5 years. And then, it was the late 90s. And back then there were a couple of pretty exciting things going on, both in technology, obviously, and in finance. And it seemed like being a lawyer was not the best place to be. So I lateraled into finance and into trading, and then really never looked back.
So how did you get into finance and trading? Like, where'd you go from being a lawyer?
Sure. So I had always been interested in trading and then followed the stock market. I actually traded my way through law school and did pretty well with a simple, I think it was either an E-Trade account or one of those basic accounts. So I was always watching the markets. And then I remember I think it was 1998 when I was at Sullivan & Cromwell working on a deal. There was the Thai baht crisis in 98. And I remember, stocks getting smashed and buying Cisco, through an online account. And then something like a day later, it had recovered, and I made something like $12,000 or $13,000 in that one trade. And then thought about it, and I was like, that's what I make in a month here, working 100 hours a week. So I had to work 400 hours to get that same return on capital, doing work that I thought was a lot less interesting. So, I began trading a little bit while I was at the firm, and they even had to restructure the compliance a little bit because you were supposed to hold it for a certain amount of time, and I convinced them, to cut that 30-day hold period to, I think, a 48-hour hold period or something like that. But either way, I knew my time as a lawyer was going to be short because I had caught the trading bug. And I then began interviewing for a couple of risk arbitrage jobs, which I thought I was well suited to with my M&A background and sort of, handicapping and analytical abilities. Got an offer from Bear Stearns, wanted to get an offer from Goldman. And then, as I write in the book, I went to visit my friend Randy, who was at a prop trading firm at the time. And I remember walking into his office, and it looked like, it looked like a bargain basement hurricane had hit it. It was broken up desks and very low grade furniture. But then I looked at Randy's P&L and a couple of the other traders around him, and these guys were making, tens of thousands a day. And the good ones were making, well into six figures. And it was really just a very smart group of Ivy League trained, mostly athletes. So you had that competitive aspect to them. But these guys were, tackling the markets and had big sort of banks and big pads that they were able to trade. And so I didn't even want to wait around and enter the world of risk arbitrage. I went straight for the proprietary trading world.
And what was that firm? Is this Daytech?
That was Daytech, which later changed its name, but it was Daytech back then. They ended up selling it, I think, partially they ended up selling the software to Ameritrade for a pretty outrageous number. And then it got swallowed by another firm, which was Schoenfeld, which is one of the bigger proprietary trading firms out there. And I was there for about 3 years or so.
Okay. Let's spend a little bit of time on this because Daytech were a very interesting firm at the time, right? Like there's something quite significant about Daytech, right?
Sure.
So, I mean, just tell us a little bit about like how that firm was run, just like what was the environment like there?
It was kill or be killed. It was, you eat what you kill. It was just very raw, aggressive speculation, and not unintelligent speculation, because there were some really top-notch traders there, guys who went on to run tens if not hundreds of millions for other firms. But at the time, in this tech bubble, intelligent speculation was penalized, and I didn't have the greatest performance in that ramp up in the NASDAQ early period from, 2000 to 5,000, just because I was a little too cerebral and I couldn't buy into something that really didn't have a business model or any prospect of ever making money, just because it was up 20 points on the day and was going to end up 30 points. I just couldn't buy those stocks that well. But the people who could, who could shut off that analytical side and just were great trend following traders, made fortunes. And I actually made most of my money, once the bubble popped, shorting a lot of those stocks into oblivion. But Daytech itself was really, like I said, it was the ultimate kill or be killed type of firm. I mean, they would give you as much money as you could utilize properly, with proper risk management and money management techniques. But they were also very quick to cut you back and or fire you if you couldn't perform. So, it was a very strange and wild cast of characters, which, as I'm sure you can imagine, I go into a little bit of detail in the book. Anytime you give 20, 21-year-old, 22-year-old kids, fresh out of Harvard, a couple of $1 million, $10, $20 million to play with, and these guys start producing, eye-popping numbers, it sort of warps your sense of reality. So, they would put contests together or offer people prizes for different exploits, and it became, almost like the Wolf of Wall Street in some ways, in that, money would buy everything, and whether it was the steak dinners or other types of, behavior designed to basically incentivize these traders and keep them loyal. I mean, it wasn't Wolf of Wall Street in that entire category of firm were creating stocks that didn't really exist and companies that didn't really exist and just trying to sell them to other people. In this case, we didn't have any outside money. We were trading just the partners' capital. And those partners were very wealthy people who, again, went on to found other firms. Guys like Jeff Citron founded Vonage and a couple of other tech firms. So, it was a extremely competitive, extremely high testosterone environment that produced, some people who were some of the best traders out there, as well as, others were very quickly eliminated and sent back to wherever they came from.
Yeah. And was there a high turnover of traders there? Like, did a lot of people come through the door and, not stick around for too long?
Yes, but not as high as you would expect. Again, because I think that bubble mentality, there were a lot of people who passed for genius. You know, it's the old Warren Buffett quote, wait till the tide comes out to see who's really wearing any clothes. In this case, there were people who, you know, the market was up every day. So it didn't take the greatest amount of technique, skill, or money management in order to make money. But once that bubble popped, there was a whole, I'd say probably by 2002, 85% of those people were gone.
Now, was there anything unique about the sort of trading that was going on at Daytech? Because isn't this the era where the SOZ bandits came to be?
It is. And it, you know, it became one of these things where these guys were deemed to be aggressive or the bad guys, but in reality, all they were really doing was offering some competition to the big banks, and the banks didn't like that. And, you know, in America, it's kind of interesting how things are set up and that people think, oh, the SEC is there to protect the average investor. The SEC is on the side of the small retail client. That's not true. The SEC is there to protect the big banks. They're kind of like the crooked cop on the beat for the most part. And I don't think they're that way these days as much. But back then, they were there to protect the monopoly of, you know, Merrill Lynch, Morgan Stanley, Goldman Sachs, and a few of those other firms. So when you had a firm like Daytech, and Daytech wasn't the only one, there were a couple other that weren't using the traditional big banks and keeping the spreads in stocks very wide, or keeping the fees those banks would charge for a trade very high. I mean, back then to trade, you know, in my Merrill account, I would pay $80, $90, $100 a trade, whereas the Daytech software that they created on their own, you could execute a trade for $5, $10. So it basically democratized the markets in a way that angered the big banks. And of course, you know, they lobbied their friends at the SEC to crack down on it. And the SEC did indeed take a look at some of these firms and try to cite them or censure them. But most of the censoring that was done were wrist slaps, because, you know, it was really obvious that this was good for the retail client. I mean, you know, think about Microsoft. If Microsoft, you know, according to a Merrill quote, is trading by $25 by $25.50 with a giant 50-cent spread, obviously that's like a $500 tax on an investor. Whereas, you know, with the SOZ ability and the electronic trading that these smaller firms came up with, spreads shrunk dramatically, and that same 50-cent spread dropped to a nickel or to a penny spread. So not only were, you know, investors saving on the $100 trade, but they were also paying a smaller fraction and not having to pay that extra $500 spread. So it was saving the retail client a tremendous amount of money. And in the end, you know, the SEC, I think, gave up with trying to protect the oligopoly of the big banks.
And while you're at Daytech, just before we move off the subject, I'd love to ask you, like, are there any really memorable moments from working there? Like, do you have any wild stories to share? I know when I was skimming through the book a little earlier, there was a story about some guy being forced to shave his head because he was down on the day. Like, is there anything like that?
Yeah, so there was, I mean, I could give you a half dozen between, you know, the contests of chugging milk or eating saltines, or, you know, we had a party one year at the Waldorf that basically, you know, was the closest thing to the running of the bulls that you've ever seen. I mean, we practically destroyed half the place. But the most, you know, some of those memorable ones and the one you cite were just a perfect example of what a competitive, you know, take no holds barred climate it was. So there was a trader who was not a great trader, but he had made some money, but, you know, went through a period of struggling. And the boss of Daytech, you know, walked out on the floor, and he kind of ran the firm like his own, you know, private empire. And he basically told him, look, if you're negative today, and I think the guy had been negative 2 days in a row or something like that, but he said, if you're negative today, I'm going to give you a choice. You're either going to shave your head or you're fired. And this wasn't like, you know, a guy with a buzz haircut already. He was a surfer type guy. So he had long blonde hair. And you could just see the guy cringe as it was said to him. And sure enough, that day he battled all day, but ended the day slightly negative. So the boss came out with the clippers end of day and said, make a choice, shave your head or you're out of here. And it's hard to say no to a firm where you've made in the past, anywhere from 10,000 to 50,000 in a single day. I mean, that's, it's tough to shut that gravy trough down. So he shaved his head, came in the next day and was negative the next day. And the boss ended up firing him anyway. So that was one example of just, the discipline and just the harshness of that environment.
That's savage. That's really savage.
It is.
So there must have been a lot of very wealthy traders who came out of this firm. Like, guys, if you're making like 10,000 to 50,000, some making six figures, $100,000 a day, like that adds up very quickly. Did these traders keep that money?
Some of them did. I'd say the most of them did. The better ones either went on to start their own hedge funds or, manage their own money and semi-retire. But there were also a lot who stuck around too long. And, if they built up a small pot of money and were trying to do the same trading styles and techniques, in the bear market that they used in the bull market so successfully, eventually they bled a lot of that capital. And, we were trading the firm's money for the most part, so you could tuck away your money. But again, if you're going to lose money on any type of consistent basis, the firm was going to step in and say, you got a choice, you're fired, or you can put up your own capital. And most people don't admit that either the world's changed or their style is no longer applicable. Most of them couldn't adapt and would try to put up some capital, but eventually would lose that capital. So I'd say probably half of them lost a good chunk of it, but half of them retained it and either went on to do other trading ventures or employed that money in different ways. If you're smart, you moved into real estate or whatever else was out there as interest rates dropped and deployed that capital in a more intelligent manner.
Right. And how long did you stick around at Daytech for?
I was there, I believe, for about 3 years, and then moved on to a couple different hedge funds before ending up eventually making a decision in late 2007 to start my own firm.
Okay. So how did that go? How'd that come about?
So I had been at, again, probably 2 or 3 different hedge funds and had seen how they operate, seen the money they made. And some were impressive, some weren't that impressive, but I had always gone back to that prop trading model where you can charge a trader $10 a trade when in reality, we got a rate from Goldman of about $1, for 1,000 shares. So you could have a pretty big markup on that trade. And if you're a guy like me who was trading, 4 or 5 million shares a month and you have 10, 20, 30 traders trading that type of volume, that builds a really significant commission buffer to the point where, you could endure some really serious losses and not eat into your capital because you had that commission buffer. So I thought it was a better model than a hedge fund, which again is really just about asset gathering. And obviously performance has to match that. But especially these days, it's much more about just gathering assets and trying to match the market. So I decided to do a prop trading model. And, it was a good time for it because we weren't talking about small prop traders. We were talking about, during the financial crisis, a lot of these guys were trading for SAC Capital or Galleon or some of these other very big billion-dollar fast money hedge funds. And maybe these guys had double-digit returns for the last 10 years. But in the financial panic of 2008, they were down double digits and lost their jobs. So, we were able to pick up a lot of these really talented traders for very cheap and get them to come work for us. And by the end of 2008, we had something like 50 traders or so working for us. These were guys, I'm not going to say they were Derek Jeter, but guys like a Derek Jeter, where you didn't have to pay them a salary of $10 million a year. You just had to pay them based on the number of hits they would get, which is typically the prop model. You'll get 50% of whatever profits you make.
I might be missing something here, but it was technically a hedge fund though, right?
It was. It was structured as a hedge fund, but we also added a commission component to it.
Okay. So you were trading investors' capital, right?
Yes. So the primary, we had capital from RBC, Royal Bank of Canada, along with several other big hedge fund investors out there had given us money to manage.
Right. So at your peak, how much did you have in the way of assets under management?
We were about $250 million.
Okay. Right. And what sort of trading were you doing there?
So we had it was a multi-strat model. So what we basically did is we tried to hire different traders, different money managers that had their own specialties. So, rather than having a pure energy book, we would hire 3 or 4 different types of energy traders. Maybe one guy was a utility guy. One guy may have been, a downstream type of energy guy. And then we also tried to just bring in other traders that were running different systems. So different sectors, we would obviously diversify. We had technology, we had, retail, consumer. So all of that. And then we had guys who's, would specialize in commodities or certain option strategies. So we really tried to have a very diverse mix of portfolio manager in order to give us that diversification.
Okay. Right. Now, I'm not sure when the best point to ask this question might be, but, at some point, from my understanding, it was almost out of the blue in some ways. The FBI came banging on your door while you're at home early one morning. When did that come about?
Very early. It was about 5 a.m. on in November of 2009. And, it would have been a pure shock to me, but for the fact that Raj Rajaratnam, who ran Galleon, which was a $7 billion technology fund, had been arrested 2 weeks earlier. And the way these things work is when you're arrested, there's something called a criminal complaint that's filed, and that's a public document. So when Raj got arrested, I pulled that right away because my partner in my firm had worked for Raj directly. He was sort of Raj's right-hand man when I hired him. And I read the criminal complaint, and it was during the exact time that my partner worked for Raj that these, insider trading allegations that the feds made against Raj took place. And I looked at, they even tell you what stocks, and some of the stocks were stocks I traded, like Hilton Hotels, was a stock that Raj, they charged Raj with making, a lot of money on unlawfully. And this was a stock that my partner had tipped me as well and told me, he was buying it and a lot of smart people, his firm, were buying it. I, was concerned that my partner would get talked to by either the SEC or the DOJ, but I never imagined that it would have gone that extra step and that I would have become a target or a suspect in this investigation. But sure enough, I was arrested along with about 14 other people. I think there were 9 in our specific case. And it was a mind-boggling experience, to put it mildly.
Can you just go into that a little further? Like, what was it like when the FBI just came running through your house? Because, for most of us, that's something we'll never experience. It's just sort of one of those things you see in the movies. What was that like?
Sure. And, that's the opening chapter of the book. I think I try to convey the shock and surprise of it all and fear and terror that you have. At its base, they could have called me or called my lawyer or anybody else and said, we've got some information. We think, you're a suspect and we'd like to talk to you. And of course I would have come into the office or talked to them. One of the things that bothered me is I was arrested in this pre-dawn raid, and it was a raid. It was a FBI SWAT team with this flak jackets, probably a half dozen agents along with, canine dogs. And again, it was 5 a.m. I've got 3 young children. My wife is there. It was designed really solely to do one thing, and that's terrorize. So, when they came in, it was, hey, you need to talk to us. If you don't talk to us, you're not going to see your kids for 10 years. And, it's very much a show of force, with the flashlight in the eye and everything else, designed to get you to talk or to, beg for a deal or whatnot. And, I was just curious, like, what was the charge? I was a lawyer. I didn't just watch a lot of Law and Order. I went to law school and practiced law for a little bit. And they wouldn't even reveal to me what I was being charged with, just that it was some type of securities fraud. And, the dogs running through the house, and they had to search the house and everything else. And, all I could think to myself is, well, what are you searching for? The securities? It was a very big invasion, I thought, of privacy, and just done in a way, again, not designed to elicit any type of truth or anything else, but designed to intimidate and scare me into cooperating.
So that is why they did it, you think, is to intimidate you and get you to talk instead of doing something maybe a little bit more civil and just trying to give you a call and get you to come down to the office.
Yeah, they don't want you to meet with your, obviously consult a lawyer or anything else. I mean, in my case, they didn't even read me my Miranda rights. I mean, not that is a big deal. It's supposed to be a big deal, but it didn't matter in this case. It was just, flashlight in the eye, dog in the house. You need to talk to us right now, or you're going away for a very long time. You don't want to talk to a lawyer. Are you sure you want to do that? It's designed to catch somebody off guard. And to offer them that sort of, prisoner dilemma that you see in the movies of, hey, if you don't talk, somebody else is going to talk. And then, any deal or any way we could help you is gone. You got one chance to help yourself, and that's right now. And, again, it worked for several people in our case. I happen to know a lot of prosecutors and know a couple of FBI agents, and again, went to law school. So I know you don't talk in that type of situation because that's how prosecutors sew up a lot of their cases. It becomes your word against an agent's word. And, before a federal judge, who do you think is going to win that contest? So, they could say that you omitted information or obstructed justice or lied and committed perjury. So, we had been advised, or I had been advised and learned in law school and other places that, you never talk to people in that type of situation because what you say can be misconstrued and used against you. So, I opted not to speak. But there were two other people, at least in our case, who spoke, who I don't really believe either committed securities fraud. But, again, the FBI came in and said it'll be 10 years. And they said, all right, well, what do you need me to do? Or what do you need me to say? And I think both of those people in our case made very bad choices, but their choices I understand, under that type of duress or coercion.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So even though they didn't tell you specifically what you were being charged for, all they said was securities fraud.
Securities fraud.
Right. So it's, that's pretty broad, right? Did you have a suspicion on why they were there though? Like, could you recall something which you think you maybe did in the past which maybe crossed the line?
I did. Not to cross the line, but I thought I was being arrested for the Hilton trade. After reading the criminal complaint and that Raj traded Hilton and he was being charged with insider trading on Hilton, knowing that my future partner had worked for Raj and had told me, again, he didn't work for Raj at the time, but he called me up and said, I'm buying Hilton. There's a lot of guys at my current firm, and he was at a different fund, who like the name here. They think something good's coming. I'm getting long a lot of Hilton. You should think about it. And I bought it based off that. I thought that's what I was being arrested for, which I thought was absurd, because that's the type of ambiguous tip that traders get all the time. I mean, I would probably get a dozen of those tips a week or more. Smart guys like this, or this analyst likes that. It didn't have the type of specific information or identify a source, a insider or illicit source that would have led me to believe that it was legal information. But I thought, in the financial crisis, these guys are making a big move to, punish some people, and they got Raj, and who knows what else is out there. I thought Hilton was the trade I was being arrested for. And it turned out they didn't even charge me with Hilton, or they ended up thinking about it. But then when they looked at all of the information, they realized that there was absolutely no case whatsoever to be made for it. So they never ended up charging Hilton. It was a different stock, 3Com, that I ended up getting charged for.
And did you feel as though, still on that morning when all this was going down, did you feel as though there was a misunderstanding and that, this would all be worked out and you would, you'd be back at home later that evening?
Absolutely. But I also understood, Aaron, that, finance is different from anywhere else. So the mere hint of impropriety or loss of confidence in finance can be fatal. So I thought it would be okay for me, but I thought my firm would be done because I did think, look, if they're doing this to me, God only knows what they're doing to Zvi, my partner, the one who worked for Raj. And, if this is going to be a really big deal, and it sounded like it was going to be a really big deal based on the fact that Raj was paraded all over CNBC and all these other channels, and it was front page of the Wall Street Journal, New York Times, I knew that my firm was toast. In 8 seconds, I knew we weren't going to survive that. Even if, as I thought and hoped, my attorney would, come down and clear all this up, and they'd realize that, I wasn't given illegal information. I was given a sort of broad tip on a stock that was not unlike many of the other tips I had gotten in my career, and was well within my right to play that.
Right. So were some of your other partners raided at the same time as this was happening?
It was. They grabbed something like 5 or 6 other people, of which one was my partner. 2 were my partners. They were brothers. Another one was a passive investor in our fund, but he was a galleon guy who worked closely with one of my partners. And then there were a couple other traders that I was familiar with but didn't know personally that worked for another hedge fund.
Okay. So what happens after you're taken away? Like, what happens from that point?
So in this case, they bring us all to a holding cell, and it's, again, very surreal. And when they put you in this holding cell, I knew right away, that clearly it was my partner who was responsible to a large degree for this mess. He's in there. There's another 5 or 6 of us in there. And even though there's a red camera in the corner, meaning, recording everything, he's carrying on about, who's the rat? I can't wait to find who did this to me, blah, blah, blah. I mean, he's just running his mouth like, something out of the movies. And, talking to another trader about, who he thinks was, turned him in or was an informant. So at that point, I knew he was dead and responsible for most of this, and just tried to sit quietly and bide my time until they let us know. I mean, you're just waiting for them. And at some point they pull you in and say, here's the criminal complaint. And I remember reading the criminal complaint, and it just seemed very out of context, clips taken from different body wires or calls that were out of context and didn't make sense. And then a very small number. In the criminal complaint, they charged me with making a $16,000 trade. And I was like, this can't possibly be, I can't possibly be being arrested in front of my family in a raid, my firm destroyed, my reputation destroyed over a $16,000 3Com trade, especially when 3Com was a stock, again, that my partners V tipped me on. But it was a very ambiguous tip of, smart guys I know at this fund are buying it. I like it. It was in the Wall Street Journal the week before saying this stock is in play. Wall Street Journal even had the acquirer, Bain Capital, the bank, Goldman, and the price, the eventual price it would get acquired at. And then it didn't get acquired for another 2 months or so. So it was all just very hard to believe that this entire thing was happening over this one trade. But, another 5-6 hours, you get arraigned by a judge. They set a bail. In my case, I think it was $250,000, which I was fortunately able to make. And then you go home at night and try to pick up the pieces of your life and figure out what's going on.
Why was this happening? Like, why do you think this was happening? Like you said, the criminal, what's the word? Criminal complaint? Is that the word?
Yes. Yep. Criminal complaint.
It stated this was all over a $16,000 profit, which is very minimal in the scheme of things. Why do you think this was happening?
I think, there's a couple reasons. One, and they did end up adding some other trades, some other 3Com trades to that to get that number higher. But I think point blank, what you had was, a very bad financial crisis. And you had basically a very angry public, and rightfully so. And then there was a deliberate decision on the part of either, the Obama administration or the Southern District U.S. Attorney that he would go after a lot of these hedge funds or traders for insider trading, because that's kind of, it's easy headlines and these are easy money. It's a very simple and convenient narrative that you can sell to an angry public that, hey, we're on the case. We're doing something about the financial crisis. This stuff's never going to happen again. You'll never lose your home again, and your money is safe in the bank. So you have this sort of preordained storyline, and a lot of cases were then chosen to fit that storyline rather than a real investigative approach that might have yielded some real targets and real reform. I mean, by going after insider trading, the total, I think, losses, and they're not losses, they're actually gains, there's no victims, were maybe in the order of $100 million or so. Compare that to the trillions of dollars that were lost from mortgage fraud or some of the other, bad actors and bad actions that took place during the financial crisis. So I think it was a deliberate choice. And then I think you also had an environment where, prosecutors want to get those scalps so they can get their 7-figure jobs when they leave the office. And these are very easy cases to explain to the public. Everybody's seen the Oliver Stone Wall Street movie. Everybody knows you're not supposed to do insider trading. Nobody really understands what it is because it's never been defined other than when it's really obvious. But you have a lot of these prosecutors and agents who don't have any real finance experience. They're lawyers or they were English majors. They didn't understand trading or math or the difference between bond or equity or anything else. So you had a lot of them come in and sort of say, all right, here's the guy telling him to buy this stock that he thinks it's a great buy or whatnot. And this guy knew it was coming from an illicit source. Therefore, 2 or 3 people removed from him, he should have known it too. And that's not the case. And that had never been the way these cases have been looked at or prosecuted. And it took, unfortunately, another 4 or 5 years before the Second Circuit and the Supreme Court really sort of spanked, the U.S. attorney as well as one particular judge, which just happened to be the judge I got, unfortunately, who was a rogue judge, that he was applying the law wrong. I mean, they were omitting entire elements of the law in the jury instructions, the ability to find knowledge and that there was a benefit exchanged. Our judge took that out of the jury instructions, and something like 3 or 4 or 5 cases after mine all got overturned because they applied the wrong law.
In some ways, if your partner hadn't have previously worked with Galleon Group, you might not have got caught up in this mess.
Yeah, I mean, there was, it took a lot of different, unlucky coincidences to make that happen, but he was clearly a guy who was trying to do things that were wrong. When a guy is trying to find somebody who knows a lawyer or bribe a lawyer, that's illegal and that should be punished without a doubt. But what I disagree with was they then took that particular person, and when he tipped some other people, he didn't tip some other people saying, hey, I'm bribing a lawyer. Here's this stock we got, because he wants to sound like a smart person himself and was selling himself as a brilliant trader and analyst. It would be, I'm a connected guy. My hedge fund friends are telling me this, or I've done some work and I think it's this. So he would always portray it as, I'm talking to smart money guys and they're telling me this, I'm getting law on that. Not, I'm bribing a lawyer and here's what he's telling me. And again, the feds came up with this theory, which is legally incorrect, that somehow when you trade a stock, you have to verify where that stock came from and then go down the line, the entire chain, each level, and verify that it was, not illicit or that it was a legal trade. And that's never been the way the law has been or how it's been implemented. I mean, think about, I don't have the ability to independently verify either the sources or the intermediaries. If I said to him, I need to know the name of each of your hedge fund friends, I need to interview them myself and confirm where they got it, he would look at me like I had 3 eyes, as would anybody else in the industry. It's in this industry, it was very much a swim at your own risk. Like you could either make the trade or don't make the trade, but I'm telling you what I'm telling you. I'm not going to let you talk to people on my network because then, I could cut him out of that network. But in the Fed's mind, it was, by not saying, hey, I need to know exactly where this trade came from and speak to these people, that I was somehow conspiring with him. It was a very big stretch in the law, in my opinion. And that opinion was backed up by the Second Circuit later on.
And what was happening to your fund during all of this? Because like you said earlier, obviously your reputation was damaged at that very point that you were raided. You had $250 million under assets. What happened?
Yeah, the fund, as I mentioned, ceased to exist about 8 seconds after I was arrested, for all intents and purposes. They did put us on CNBC and frog marched us out in front of reporters. And when that happened, Goldman, who was our prime broker, basically froze the assets and sold them off in a way that was probably very advantageous to them. So, whether it was a market sell for a very big number and then they were on the other side of that trade or not, in liquidating the accounts, a lot of partner capital was wiped out. So the fund was gone literally by the time the markets opened up that morning. Not unlike, if you remember Diamondback or Level Global, when 2 different traders were arrested there, and the feds did a raid just to get documents. Both of those funds, which were, $6-7 billion funds, both ended up shutting down just again because of that appearance of or a cloud that was hanging over them. So in finance, it's almost impossible to survive any type of serious investigation, much less, a dramatic FBI raid of the 3 main partners.
Just so I understood that correctly, pretty much by the time the market opened that morning, your fund had been entirely liquidated.
Correct. It was done.
But you hadn't been found guilty at that point. So how can they force you to liquidate your entire fund? How does that work?
Yeah, I mean, sadly, I think the presumption of innocence, and a burden of proof on the government to prove, guilt beyond a reasonable doubt, those are sadly more Hollywood fiction than reality. In my case and many other cases, the government can freeze your assets. They can lock you up and prohibit bail so you can't defend yourself. They can do a host of things in order to make it impossible to get a fair adjudication of your case. And in this case, again, Goldman or whoever the prime broker was, these are private parties. They're not government actors. So they do have the right, likely underneath, whatever documents we may have signed to get the account set up or whatnot, to take control of the accounts and liquidate if they felt there was a need, or if there was some type of, perhaps there was a moral turpitude clause or something like that. But it was done in a way that was, again, very unfair and should have been done in a more orderly manner as well in order to preserve, investor and partner capital.
Yeah. Wow, that's incredible. So what was the trial process like? How long did that drag out for? I mean, I presume it was also quite an expensive exercise for you to go through, right?
It was. And that's, again, one of the things about the criminal justice system that people don't really understand is, everybody is used to watching Law and Order. They think it's over in 40 minutes, from start to finish. So in my case, I made the decision, shortly thereafter my arrest, my lawyer made a pitch to the feds to drop the case because there was not adequate evidence and they felt, it was wrong for me to be arrested. And the feds, after a little more investigation, came back and said, look, we realize your guy is a peripheral player at best, but how about this? Let him plead guilty to one count of conspiracy. So no actual insider trading, but conspiracy to commit insider trading. And we'll give him probation, no jail time. And that's obviously a very different offer than, talk to us now or you'll get 10 years, which the feds, made when they came through the door. But I think after they saw that the evidence was extremely weak to non-existent, and they probably misunderstood some of the case and investigation, they came back with that offer. And I was stubborn and didn't want to take a deal and didn't think I did anything wrong and told them, no, I'm going to go to trial. Now, obviously, I handicapped that pretty badly, despite being a lawyer. In law school, we're taught that it's an objective, fair adjudication, that, both sides present their arguments before a neutral judge and a jury of our peers makes a fair and informed decision. That's obviously not how it really plays out. But it took something like almost 2 years before I got an actual trial. And then instead of getting my own trial, they put me on trial next to the two brothers, the one who had worked for Raj, who was incredibly guilty on his face and had no business going to trial. And they literally sat the three of us together and said, partner, friend, partner, friend. So it was a very big guilt by association case. And again, we were tried probably 500 yards from Zuccotti Park, which is where Occupy Wall Street went down. So this is the height of the financial crisis. This is, when anger at bankers and finance guys is at its peak. And I knew during jury selection that I was dead on arrival. I mean, the judge, sort of during jury selection said, how many here have a negative view of hedge funds or Wall Street? And the joke I make is you would have thought he asked who wants a free iPad, the way people's hands shot up. Probably, 9 out of 10 people raised their hand. And it had also been, sadly enough, Raj had been convicted himself the Thursday before our trial. We were on trial Monday. And so during the weekend in the Wall Street Journal, New York Times front page was pictures of Raj and then pictures of us and, saying Galleon Trial Part 2 and linking us to Raj, who at that point was basically a financial Lex Luthor, the most guilty person on the face of the earth. So you had overwhelming prejudice and bias existing at the time. And a judge who, again, I believe was a rogue judge and complicit with the government and let them get away with literally anything they wanted to do at this trial. And it wasn't until a couple years after that, a better lawyer than I had came up and challenged the judge's rulings in several of these other cases. And those cases all got overturned that had identical facts and basically identical incorrect jury instructions. But unfortunately, I had already been convicted and had already served, my time in prison.
So what were you actually convicted of? Because you said that you were offered, I think it was a plea deal, right?
Yep.
Yeah, so a plea deal for conspiracy and, no jail time would be served. But you went to trial and you didn't accept that. What were you actually convicted of?
I ended up getting convicted of 2 counts of insider trading, both in that same stock 3Com. So 2 counts just means one time I bought it and then sold it, and then one time I bought it again. So I basically ended up getting convicted of 3Com, insider trading, and then conspiracy, which is a catch-all that they throw out there. And I got sentenced to 30 months in prison after that.
30 months, okay. And these 2 trades, so that I remember you mentioned $16,000 earlier on. I presume that was just for one trade. What was the other trade worth?
They ended up adding some other trades in there, and the total trading, I think that they ended up charging was about $160,000 or so. And again, in a prop format or prop trading format, I wasn't at my fund at the time. This is when I was at a different hedge fund, so I had a 50% payout. So I really made off the trade about $80,000. So after taxes and everything else, it wasn't a big amount. And I was running, a $20 million pad at the time. So I ended up settling the case with the government for $30,000 is, sort of what they felt was the amount that I actually ended up taking home. So not $16,000, but certainly not much more, and for that $30,000, I ended up getting 30 months in prison. If you compare that to, let's say, the big banks who were fined something on the order of $400 billion, that's billion with a B, and virtually not a single person went to prison, or Phil Mickelson recently in a case, was cited for making $1 million in illicit gains, and he wrote a check for $1 million and gave it back to the government and didn't even get prosecuted. So, if there is any lesson, it's that it helps to have, political clout or friends in high places in these types of cases.
That's incredible, man. I can't believe you served 30 months over essentially $30,000. That's ridiculous.
Pretty crazy, right? Especially when, at the time I had the fund and had sold a piece of the fund for about 8 figures. So, the fund itself and the amount of money we were managing and everything else and employing 55 people, again, I do think there's something called pot committed, which if you play poker, it's, you put so many chips into the middle of the pot that you almost have no choice but to play the hand out. In this case, had the feds or the SEC come to me before the arrest, before it was on TV and splashed in the papers and everything else, and allowed my lawyer or myself to make the defense of, what they thought I did and what I actually did, I'd say there's zero chance I would have been charged. Certainly, this case would have never been brought today. It would have never been brought in 2003. And there was a lot of things that happened at trial that make me believe that but for the judge we had, Judge Sullivan, who, again, is a bit of a lunatic, any other judge probably would have dismissed this at the summary judgment stage or have given some type of probation sentence or a very minor sentence. But he happened to be a very, law and order, hard on Wall Street type guy trying to make a name for himself. And he sentenced my partner, who, again, was a bad guy, but nobody lost any money. He sentenced my partner to 10 years. There's cases in the U.S. where people try to throw a grenade or try to shoot somebody and they get 5 years. To get 10 years for what amounts to a victimless crime is a pretty serious sentence. But again, he was breaking the law and deterrence is necessary. And it was during the financial crisis. It made good headlines. So I understand the sentence. I just think it was a little bit excessive.
So what was it like going into jail? I mean, walking into the prison, what was that moment like?
It was actually, it was twofold. One, it was, again, it never stopped being surreal to me. I still was getting over the trial where, as part of the trial, we called as our only defense witness the lead FBI case agent. That was our only defense witness. And my lawyer asked him, can you point to one email, one body wire, one wiretapped call, instant message where Mike Kimmelman has passed inside information and trades on it? And she, after hemming and hawing for a bit, admitted no. That's the type of thing in my mind, or at least in the movies, where, the judge bangs the gavel and the case is kind of over. But again, not in this environment, not before this judge. There was a FBI informant, it came out, who was sitting next to me on the trading desk for 18 months, literally, 2 feet away from me on a trading desk, who I thought was my friend, but he was actually an FBI informant. And he was wired up every day trying to incriminate me in some type of trade or some type of scheme. And the feds didn't even call him at trial. And we wanted to bring that fact into the case to say, hey, you guys had an agent sitting next to him for 18 months wired up, and you didn't find a single, piece of evidence that was incriminating. Like, that should be implicitly say that there was a lot less going on than you think there was. But we weren't allowed to bring that evidence in. So there were a lot of different things that were still grating on me. But at least walking into prison, I knew that I could start marking the calendar. I could start, figuring out what to do with the rest of my life. And that at a certain point, I'd be able to go home and see my kids again and be their father and figure out, the second half of my life, despite, having had my reputation, my freedom, my liberty, my money, and everything else taken from me. So I was scared only because it's a pretty intimidating environment. But I was also excited to some degree that the uncertainty and that the limbo, of years pre-trial and what am I going to get as a sentence? Again, the government offered me, like you said, that probation plea if I took the plea. But once I got convicted, the government was trying to argue for 5 years. So, it's a pretty big change. And even the 30 months is a pretty big sentence just for exercising, your right to go to trial. Supposedly you have a constitutional right to trial. The judge was aware that I was offered probation, but, decided to give me, a sentence that was dramatically longer than that probation sentence. So it was twofold. It was fear, but it was also a little bit of, relief and excitement that the end was possibly in sight.
And what sort of prison were you sent to? Like, who were the cellmates and inmates who you were kind of put in with?
So this is a big misconception everywhere. Everybody says, you probably just went to a white-collar prison. There's really no white-collar prisons anymore. There were perhaps a few back in the day, and there might be one or two now that are a little bit softer. But because of the war on drugs and because of, cutbacks and whatnot, all prisons are pretty bad. This was a minimum security prison, so it wasn't nearly as bad as, heavy barbed wires or guards with guns. There were no fences. But, I'll give you an idea. The population was probably 500 people. It was probably 200 black inmates, 200 Spanish inmates, and maybe 100 white inmates. And out of all of those, maybe 25 white collar. Because most people are in prison these days because of the war on drugs. And that war is pretty indiscriminate, and they scoop up a lot of people and they give them insanely long sentences. So there were people I was with, who had, what's called a skid bid like me, which is only 30 months or 24 months. And then there were plenty others who had been there for 10, 15, 25 years. So, it's a large mix. Minimum means, people are supposed to have less than 10 years left on their sentence. So you do get some people that have worked their way down from penitentiary level who might have been in for, murder or bank robbery or kidnapping or something else. But for the most part, it's a lot of people who just want to go home at that point.
Okay. And what was life like for you in prison? Like, did you have any run-ins with anyone, or were you fairly well looked after? I mean, how'd it go?
It was rough, especially in the beginning. And I talk at length about it in the book, that the Bureau of Prison, in its infinite wisdom, decided to put those two brothers that I was partners with in the same prison. And these guys, or at least one of them, he was so deranged and angry over his 10-year sentence that he sort of blamed me for that 10-year sentence to some degree, because I went to trial with him. And at trial, I put on in my opening statement a whiteboard that basically said, out of the 14 people in this case, there's only one of them who didn't have a prepaid cell phone and who didn't pay any cash bribes. And the only person is Mike Kimmelman. In his mind, that made him look more guilty, which I'm sure it did. But at the same time, he didn't get convicted because of that. He got convicted because there was 500 hours of him on tape saying crazy things like, if we get caught, we're going to go to the big house and, don't tell anybody X, Y, and Z, as well as 7 informants that came forward and pointed to him and said, no, that's the guy who paid me a cash bribe and told me this. So, he was guilty as can be, but with no one to lash out at except me, he took out his anger on me and came after me in the beginning when we were both there. So I was on my heels and obviously had to watch my back and had a very rough time for those first few months before I knew enough inmates and knew enough people that I was able to, steer clear and protect myself.
Okay. So it was mainly someone who you already knew of, right?
Yes. If it hadn't been, likely it would have been a lousy experience, marked more by boredom than any type of habitual violence. There is violence, but limited violence at a minimum security level because they have a zero tolerance policy for it. It's not until you go up in levels to a low or a medium that you start to get, sexual assault and really rampant violence. But you hear the stories, and I saw, several episodes myself while I was there. And I do think the American prison system, I don't think the average American would allow it to exist in the form that it's in if he had any real understanding of what it looked like or how it was set up. It is a, pretty barbaric place, and guards have absolute power, and there's a tremendous amount of corruption on all sides, and it's really, incredibly punitive, and it's supposed to be punitive. I know you broke the law, you should pay a price, but there's zero rehabilitative aspect to it. So we can't be surprised as a society that we have a recidivism rate of about 66%, meaning 2 out of every 3 people that go through the prison system end up back in prison within 5 years. And if you think about, the societal, the moral, the financial cost of all of that, it rises into the hundreds of billions of dollars, really, because we have done zero training or rehabilitative, implemented any of these types of things that we could easily do for very little money that would give people a better chance of succeeding on the outside once they're released.
Yeah. So what would you say are some of the things which shocked you the most about life in prison?
Just that there are, one is I think they are warehousing a lot of mentally ill people. And I don't know if that's a budgetary constraint or whatnot, but there was a significant portion of the population that had clear mental health issues that needed help and medication. And were probably just a little bit of help or medication away from being normal, productive citizens, but never got that help. That shocked me a bit. I think the other major factor that I saw, and I think society pays a pretty big price for this too, is that addiction or substance abuse plays such a huge issue. I'd say something like 80% or more of the people that are in there had some type of substance abuse issue that may have led to them either directly getting into prison or clouding their judgment and making them do things or, not seeing what the right path was. And again, a very expensive way to treat addiction, which I do think is a real problem. I mean, if you have cancer or diabetes, you get real treatment. Nobody or something like 1 out of 10 people who have an addiction problem get any real help for that addiction. So I think if we intervened earlier in some of those cases and offered people help and treated addiction as a mental health issue rather than trying to criminalize it and punish it and put people in prison, separate them from their families and remove their ability to get employment or housing or anything else later on, I think it's a very, very bad policy. I think the war on drugs has been, probably the worst public policy we've ever had in this nation, at least in modern times. So that part shocked me as well. And then, two other things where I found a large chunk of people who were just like you and me, who were everyday normal people who made a mistake and admitted it or, got caught up in something, as well as, probably 10 to 15% of the people there I thought were innocent and were either, part of some other bigger conspiracy or got scooped in a big net, but there was several, innocent people as well. And then I think, there's the flip side of that is there's people who life is just really cheap too, and don't really care about anything, lacked total impulse control. And that and the corruption of, I think, the guards and the administration, I thought was kind of shocking. It's probably Piper Kerman, who wrote Orange is the New Black, said it best. It is the greatest mismatch of power that exists anywhere in the United States and possibly the world. I mean, you have a guard who can do or say literally whatever they want, and an inmate who has zero rights whatsoever, zero right to, to appeal a decision, zero rights to do anything. It's in some cases almost worse than modern day slavery as far as rights, because we obviously don't have any, say in anything. And our rights are solely derived from what the guards and administration say we can do. So it's a pretty barbaric existence.
Yeah. No, it's not good, man. And where was your head at, during this time? Was it a depressing time in your life for you, or did you manage to stay somewhat positive throughout it?
Once I got past the initial, partner drama, I was in a decent place. I mean, I had gotten sober, which, not that I was an out of control alcoholic. If anything, I was certainly highly functioning, but I had been drinking far too much. I had probably been drinking heavily since I was 15 or 16. After 9/11, turned that up a notch. After the financial crisis, another notch. After the arrest, another notch. So really, had an issue that needed to be confronted, and it got confronted on that level. So in some ways, it was a blessing. So to be clear and clean and sober for the first time in 20 years plus was something that felt nice, and allowed me to get some perspective on what I went through, on what I still had, and to see that I still, was in many ways blessed with 3 healthy children, great friends and family, and then start thinking about what I wanted to do the rest of my life and how I could possibly have an impact on others.
And so did you end up serving your full 30 months? You didn't get out any earlier?
I ended up serving 21 months. I was able to knock some time off through good behavior and through going through a substance abuse program in prison that allowed me to do 6 months in a halfway house as well.
Okay, so what's a halfway house look like?
Well, this one was in the Bronx, and I don't know if you know anything about the Bronx, but it's a bit of a rough area. And the joke I make is the only thing worse than a Bronx halfway house is prison. So it was a pretty rough. It was a pretty rough environment. It's like a 5 or 6 floor walk up, really bad shape, run by, again, corrupt people who have zero interest in, what your best interest is. They're just sort of running out the clock on their job and have the ability to mess with the inmates or the halfway house, residents. And, again, you wouldn't believe it unless you saw it with your eyes. I mean, the whole point of a halfway house is to help people adjust to society and to re-enter society. And it's almost the exact opposite. I mean, you can't, there's no computers. There was one phone. You had to wait in line to use it with quarters, with a dozen inmates in front of you. You had to make an appointment if you wanted to go out to try to find a job or to take an interview. You had to give 48-hour notice. So, imagine there was one guy I was with there who was like a chemical engineer, mechanical engineer, the best resume you've ever seen. But what was he going to do? He couldn't produce a resume. If he got a call back from a firm that he interviewed with, he had to rely hopefully on an inmate to answer the phone and take a message. They made it in a way that was all but impossible to gain productive employment or to re-enter society, which is really the exact opposite of what it's supposed to do. So again, just really a silly, backwards environment.
Wow. Okay. So what's life like for you today? What are you doing these days?
These days I'm doing several things. So when I got out, I started some real estate investment. I had invested in some properties and some fix and flips back when I was in law school, and had those skills, having been, an M&A and a real estate lawyer, and understood how to look at investment. So have done a lot of deals on that front, and then also put some time into finishing the book, got the book done, out and published, have been speaking at different events as part of the book, and have now also been doing some coaching, some high-end personal growth coaching related to the book, and some of what I've gone through and overcoming adversity, and how to align, yourself properly to overcome those types of obstacles. And then more recently too, in the last year or two, there's been two sectors here that have been really sort of a paradigm shift in the U.S. and globally that have shown tremendous growth and are almost disruptive, and that's the cannabis industry. I've been making some investments on that front, mostly on the medical therapeutic side, which I think has tremendous ability to confront a whole host of afflictions in an organic and more natural, with less side effects manner than a lot of the existing pharma applications out there. So have been looking into investing and consulting on that front. And then have also been active in cryptocurrencies for the last couple of years. I have a close friend of mine is a bigwig in that industry, and we've recently been putting together a product, a newsletter product, as well as a trading product in that sector that we think is really sort of cutting edge and different and adds a lot of value. So we've been taking, a lot of the private advice we've been giving to clients, and we're going to roll that out on a more broader scale, open to the public.
Okay, so you haven't been entirely scarred from financial markets.
You know what? I was up until recently. I do think, in this case, especially with cryptos, again, the regulations aren't clear, but there's nothing preventing me. There never was anything preventing me from managing my own money or somebody else's. I just couldn't register with a firm, like a Goldman when you have to register with the SEC. I didn't think it was an issue.
Right. All right, Michael, well, let's leave it at that for now. Man, I have to say, thank you very much for doing this and being so open and sharing your story. I mean, it's certainly been a wild ride, and I'm glad, a lot of the drama's behind you now, so I hope better times ahead. But yeah, thank you very much for coming on the podcast, Michael.
Thank you, Aaron. Read the book, get the book. I think you'll enjoy it. I think your readers will enjoy it. And or check me out on Twitter, Mike Kimmelman, and I look forward to hearing from some of you guys.
Yeah, if someone does want to pick up a copy of the book, where's the best place to get it?
Amazon usually, or any bookstore, but Amazon, Confessions of a Wall Street Insider, easy to get electronically or hardcover.
Okay, and you're also on Twitter. What is your Twitter handle?
It's at Mike Kimmelman, 1M.
Okay, do you just want to spell that out?
Sure, MikeKimmelman.
Very good, man. All right, well, enjoy the rest of your evening, and let's talk soon.
Sounds great, Aaron. Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Traders, how y'all doing? Now, I'm preparing this episode a couple weeks in advance because as this is being released, I will actually be away on holiday. I'm going to be in the Maldives for a few nights, channeling that Timothy Sykes lifestyle. You feel me? I'm kidding. But I will be in the Maldives for a few nights, and I'll also be in Singapore for a few nights. So I'm just taking off for, I think it's about 10 nights with my girlfriend. It'll be nice to kind of switch off for a little bit. The last couple trips I've been on have obviously been trading related and related to the podcast, etc. Anyway, on with the show. I have a fresh episode for you that quite possibly will introduce you to a new type of trading strategy, one you mightn't have heard of. My guest is proprietary trader Tim Steenstrup, someone who I actually met briefly while I was in New York City. Tim came out to the event. We've had a few emails back and forth over the past kind of few months, and Tim's also a listener, long-time listener of the podcast, which is very cool. So since 2013, Tim has been a cross-border arbitrage trader at Conventus Capital. But markets have been a part of his life going right back to 1994. Tim's been a part of a brokerage firm in Japan, a hedge fund, which was actually featured in the Big Short movie, and trading firm. During this episode, we skimmed through Tim's backstory and then spend a large part of the episode going into the mechanics of how a cross-border arbitrage strategy works. Tim does mention that this type of strategy can be difficult to implement as a retail trader, but regardless, I think it's good for you to hear about the various approaches of how professional traders are trading the markets. It's also quite interesting to hear how Tim's used insights from previous roles and experiences to shape his trading strategy of today. Like, in some ways, it's almost no surprise that he's wound up trading this particular type of strategy. It seems like it's something which is well suited to him given his background. Tim also makes some helpful comments about taking and recovering from losses throughout the episode too. I hope you will enjoy this episode and learn a few new things. Here is Tim Steenstrup for episode 144. Just for starters, Tim, how many years have you been trading now?
I've been trading since, I've been in the markets since 1994, and I've been on the proprietary trading side since 2004, and really been truly my own proprietary book since 2007. So it's kind of a combination.
All right, well, let's wind the clock back to around 1994. How come you got involved in financial markets? Like, what attracted you to all of this?
Right. I'd always been a risk taker. I always enjoyed risk when I was growing up. I was, played a lot of poker, which is kind of the typical MO, and, gambled a little bit when I was in high school. And, I loved risk. But after college, my family definitely had the course for me to go to law school. It's a much more conservative course. So I graduated from college upstate New York, went to New York City, interned at a law firm, took my law school exams. I did pretty well, but I wasn't really thrilled with the career choice. So I decided to defer applying to law school for a year, and I thought I'd travel the world. And at the time, Japan was, a very powerful force in the world. They had bought Rockefeller Center. They had, they were just a huge player in the world in the early 90s and late 80s. So I basically moved to Japan in 1991. I thought I'd travel the world, and I started with Japan. And one thing led to another while I was there. I was just kind of having fun for a year or two. And while I was there, I met some guys who were working in the markets, and they asked me to interview at a brokerage firm. So I came in for the interview. I loved the environment. I thought it was super exciting, and they needed basically Western guys in Tokyo to cover U.S. and European accounts out of Tokyo. And these were accounts that were coming into Japan to try and buy U.S. bonds, Japanese government bonds, and things like that. So that was actually my first stop in the financial markets. And I did that for a few years, and I liked the environment, but I was not a decision maker. I was kind of helping other people buy bonds, which, there was a lot of excitement to it, and you saw a lot of money moving around, but I wasn't the guy making the decision. I always wanted to be a decision maker. But I stayed on this path for a while because it was very secure. So I had good accounts, and I was moving back and forth between Tokyo and New York, and, it was an exciting business. Eventually, I was working in Tokyo, and I kept trying to get back onto the proprietary trading side. And one of my accounts was a very famous place called Front Point Partners, and which became famous in that movie, The Big Short. And they needed a trader for their growing Japan fund. I got a job with them. They were situated in Greenwich, Connecticut at the time, and I was kind of trading very late hours out of Greenwich, and then I was trading late hours out of New York. So I was basically trading Japan until 1 or 2 o'clock in the morning in New York City. And I was part of it was quite a big hedge fund. It became $1 billion fund after a while, and it was fairly successful. But I was not really a decision maker there. I was reporting to my boss, and he was making most of the decisions. So still, although I was part of, a really good hedge fund environment, and I was learning a ton, and I was learning a ton about risk and how to do the job, I wasn't the guy in control, and I really wanted to be the guy in control. And eventually, we parted ways in 2007, and that's when I really became a proprietary trader. I got a job at a firm called, which at the time was one of the larger proprietary trading firms probably in the world. And I know you've had guys on the podcast before that have talked about proprietary trading firms, but the basic dynamics of these firms can vary a lot. And this one basically, they gave you some capital to trade, and they levered it up quite a bit. So, and then you would make a percentage of whatever profits or losses that you made with the firm. So I joined there, and it was a very rocky start because coming from Fund Point, which had been $1 billion fund where we were kind of running these long short portfolios in Japanese equities, you can't trade that way when you go to a prop firm. You have to manage risk much more quickly. Proprietary firms really don't allow losses to continue for long. So when you're at a hedge fund, you can short a stock, and you can hope for some catalyst to come in the stock after a few months. And if it goes against you by 10%, that's okay, because you've got this huge capital base to maintain losses. But when you're at a prop firm, you can't do that. And you kind of have to cut losses very quickly. And it was a very painful first few months for me, and I had to learn that lesson. And I got into a hole very quickly. I'd lost about $60,000 or $70,000, and they called me in, and they were like, what are you doing? You need to manage risk better. So I decided to go back and reread some of the books that I'd read in my early days in finance, and the biggest one that I reread was Market Wizards by Schwager, who you've had on your podcast. And when I reread the book as a prop trader, it was so different from reading it as a non-prop trader because, obviously everything related to me much more thoroughly. And basically, a lot of the prop traders in there talked about managing risk over and over and how they were preparing for the great crash of 1987. And this really started, ringing bells in my head. I'm like, okay, let's manage risk a lot better. So I completely changed my strategy, and I moved on to a much quicker strategy of more or less, I took a delta neutral strategy for a while. So I was shorting one stock versus buying another stock. And that strategy was really good in 2007 and 2008 because volatility was picking up. And in a higher volatility environment, sort of a delta neutral strategy like that really works pretty well. And the other thing that I did was I really got into a new type of trading called cross-border trading or ADR arbitrage. So you want me to go through what that whole strategy is?
Yeah, I mean, I'm definitely keen to speak with you about that strategy. Just before we go that far, though, let's backtrack just a little bit. I want to talk to you about those first few months you said you lost about $60,000 within the first few months there because your strategy just wasn't working out. How did you come up with this new strategy? Like, where did that come from? You said you described it as a delta neutral strategy. Like, how did you come up with that?
So what happened was it was really a big moment for me because I was like, can I hack this? And I went back and I read Schwager's book, Market Wizards, and it just, the light bulbs started going off like crazy as I reread it. And I was like, if you really read the book carefully, there's several of them that talk about the 87 crash and how they were treating markets going into the 87 crash and how they were all managing risk. And I hadn't been doing any of the things that they were talking about in the book. And I said, well, let me start doing these things. And the strategy that came most clear to me was trading delta neutral. And I just said, well, I might make less money trading delta neutral because you always got one long versus one short in terms of dollar amount. Looking back, maybe I was a little naive, but it just clicked. And at the time, the only delta neutral strategies are only going to work if volatility is decent because you're looking for dislocations in your stocks and to be able to take advantage of them. And if there's no volatility, those dislocations won't really happen much. So that was it. That was like the first strategy I tried with delta neutral. And then I combined that with this cross-border trading, and it just worked really well.
Okay, well, let's speak a bit about this strategy because this is still the strategy you're trading to this day, right?
Yeah, I trade it still to this day, although not as much. You need vol to trade that strategy. So although I still do it, it's you have to be much more selective about it. But yeah, why don't we go through how it works anyway?
Yeah. Break it down for us. Explain the strategy. Yeah.
Yeah. So I was living in Japan. I decided to do it with Japanese stocks, and there were other guys that were already doing this, but they had never lived in Japan. They were just kind of using their own market knowledge to trade the strategy. So the most obvious way to look at this is there's a lot of stocks that trade on different exchanges around the world. And a lot of those stocks are fungible between exchanges. And the obvious example is a stock like Sony. Sony trades in Tokyo under the ticker 6758 in Japan. It also trades in New York under the ticker SNE. You can buy SNE in New York, do a foreign exchange transaction where you would sell yen at the same time, and then you would sell 6758 in Japan. And if you have a broker that will help you, you can collapse that trade into one. So, the most obvious thing is, let's say Sony reports earnings after the close in Tokyo, and they're bad numbers, for example. And then the Sony shares in New York, say they drop 3% in New York because, all the markets and all the algorithmic traders are reacting to the bad numbers in New York, so they drop them 3% below the Tokyo close. So if I think that 3% is too much of a drop, I can come in and buy SNE in New York, do an FX transaction where I sell yen, and then hopefully 6758 in Japan will open above 3%, less also the transaction fees. And that strategy, works in high volatility when people aren't pricing things correctly. So that was basically the type of strategy that I started to get into in 2007.
Let's break that down a little further. The first thing you mentioned, which I have a question around, is you said you do an FX transaction. to trade the overseas product. I mean, what do you mean by do a FX transaction?
So you have to collapse. So when you're buying SNE in New York, the SNE in New York is trading in dollars. And the 6758 shares in Japan are trading in yen. So to lock in the arbitrage, it's not really an arbitrage, but to lock in the arbitrage between the two markets, you have to do an FX because you're locking in the price of SNE versus 6758. And, the yen could move. If the yen moves 1% or 2% while you have the transaction on and you haven't done your FX, you'll be making or losing money depending on how the yen moves. So you have to there's three transactions to every one of these cross-border trades. There's the trade you do in the US, there's the foreign exchange transaction, and there's the trade you do overseas. You do three things.
So when you do this FX transaction, what does that mean? You're actually buying, so you're actually trading the FX markets as well. So you're trading US dollar versus yen.
Yeah, you have to do an FX. I wouldn't. Yeah, exactly. It's a hedging transaction, but yeah, you're actually. So let's say that I buy SNE and sell 6758. Then I need to sell yen. Okay, so I need to buy dollars and sell yen overseas. And if I'm doing the opposite, if I'm selling SNE and buying 6758, I need to buy yen. So you have to do, whatever the amount of yen that you're selling or buying, you have to, do an FX on that transaction, or else you haven't locked in your arbitrage. And that would be standard for any, cross-border arbitrage. When you're going between countries, there's always going to be a foreign exchange. Even if it's merger arb between countries, you're always going to do a foreign exchange to hedge out your risk.
So is that the only reason why you're trading the underlying currency as well, is to hedge?
Yes. I'm not taking a view on the underlying currency at all. In general, I mean, we do occasionally, but that's not really the game.
Okay, so there is a chance, that part of the trade, like that particular transaction, you could actually lose money and reduce profit on your trade from that?
But you're doing this as a stock transaction. You're thinking to yourself, I'm here to trade the arbitrage on the equity, not the FX. And very often they go hand in hand, because when the Japanese yen is weakening, that's generally good for Japanese stocks. So, this is all very combined with each other, but still, there's usually only a few hours between the New York close and the Tokyo Open. So you're usually just getting minor movements in the yen, and you're just kind of locking in the stock price. So, but you got to remember, in 2007, I was doing this mostly on a delta neutral basis. So I actually wasn't doing a lot of yen transactions, because if I was buying SNE, I was shorting some other Japanese name against it. So they would cancel each other out, and I wouldn't actually have to do a yen transaction in those cases. But in general, you do have to do that.
Right. And you said when you were first describing the strategy as well, that sometimes, or depending, your broker might actually be able to help you out with this. Is that a common thing, or do you need a specialized broker for this type?
No, it's very, you really have to be at a fund to do this strategy, in my opinion, unless there's a retail broker that's willing to do this, to help you through, because you can't collapse the trade without someone actually funging the U.S. share versus the foreign share. Like, you can't just do it naturally. Like, a retail trader can't just go out there and do this strategy. It's very difficult. Now, that's not to say it's completely impossible, but it takes a lot of legwork. I had a friend who was very experienced in this strategy, working at a fund, and he tried to do it on his own, and he couldn't. He said it was just he couldn't find anyone to collapse the trade for him. That's not to say it can't be done. It's just saying I just think it would be difficult.
You also said when you were first describing the strategy that if you think the stock has dropped too much or gone up too much, how do you define what too much is? Yeah,
well, that's the nature, that's where experience comes in, and how you think the stock is going to react. So I do a lot of work, looking at the news and understanding the numbers and looking at how the stock has reacted before to similar news. So earnings are the most obvious catalyst to move these stocks, because they happen every quarter, and they can move quite violently on earnings. And a very typical thing that happens is, let's say Sony again comes out with numbers after the bell in Japan, and it drops 3% in New York. And I think the numbers are horrendous. Okay, I think they're much worse. I think Sony will open. I think the market's going to react much more negatively. So I might short Sony in New York and try to cover it in Japan at a much lower price. But I have to really study the numbers and just see if that's justified. But very often what happens when you get a big discount on the screens, a lot of the algorithms or other traders that aren't as experienced come in and they'll buy, the bigger discount because they just see a big discounted number and they just come in and start buying it kind of blindly. So you just got to be aware, and those are the kind of trades that I look for pretty regularly. And it doesn't always work. Believe me, I can be very wrong at times too. I mean, if I guess wrong, or if the market is or if some news comes out after New York closes, the whole thing could reverse very quickly. Sony could have, a conference call, before Japan opens and say, well, we made a mistake when that was reported in the numbers, or they could say our sales of this product were much stronger than we thought, and the whole thing could turn around. So there is a lot of risk in these trades.
I think what might be helpful for not only myself, but everyone listening to this podcast, just to get some better context around how the strategy actually works, is maybe if you could give us another example. So here we've talked about the Sony example. I mean, can you walk us through maybe a recent trade that's worked out?
What has worked out recently?
Or not worked out?
Well, we can go through what have I done very recently that has been good. There have been a lot of good trades recently in see, the thing is, these trades aren't as exciting, but why don't we go back to the financial crisis for a second, when things were really starting to blow out, and every day you'd come in and U.S. futures would be down 2-3%. And what was happening, these we call the ADRs, which is the American Depository Receipts of the Japanese stocks, were moving wildly because hedge funds had to dump, massive positions, or, it was just these huge dislocations were occurring, and there were huge profits to be made and losses to be had at the time. So, one of the biggest trades I did in those days was I think we came in, futures were down about 3%. And I looked at some high beta names. Like there was a high beta name, or a higher beta name, which was Honda, which trades in New York and Japan, and a low beta name, which was NTT, which also trades in both markets. And they were both trading at about the same level, which was down like 4% in New York, something like that. And so what I did was I shorted Honda and I bought NTT, thinking that the defensive name NTT would far outperform Honda when Japan opened because markets were so volatile. And sure enough, when Japan opened, Honda fell dramatically. It was a huge fall. It was something like 15%. And NTT only fell like a couple percent. So that was like, a very typical kind of great trade that worked in those days. I had a couple disasters with this strategy. 2 years ago, Nintendo, which is a stock that everyone knows, came out with news after the Japanese closed that they were going to move into the mobile gaming business. Nintendo jumped, in New York, it had jumped up over 30%, which was above the limit that it could go in Tokyo. It was kind of crazy, and I thought it was just much too much. So I started shorting it in New York, thinking I'd be able to buy it back, up 20% or something in Japan. But when Japan opened that night, Nintendo went right to its max upper limit and barely traded. And I was kind of caught short. And the next day I had to cover in New York, and it rose like another 30% in New York. So it was a huge loss. But that's also happened on the good side a couple times too, where you catch, some stock will come out with earnings, like a couple times Honda's come out with earnings, and the market has just completely misinterpreted them. You have the chance to short it in New York and buy it back in Tokyo when it drops much more. So, it kind of cuts both ways.
Okay, so how come these trades turned into really big losses? Just because of how fast the price was moving and the gaps on the open?
Yes. Yes. I mean, I had underestimated like the Nintendo trade, I had underestimated the magnitude of how much, how underowned Nintendo was in Japan and how many fund managers didn't own it. And they saw this as their catalyst to get into the stock, and they just bought it like crazy. And plus, there were a lot of guys who were short the stock. So there was a bit of a short squeeze on. That's what happened. It was brutal. One thing you have to learn in trading is how to accept these losses and accept that losses are part of, your strategy in the trading business. And you just kind of have to roll with them and move forward.
Yeah. And I know throughout your career, you've had a few really big losses, somewhere around the dollar mark. I mean, was that one of those?
Oh, yeah, that was one of those. Yep.
Okay. So how do you move forward from that point? Like, what do you do the next day when you show up at work?
Well, I have to say I've handled it differently over the years. After that loss, I had planned a vacation the next day. So we were off on vacation for 2 weeks. And I was thinking about it on vacation, but it definitely got me down. But after that, you go through these phases when you take a big loss as to how to accept them and move on. And I think it's just a crucial part of trading. And I kind of had, I kind of worked in my head that, you just have to accept that these are part of the business. And you move forward, and then you start chipping away at the loss, and you start, hitting singles and doubles. And before you know it, you've suddenly made back everything that you lost and then some. And then you got, you're back in your groove, and then you're starting to hit much bigger shots, and you're seeing other trades that then you make, huge money on another trade. You make on another trade. And, so, it goes in phases.
So how long did it take you to recover from something like this? I mean, it
was actually much quicker than I thought. It took, I thought it was going to take a while, but it just took me, the Nintendo loss took me a few months. And I was kind of right back to where I'd been. And, it just shows you can't get too down when these things happen. You just got to fight through it.
Yeah. And I think that's really important to keep in the back of your mind, like how quickly you can lose money. Like you lost over $1,000 on this particular trade within the space of 2 or 3 days, which took you then a few months to get back. I mean, I think that's pretty good that you were able to make that back in a few months, but just shows like how quickly it can all be taken away from you as well.
Yeah, it can be taken away very quickly. And it can also be, you can also, there are other times that you don't realize you can make it very quickly too. The one thing is, if you get down about a loss, your brain is not ready to look at new opportunities. So you just have to switch your brain back, just like an athlete, who has a bad play, he has to turn it off or else he's going to make more bad plays in a row. So you just have to recover and get back in the game. It's a good lesson for all of life.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Can we talk about some of the factors which have contributed to some of your most profitable trades? You know, just sort of switching this around here.
Yeah, I mean, definitely the most profitable I had been was during high volatility events, or when I read the news really well, and I understand that the market has misinterpreted the news. So, I mean, I definitely during the crisis were some enormous trades, and they were happening almost every day. You know, and recently, you know, the trades are a lot more boring. They're just like things like what happened with Sony. Sony came out with numbers after the close one day, and they were terrible numbers, and the market had only taken Sony down 2 or 3%, and I shorted it, and it ended up opening down something like 10%. And these are the kind of trades that, you know, are much more common and regular, these kind of volatility events, and they're happening. You know, what's happened now to this entire cross-border merger, this cross-border ADR arbitrage game is, you know, the algorithmic traders have really come in, and, you know, on a normal day when there's no volatility, there's very little to do in these trades. If there's not much news out, then the algos just come in, and they have their algo based on where Nikkei futures are trading in Chicago and where S&P futures are and where dollar yen is, and they have an exact algorithm as to where these stocks are going to open. So, you know, it's a lot tougher now, but the volatility events are still there, and the best events are still definitely during earnings season, when, you know, when you can really get dislocations, and the algos don't really know how to trade those events very well.
How much time would you say you spend reading the news and actually studying for these particular trading opportunities?
Massive. I mean, I'm in the office usually around 7:15, and I'm just reading, you know, news nonstop. And I'm reading it during the day too. I'm just reading news nonstop. And to be honest with you, I enjoy it too. I mean, I think the markets are a giant puzzle, you know, where you have news coming in from around the world, and you kind of want to gather it and see how it all fits together and how it will impact, especially the stocks that I trade. And I love that aspect of it. But yeah, you are reading, I mean, especially during earnings season, you know, I'm reading everything. You know, I'm reading analyst reports, and I'm reading, you know, doing a lot of historical checks to see how the stock reacted last time it had earnings. And, you know, you're doing a lot. And, you know, but I really enjoy that aspect of this job. It's very, very challenging. And you're learning, you know, tons every day, not just about your own stocks, but about other sectors, you know, that are going on. And you're learning, you know, more and more every day. How does, you know, how, you know, when this U.S. stock does this, how does this Japanese counterpart that's in the same industry react? So there's a lot of trades like that are out there. And the more you learn about the markets, the more you learn how to take advantage of them.
And how do you keep all this information together? Like, do you just store it all in your head, or are you taking notes, or like, do you have a sort of a process around this?
Yeah, I mean, I come in the morning, I have my pad out, you know, I basically put a line down the middle of the pad, good news on the right, bad news on the left, U.S. news up front, and in Japan or you know, Hong Kong news and Australia news on the bottom. And I'm just, anything that I think is going to impact some of the stocks that I trade, I just jot it down and see how it all fits together when these stocks open and you start seeing, you know, what they're doing.
Okay. And are there any news sources which I guess are a favorite of yours or you think are most credible? What news sources do you prefer to read from?
Well, I mean, I trade off of Bloomberg. So we, you know, everybody at our firm has Bloomberg terminals, and, you know, we use those for trading, and, you know, we pay for, you know, up to the second news. And I'm also, you know, I'm on Twitter. I don't tweet much, but I do follow, you know, a lot of people on Twitter, seeing what they're saying. And I also get a couple of professional news services, stuff that's going to come very quickly. And I'm also, you know, hooked up with a lot of analysts. So, you know, we're seeing analyst reports flow in, and, you know, looking for how news is going to impact the stocks that I trade based on that too.
And just a couple minutes ago, you mentioned Australia. So this is a question I actually meant to ask you earlier. We've spoken a lot about the US and Japan. Do you trade this particular strategy or a strategy similar to this across other countries as well? I mean, either US versus Australia?
Yeah, we used to trade Hong Kong. Yeah, occasionally we trade a lot of these markets. Just Japan is the easiest to trade because the cost of trading in Japan is fairly low. We do trade Australia too. The problem with Australia is the biggest stock in Australia is BHP, and it's probably the most arbitrage name in the world. So, even if let's say in New York, BHP is at a 6% discount to Australia, it will often open almost exactly where it closed in New York. Just because so many people are involved in it and they're kind of a self-fulfilling prophecy. So if they all buy it, they're all selling it in Australia also. So it's just kind of and their break even is always the same price. So that's what happens. Some of these markets are much, much harder to trade than others. But we have a guy in our firm who trades Europe. We have a couple of guys trading Japan. We have someone who specializes in India and Indonesia. So we are trading a few markets.
How accurate is this statement that you want to look at places that fewer people are looking? Are there many people? I mean, out of everyone I've had on the podcast, I don't think anyone trades a strategy quite like this. So is this a strategy that's, obviously it's quite unique in many ways?
Well, it's very interesting because it varies. The algorithms obviously make my job tougher on low volatility event days. However, when a volatility event does happen, I feel that I like to think that I'm more knowledgeable about the stocks that I trade than a lot of the other people who are looking at these markets and trying to trade them. So I think I tend to think that they're going to try and make a mistake, whereas, I'm going to be more often correct than they are. So, I don't fear more people coming into these type of markets. But yeah, we are always looking for, obviously, I think every trader is looking for where there are opportunities, and there are usually more opportunities where it's not as conventional. I do trade a lot of pink sheet and OTC names in New York, and there's a lot of Japanese names that trade pink and OTC in New York that very few people trade because they're very difficult to trade. You need to go through a broker a lot of times, and there's not a lot of liquidity, and they take time to get these stocks on. And you kind of have to finesse your way through that market and figure out where those opportunities are, and it takes time. And it's not easy to trade. So we do trade a lot of those, and so it's kind of a mixed bag whether it's good for more people to be in, to do what I do or not.
Can you speak a little bit more about that last comment about pink sheets and grey markets? What's that referring to?
Sure. There's a lot. So I'll just give you, Nintendo is a prime example, although a little bit not a perfect example, because it trades as a 5-letter name. Which means it doesn't really trade on a proper exchange in New York. So, and there's a lot of them like that. There's a bunch of Japanese stuff. Maybe you've heard of the big construction maker Komatsu, which is a competitor to Caterpillar. They also trade as a 5-letter name in New York. So basically, they're they're not very liquid. They trade wide bid offer spreads. Market makers are, very involved in protecting themselves in those names. So really the only time you can get liquidity in those names is if there's an account in New York that needs to sell or buy in pretty good size. That's the only time you can really do those trades. But you really have to know your stuff to get involved there.
So why do you get involved in those particular markets if they're...
Oh, because I know these stocks. I know these stocks. These are big Japanese companies. They just happen to, for whatever reason, they've decided to not list on one of the top exchanges in New York. That just, the listing fees to trade OTC or pink in New York is, in the U.S. markets is, obviously much less. It's less restrictive for them. So that's why that's one reason why they trade on, on the less liquid exchanges. But for me, it's great because, I know that. There's very few algorithms trading those names, so you can come in on just a regular day and sometimes some of those stocks will be out of whack and you'll have a chance to take advantage of a dislocation.
Now, why would a company want to list in multiple countries? Why do they do that?
I think it's to gain exposure in those countries for the most part. They want access to U.S. capital. So, and they want access to U.S. investors, and obviously they want their, a lot there are some U.S. funds that can only buy stock in U.S. dollar terms. So, let's say there's a fund that can only buy U.S. dollars, but they want to own Sony. So they don't have to go to Japan and buy 6758. They can buy SNE in New York and stock, and create a nice sized position in that if they want to. That's one reason. But obviously, all these companies are so tied to the U.S. Most of them do a lot of business in the U.S., not all. And they all want exposure to U.S. investors.
And what sort of, I guess you'd probably call yourself a discretionary trader, right?
Yeah, I'm definitely a proprietary trader, yeah.
Yeah. Is there any aspect to this strategy which you use quantitative modeling?
Yeah, I mean, we have, well, put it this way, we're spitting out, all these names are coming off of our Excel sheet on the daily basis. So, we're looking immediately to see what's sticking out, right? So, but I wouldn't say that we're really modeling it because there's just, I'm only trading, 50 names regularly. So they're all just popping up on the Excel sheet and you can pretty easily see what's sticking out and what's not. Having said that, we are moving into some gray box kind of trading, doing other markets. Since I've been listening to your podcast, to be honest with you, I've kind of expanded into other markets and especially the US and options trading. And we are working on a gray box to trade some of that.
Okay. Well, let's speak a little bit about that. And I also want to speak to you about, you said this strategy, which we've been talking about for the last 30 minutes or however long, is particularly good in high volatility markets. What do you do in low volatility markets? Like how is most of your day spent? What sort of strategies do you trade when volatility is just simply not there?
Yeah, well, when it's not there, there's oftentimes, if you're not in earnings season and there's no news coming out after the close in Japan and there's not much going on in the US, there's not going to be much to do, to be honest with you. I mean, the algorithms have completely taken over at that point. Everything's priced basically perfectly. So you're still scanning for ideas because, it's one part of this job is you still have to read everything because you don't know if you don't want to miss anything in case there's something out there other people haven't seen. So you're still doing just as much work, but it can be very, very slow on days like that for this particular strategy. But what's happened is since I started listening to your podcast, I started hearing, other traders, talk about trading U.S. markets, talk about trading options. And, I started experimenting with that and expanding my horizons a little out of the strategy that I had been doing. And it's been pretty successful. Options are, a very interesting market for proprietary trading because they, your downside risk the second that you put on an options trade, usually. So you can put on an option spread, that your max loss is, $7,000, $8,000. You can't lose more than that. And so those kind of trades work really well. I think they kind of fit in with the type of trading that I do.
Okay, so how are you using options though? Like this is just for trading pretty much US markets?
Yeah, I'm doing it for US, but I've actually expanded into, I noticed that, options do trade on some of these larger Japanese names in New York too, like, the Sonys, the Canons, the Hondas, the Toyotas, they all have options. So we started to trade options in those names now too, as an aside. But yeah, more typically we're trading straight U.S. stocks. We're looking for upcoming catalysts in the stocks. We're trying to see how, the stock is going to react to those catalysts and, more or less place bets, via options, specifically option spreads on, on upcoming catalysts in a name. So, especially during earnings season, if we think Google earnings are going to be good, we might sell a put spread and earning, in Google into the number if we have some feeling that Google's going to be good. And then, something like the put spread would expire worthless if we're right. But it's definitely newer to me. I mean, we are, this has only been about a year doing this, but it's been relatively successful as as I'm getting more into it. So it's been good. It's been good to expand my horizons and adapt, especially for the times when it is very low and very quiet with, the main strategy of cross-border.
How easy has it been for you to pick up on options? Like you haven't really traded them much in the past, like prior to a year ago.
I mean, I knew, I had traded, I had sold them a little bit in the past. I basically knew them, but yeah, it took a little time, not that long. Once you play with it, start in very small size and just get a good feel for them. It took, it did take time, but once you understand that you can do spreads and your max loss as soon as you put on the position, you can get very comfortable with them. At least that's what happened for me. And I was kind of ready for a new challenge in my trading journey. I really wanted to do something new, and options were a great avenue for that.
So how did you start learning more about them? I mean, did you just start getting your hands dirty trading very small size, or were there actually some good resources that were quite helpful?
Yeah, I already knew the basics, to be honest with you. Like I said, I broke them in the past. I kind of understood them, but I'd never really traded them as part of my proprietary trading book. Yeah, and I just started doing them in very small size and seeing how stocks reacted and seeing how it fit in with my other strategies. And I just started doing them and just started growing in size, and it was working. I still can't say that it's my main strategy, but it's a growing part of, how I trade. And it's also expanded, it's really expanded me much more into U.S. trading. And I've realized that, reading much more about U.S. stocks has also helped me trade Japan, because so many of the stocks are related to each other. And it's, increased my knowledge base pretty massively.
Just generally speaking, are the characteristics between US markets, like how they behave and how Japan markets behave, are they quite different, or are they quite the opposite? I mean, I asked this question because I interviewed Derek Wong on episode 97, and he's in China there, and he was describing that the whole market behavior and how markets move, what they're driven by, is completely different to how markets are in the US or Australia and that type of thing. Does any of that stand true?
I don't think so. I don't think the market overall behaves that differently from the US, except of course it's a different market, and it's a much smaller market. There's a much smaller universe of stocks in Japan to trade, but and you kind of get a feel for when funds are going to gravitate. You kind of get a feel for when funds are going to gravitate to the high beta names in Japan and, the lesser tiered names in Japan and those kind of things. But it's not like China, which can act, in a very different manner from Japan. Japan is a much more mature type of market.
Now, as you mentioned earlier, this particular strategy is probably going to be quite difficult for someone who's just trading independently to try and replicate. In saying that, though, how hard is it for someone outside of Japan to open an account to start trading Japan markets? I mean,
well, to trade Japan, anyone, if you just wanted to trade Japan or just wanted to trade US, there's lots of brokers that will, well, not lots, but there's several brokers that will definitely trade both markets pretty easily. The problem is if you want to do that arbitrage type where you need to be able to do a foreign exchange transaction, and you need to be able to collapse the arbitrage, you really, I don't think you can do it as a retail investor. I'm not 100% sure, but it's very, very difficult to do if you're just a retail guy who's starting up on his own. You kind of need to be, I work for a proprietary fund right now called Conventus Capital, and we're very involved in this type of trading. We have a broker, that will, that helps us collapse these trades. So, and I think you kind of need to work for, a proprietary firm to get involved with that type of business. And I would just say also, anybody looking at proprietary firms should know they run the gamut. There are some of these proprietary trading firms that, some of them, like mine, really want the traders to do well, and their main purpose is that everyone's profitable. But then there's other types of firms where a big part of their business is just to, make revenues off the trader by charging the trader commissions. And I think a lot of your listeners should be aware, that's out there too. And so some firms might charge their traders a penny a share, on every transaction that they do. And so the firm is making money whether the trader, makes or loses money.
Are there any things you would suggest that people maybe ask? Let's say they're going for an interview at a prop trading firm. Are there any questions you suggest they ask to try and make sure they get in with a good sort of firm?
Yeah, just, you want to ask what all the fees are that the firm is going to charge a trader. Like, what do I, what am I paying in commissions? What fees are you charging me on top of those commissions? Questions like that. And they'll get a sense, and you'll also get a sense pretty quickly when you're trading at a firm like that. If you think you've made, I don't know, $10,000 your first month and your check comes in and it's only, $2,000 because there's fees, they've taken out fees galore, and that kind of thing happens. So you just got to be somewhat careful and, look for a good firm.
I mean, there's no getting around the fees though, is there? I mean, they're just going to vary quite a lot.
No, there is. No, some firms are much more. Some firms are, really want their traders to succeed. The one that I work for absolutely does. And the, fees are really, minimal. I have to say there's a huge divergence. So you got to look.
Tim, is there any other final words you'd like to pass on, share to aspiring traders, anyone who's coming up through the ranks, which you think might be helpful for them?
No, I think a lot of your traders say it on the podcast regularly. Just understanding how to contain risk is, the number one part of this business. Understanding that losses are part of the business, and they're just, every trader is going to have loss along the way. How you react to those losses is going to be vital in your trading career. Bouncing back from losses is huge. Be creative. Have the ability to change how you trade when the markets dictate. Always try and learn new things. I mean, certainly for me, the desire to learn and to challenge myself is a big reason why, I really love, trading, and I love the markets and the freedom that it gives.
Well said, Tim. I appreciate it, man. Thank you very much for coming on the podcast. If someone wants to find out a bit more about you, or, I don't think you don't have a website or anything like that. I know that for sure. You're on Twitter though. What's your Twitter handle?
It's just at T Steenstrup, TSTEENSTRUP. I don't tweet much, but I'm happy to converse with anybody who contacts me.
Excellent. All right, Tim. Well, once again, I appreciate you doing the podcast, and thank you very much.
Thanks a lot, Aaron.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey team, what's happening? So this episode is the first episode in the history of Chat with Traders podcast where I do not have a guest with me. That's because this episode is the recording of a talk I gave at Noosapalooza 2017, which is a trading conference hosted by Nick Raj here in Australia at Noosa. Noosa's about an hour and a half north of where I live on the beach there. It was a really nice couple of days. Anyway, the talk I presented and the talk you're about to hear is titled 6 Ways to Emulate Talented Traders. And throughout it, I reference many conversations which have been had here on this podcast. And just so you're aware, I've actually put together a full list of episodes which are referenced and a summary of the talk, which you can find this at chatwithtraders.com/145. And the last thing I'll mention, the audio quality isn't amazing. I do apologize for this, but it's the best we could get. I'm sure your ears will quickly adapt, or fingers crossed at least. Enjoy the talk, and I welcome any comments again at chatwithtraders.com/145. Thanks for listening. Here we go.
Our next presenter is Aaron Fifield. We've invited Aaron to condense his interviews into a presentation for you today and to reveal 6 ways that you can emulate talented traders. Welcome, Aaron.
Excellent. I'm absolutely stoked to be here. So first of all, thank you very much to Trish and Nick Raj for inviting me out here. It's a real honour. As Trish mentioned, my name is Aaron Fifield. I host the Chat with Traders podcast. And I mention this because that's essentially why I'm here. So I interview traders from all across the globe who trade all different markets, all different time frames, all different methods and styles and that type of thing. So when Nick and Trish initially reached out and asked if I could come along and speak with you guys, they asked if I could perhaps pull upon some of the best insight which I've been able to gather from, which is now over 130 different episodes. Yeah, so I do want to preface this by saying that some of the things I'm going to be talking about here, we are speaking in general terms to a certain extent. There will be traders who do almost the exact opposite of everything I'm about to say and still have some success. But for the most part, I think these things are fairly effective. So I think I've appropriately titled this talk 6 Ways to Emulate Talented Traders. So the way I'm going to go through this is, or how I'm going to structure the talk, is I will pull upon a quote which has come up from one of the conversations I've had, which I feel like actually in some ways frames that particular point, and then we'll go through and we'll flesh things out. So the very first thing I want to address, I guess, is point number 1, have an unstoppable demeanor. So the quote I'm going to pull upon here is from a trader, Darren Reed, who is, he was a prop trader, and for most of his career he's been a prop trader in Sydney, most of his trading career, I should say. He's been a prop trader in Sydney, actually just moved back to Perth to start up a firm of his own. So Darren says the number 1 thing is grit. You need to be like a bulldog that gets his teeth around a bone and will not let go. Now this of course refers to the, and I don't use this word lightly, insane work ethic that so many of the traders I've spoken with have. Okay? It's not uncommon for some of my guests to put in up to 80 hours a week into their trading. Now, I'm certainly not saying that's something you guys will need to do, and I'd be a hypocrite if I did say that, because I certainly don't spend that much time on my trading directly. But I think it's worthwhile mentioning because you need to have an appreciation that there are people who are putting in that many hours and taking this that seriously. As Tom Dante, if any of you guys are on Twitter, you're probably well aware of who that is, a trader who I've interviewed from the UK, has this brilliant line which he mentioned, while you're not working on your edge, someone else is. Okay, so no one got to where they are now by putting in mediocre effort, and no one got to where they are now by half-assing it, right? So when we're talking about having an unstoppable demeanor, this of course refers to having a really strong work ethic, putting in the time. It also refers to things such as overcoming challenges, overcoming adversity, and overcoming various failures. So I'm going to share a couple examples of some of the guests, which I think kind of capture how some traders who are very successful in their own right today have overcome those types of challenges. Now, these are certainly not the most extreme cases, but I think they're somewhat relatable, and, we're not really talking about anomalies here. So the first trader that comes to mind is a trader named Jonathan. I'll keep his last name private at his request. But Jonathan's a trader I interviewed. I'm pretty sure he's from Texas. So he actually was in a fortunate enough position when he got into trading that he was mentored for about a year, fairly intensively, by a former trader from SAC, Steve Cohen's hedge fund. And after a year of trading, being mentored by this particular trader, he went out on his own and he was like, I'm going to fund an account and have a crack at this. He took out a $35,000 student loan to fund an account to begin day trading futures. So I certainly don't recommend anyone does that, but he certainly did. Needless to say, he lost every dollar of that in a fairly short period of time. The next rational thing that someone in that situation might do is approach a family member and ask them for a similar amount of money, another $30,000, $35,000. Same thing happened. He lost every dollar of that. At this point, he's $70,000 in the red. So it's hardly a position that any of us would be envious of. Anyway, he didn't stop at that point. He realized that maybe he would try and get into a hedge fund. Get into a hedge fund's a pretty tough thing for many people because of what they're looking for. He went to university, got a degree or two, I don't remember, 1 or 2 degrees anyway, that would potentially give him a really good shot at getting a job at a hedge fund. So he went, got his education, got his degree. Then, so he was all qualified, still really struggled to get his foot in the door at a hedge fund. He emailed something like 92 different hedge funds over the space of a few months, trying to get an interview. Finally got into a hedge fund. Within 6 months, he was promoted to head trader at $1 billion hedge fund. He was there for a few years. He left. I think it was about 5 years later where he was head trader. He left to go out on his own. So he cashed out. I think he'd become a partner at that point. Funded a trading account of about $200,000, $250,000. And the past 2 or 3 years, he's run that account up to over $2 million. So, that's a really great example of someone who had it very tough in the beginning, but has managed to pull through. Someone else who comes to mind, Sean Hendelman. Now, I'll mention who Sean is in just a moment. Sean started out as more of an investor. He had summer jobs. This was when he was a bit younger, and saved up a bit of money, got into investing, and actually did quite well. Decided he was going to have a shot at active trading. So that, I guess it started out okay, but soon turned pear-shaped, lost all the money he had, okay? Back to zero. Picked himself up, dusted off his shoulders, I guess changed his approach to trading a little bit and actually started to have some really good success and was making some real progress with his trading. Him and a couple others at that point decided that they were going to start a hedge fund. So they went about that, they started a hedge fund, got it set up, but for whatever reason, and it's not really important, but the hedge fund failed to gain traction. They ended up having to wind it down, and through that process, Sean actually lost all his money again. So twice over now, he's lost almost every dollar he had. If we look at where Sean is today,
He's the CEO of one of the largest proprietary trading firms in the US in terms of number of traders, which is T3. But when we're talking about having an unstoppable demeanor and overcoming adversity and challenges and that type of thing, we're not just talking about losing money through trading errors and poor trading, etc. We can also talk about sacrifices that people have made to pursue their trading career. So, for example, we can take Darren Reed, who I've quoted up on the board here. At the time, Darren was working at a brokerage in Perth. It was kind of an old school shop, and he really wanted to pursue his career as a trader. He felt as though the best bet to do that was to join a proprietary trading firm. And as I'm sure you guys are well aware, most of them are located in Sydney. So he moved away from his partner, moved away from his family, over to Sydney. He wasn't getting paid a salary at this firm and really had to try and make it on his own. So it was a huge risk to take, a really big sacrifice, and, it's obviously paid off for him. Another really great example, which I'd like to share, is my buddy Bryce Edwards, who's a brilliant day trader. He's also in Sydney. So Bryce, a few years back, actually had a few $100,000 with a particular broker. For whatever reason, and I don't know all the details of the story, but that broker went bust. And he pretty much lost all the money he had with that broker. So pretty much one day he woke up, a few $100,000 had disappeared through no fault of his own. If we look at where Bryce is today, he's a 7-figure trader many times over. Now, I share these few examples because I think they're really great in the sense that I think probably most sane people would probably walk away if these types of things happen to them. But as these 4 examples show, when things get tough, they tend to double down. And having spoken with the founders of some of the really prominent prop trading firms, and I even spoke with one gentleman who he's a recruiter, he's a headhunter for some of the very large prop firms in the US and Europe and that type of thing. Also some of the bigger hedge funds and even banks. And every single one of these guys have said to me that when they're hiring, they really like to see that you've experienced some form of hardship and been able to push through it. They really respect those with a competitive drive, which is important because if you're going to fold at the first few setbacks, which are inevitable, you're not going to get far as a trader. I can promise you that. And just to take that one step further, I interviewed a trader, prop trader in the UK, someone who also actually, funny enough, moved from South Africa to the UK to pursue his trading career, putting himself in a really great environment. He said when we spoke earlier in the year, this is, and I quote, "One of the key characteristics of a successful trader is dogfight, meaning you keep going and going and going. This job will turn you over and spit you out so many times. If you can't keep coming back and rolling with the punches, you'll never survive." Now, I do realize when we're talking about this type of thing, there is a certain amount of survivorship bias. But any way you want to look at it, there is no replacement for grit, okay? It's such a big part of the makeup of any successful trader. However, it's not the only part. So the next piece of the puzzle, playing the long game. Have a willingness to play the long game. So I'm going to refer to a quote here from Peter Brandt, and I'll tell you who Peter is in just a moment. But Peter says, "It's been quite a ride for me. It's been one I've enjoyed. I like trading. I like watching markets. I love being a student of markets. I guess more than I actually like to trade. I'm a real student of the markets." So Peter Brandt is someone who's been trading for 45 years, has a very respectable track record, and to hear someone in his situation refer to himself as a student of markets, I think is very powerful. That speaks volumes. What it says to me is that you need to be humble enough to know that you'll never reach a point where you know everything. And just to really emphasize that, so this comes from a conversation I had with Peter, must have been at the earlier part of 2016. Now, Peter had not long actually just recovered from the largest drawdown of his trading career. Okay, so this is a man who's been trading 45 years, yet only recently has experienced the largest drawdown of his career. So it just goes to show you'll never reach a point where you know everything. And because of that, you really do need to enjoy the challenge of trading. Every one of my guests, although they'll express it in different ways, if you get to the root of it, there's no denying that they have a curiosity for learning new things, okay? Now, many people are attracted to trading because of the great earning potential, and I'd be lying if I said that wasn't partially the reason why I got into trading. And I know for many of my guests, it was certainly one of the stronger motives for getting into trading as well. But as Kevin Davey, one of my guests, who is a championship-winning algorithmic trader, says, trading is the hardest way to make easy money. So I bring this up because the money alone is not going to be enough because it doesn't come right away, okay? Most people I've interviewed, so as I mentioned, I've interviewed over 130 different traders and market participants now, and it's something I quite frequently ask. And if I had to think in general terms, how long it actually took them to gain some consistency and gain some real traction with their trading, I think probably around about 5 years is an average type of answer. To some people, I think that might be shocking, but really if you think about it, I don't think it should come as a surprise. Normally I hate analogies, right? But I feel like it's probably appropriate in this case. So if we look at someone who's perhaps an Olympic swimmer, okay, you really need to think about all the work they've put in to get to the point of where they are now. How long have they been participating in that sport? They've probably been swimming since they're 5, 6, 7, 8 years old. How many hours a day they put in, how long they've been participating in that sport to get to the point of where they are now. And really, in many ways, I don't see trading as being that different from any other discipline where high performance is a requirement. So yeah, anyone who comes into trading certainly has to have the willingness to play the long game. I interviewed a trader, Nico, again I won't mention his last name, but he's from the US and just an average sort of guy. He was running an IT business at the time. I think one of his clients was more of an investor, but that kind of piqued his interest in trading. Anyway, so he got into trading, started dabbling in it. One thing led to another, and he really started putting some money behind it. He'd make some money, lose some money, could never really hit his stride. Anyway, this went on for 8 years. He didn't give up. He kept pushing on. And these days, he's very consistent, consistently making 5 figures a month. But, had he not had a willingness to play the long game, he would never got to that point where he's now making 5 figures a month. And I think really he's just getting started. So the ones who are doing this for real do not have a get-rich-quick mentality. They have a mentality of longevity and building real wealth in the long run. And I'm going to share a story with you. So I mentioned Tom Dante in the last point I made. When I interviewed Tom, he actually shared this story. So this is not word for word, but you'll get the general gist. So Tom used to work at a prop firm in the UK. He says there was a huge trader there, and this guy, it wouldn't be uncommon for him to make a couple $100,000 in a week, right? There was this one particular day when this guy had an absolutely stellar day, made a huge gain. Tom says there was a real buzz around the office. But this guy, he was emotionally cool. We had a smile on his face, but he wasn't running around doing backflips off the desk or anything like that. 5 p.m. comes around. Tom gets on the train, heading out of the city, going home. Gets home, thinks, oh shit, forgot my keys. Doesn't want to pay for a locksmith. Gets back onto the train, into the city, back to the office. Gets to the office. By this time, it's around about 9:30 p.m. at night. All the lights are out except for one light. Underneath that light is the same trader who had just had the absolutely stellar day. Okay? And Tom says this particular moment for him was a real eye-opener because a lot of people get into trading for an easy life, but if you look at the ones who are really making a whole lot of money, they work very, very hard at this. So anyway, just to finish up this point, getting good at anything takes time, and in trading, you certainly have to be amongst the best to make money. This is not something where you can afford to be mediocre. Point number 3, know your strategy intimately. Keyword being intimately. So I'm going to point to a quote here from Jeff Davis, who's he trades the S&P 500 futures day trader. Anyway, it's not really important. But Jeff Davis has these few words which are absolutely fantastic, nice and simple, but very effective. This is what he says: do less, do it better, do it bigger. Okay? Now, just a few things on this. I want to make it very clear there is no best way to trade, all right? You can be a day trader. You can be a long-term investor. You can trade technical patterns. You can trade a hypothesis. You can data mine for strategies. Hey, Nick. Almost everyone I've interviewed trades in their own unique way. So there is no best way to trade. But regardless, however you do decide to trade, there is no replacement for knowing your strategy intimately. Because every single person I've interviewed can tell you with absolute certainty what they do trade and what they do not trade. And just to give you an example on this, someone who might trade, let's say, small cap stocks here in Australia, they don't wake up one morning and see that crude oil is up 5%, and for the rest of that week, they just start trading energy futures, right? It just doesn't work like that. The only way to know your strategy intimately is to specialize. Now, everyone specializes in some form, shape, or another. How you choose to specialize is certainly going to vary from person to person. I think it's quite a personal thing in many ways. Some people are going to specialize just running with that theme, energy futures. Maybe some people are going to specialize in certain types of strategies. They might just trade news events or earnings. They might trade breakouts. They might be a trend follower. They might trade just small caps on the Australian market. Whatever it is, find what your thing is and then specialize in that. And I guess in some ways I'm just going to echo what Nick said earlier on, but I've actually got a note here to pull upon a conversation I had with Nick for the podcast. So Nick's been on the podcast twice now, and I'm sure he's probably said the same thing both times he was on in maybe slightly different ways. But I'm going to quote Nick here. So Nick says, "You must know why your strategy makes money. Because if you don't understand why, you're going to find it very difficult to stay with your strategy when it goes a little bit pear-shaped, as every strategy will at times." Now, I just want to take this one step further because I think that's a huge benefit of knowing your strategy intimately. But when you really focus and you begin to build confidence from knowing your strategy and getting comfortable with it, that's when you can really begin to scale. As Jeff says up here, do less, do it better, do it bigger, okay? When you can begin to scale your strategies, that's really when it all becomes worthwhile. And as I mentioned focus just before, I'd like to add this in because I think it's really cool and it might help in some ways. So just recently, actually, I interviewed someone who, up until recently, was the performance director at a oil trading firm in United Kingdom, in London. Now, this guy was the performance director, so he wasn't a trader, but his sole job was to help accelerate excellence at this trading firm, okay? And they had this question that they would, or this sort of saying that they would use around the office, and they said, "Will it make the boat go faster?" And I think they actually pinched it from the Great Britain rowing team. I think that's something they used when the Olympics were on there. Will it make the boat go faster? And if we want to tie that back into trading, maybe we would ask something like, is this increasing profitability or mitigating risk? It's very easy for us to go down rabbit holes and get sidetracked. So I think if you use a question like, will it make the boat go faster? That's something which should really help to guide every decision you make as a trader.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, point number 4, trade with an edge. This is perhaps my favorite point. And who better to quote than Blair Hull? If you're missing an edge, there is no reason to play. I absolutely love that line. And I really think if this one line alone could save traders untold amounts of money if understood. Okay, so when I first got into trading, I would hear traders talking about having an edge and that type of thing. I guess I'd never really fully understood. It took me a while to fully understand it. I guess by the time I actually got to a point where I could interview Blair Hull, I had kind of worked out what it meant to have an edge. But I wanted to hear how Blair would put it in his own words, because the way, my opinion, Blair is like the master of edge. So I asked Blair, what does it mean to have an edge? And I quote, "If you do this same kind of trade hundreds of times, in the long run, you'll have more money than when you started." And he goes on to say, without an edge, it's gambling. It might be fun, but it's going to hurt you financially. Now, I spoke with Blair for probably about 60 minutes or more, and from that conversation, it was just so obvious that here's a man who's not going to bet or wager on anything unless he feels as though he has an advantage. You know, where the probabilities of him winning a bet or whatever it might be are in his favour. He even actually said, and this is a direct quote, "Whether I'm on the golf course or anything, I must have an edge in my favour." Okay? And that's a man well worth listening to. Now, someone who influenced Blair, now I referred to Blair as the master of edge, so this gentleman is on another level again, and someone who I've had the great opportunity of interviewing is Edward Thorpe. Now, if anyone plays blackjack or maybe has any interest in gambling, Edward Thorpe actually invented card counting, and he wrote the book, Beat the Dealer. So when he actually started out in Las Vegas at, where he played blackjack, he beat roulette, and a couple other games as well. But, you know, when things got a bit hot and heavy in Las Vegas, he moved to financial markets and ultimately became a legend in the hedge fund world. Anyway, so I interviewed Edward Thorpe, and I wanted to hear, in his words, how he would describe having an edge. specifically around financial markets. So Edward Thorpe said, I try to think through how good or how bad something might be compared with my most probable estimate. And even if the bad situation looks good, then I know I've got something worth playing on. And like I mentioned, Ed comes from more of a gambling background and has sort of applied some of that theory to financial markets. And Ed actually said, understanding gambling games like blackjack and some of the others is one of the best possible training grounds for getting into the investment world, because you learn how to manage money, how to compute odds, and how to reason what to do when you have an advantage or when you have an edge. Now, I'm not going to gloss over that last point because I think that's absolutely key. Reasoning what to do when you have an advantage. So we've talked about trading with an edge. Just to take this one step further, when you've got an edge, how do you actually make the most of that? So I interviewed a gentleman, Victor Hagani. Now, Victor was one of the founding partners of Long-Term Capital Management. Now, Long-Term Capital Management, for anyone who doesn't know, was a hedge fund that came about in the 90s. Did extremely well, had an amazing track record until 1998, and they failed in a spectacular fashion. They failed so badly that the Federal Reserve, I think it was, actually had to step in and organise a bailout in order to prevent the possibility of a collapse in the global financial system. So they messed up pretty bad. Anyway, I had the opportunity of speaking with Victor, and he's still around today. And Victor actually ran this experiment, funny enough, with the help of Ed Thorpe. And this was an experiment they did recently. They gathered 61 participants in a room. And each one of these participants came from a background either in math, science, investing, finance, in some form or another. So these were smart people. As you'll find out, they should know better. The experiment was they were given $25 of real money, and they were told to flip a coin for 30 minutes straight, just flip, flip, flip as much as they could. If they bet $10 on heads, they made $10. If they bet $10 and it came up heads, then they'd win $10. If they bet $10 on heads and it came up tails, they'd lose $10, okay? The catch was this was a biased coin. So 60% of the time it would land on heads. 40% of the time it would land on tails. Okay, so there's a very clear edge to be had by betting on heads. However, at the end of 30 minutes and even before, a third of all participants had managed to go bust. So even with a very clear edge, they still found a way to mess it up. So I think, as this experiment proves, if you can build your knowledge on, probability and maybe some basic statistics, can really help you make the most of how to reason what to do when you have an advantage, as Ed Thorpe says. Now, any of the astute traders in the audience here, I'm sure were waiting for me to bring up something like this. Manage your lifeblood, manage your risk, essentially, okay? This quote here comes from Saul Knapp. He says, it's not all about getting one trade right. It's about staying in the game by having the right risk management. Now, Saul is someone who was the risk manager at a prop firm for 120 traders. So he managed risk controls for all of these guys. Now, some people might say on the subject of risk management that this is the most crucial part. I guess it would be difficult for me to disagree because as a trader, your capital is your lifeblood. If you lose your money, you're out of the game. It's plain and simple. As a trader, your job is to position yourself so that no one trade or series of trades should take you out of the game. And from doing these interviews and speaking with so many really great, talented traders, it's been so obvious to me that they really do have a deep respect for just how quickly the market can take away their money. And believe me, If they ever forget, they're very quickly reminded. I've interviewed numerous people who have lost hundreds of thousands of dollars in the space of just a couple short days. I even interviewed one trader who lost $1 million in the space of 4 hours. And of course, when these type of events occur, it takes them months and months to recoup from those losses. Not to mention opportunity cost, okay? So on a balance sheet, there's no column for opportunity cost. Now, something I want to bring up on risk management. Now, I mentioned Peter Brandt on the second point I made earlier on. Peter Brandt, when I spoke with him, he said something along the lines of this. He said he makes about 80% of his gains from 20% of his trades. Okay? I've interviewed Tom Baso, who some might consider to be a legendary trend follower, was profiled in the New Market Wizards book. Tom said something along the similar lines. He said that some years, 2 or 3 trades were so profitable that if he had not have had them in his portfolio, he would have broken even for the year. Jerry Parker, who Nick brought up earlier on, one of the turtle traders, when I spoke with Jerry Parker, he said also something along the same sort of lines. 5 to 10% of his trades will often make the majority of his money. So I think it's important to mention these 3 examples because I think this in many ways kind of captures or is the crux of why risk management is so important. Often we have a lot of small trades that don't really add much to our bottom line. So that's why you need to effectively manage risk, making sure you don't go bust in the meantime, waiting for those really decent, good trades to roll around, which make it all worthwhile. I guess, someone might ask the question, well, how do these traders manage risk? And to be fair, I think that probably deserves its own 45-minute talk. But I can certainly say one thing that's been echoed throughout many conversations I've had is having a plan. Now, I know that sounds very simple and basic, but, who says it needs to be complex? Everyone's plan is obviously going to vary. And Jack Schwager, I think, is well known for saying, know where you're going to get out before you get in, okay? So that's all part of having a plan. So important because as soon as you've got real money on the line, emotion obviously comes in and can cloud or get in the way of good decision making. Mark Gardner, a prominent figure in Australian prop trading who I've interviewed, he actually has power generators running at his house. In case he loses power, he needs to be able to manage any positions that are open. I mean, that's probably not something that most of us need to worry about at this stage. Point number 6, stick to the game plan, all right? Jerry Parker, when I interviewed him, he said, there's been many times in my earlier years when I didn't follow my systems. I would be much wealthier now if I had. Okay, this is someone who's been trading a very, very long time, one of the most successful turtle traders, manages billions of dollars. For sure that he's already very wealthy. So to hear him say something like that, I think is worthwhile paying attention to. Jerry also went on to say, we're not concerned with performance, we're concerned with following the system. Now, obviously that comes from someone who has huge amounts of confidence in their system, okay? And I think that's something that each one of us should really strive for, is obviously having the discipline to follow a strategy during periods of bad performance, which we know are going to happen occasionally. But this point is twofold, okay? So there we've obviously talked a little bit about strategy, sticking to the game plan or sticking to the systems in terms of a trading system, okay? I also want to hit upon the point of process. So processes for your workflow, processes or routines, and the discipline to follow those as well. Okay, as my buddy from New York, Dan Shapiro, says, your God-given talent is not going to make you money. And one of the things I've come to notice from doing these interviews and speaking with so many traders is that in many cases, certainly not all, but in many cases, traders don't use highly complex methodologies. Instead, they consistently apply a well-thought-out process. And I think one of the flaws of new traders, and it's through no fault of their own, but when they come into trade, and I think what might be helpful is instead of thinking about I want to become a trader, thinking about I'm starting a trading business, okay, like an actual business. How do you run a business, right? Well, from my experience, most businesses operate on well thought out processes, okay? So when we're talking about trading, these processes might be, how do you scan for potential trades? How do you evaluate? How do you manage positions? How do you adjust your strategy if necessary? Those types of things. And to continue on process, I interviewed Michael Mauboussin, who some of you may know or may not know. He's a best-selling author. He's also very high up at Credit Suisse. So I'm not sure on his exact title, just off the top of my head. But he's also someone who's highly regarded as an expert on decision-making. And he's very well known also for 3 very simple words: process over outcome. Meaning you need to judge outcomes based on how you made the decision. Okay? Meaning, did you follow your processes? It's very difficult, and I really don't think you should judge yourself based on the outcome of whether a single trade made or lost money. Instead, you should really be judging yourself based upon how well you followed your processes with the information you had at the time. Adrian, a futures trader from UK. I know it sounds like I interview a lot of traders from the UK, but I didn't realise that was the case. Adrian, when I interviewed him, he said the common link between profitable traders is not so much their edge, of course, because everyone trades differently, as we've already established, but how they approach the business of trading. So everyone who I know of has a very big focus on process, very process orientated. Now, just to close things out here, I often get asked, and I guess that leads on from the topic of this particular talk, what are the characteristics of great traders? What are the personality traits of great traders? And I really think it's very hard to try and come up with a perfect answer. There's no one size fits all, okay? I guess that's what I'm trying to say. There is no one personality type which is best for trading. Now, this quote comes from a gentleman who was the very first person I actually interviewed. His name's Tim Walker. And he said something to me. He said, amateurs never win in the game of life, okay? So like I just said, it's very difficult to say there's one personality type or one characteristic which makes the ultimate trader. But whoever they are, the one thing I can tell you is that they hold themselves as professionals in every way. Trading is not something where you can afford to be mediocre because amateurs never win in the game of life. The end.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's good, team? Welcome to the podcast. Last week, as I mentioned, I released the first ever episode without a featured guest. That's because it was the recording of a talk I gave recently. Anyway, this week, I'm certainly making up for it because on this episode, I'm joined by 3 traders from the data-driven, options trading, performance-based fund, Black Pear Capital. If you've been a regular listener since around about mid-2016, then presumably you'll already be familiar with one of these guys, Ryan Moffat. He's the lead investment manager, and he appeared first on episode 83. He's back. Guest number 2 is Tyler Micah Love, who plays a key role in trade execution. And the third guest is Wayne Klump, who heads up research and strategy development. Now, the interesting thing about Wayne is he was a Chat with Traders listener when Ryan was first on the podcast, as I mentioned, episode 83. Ryan made an offhand comment about how they were looking to bring on someone else towards the end. From that, he received something like 200 emails. One of those emails was from Wayne, and now Wayne's become a part of the team at Black Pear, which I think is a really cool story. Anyway, we talk more about this during the episode. We also talk about mentoring, the benefits of working in a team, the upside to trading options, the unique edges which can be gained from the multiple dimensions inherent to options, an example of how options could potentially improve an existing strategy, and lots more, of course. All right, well, let's get things underway. Here is Ryan, Tyler, and Wayne for episode 146. Yeah, no, I think we're good.
Guess he's going to fix it. Jesus. I just think Wayne's getting kidnapped again. Jesus.
You know, my chair is really creaky, and I probably need to just get a new chair, but it's been with me through all the thick and thin, so I can't get rid of it.
I used to, when I first started doing the podcast, I had like an old shitty chair that used to squeak all the time too. I used to, whenever I jumped on a podcast, I'd like swap it out for like a chair from the dining table. It was pretty ghetto. I've managed to upgrade a bit since then.
Well, I aspire to be like you then.
Yeah. It's worth the investment. But anyway, we'll get this started. So, Ryan, good to be speaking with you again. Also joining us on this episode is Tyler and Wayne. So, guys listening, you'll probably be familiar with Ryan. He was on episode 83. If you want to hear a bit more about his backstory, I suggest you check out that episode. It's chatwithtraders.com/83. So Tyler, you're also joining us. What's going on, man? How you doing?
Doing good, Aaron. How about yourself?
Very well, very well. What is your role at Black Pear? Just give us a little context before we get into things.
Yeah, sure. So I mostly head up the trading and execution side of things that we do. So most of it's just making sure that all the work that we do on the back end gets put through the markets the way that we want it to. We do all this work and, we have to make sure it gets done, put through like it should be.
And what's your background like prior to Black Pear? Like, do you have trading experience going back further?
Yeah, so I joined Black Pear about 2 years ago. maybe going about 2.5, and been trading for about 7 years. I mostly taught myself how to trade going through college. I was a finance major at the University of Tennessee. And most of what they taught there was fundamental analysis. They were really, really heavy on that. You brought up anything related to technicals, and it was just like the teachers just like, the teachers very helpful, but you couldn't come across any good conversations when it came to technical analysis or just anything related to options trading. And so a lot of it just kind of had to be self-taught. And kind of through that research is actually how I ended up getting in contact with Ryan.
Why is that the case that most of these teachers at universities and that type of thing don't have any interest in technical analysis? Is it because they're all believers of efficient market hypothesis? I know we're speaking in general terms here, but what's your...
I think they see that's the way that it's the conventional model on it's safe. If you put your money in there, you'll probably do well. And it's what they know, it's what they're familiar with. I'm not sure that they're entirely convinced that there's other ways to make money in the market, that, looking at expanding your horizon, even looking at currencies, options, futures. And, they see them as tools to be implemented in portfolios, but how you actually approach the market, they only see that there's a single way to do that. I remember talking to one guy, a really smart teacher, and helped me out quite a bit to get where I was. But you get talking onto like momentum indicators, and they'll refer to academic papers and just saying like that the academic papers prove that it's not actually viable. When in fact we know plenty of people who use momentum indicators to make money day in, day out. So I think it's more just the background that they come from in their learning environment. I'm a big believer in the other side that, you can make money through just about any way in the market as long as you put the work into it. And it's just from my personal experience, from what we've seen on our end.
Yeah. Yeah. It's funny. Like I've got a buddy of mine here in Brisbane who is, I'm not sure exactly what he's studying, but it's something in the field of finance, economics, sort of, definitely hits on investing. And it's funny, like just hearing about sort of the things he gets taught compared to the sort of things that, we talk about, and, the topics that are covered on this podcast and that sort of thing. It's kind of funny. But so also joining us on this episode is Wayne. Wayne, you're the newest member there at Black Pear. How you doing, man?
I'm doing great, Aaron. How about you?
Very well, very well. So yeah, just bring us up to speed. What's your role at Black Pear?
I primarily head up the research and strategy development side. I'm constantly working on creating new things or finding new edges and looking at the market in different and unique perspectives.
Okay, and how did you get onto Black Pear? Like, what was your trading experience prior to joining the team?
I started out, my first stock that I actually ever owned, my dad helped me purchase when I was 11 years old, but I never really took it seriously actually until about 5 years ago. And once I graduated college, I ended up starting to take it really seriously because actually that's the career field that I wanted to after I graduated. Sometimes I wish that I would have taken it earlier when I was in college, but after that, I started taking it seriously. I devoted pretty much all my being to it. And then eventually I actually heard Ryan on your last podcast, and that's how I ended up getting in contact with him.
Excellent. Yeah, so that's a really cool story, man. I'm pleased that's worked out for you. And we'll probably get into this a little bit further. Ryan, I want to speak to you a little bit about, what's new since we last spoke. I know that obviously when you were last on, you had a hell of a lot of people sending you emails and that type of thing. I think you made some sort of comment about how you were looking to bring a new person on or something along those lines. I don't remember exactly what you said. But what's new since we last spoke, and what was some of the... I'm interested to also hear a little bit about sort of some of the things you noticed from the emails you received from the traders.
Glad to be on again, Aaron. It was fantastic talking again. But yeah, we've had kind of a renaissance here at Black Pear Capital where we kind of went from a really kind of a 2-person shop, me and Tyler really working through stuff, to now we've got Wayne aboard. We've got another operations person, and we're bringing on one more person as well. So over the last, I would say, I think it's probably been 6 months since we talked, Aaron. We've grown like crazy. Our fund's grown. We've added a ton of new clients and partners within our fund and managed accounts. And yeah, like you said, we had a small comment on, we're kind of looking for, and we're always looking for good traders to work with or to mentor as well. And literally, I got over 150 emails from traders around the globe, really asking about kind of what kind of we had or offering and what type of coaching and things of that nature. And it was very, very interesting because I wasn't expecting that. When we were talking, it's really almost an offhand comment of we're always looking for that. And really what we found is from the emails is there's just so many traders looking to try to expand what they're doing. And also I think really what resonated with them that I found and what they really kind of told me was, a lot of times, a partner at Goldman Sachs or a partner or lead guy at Citadel or a high-speed trading firm, it's hard for people to relate to that, most people, because most people don't work for Goldman Sachs and don't have the pedigree coming from Harvard, Yale, and don't kind of relate to that. And from where I came from and Wayne came from and Tyler came from and a lot of other traders probably that you've had on is when you kind of do it on your own and from scratch and you really kind of claw yourself up and teach yourself, that's where a lot of people, I think, listening to you, that's where they're coming from. And really when it comes to even starting kind of a private partnership or a hedge fund, it seems so much out of the realm of someone that, that is in Knoxville, Tennessee, or in a small city, or that's not in New York or Chicago or Boston or London or Tokyo. And so I think that kind of related to people. And so I got so many emails on traders asking, how did you do it? What did you do? What sort of things are you doing to grow? Which was fantastic. And, we answer every single email I get when it comes to that, because I was in the same spot and I had to reach out to my mentors. And when I kind of cold called 50 hedge funds, if my 2 or 3 mentors didn't reach out to me, then I wouldn't be where I am. So it was extremely eye-opening to see that. But it's something where, that's the thing about trading. You can do it from anywhere, especially with the internet the way it is. So it was extremely encouraging to see that. But we talked to a lot of traders and we talked to a lot of them about where they are and where they want to be. But also we talked about what it takes to get there. And I can expand into that. And some of the guys that we're mentoring now, we've got about 4 or 5 incredible kind of students that we mentor. And they have made leaps and bounds in their trading. And it's not due to us, it's due to them doing the work. But a lot of times a mentor is just to show them what the work is or what true deliberate practice is, versus a lot of times as a new trader, you're just kind of reaching around trying to grasp at straws because you don't really know what you don't know. So that's been really encouraging for us. We love working with traders. And then from that, just like Wayne said, we got Wayne, which was fantastic. And, on a selfish kind of thing, that's really kind of what we were working for. When we looked to mentor people, when Wayne came on, we were mentoring them. We were coaching them and working with them. And it was incredible because we have over 150 emails. And really kind of once we worked with Wayne, you started kind of separating what he was doing versus some of these other guys, because the work that he was doing was absolutely incredible. And I know we'll probably dig into a little bit more of Wayne's background. And I can dig into a little bit more of that if you'd like me to.
Yeah, well, just before we do so, I want to ask you, just speaking in, I guess, general terms, from these emails you received, you said that some people were kind of like asking you how you did it. I mean, obviously we did speak about that on the podcast at length, but questions around that, I presume. And people were sort of under the impression that, starting a fund of some sort is like way out of their league. Did you find that some people had sort of assumptions or limiting beliefs in what they could and couldn't achieve from trading?
I mean, it's absolutely incredible what you start uncovering when you start talking to a lot of people about what they think they can and can't do. And I think one of the biggest things I think everyone does is you have these beliefs, and your limiting beliefs, you're only going as far as those are going to allow you. And you hit it right on the head. And I mean, people, when they look at that, they think there's no way they can get there. And really all a hedge fund is a private partnership. That's all it is. And you get people to believe in you and give you money, and then you work with their money. That's all it is. And when you start boiling it down to just really the simplistic version of it, why can't I do that? If I put in the time and I put in the effort and I put in the hours and I put in my 10,000 hours, what is separating me from all these other guys? And what you start finding is all those limiting beliefs are just that. They're just beliefs. They're just limiting beliefs. And once you start breaking that down and you start seeing cracks in the dam of those beliefs, you start tackling them and you start looking at it saying, okay, well, let me maybe expand these beliefs and see what happens. And that's what we try to do with people we work with is, anything you think you can do, go ahead and multiply it by 10. And at least if you fail, you're going to get way further than if you had the original belief. And so that's really what we try to do with ourselves at Black Peer, is constantly tackle our assumptions. How much capital we can get per year. What are our assumptions on our return stream? Now, this is one of the biggest limiting beliefs we've seen just in the industry, finance industry, is what you can get on a yearly basis return-wise. And if you talk to, I know you guys mentioned kind of more of the finance, professionals and institutions, and they're saying, well, you can't get more than 8%. Well, tell that to some of my mentors who have annualized 30 to 40 to 50% net after their fees year after year after year. And so this is something that we constantly tackle with ourselves and our beliefs and our psychology, but also with anybody we want to work with. And you're right, Aaron, that was a huge theme throughout the emails, is what people already have made up their minds what they can and can't do. And it's incredible that the people that really succeed, they just allow themselves to really go beyond those beliefs or shatter those beliefs and start questioning all of that. And so that's a great point.
Yeah, so you briefly hit on it a little earlier, but I just want to go into a little more. Out of everyone who reached out to you and everyone you spoke with, why did Wayne stand out to you? Like, Wayne's obviously come on board now. I mean, what was it that Wayne did which was kind of special in some way?
Well, talking with so many people and working with them, and when you talk to and you get emails from 150 to 200 people, you start seeing people in all kind of different scales of where they are in their trading. And really what we try to do is, work with people that have traded, but they want to take it to another level. They want to take it to a professional level. And, selfishly, we want to do that because we wanted to bring them on our desk to, diversify what we have, but also bring on some really good energy, really good talent. So, from those 150, 200 emails, we really talked with, on a serious level, probably about 50 people. And really what separated Wayne was he really made it very easy for us to make a decision, meaning he did the work that we needed to see before we even asked the questions. So when I talk about the work, one thing a lot of traders do is they kind of do a hodgepodge of different things, maybe listening to the podcast or maybe getting a system. But when I'm talking about deliberate practice and being very clear on the goals for what their strategy or system or portfolio needs to do, and then doing the work in order to get there, meaning the deliberate practice in the day-by-day grind of a back test in order to get the actual results or get a good good example of what results you're going to see, talking about the drawdown of a strategy, your expectation of results. Is it scalable? What type of liquidity you're looking at? And so something that literally is plug and play. And so when Wayne did that and we really worked with him, kind of going through the mentor, it got to the point where there was no more questions to ask. Just bring him on the desk, because he did so much work. 10,000 hours of work on what he was doing. And it was very easy for us to understand what he's doing because he did the work to clarify it. And then also just all the data points we needed. We are a very data-driven firm, meaning I want to see 50 or more, close to 1,000, if possible, data points in order to show me what this strategy is going to do. He provided that. And anything that we asked for, if he didn't have it, then within a week, he would go through, and when he talks about dedicating his life, he literally did dedicate any free time he had, because he was working a job as well in order to do this. And this is really what separated him from the other traders who said they did the work but couldn't provide it, or wanted the easy way out. And I'm not saying all the traders we work with are doing that, but there was just a very distinct difference in what we saw. And it's the same thing that I saw from Tyler. And hopefully it's the same thing my mentors saw from me, is someone who doesn't talk. They just do. They just provide. They just show. They kind of work through their actions, not so much with their words. And so it was a really easy answer. And, I don't know if that was a specific answer, but that really is what clarified it for us, on very easily to bring him on the desk. And then, from that point on, it's a personnel thing, making sure he works well with the team in place. And that's been like gangbusters. That's worked very well. And then I think Tyler's going to probably hit on that, just really working as a team. But it's been great since bringing him on.
Well, let's shift back to Wayne. So Wayne, let me ask you, why did you want to become a part of Black Pair? And the reason I'm asking this question is just to find out a bit more about your motivations and what you saw as an incentive of actually joining, in this case, a fund or a team, and what about the kind of situation appealed to you?
Yeah, actually, when it all started, the whole reason I got into trading in the beginning was actually an enormous amount of student loans that my wife and I piled up. And I was looking for a way out. And I started flipping cars at first, because actually at the time I was operating an automotive shop. And so that was kind of the path. But then I started going back into the finance world. So anyways, as I kept on going through that, I decided I 100% committed to the idea that, look, I'm just going to do this for my living. I'm going to do this with my life. I'm going to, and actually the original idea was that I'm going to create a hedge fund myself, and I'm going to do my own thing and build this. And then so when I heard Ryan on Chat with Traders, I'm like, man, this is already someone that manages a hedge fund that can help me get going in that space. And so anything was almost to the point where it was like, okay, well, how many times do I need to jump? What is this? What do I need to do to go in this direction? And I'll just go. It was point me, and I'll take it from there. And so that's what he did. And I think inevitably, and Ryan can probably speak to this a little bit better, but I think inevitably what it was is it came down to the point where they were kind of like, well, he's going to do this anyways, whether it's with us or not. And, it was kind of one of those things where hopefully they saw that me being with them was better. And that's how it kind of branched out. And I was humbled actually when the offering came up that they wanted me to join the team. And actually it's been the best thing ever since.
Oh, that's excellent, man. It's kind of like you just found someone who was already doing what you wanted to do, essentially. So, there's a lot you can learn from someone like that, right?
Right. In my experience, if you want to do something, you can try to do it yourself and learn from scratch, or you can get someone to help you. And that's why mentors are so great. Mentors can speed things up dramatically, and actually they do it in ways that seem so effortlessly, and it actually is kind of frustrating because Ryan and I were sitting there and we'd be going into parts of my strategy or something like that, and it was like a single off the cuff comment that he didn't think twice of, but was like, oh, kind of a moment, and you're like, oh man, I can't believe I didn't think about that before. And so mentors are amazing, and that's what I think. I think you should find someone that is doing what you're wanting to do or has already been successful at it, and mimic them. But then not only mimic them, but use your personal strengths and your personality in combination with what they've done successfully, and then all of a sudden the breakthroughs happen.
Yeah, I think that was a really cool comment you made there, because I've noticed that as well from doing the podcast. Like some of the people I speak to, they just make a subtle comment, or it's just an off-the-cuff comment. Like it's not even really their main point that they're trying to get across or emphasize. And it's just like, that's spot on. And, I usually try and write that down in my little notepad if I don't forget it. But
are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I want to ask you, just totally off topic, how did you go flipping cars? I mean, I haven't spoken to anyone who's tried flipping cars before. How'd that work out for you?
I mean, it worked out fine. I mean, before trading and options trading and everything, I was actually a master tech. And that's how I paid my way through college. And even then, it didn't pay for everything through college, but it definitely helped. And I got my master technician through college. And since that, they offered me as an operations manager after I graduated. And so I did that interim until I became a trader. But I needed some extra money because I needed to take care of student loans, not necessarily just for mine, because I had that planned out. But my wife's on top of mine was too much for us. And so I was trying to figure out an extra way to do that. So flipping cars. But then what happens, you're still breaking your back, and the return is great on money if you're doing the right thing, so you can normally, double your money or so. But the volume is the issue, and volume in trading is significantly better than volume in flipping cars. It takes a lot of time to flip 1,000 cars.
Tough to scale. So you were obviously trading options before you came on board with these guys?
Yeah, significantly. I mean, I traded my own account for many years before I was with Blackpeer, and before trading options, actually, I did algorithmic trading using patterns and ETFs, and that's kind of how I started, was algorithmic, and I was very conscious of curve fitting models and stuff like that, and so then I kind of tailored that along with the business courses that I took during college, and funny enough, behavior analysis. It's amazing how much behavior analysis and satiation and all these terminologies actually provide insight into what the market's doing, because in essence, it's not necessarily economics per se, like the fundamentalists think, although I think there is a space for fundamentalists, especially long term, but short-term trading is much more about human behavior, more so than the actual fundamentals of the market.
So you said there, if I heard you correctly, you started out trading ETFs and then slowly gravitated towards more option-based strategies. How come?
Well, so it's the pathway to options was kind of strange, actually. So I was doing algorithms on ETFs, and you start running into so I started running into volatility products because there was an edge on like UVXY, VXX, and then also the volatility futures as well. And so as I started dabbling, more and more into these other things, because I'm always trying to look for a new edge somewhere. I started running into volatility, and then kind of the epiphany happened that, oh my gosh, well, if I can learn how to trade volatility, and options have volatility priced into them already, is there an edge in just trading options and using the volatility inside them as an edge? And so I started going into double diagonals and things like that can really tweak volatility. But then there was of course significant complexities into that, and so that's how it all kind of branched out into options. And then eventually I just kept honing my craft as I learned more people that traded options, and I took bits and pieces of how other people were successful in all different realms, from day trading to futures trading to intraday to trend to everything. So I just started grabbing all of these things, and then I finally compiled them into the Frankenstein of what my trading is now, using derivative options.
Okay. So we'll pick up on options again in a bit. Tyler, I don't know if you want to jump in here, but I'd like to speak a bit about the team aspect, if you will. So, you guys are a fund, but there's only a few of you there. Usually when, I think, probably a common misconception, when people hear the word hedge fund, it sounds quite big and monstrous. You guys are almost like a startup in some ways. There's just a few of you there. How do you use that to your advantage?
With what we do, it wouldn't be possible to do it without the team that we have. Every single one of us has a very distinct personality and something different that we bring to the table. One of our strengths, or one of my strengths, might be a spot where someone needs help in, or every single one of us contributes something a little different. One thing me and Ryan realized pretty quickly when we first started trading together is that there was so much emotion involved with our trades, and what we did is, we just switched accounts. I would trade his accounts, he trade my accounts, and all of a sudden there was very little emotion involved in trading. We'd look at the strategy, say, okay, this is what we need to do, and we follow it perfectly. But the second we were trading our own account, it's like, oh man, it was just night and day when we made that switch. And we started adopting more and more of these things. We would start to cover up our profit and loss. We'd only look at the market a certain time of day to kind of put these firewalls in place to where we could follow our strategies exactly the way that they needed to. And as we got to working more and more together over a longer period of time, we figured out where my weakness is at, where it might be someone else's strength, and vice versa. For me, it's like, with my personality, it's easy for me to look at a pair of rules that, Wayne comes up with and just follow it. Okay, this is what needs to be done. This is because I know the work that's gone into it. I have the trust in Wayne that he's done the work. We've all vetted the system and, just execute it the way it needs to be. And every single one of us has these different things we're pulling on constantly back and forth to make sure that, everything that we put in gets comes out the way it needs to.
Right. Now, I'm not sure if this is a good question to ask you, but I'll ask it anyway. We'll see how it goes. How do you guys tackle problems and challenges and that sort of thing? Like, do you have a certain way that you address problem solving?
It kind of comes, it depends on in what context. Like, let's say, I guess we'll use one of the most recent strategies that we're developing. Our most recent strategy that we put into the fund was for a black swan event. So, we want to protect our portfolio if the market, we have a 1987 crash, we just gapped down 20% overnight, and there's nothing that we can do about it in the meantime. It's always been it was kind of a worry in our portfolio. We want to make sure we had it covered. But the one thing that we really do when we're approaching a problem is just making sure our goals are defined. Because, when we're creating the strategy, there's, hundreds and hundreds of ways that we could end up protecting ourselves, but our goal for it was we wanted to have a strategy that had, a 0% drag on our portfolio, meaning that it's not going to take away from our absolute returns in the strategy. And so there's so many ways that we looked at this, and it was a long process to go through. But because if we stay focused on the goals that we set for ourselves, which is something that Ryan does incredibly well with, like his biggest contribution to this team is his vision that he has for Blackbeard and his ability to keep us focused on the goals that we're trying to get. And as long as we keep on that, the problems kind of take care of themselves as long as we stay focused on those goals.
So I just want to pick up on your comment there about this type of strategy that you've recently implemented to, I guess, protect yourselves in black swan events or to capitalize on a black swan event. Can you just explain that a little further, like what you mean by that?
So with the way we trade, we trade options on broad-based indices, like S&P 500, Russell 2000. And, we have a wide range of profitability to the upside and the downside. But yeah, you have that big downside move, overnight gap. We could potentially is where, the biggest hole in our strategy was. And, we want to make sure for us and for our clients that, we actually make money in an event like that. And so without getting into too many of the details, is we created a hedge that will just absolutely explode when volatility goes up. We have a little bit of movement to the downside, but it's mostly a volatility hedge that we created, and we've done that through positioning the option structure in the most optimal way to take advantage of that huge volatility spike that you'll get. So we don't even need that huge 1987 crash to happen. It just has to be a larger move in volatility.
Okay, so how often does this strategy trade?
So it's continuous. It's always on because you can never expect a black swan event to happen. You can't predict. You always know that it's going to happen, but you can't pinpoint what's going to happen or when it's going to happen. So you always have to have it on. But it's easy to do. Like the most common example is, buy a put. And that will give you downside protection. But buying a put is an absolutely terrible strategy. It will protect you and all. But over the long run, if you are constantly shelling out premium and spending money to have this protection, it gets very expensive to do that. And so our whole goal was we wanted to create a strategy that when the market moves down or you have a large spike in volatility, will make money that we can have on all the time, but without creating a drag on the portfolio. Now, it took quite a bit of research into this, a lot of work on all of our parts to develop this strategy, and some help from just any source we could get. But it goes to show that, it sounds like it's kind of not possible to do it. Why should you be able to have protection for free? But if you put in the work and look for the nuances of the market and just really define your goals and see what you're trying to do, it's possible to create some pretty incredible strategies.
Yeah, I guess that's one of the advantages of using options is there's, all these three different dimensions to the product, which is something I want to ask, I guess, maybe Ryan a little bit more shortly. But as we're talking about the team aspect here, now, you guys are all remote now. I know Tyler and Ryan, you guys were working together up until recently, but all three of you are remote now. How does that work? What sort of technology do you guys use to stay in touch throughout the day? Is there any challenges to doing things this way? And why do you even prefer to work remotely?
I guess I'll take that. So yeah, it actually was a fantastic getting Wayne aboard because it really gave us a test on what that was going to be like. Me and Tyler have been working together side by side for the last two and a half years. And so going from that to working with a trader that is across the country, literally, he's located in Seattle, 3 hours behind. So it was a little bit getting used to it. And, we really utilize WebEx. We crank out WebEx on a daily basis because we're talking with Wayne all the time. And so now, because of WebEx, we use Slack as well. So those two things we really utilize a lot. for us. So that really keeps us going. Obviously, you've got Skype as well. WebEx works really well for us because you can record it as well. So that helps us with any training or anything to that regard. So we utilize those quite a bit. But now with Tyler moving, so he's moving across the country as well, there really literally is no change. It is no big deal. I've talked with Tyler since he's been gone just as much as I talked to him when he's going to be here. And we're looking to add another person here in Knoxville as well. So we'll have another person in the office as well. So we've really got all our bases covered. But the strengths of having people in different locations is really fantastic. First of all, you have redundancies. We have redundancies. We've got traders on the East Coast, in the Midwest, and on the West Coast. So literally, if the Eastern Seaboard shuts down, we are covered in the Midwest and on the West Coast. So it's great for redundancies. Also, just capital raising. When we are taking on new clients and partners, we serve a very specific purpose for our partners and clients. But, being in different areas, we're able to get the word out on exactly what we do and how we add value to our partners. So with the guys being on the West Coast and me being more on the East Coast, it gives us kind of a lot broader range in order to raise capital and help add value to more and more clients and partners. So in two, kind of being away and being in different areas and really distinctly different areas, again, all this really with the team, it just brings all different dynamics, and Tyler really talked about the team. One thing that we really gain is just different mentalities, different psychologies, and you have a mastermind network. Basically, the mastermind principle is when we get together and we start talking about ideas and Wayne starts spitballing about a new strategy, and then Tyler asks questions about vetting it, and I'm asking questions about the goal and the vision of it. You start developing, that's where some of our best ideas have come out of. And this is where we really, with people listening or traders, getting together with a group and getting a mastermind group together and start getting people with similar visions and similar ideas, but different backgrounds and different psychologies. It's just, you get incredible ideas that come out of that. And so what we found, and I think that's one of the biggest reasons that Blackpeer really has exploded over the last 6 months, is because the people we've gotten on board. We added 1, 2 plus 1 actually equals 5 or 6. Because when we get together, those ideas really explode. So being remote, really, you never can kind of reconvene or repackage the energy that you get when everyone's in one room. But we do have a lot of strengths kind of working remote with redundancies and also kind of the different atmospheres as well. So it works very well for us. And especially with the technologies utilizing WebEx, 10 years ago, we probably wouldn't be able to do it the way we do now. But timing's everything. And it works very well for us. So, it's worked definitely very well for the last 6 months.
Yeah, I think it's really cool that you guys are able to do that because, it's like, what if the best person for the job is not there in the same city that you are? What if they live on the other side of the country like Wayne does in this example?
Odds are they don't live where you do. I mean, that's just the probabilities of it. So odds are, and one thing that with teamwork I kind of want to add as well is just execution wise. Tyler is really kind of our head of execution, but this is very important. Aaron, you probably know, every trader knows, is having basically trade errors. When you're executing. But one thing we've seen when you're working with millions and millions of dollars is you don't want to have trade errors. And so we have a co-pilot system, redundancies everywhere within the trading process, checklists, to where we have to have 2 people looking at the trades, anything being executed at one time. So whether it be Wayne and Tyler, which generally it is, or if one person's out, then I will have to cover, and then we'll have multiple redundancies with traders out of Chicago. But what it also allows you to do is Wayne can go on vacation, like Tyler can go on vacation, and they don't have to worry about things being taken care of. And that's why working as a team is incredibly conducive to that. Is it just makes where everything is covered with multiple redundancies, because really all this boils down to giving the client and the partner really the best and the most value possible, and without any trade mistakes or any errors. So that's what we're trying to do.
Okay, so let's say that someone listening to this episode right now, they want to try and emulate the type of setup that you've got on, not necessarily start a hedge fund and go to that extreme, but they want to sort of get together a group and sort of build a little bit of a team where they can help each other out and do some of the things which you've been describing here. What are maybe some actionable steps on how they could actually put something into place? Like, where should they start and how should they go about that?
Always, and people kind of get into certain types of trading, and within that trading, you start seeing different groups, come together. There's a million different trading groups out there, but what you always find is when you're in a group, you generally find people that are really doing the work and looking to get better and have clear goals on what they want to do with their trading. And that's one thing, I mentioned it with Wayne. Wayne had very, very clear goals on what he was trying to achieve with his trading. And once you get the goal and you get where you're going, the steps to get there start to appear. So I would say when you get with the group, start identifying the people who are going somewhere with the trading, because a lot of times you get in groups and people just kind of dabble and they don't really go anywhere. And they're kind of doing the same trading they've been doing 3 years ago and not really having much success to it. And so start gravitating to the people that you find are doing some very interesting things within these groups. So, with us and with the options, generally you've got groups kind of around the country where it's of options traders. You kind of sniff each other out and you look for them. And that's what I had to do. I had to cold call 50 hedge fund managers to try to get someone to call me back. But when you're very clear on what you want to do, that's what Google's for, right? You can really find anything you want and any way you can. Get out there and start finding people. They don't have to be where you live, obviously, because obviously you can do this remotely. Start finding people who are doing kind of what you want to do, or trading the way you might want to trade, or trading totally opposite, but they're doing really well with it. And start getting a part of those groups and then really start working and getting involved with them and putting out the work and start add as much value as possible to other traders, and it will continually come back to you. The more you give, the more you get. And so I think that's what Wayne did. That's what Tyler did. That's what I try to do, is really add to the groups that you're a part of, and make it a group or create your own group. I think that's a real simple, maybe not easy, but a very simple, actionable step that people can take to get going. Hit us up, email us, tell us what type of trading you're doing. We always love hearing from different traders, but it's very, very important to get a little bit outside, I think, of the shell and get other people's ideas. Not saying that you need to trade that way, but it does give you a certain kind of mastermind type energy, and getting people with, first of all, similar type goals. And I'm not talking about trading goals, but just trying to be successful with what you're doing. It makes a big difference.
Yeah, and I've got a Facebook group for Chat with Traders, and I'm not saying this is the solution, but what I'm getting at is that, there's people in the group, like there's a few thousand members in the group, so obviously that's no good for what you're describing here, but there's people who have connected inside of that group and sort of formed their own little team, if you will, and are sort of helping each other out. And yeah, so that, I guess that's just one example of how you can meet other traders doing similar things. You spoke a little bit about, and I think this is a good point, about how the group has to have a focus and you have to be very deliberate in what you're trying to achieve and the reasons why you're kind of getting together. What's maybe an example of that? Just so that if someone's listening to this and they haven't really thought about that side of it.
Yeah, having a clear goal on anything is going to make it a lot more simple and really guide your actions moving forward. But what we found in different groups, and the ones that succeed and the ones that fail, is just the clarity of what the group is there for. And, one thing that we found with a lot of traders is they don't commit to their trading, and they aren't very clear of what they want to get out of their trading, because that's going to guide what type of trading they do or what type of work they put into it. And with the group, there's no difference there. So as a group getting together, and even, simplistic goals of, we want to take our trading to this level, or we want to get or put this amount of work into our trading, or find or create a system that creates a certain exposure to the market or a certain equity curve that they want to see. Having those clear goals, it really defines what your actions are going to be. Now, getting a group together and say, hey, we're going to get good at trading. Well, what does that mean? Literally, that is very undefined. It's, and you can go and really define how a goal is. You want a very actionable, measurable goal. But unfortunately, a lot of groups that get started, don't have those type of mentalities or goal settings. So again, I would say on anything you do, be very clear on what you're trying to get out of it. Be very direct and very definitive in your actions. And, you know, being very upfront with someone in the group on what you're trying to get out of it. That makes it very clear. You know, talking with Wayne, talking with Tyler, we don't mince words when we're saying, here's what we want to do. And here's the ride that we're on. And whoever doesn't want to be a part of it, they can choose not to be a part of it. And so, but you get the right people on the right bus in the right seats, and it's amazing how fast that bus will go. And that's really when, once you get with the group and you're very clear on what you're trying to do, that's how it goes. You go light years ahead of if you were just trying to do it yourself. Long answer to a short question, but I think that's a big difference of what we found with the groups that really do really well, or the trading shops that do well and the ones that don't. It's just the clarity of purpose.
Yeah, absolutely. No, I think you hit on a lot of really great points there. So I guess the last thing I'd really like to go into with you guys is speaking about options. Okay, so your fund, I believe, solely trades options. Now, I don't trade options myself, but one of the things which I do find quite interesting is how people actually use options. So maybe could you just give us a better understanding, help us to better understand your reasons for choosing to use options?
Yeah, I'm going to hit just a little bit on this, and then I'm going to let Tyler or Wayne kind of interject, because obviously they are incredibly detailed when it comes to knowing very in-depth options. But one thing that we do for our clients and partners is utilizing options. Most people with their portfolios are long the market, they go up. So we provide a exposure to them of something that's going to do incredibly well when the market goes sideways, down, even gradually up. We give them something on a small portion of their portfolio does really, really well when the rest of their portfolio isn't. And what options allows us to do is it allows us to create any type of exposure to the market we want. We can be very, very flexible with it. And what most people utilize options are very simplistic covered calls, or selling puts or buying puts. What we do when you get into the more complex stuff is you really can, once you understand, now it takes a good foundation of understanding that, but you can really create any type of exposure or really a type of equity curve that you're looking to, as long as you're very clear on what you're trying to do. So that's really what we kind of do for our partners and clients at Blackpeer, is kind of create that something that is actually hedging and diversifying their portfolio. And obviously we're only performance based, but so we work with that. So Wayne, if you want to dive in and kind of give you a little bit more on that, but that's kind of an overview of really what we do, kind of a mindset of why we utilize options.
Yeah, I mean, I could take it from there. There's something about returns as well that I want to go into. When you buy and sell stock in the traditional two-dimensional up-down model, the growth of the asset is actually the way that you're going to make your money. Whether you buy low, sell high, or sell high and buy low, or buy high and sell higher. I mean, it doesn't matter. You've got to have just that single movement. But in options, the beauty about that is you can sell extra value over that growth because of extrinsic value in options. And you can also, in some ways, you can also leverage the growth underneath if you want to take the other side of that extrinsic value and put yourself at a perceived riskier situation. But I mean, there's so many ways that you can manipulate things to gain extra edges. And the fact that there is multiple dimensions in options means that if you know what you're doing, you can get multiple edges beyond what you can do on just a directional basis as well. Or, if you're a value investor, and we do derivatives, but I mean, I've made strategies on single assets as well. In regular assets, if you are directional on those, you can get extra edges utilizing options. You can even do leap options, which are just long-term options that give you the equity curve or the exposure that you want, but at significantly more value, meaning that you might have to risk less to get the same exposure that you would be getting as instead of just buying long or selling short. And you can get significantly outsized returns because it's a product in itself, unlike just owning a portion of the company or owning a portion of the S&P. Since it has its own value, the option does itself. Buying and selling that, it gives you an extra edge as well.
So can you just break it down a little bit more, and forgive me if you've already kind of described this, but what do you mean by you can almost create any type of exposure you want? You keep using this word exposure. So what are you trying to get at there?
So anytime that you take a stance on a market, you have exposure to either profit or losses, right? So if you are, say, long the market, basically you're thinking it's going to go up. So if you're thinking values are going to go up, you buy the market, or you buy, SPY or an ETF or anything like that. And as it goes up in value, you can gain from that. And that's all I mean by exposure is, okay, we're going to have exposure to growth in the asset, or we're going to have exposure to some downside in that asset as well. And so with options, you can create exposure to the long side, but at the same time, because of how, if you can get the complexities of the options correct, you can actually gain even if the growth doesn't happen. And so now you're creating returns when you're wrong. So that puts one more edge in your favor. And, Paul Tudor Jones, of course, always goes back to risk reward. You can really, really leverage risk reward with options because of the flexibility that they give you. And so if you want your exposure to say you have a long only portfolio, say you got a 401k or something like that, what we do for many of our clients is that they have, a side IRA that they've forgotten about, or it's sitting off or whatever. And they invest with us, and we can create with a very small amount of capital, something that does extremely well and high, and provides a lot of value when the market is sideways, or even just a slow grind up like we've had all year. And then also when the market starts to come down or reverse, say like a 2008 or 2007, not necessarily the crash times, but even in the crash times we can do well, but you can offset their entire portfolio with a very small amount of capital. And that's the flexibility and leverage that options give. And some people cringe at the thought of leverage, but leverage, you can use leverage in two different ways. You can add more risk, or you can de-risk by not putting so much capital at risk and can get just as much as returns. And that's what options can give you as well.
Okay. Would Ryan or Tyler, do you guys want to add anything to that?
Yeah, I mean, that's the very simple part of when we kind of talk about exposure is with different parts of a portfolio, how is it going to make money? I mean, literally, we break the market up into 5 different scenarios. The market can go down hard, can go down gradual, can go sideways, can go up gradual, can go up hard. And so we want to have strategies that do well in 1, 2, or all of those scenarios. So when we're building a portfolio of strategies, we need the strategies, just like as a team, we want our personalities to offset each other. Well, in our portfolio, we want the strategies to offset each other. So it's going to give different exposures to the market. And so pretty much we utilize good risk reward in every single one of our trades. But, within our portfolio, we'll say we run 3 strategies, actually 4, including the overall portfolio hedge, but 3 main strategies. Well, one of our strategies gives incredible exposure within a high volatility environment. It just mops up, does incredibly well. But it does struggle with a market that shoots straight up to the upside. Well, we've got another strategy that does very smooth. It smooths out very returns, but the overall return is much less than, say, some of our other strategies. But it's real smooth, very smooth equity curve. And then we have another strategy, which is actually the one we have kind of pulled in that Wayne has kind of championed. And it's an incredible alpha generator. It takes market environments into context. We take a market stance, utilize the options, and give incredible edge. Now, the thing with that strategy is we're right half the time, we're wrong half the time. But the trade management allows it to be the biggest actually earner of any of the strategies. And then what we do is we put the strategies together and kind of utilizing modern portfolio theory to give us the most efficient equity curve with risk reward to give us the right exposures for what our goals are for the strategies themselves, for the portfolio. And so the nice thing about options is like, okay, well, do I want something that's going to do well in an up market? I can create that. Do I want something that does well in a sideways market? I can create that. And so that's really what we do day in, day out is we've got the strategy we utilize. But right now, I mean, in our test kitchen, we've got 2 or 3 other strategies that we're grinding through to get the data points to see if we want to add them to our trade desk or maybe at some point add them into the fund. And that's all we do is we want to get things to plug holes in our portfolio, but also plug holes in our clients and then our partners' portfolio, just to add more and more value. And that's what options does is that it gives you, people always think, you can only make money when the market goes up. Well, that's not the case whatsoever. It's utilizing options. You can get great risk reward, have less risk, more reward, and really create strategies that do well in really any environment that you can think of, as long as you've really done the work and got the foundation and the strategies to do so. So that's kind of my 2 cents for it. And that's really what we try to do really day in, day out here at Blackbeard.
Cool. Now, you said one of the things that the strategy does very well and it takes into consideration is the type of market environment that we're in. What sort of things does it look at to gauge market environment?
We really view the market through a volatility lens, and we do it a few different ways through pricing of the options and our positions. We've done thousands and thousands and thousands of different positions. We utilize butterflies quite a bit. So we see the pricing in different environments, and the pricing really tells us what sort of environment we're in. But also we take in consideration the market environment with the ranges of the market. Let's say the S&P 500 and the Russell 2000. We look at different ranges where we're in with that, the ATR. So we're taking in consideration what the volatility and the pricing of the options is telling us, because that's really kind of the undercurrent of what the market makers are saying. And then we put that really kind of on top and overlay that on top of what the charts are telling us, or what the different ranges, pattern targets, things of that nature is telling us as well. So we kind of view it through a couple different lenses. But really quickly, with the pricing options and the skew curve, which is getting a little bit more in depth, but we really see that as well with the different volatilities going up and down the options chain. And that's getting, again, a little bit more in depth into it, but we really view it from a lens of volatility and the pricing of the options.
Okay, and are you ever taking just outright directional positions, or is every position got a hedge on?
So we are, within our strategies, we have 2 of our strategies are very mechanical. So they are going to be, they take into different considerations the volatilities and pricing, but for the most part, they're very mechanical, not really taking the market environment into account. Our other strategy does. And depending on whether what the volatility is doing or what is the environment doing in the markets, it'll take anywhere from a bullish, bearish, or neutral stance. Now, if it's bullish or bearish, it is definitely taking a directional bet. So when Wayne kind of talked about the different edges you can get, the nice thing about options is you can have 3 to 4 edges in your favor. So with this strategy, generally, we're right 54% of the time, wrong about 46% of the time. So we've got about a 4% edge that we have with the direction. The rest of it is really trade management. So on those bets, we're going to have direction in our favor, time in our favor, volatility in our favor. And so on those is when we can get really very, very large winners in that type of strategy. But we will take very directional bets in certain circumstances with that strategy.
Okay. So generally speaking, most of your trades have a hedge on, like the directional ones probably make up a lesser portion of your portfolio.
Yeah, so I mean, generally we're going to be, like I said, we're going to allocate a certain allocation to the different strategies. And when we say something is hedged, first of all, our portfolio is always going to be hedged for the black swan event. We'll always have that on. That's going to be overall with the portfolio. With each strategy itself, with each one of those, we're going to have very wide ranges that the market can move and still be very profitable. So, hedge is kind of interesting that, yes, sometimes the overall portfolio is always going to be hedged, but for the most part, our strategies really take advantage of ranges because the market can move around a lot. And the way that we trade, we can take advantage of a massive kind of range with most all the strategies. But if we get into where we see opportunities with one of our strategies, which takes directional bets, if we see an opportunity or a confluence of indicators that says we have edge here to take a directional bet, yes, we will. Now, that won't be a large part of our portfolio because it doesn't need to be, because the risk reward is so good on that the returns are so good with taking very little risk that it doesn't need to be a very big part of the portfolio. Just like our strategies don't need to be a big part of our clients' portfolio because we do outperform with it. So we do kind of look at that. We do take directional bets, but for the most part, in all of our strategies, we're going to have a very wide probability range and have several edges in our favor.
Now, you've brought it up several times. You've thrown around the term risk to reward, and that's one of the, I guess, advantages of using options is that you can get a great risk to reward. You also certainly hear some horror stories about people who have used options and things have gone terribly wrong. Obviously, presumably more people who are newer to options fall victim to that sort of thing. But how do you get a good risk reward? Like, I mean, I'm sure it's very easy to get that risk reward wrong and really do some damage as well.
Yeah, Wayne, you want to jump in, or Tyler?
When I first started trading, I got into options, and that was very much me when I first started trading. I would think I would have a good risk reward. So, like, let's take a credit spread, like a put credit spread. So you'd be bullish on the market. And, there's like a 90% probability that, you can make money. That sounds great. That's awesome. But, you may pick up like $100. Awesome. You'll do that for 2-3 months and then you just get wiped. You have a big down move and you just get smacked in the face. You wipe out, almost that entire couple of months worth of trading. And, you see like, okay, you think you're getting good risk reward on that because you have like a high probability trade, but that might not actually be the case. Over a long period of time, like over the last 10 years doing a put credit spreads, that's a great strategy. You'll make money, but you kind of have to understand that every once in a while you're going to get smacked in the face. But what we look at with the good risk reward is we look at how much cash is actually in the market. So we view everything through the option structures. So most of our trading and research and strategy development, we're looking at the actual structures themselves and saying, okay, how much cash are we putting in the market versus what's the absolute max risk reward? And in between that, we're managing the T+0 line. Now, I think that's one thing that, at least when I was really got into kind of the professional level of trading, is one of the biggest changes I made to improve the trading was looking at the T+0 line. What's going to happen today and, within the next couple of 3 days, and really managing that line, because that's where a lot of your risk reward is. And, kind of getting like, I guess, another example would be like, the strategy, I think the strategy is just fine. Like doing a covered call, if you own stock and you're trying to generate some extra income, selling a call against it might not be all that bad idea. But if you're looking on a pure risk reward standpoint, you can do the exact same thing, create the exact same exposure in T+0 line with a ton less capital. So you can do a bullish vertical and have the same exact risk in the market, be able to make the same exact amount, but you would have all your cash. You don't have to own the stock, so you get to keep all your cash, but you get to make the same amount of money. So either you could take that cash and do something else with it, maybe do something if the market goes down and make something there. If the market sits still, you can put on another position. So, this kind of goes back to why we really enjoy options. There's so many things that you can do with it to really maximize your risk reward.
Let's do this. Let's say that I wanted to develop an options trading strategy of my own. How would you suggest I go about this? Like, what are some of the first things I should do?
The very first steps to developing any kind of strategy, and it goes beyond options, but I mean, is you got to know the why. You got to know what you're trying to accomplish with what you're doing. So if you just go into and find options that generate money, I mean, that's all fantastic and fine and dandy, but what'll end up happening is you're just going to get a Medusa's ball of things that happen, and they really don't work in tandem with anything. So if you can sit there and say, okay, well, my portfolio is long and I want something that's going to, do well in the downturn, or, hey, my portfolio is long, but I want to leverage that. Okay, well, that's great. You can do that too if you want something that's going to do well sideways. So anyways, so once you get the why, then you can work from there. So like a really short example. I mean, some people kind of joke with me about this, but I'm always optimizing, and I'm trying to figure out a way to develop a strategy that does 1,000% a year. And like I said, you might laugh, but it really quickly, you rule out certain things. I mean, just by having that one goal, is a covered call strategy going to be able to produce 1,000% a year? Well, I don't have any record that it can. So then what can? Well, I think the only thing that can get that kind of leverage would be, like a something that's negative theta, or positive vega strategy or something, so then it starts leaning you into a direction that you have to go because of the types of returns that you're trying to get, or the types of environments that you're trying to produce those returns in. So like during a really high volatility time, flash crash areas, or 2008, or, even the bottom of .coms, these crazy swings in the market are really scary for some people. But if you're trying to generate 1,000% a year, they're really easy in those situations, because the market has so much movement to that you can leverage movement. Now, at the same time, you can also get your face ripped off, because when you're wrong, it sucks. So that's when risk reward and trade management and honing in the strategies are so important. And then also, just like what we do with our clients, is position sizing within your portfolio to make sure that you're matched really well on modern portfolio theory, that your really high risk, high returns types of strategy that you're hopefully developing is, a small portion of your portfolio, while you have other things that have low drawdown that are going to produce your, bread and butter that just kind of are there no matter what. And you'll get a better equity curve out of that and a stronger portfolio in general. So when you're trying to develop something, or when you're developing something in the very beginning, answer the why. Once you've got the answer to the why, then start looking for things that already exist that you can get education on that might get similar results. Okay. Then once you start getting those, then okay, with the knowledge that you have and the experience that you have, can you utilize any of those in tandem, and can you outsize the returns that are there from a strategy that already exists? So if you want say a trend following system, that was popular back in the day on equities, can you use your knowledge of that trend following style of trading? Does that work on other assets right now? And can that help you? And so once you start piecing everything together, at the end of the day, you can come up with a product at the end that fits the exact need that you want. But without the need, without the why in the very beginning, you can't even get off the starting line, unfortunately. So that's the most important part.
No, I think that's a great answer, Wayne. As crazy as it sounds, I think that's kind of a good way of approaching what seems to me like a good way of approaching strategy development, like as a way to like almost instantly remove certain things which aren't going to get you your objectives, as a way to sort of filter out things right at the beginning, so you don't, I guess, waste time on things which are never going to get you the type of goals or reach the objectives that you're trying to reach.
Yeah, I mean, it's funny you say that, because I mean, we've worked with traders that are frustrated about their results, and because they're not getting what they're wanting, and then you just simply ask them, well, what kind of styles are you trading? And then they say, well, I'm trading this, and I've only gotten 8% or 10% a year. And you ask them, well, what do you want? And then they have to think for a second, because they never quite answered that in the beginning, but some do. And so then you get well, I want 25% a year. And they go, okay, well, has whatever you're trading, has it ever done that? And they go, well, no. Well, then of course you're going to be frustrated doing that. So, start looking exactly where you need to go. And that can take years off the frustration of your life.
So I guess a slightly different question. Let's say I have a strategy, which I do, which trades the SPY, okay, the ETF. Now, I just trade the SPY, like the actual ETF. So I'm just interested to hear like what either one of you would suggest is how you could potentially improve that strategy by utilizing options, like just speaking and I guess from a high level.
I guess the question is kind of getting on to what Wayne was talking about, kind of define improve. Is that more return? Is that lower risk, lower drawdown? Just what type of improvement would you be looking for?
Let's just run with the example of high returns.
Okay. Tyler, you want to get in? Wayne? I can take it if you guys don't want it.
I guess one easy way that you could do is buying a really deep in the money call. So you can get the same exposure to the SPY without actually owning the SPY, with just buying a deep in the money call, but it will cost you about half the amount of your capital. So let's say, okay, now you have half your capital left, and you can do whatever you'd like to with that. I'll pass this over to Wayne. So Wayne, if you had half your capital, what would you do with it in the SPY?
If you're making money off of the SPY, and I'm assuming you'd just be making it on the upside or maybe market timing. Is that correct, Aaron?
Essentially, yeah, it's a long only strategy.
Okay, long only. So if you want to amplify, so now when you go long, instead of purchasing the stock outright or purchasing the ETF outright, you can do actually very similar to what Tyler said. You can buy a deep in the money call, and then you can even sell an out of the money call that might flatten out it might take away the drag of the option decay. And now, yes, it does cap out the amount that you can make to the upside, unlike having the unlimited returns of having just being long only. But then when you get down to it, then sell a call that 98% of the time, and I'm not saying a 98% probability out of the money, just 98% of the time, the market's never gone that far, from where you are now or something like that. And then so now you can start leveraging those ranges that you're talking about. So now you can start getting some premium decay off of that, and that can also boost returns. And then you can go even heavier on your directional timing in that, like, okay, well, the way that you go long is during extremely high volatility times when the market has downturned. So, people will talk about the buy the dip moments, right? Well, the buy the dip moments, what normally happens? Well, in the SPY, it's traditionally a springboard, right? You get this build up all the way down, then all of a sudden it shoots like a rocket. Well, if it shoots like a rocket, you don't want to be in something that caps potential to the upside, kind of like the strategy that we were just talking about. So why not in those situations when the environment is acting exactly like what I was just talking about, and those strategies start to switch over to something that does extremely well in the explosive. So like maybe a very light out of the money call that might have a little bit of shorts ahead of it that offsets some of the cost of that call. So that way it's not too much of a drag. And then what happens is when you get that explosive move, your volatility will get pumped up in the call that you just bought that's just slightly out of the money, because it'll do well in that type of environment. But then as soon as things start slowing down, your shorts will actually start coming in. So it'll offset that drop in the call. And then you can switch to something else because now your environment changed. Now the springboard is gone. And so you can all of these in tandem. And once you piece them together and you have ways to determine and justify the type of environment you're at, and you stay very consistent with those, and you take into account the ever-changing market internals and how they'll be different tomorrow than they were yesterday, and make sure that your concepts are very, very, very concrete, and that literally it would have to break the market in order to nullify your assumptions. You can really, really outsize those returns that if you're a long-only type of SPY buyer. Did that answer your question, hopefully?
Yeah, it did. It really did. I guess probably a little bit beyond my understanding of options. I mean, I'm a bit of a self-confessed dummy when it comes to options, but I think you've given me something to think about at least, and probably many others who are listening to this. So, no, I appreciate that answer and you sharing that with us. So, anyway, guys, we're getting on a bit. We should probably wrap this up here. Is there anything either of you would like to add before we close things out?
Wayne, Tyler, I mean, I'll add something. I didn't know if you guys wanted to add anything.
I think that what Wayne was talking about last just kind of really underlines, why we work together as a team. Ryan had asked the defining questions, help clarify what we're working on here, filtered on down through the line to where we have a strategy that, we probably could implement. It's really amazing what happens when you get a group of people together who are working towards a common goal. It truly is amazing, and just happy to be working with these guys.
Yeah, we touched on a lot of different things, and we got a lot more in depth on the option side this time than we did last time, which is fantastic. But I will say, with a lot of traders, and we had a lot of kind of material. Shoot us a message if you want, get in contact with us, have questions or anything, because we love talking to traders. If we can help out at all and add value, we love doing that. I know me, Wayne, and Tyler, we love, all we do all day is talk shop. We love talking with other traders. And again, we always are looking for new traders to diversify our desk. And that's something that we'll continue and do. This is a firm that's built by traders and will always be about trading. We unfortunately within the industry, what we've seen, especially in the larger hedge fund industry, if trader, quote unquote, is a bad word. You've got to be an investment manager. And kind of what we've seen is if you're not a true trader and you're managing risk reward, then you're not doing it the right way. We've seen some of the most incredible, quote unquote, investment managers, and they're traders, and that's what they are. And that's what we call ourselves. And we're proud to be that. So, I will say, from your Chat with Traders podcast, I received, a huge asset within Wayne, and because he did the work. And, I want to thank you, Aaron, for having that, because that was a big asset and a big improvement to Blackbeard. So, I just want to give a big shout out to Aaron for having the podcast.
No trouble, man. Most welcome. Okay, very good. And if someone wants to get in touch, what's the best way to do so?
You can hit us up always at info@blackbeardcapital.com, or you can kind of hit us all up. Do you have show notes, don't you, Aaron?
I do, yeah. Yep.
Okay, if you want to you can throw our emails in there as well. You can throw mine, rmoffat@blackbeardcapital.com, as well. And but yeah, hit us up anytime. We'd love to talk about it anytime.
Okay, and I know many listeners are on Twitter. Are you guys also on Twitter?
We are. Tyler, what's our Twitter?
That's a good question. I think we're Blackbeard Capital LP. We're not too active, but we do shoot out some stuff every once in a while on there if we think it's worthy of sharing with the community.
Yeah, and head to our website and sign up. What we do is we send out kind of volatility updates. Obviously, we dive into volatility quite heavy, but we do send out updates and we send out articles. So you can go to our website, www.blackbeardcapital.com. Go ahead and sign up. We have a blog. I think we've got some really good articles on there as well. But again, if anyone wants to hit us up, they can hit us up through there and sign us up, and then we'll shoot some info to them.
Okay, and I will just mention, actually, in case there's any confusion, Black Pear is spelt B-L-A-C-K, as in black, and pear is P-I-E-R, correct?
That's right.
Okay, good. Just checking I didn't get the I and the E around the wrong way.
No, you're good.
All right, guys. Well, I appreciate you doing this, and it's been good chatting. Thank you very much.
Thanks, Aaron.
Yeah, thank you so much, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey guys, what's good? You're plugged into episode 147. Let's get this going. So my guest here with me on this episode is Dr. Thomas Stark. Thomas is a physics PhD who once designed microchips, was an engineer for Rolls-Royce, lectured at University of Oxford, all before applying his knowledge of modelling to financial markets, working at a fund and then joining a well-regarded Sydney prop trading firm as a quantitative developer and trader. And it's only very recently that he's left this role. Thomas was great to chat with. Not only did we discuss topics related to quantitative trading, strategy development, and robustness, but also his infatuation with the rise of artificial intelligence and quantum computing. I think this conversation begins around about the 50-minute mark, roughly. As you'll hear, we mentioned quite a few links, resources, and different things during this episode. You can find all this curated at chatwithtraders.com/147. And while you're there, if you're feeling generous, please pick up a Chat with Traders t-shirt to support the podcast. Just click the t-shirt link in the main menu. And finally, I'd like to give a quick shout out to Kelly Scott at Trading Technologies. She's the one responsible for introducing me to Thomas and helping to tee up this interview. So thanks very much, Kelly. That's it. I'm Aaron Fifield. This is Chat with Traders podcast. Here is my guest, Thomas Stark.
Hi, Aaron.
Hey, Thomas. How you doing?
Good. How are you?
I'm all right. It's yeah, I'm telling you, it's not been my week this week.
Oh, really?
Yeah, I was interviewing someone yesterday, and we're about 20 minutes into the interview. It was going pretty well, and then we had a power cut here at home. Everything just switched off, obviously, and I lost everything. Well, when I say everything, I lost the recording. So
really,
that was a pain. Yeah, but it's all right. We've rescheduled for a couple weeks' time. But
oh man, I can imagine that must be gutting.
Right? Yeah, bit of a black swan event. It's the first time it's happened since I've been doing the podcast.
Yeah, these things happen, I guess. And especially because you do so many interviews, there's bound to be occasional hiccups.
Right, exactly. But anyway, how have you been? Recovered from your cold and all of that?
Yeah, slowly getting there, but still, it's still a bit funny. I'm still not 100%, but I'm more than okay to talk. I've been working quite a bit, so... But I still feel it. It's been a real drag.
Yeah, I mean, traveling often does that as well. How did you go in Singapore? How was QuantCon?
It was really nice. I really enjoyed it. It's always good to meet interesting people. So I'm friends with Andreas Klenov, and it's always nice to exchange ideas with him, especially to hear about his ideas about Bitcoin and more cryptocurrency things, and also the whole Quantopian crew. They're really nice people, and I always enjoy hanging out with them. Very interesting.
Oh, that's good. And what did you speak on? What was your talk about?
My talk was on how to was actually on overfitting and how you analyze strategy parameters. So let's assume you backtest a strategy and you want to know whether that strategy has any merit at all. And most people, they just optimize that and they find the best parameter set and then just see whether that works going ahead, which is, the traditional way of doing things. And you're probably aware that recently there have been a bunch of papers coming out on something called system parameter permutation. And basically the idea is that rather than throwing away most of your data from your test set, you run your whole strategy through the training and the test set equally. And then you do something like a linear regression between the results from the training set and the test set. And if you can see that there is a correlation between them, you can say that that strategy that you've developed has some sort of predictive power. And that can really help to say whether your strategy has any merit. Of course, there has to be a bunch more tests, but that's really one interesting way of looking at it. And so what I did at QuantCon was it's an experiment to instead of just giving a talk and showing some graphs, I actually presented a whole IPython notebook with all the calculations and even the strategy with the optimization on it, and demonstrated that live in front of everyone. And I think it went down really well.
Oh, excellent. Is that IPython notebook, is that available on your website, or was that just for the talk?
Yes, it is actually available on GitHub.
Okay.
So I made that available. I can send you the link to that.
Yeah, we'll get that link and we'll stick that in the show notes in case anyone wants to check it out.
Sure.
Now, I don't know if I understood you correctly when you were describing what you spoke about there, but you're talking about using the in sample and out of sample together all at once. Did I?
Exactly. Yes. So what that is you look at the in sample and at the same time you look at the out of sample. So you run all your parameter sets. So the strategy has say in this case I just used a really, really simple moving average crossover strategy just for demonstration, because otherwise it would run way too long. I just ran it through an in sample period and then through an out of sample period, and basically took all the data that I have from both periods. And then what you can do is a regression between the results. So you could, for example, regress the P&Ls with each other, or the Sharpe ratios, or even the drawdowns. And then you look at whether your in-sample period actually does inform the out-of-sample period. And if you find that there's some sort of correlation, then you can say, oh, there is some information in that strategy. Because if you just see a round blob effectively, then there wouldn't be any information content in that strategy. And even though it might have some really good results somewhere, it doesn't really have any merit in terms of what it can do most likely.
Well, before we dig too deep into this, I think it might be helpful if we can hear a little bit about your past and sort of where you're coming from. So, I know you've had an interesting path leading into trading. I think you worked with Rolls-Royce at some point. You've been an engineer with something to do with airplanes and that type of thing. Just give us a little bit of context about some of the things you were working on before coming into trading.
Yes. So I've actually done a physics PhD in the UK, and then went into several parts of electronics, mostly microchip design. So I was part of a startup company in Wales developing microchips. And from that, I moved on because I got a position at Oxford Uni and did research there and some lecturing, and got more and more into computer modeling. And doing that work at Oxford, I also got a call from Rolls-Royce. They were interested in me doing some work for them on airplane engines. So I spent my time at Rolls-Royce developing airplane engines, but I realized that the big stuff wasn't 100% for me. And so I moved back into microchip design. I was always more interested in the small things, and came to Australia, worked here in the microchip world as well, developing or working on some of the developments on some of the world's fastest inkjet printers. And during that time, I developed an interest for trading. Initially, I had actually done a bit of day trading before during my PhD, just to support my small salary there. And that was pre-2000, so the times were pretty good for some intraday trading. And when I started this during my time in Australia working on microchips, I just thought, well, I'm building all these computer models. I'm using a lot of distributed server clusters to do this, lots of data. Why should I not try to build some models that can trade for me on the stock market automatically? So basically build a robot. Now I, at the time, really didn't know if any of that existed. So I just got started, and bit by bit, I learned more and more about finance and trading and what it all does. And also I learned a lot more about how to set up software systems and computational work, because one thing is when you are a physicist and you build models, and another is to actually build proper computer systems that can support a automated trading system. So that was really my my beginnings. And then finally I came up with some interesting models. I hooked them up to my broker and ran them for a while, and whilst doing that traveled the world and learned more about trading until eventually I ended up getting some jobs in the financial industry. So that's basically that.
Okay, and those jobs were with a prop firm, correct? I mean, you don't have to name the firm if you're not comfortable with that, but it was with a prop firm, wasn't it?
That's right. Initially, I started working for some investment funds and hedge funds, and my last job was for a Sydney prop trading firm.
Okay, and did you find, I don't know if this question might be a bit of a stretch, but were there any transferable skills or any similarities between what you were doing in the physics world, which crossed over to helping you or gave you some advantage with what you were doing in trading, like the models you were developing, etc.?
Absolutely. Initially, when I started, I think I wouldn't have been able to build any models without my numerical background in physics and computer modeling. Now, I don't think that physics directly impacts trading, because whilst the laws of nature are kind of immutable, the laws of the market are very mutable and they change a lot. And so we have different dynamics going on there often. However, a lot of the numerical skills, the IT skills, and also reading data, understanding data, and also being able to read financial research papers that are often quite mathematical has really helped me to develop my own models quite to a great extent. And I don't think without my training, I would have been able to do that quite the same way.
So I'd like to spend a bit of time speaking with you, Thomas, about strategy development and things related to that. I know we started getting into it right at the beginning, but just to backtrack a little bit. So, I mean, I'm sure there's going to be some things which you've got to be a bit careful about talking about, respecting where you've worked previously. But can you just give us like a high level overview or a bit of an idea about the types of strategies that you've worked on in the past? Like, you don't have to go into granular detail, but just give us a bit of an idea on the sorts of strategies that you've worked on.
Sure. So initially I started with much more trend following strategies, because that seemed to be the most obvious thing. And also there was a bit of literature available. And so I initially built those first for just a few different instruments, and then for larger universes of portfolios. So I learned how to assign the positions correctly, or more or less. Obviously, you can never assign them fully correctly, but how to calculate position sizing properly, and so on. And then more and more, and until recently, I moved more into a factor modeling type approach with my strategies. So I look at universes of stocks, find interesting factors that might have some sort of correlation with the returns of these stocks, and then I rank the stocks accordingly and trade those according to their ranking, and also assign portfolio positions according to their ranking. And there's also another approach where you pre-select a certain portfolio, and then you do research trying to find certain factors that will describe the returns of that stock to some extent, and then effectively run your factors on that portfolio. And rather than in the previous approach selecting certain stocks from a specific universe. I hope that makes sense.
It does, yeah. So when you're talking about factors, or the sort of factors that you're using, are these still looking at price action and price in of itself?
Some of them do, but more and more I move away to alternative factors because it's quite well known now that price action gets harder and harder to trade on. So I get quite a bit of inspiration from academic papers, I have to say, but also from some of the blogs. And recently, or a while ago, I was really interested in different types of sentiment and how you could trade that. So there's a whole lot of sentiment providers out there, and hence we do get different types of sentiment. We get Twitter feeds, we get sentiment from news articles and so on. So they make, for example, very interesting factors. There are also interesting factors based on actual machine learning. So you could, for example, train a machine learning tool to basically take different price actions of different assets or whatever you're interested in, and then see how this can predict returns in your underlying assets. And sometimes you find quite interesting behaviors there. Now, I found that machine learning by itself mostly cannot, you cannot run a full strategy just purely on machine learning. There have to be other factors as well, but machine learning itself definitely makes for interesting factors in my models.
These alternative factors, can you give us a few examples of those? I think you maybe just did. You described sentiment there. You described machine learning as a tool that can be used as well. Can you give us an example of maybe some other alternative factors that you've found to be helpful?
So there's several providers of interesting alpha factors out there now, and some of the more well-known factors that you can get from these companies are, for example, stuff like coverage of cars in front of car parks of big retail stores, or you may have heard of there's sometimes at oil refineries you have lids, and you can figure out by using satellite imagery whether those oil refineries are really full or they're quite empty, and then you can say something about the industry as a whole and get some interesting data. There's things like crop data, satellite crop data that are very interesting. And there's all sorts of other interesting things. A lot of that I'm more interested in now has to do with a satellite imagery and what you can do with that, actually.
So you yourself are using satellite imagery, or you've played around with it?
Yes, I have. So this is something that I'm really interested in at the moment, and I'm playing around with it. I'm still working on some of those models. It takes quite some time to really get them to work, because it's an incredible amount of data that you have to sift through, and it takes time. It takes time for the computing and so on, and then to correlate that with what you think it might be correlated to. But it's definitely very fascinating, and I'm always interested in those new technologies and fascinated by that. So I'd rather spend time looking at those technologies and looking at those new ways of doing things, also out of my own interest in actually doing something that I really enjoy doing.
Of course. Yeah, and how, I mean, you don't have to tell me explicitly, but how much is that data? I don't imagine it's cheap, and I imagine it's probably out of reach for the majority of people, wouldn't it?
Well, you'd be surprised. Some of it is actually quite freely available. Quite a bit is published by governments. So governments often have a policy where they disclose a lot of free data, and it's more a question of finding those data. So the most difficult thing for me is to actually find some of those data sets, and I'm working with some people that are more in contact with what governments provide also, and out of that we sometimes get quite interesting ideas of where to go.
Governments aren't providing satellite imagery though, are they? Are you talking about like alternative data sets?
Yes, for example. So obviously there's also providers that do provide satellite imagery data sets like the ones I've said, where you look at car parks and so on, and they obviously do the data crunching already for you. But those data, yes, they're very expensive. And for a typical retail investor, that would be completely out of reach, I would say. But as I said before, there is quite a lot of government websites that provide very interesting data on many, many different topics, probably because of the freedom of information policies. And so there's a lot of interesting things you can get from those websites.
And then I imagine once you actually get your hands on those data sets that the next challenge is to actually clean that data.
Correct, yes. One of the most difficult things really is to go through those data and do something with them and actually get something out of them that is reasonably meaningful. Because often, those data sets are either really large or they're not necessarily very good. They have lots of gaps in them and so on. And so it's quite time consuming, but it's one of the things that bring me back to my work as a physicist. It's that detective work, figuring out if there's something interesting in there and then see if I can make use out of it.
Yeah. And as this data is coming from so these are alternative data sets we're talking about. We're not talking about, open, high, low, close prices that you get every day from the market. These are data sets which aren't updated every day, I presume. Does that present a new set of challenges in of itself? Like, how up to date is that data? Does that matter,
Yes, it's absolutely. It does matter a lot. And as I said before, these, depending on what those data are, some of them can be used as factors in a model, depending on what you use. So those data are obviously not something that you can use for a minute-by-minute trading strategy. They're more long-term strategies, and in that sense, they're you could say more fundamental-driven strategies. But I'm actually more and more coming back to be interested in those because, specifically as a retail trader, it's not easy to make money in the short term because of the spreads and commissions that you have to pay. And so longer term data sets, in my opinion, have become more and more interesting again. Plus the fact that I find that price action gets more difficult to trade on these days, although having said that, some of my factors in my models do rely on price action as well.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Well, let's start stepping through your frameworks. Obviously, we've spent a little bit of time here talking about different data sets, and once you've got the data, you've cleaned the data, what's the next step in your framework for strategy development?
So I'm using a framework that is basically a factor tester, and there's some interesting. I've built my own modified from something that I found open sourced, but there's actually some interesting open source projects out there where you can test factors. And one of them that I would like to mention is one called AlphaLens. So in AlphaLens, you can basically put in your universe of price data as well as the factors that you would like to investigate, and then you can see it spits out basically a whole lot of analytics on those factors and different portfolios that you can trade over time. So that's one of the really useful tools. So that's really the first step. And once this is the case, I use my own algos in Python, mostly written in Python, where I then get the data in and so the price data and also my factor data. And then I set up the algorithms, and that is then connected to my broker for trading.
Okay, can we just go into how you test these factors a little bit more? And just so we don't lose anyone, do you mind explaining what a factor is? Like, what does that mean?
Okay, so what is a factor? A factor is effectively something that is somehow correlated to the returns of the price of, say, a given stock. Let's say we have, just for the sake of simplicity, we have the price of gold, and we say, well, the price of gold may be correlated somehow to the price of oil. And what we can then do is we can take that price of oil as a factor and apply, or we do what you call a Spearman rank correlation, and then we get something from that factor which is called the information coefficient. And this information coefficient tells us something about how much information that factor has to the returns of the underlying asset that we would like to trade. And if the information coefficient is sufficiently large and interesting, we might considering trading that, because it just simply means that it has, or the change of this factor has some sort of impact on the change of the price of the underlying asset. Does that make sense?
Yeah, so this information coefficient, that's essentially what you're using to gauge whether this factor has any predictive power.
Correct. So there is an interesting formula, and it's from a book called Active Portfolio Management, and it basically says that the information ratio, which is in some ways similar to the Sharpe ratio, is the information coefficient times the square root of the breadth of our strategy. And when I say breadth of strategy, what I mean is how many assets do we trade, and what's the trade frequency that we have. So the breadth is somehow related to that. And so if we can increase the information coefficient, then we can usually increase the information ratio of our strategy. But that's obviously not the only thing. We also it's also dependent on our trade frequency and how many assets we might trade.
let's say that you have this factor which has shown that it has some predictive power. Okay, so obviously we only have data historically, so you can see that it's been historically this factor has had some predictive power. What gives you confidence that that factor is going to have predictive power moving forward?
So first of all, that you cannot necessarily be very confident about this, because you can never be confident about the future in any way. The way to do this, once you have a few factors, is to actually run a proper backtest. So I have actually written my own little backtesting platform, which I have even open source somewhere, but it hasn't got any manual with it, so it might be a bit tricky to use for people. But basically, in order to actually determine whether a factor or a group of them has any merit, one of the things that I would still do is run what I've explained to you earlier. I separate my data into a training test period, and then run the correlation between train and test, and see what the results are, because my strategy itself still will have a whole bunch of parameters. Even if the factor in itself is not necessarily a parameter, we will have probably a group of factors that make up a strategy, and these factors can obviously be combined in multiple ways. So they can be added, but they can be also combined in different ways. They could even be multiplied or whatever works. So all these things need to be tested, and so a good backtest is really essential to make sure that what we are looking at really has any merit.
Yeah, I guess now is probably a good point to ask how you reduce the possibility of overfitting. Like, how do you deal with that?
So there's really several ways of looking at it, and so I talked about this with you earlier, and I'm not sure whether that was on record or not, but may I explain it again?
Yeah, go for it.
One of the ways to do that is to separate your data into a train and test set, and then run your strategies with do a parameter sweep basically, and run that strategy or run the parameter sweep over your strategy and get the results. Which could be your P&L, your Sharpe ratio, or other metrics that you choose to use. And instead of then applying that to your test period, just like picking the best of your strategies or the most promising and applying that to your test period, what you actually do is you take all the parameter sets that you had previously run in your train period and also run them through your test period. And then what you do is you correlate the P&L values between your train and your test period, for example. And you have a look whether in those two periods have a correlation with each other. So if they do, and when I say this, I'm also saying I include strategy performances that were really bad. So say we have an exceptionally negative P&L, we also want to look at that, and we want to see whether our exceptionally negative P&L in our train period gives an exceptionally negative P&L in our test period. And if that's the case, what that means is that our strategy in the train period holds some information for what it does in the test period. And if there is this overflow of information from the train into the test period, on that level, we can say that that strategy has some merit. And so this is my main test. for strategies to see whether they are any good, whether they also help you to see whether you're overfitting in your tests, because if you have a decent correlation between train and test period P&Ls, for example, then you're most likely not overfitting as much. So if you just pick a strategy at random that seems to be good, most likely that strategy will be overfit. But if you look at the whole lot and the bigger picture, so to speak, you will get a very different sense of what that strategy is actually doing. Now, when I say that we get correlations between train and test periods, don't expect to get dead-on straight lines. That's most likely not the case. You will sometimes have certain areas where your correlation is really good. So you quite often find that you get clusters where you have a very strong correlation, and then you will get clusters with less correlation. But when you do this, you will usually get a very good overall sense of how your strategy might perform in the future.
Okay, I'd just like to pick up on something you said a couple minutes ago. You said that if you get a negative P&L in your training set and you get a negative P&L using that same strategy in your testing set, that holds some information. I mean, what information can you take away from that?
Well, that in itself does not necessarily hold information in itself. Just if you pick out one specific data point, but the information really lies in looking at the bigger picture of the overall data set. So, when you, for example, say, well, a strategy that performed really badly in my training set, but it's also performing really badly in my test set, that means, okay, so that strategy, or those parameter sets that I pick for my strategy, they perform in a similar way in both time periods, regardless of whether there's good performance or not. So if some of them perform really badly and some of them perform really well, what you can say for sure is that, okay, so there is a correlation for how this parameter set performs in the period that I've tested in comparison to the period going forward. And so that can give me much more confidence because I say, well, whether it's a good parameter set or a not so good parameter set, we will know with some confidence that it will perform in a similar way going forward.
I just want to ask you, have you written about this kind of this process or this framework? Have you written about this on your website?
Yes, I have actually, because of the conference, the QuantCon that I attended a few weeks ago. I built a little set of blog posts that talks exactly about this and a few more things. If anyone's interested, I talk about this in quite great detail on my blog posts on my website, AAAquants.com. So you could have a look and see if things are not clear. Everything is there with the code. It points to a whole lot of code that you can use to do your own tests, basically.
Yeah, I'll make sure to include a few links to that in the show notes because, I know you've got like a series of posts kind of step-by-step walking through this, which might be helpful to some people if they're interested in this sort of thing and find it a little bit hard to keep up with. But and just to be clear, your website is AAAquants.com, so it's not triple A as in the word triple, it's AAAquants.com.
That's correct, yes. I actually used to have quite a popular blog previously, but I had to shut this down from my company. So unfortunately, I couldn't have this any longer. longer. So for all the people who used to read my blog, I'm really, really sorry, but I wasn't able to keep it up.
Oh, that's a bummer.
So I'm just basically with the new website and the new business that I just started. I just thought it would be nice to start a few blog posts again and get some interesting information out there. I mean, none of this information is really secret anymore. I think what I've done was really just to take what some people have done previously and just put it into a format that is a little bit easier to understand, because a lot of it is in its original essence really, really academic and quite difficult to grasp. But once you wrap your head around it, it's not actually that hard.
So just continuing on this path here, I guess the next thing I wanted to ask you about, how do you test for robustness?
Okay, so this is one of the ways you can test for robustness, the one I just explained. But there's a few others, and let me talk about a few more that are, in my opinion, quite important. So one of them, I haven't really got much of a name for it, but I have seen it referred to as so-called BRAC test, build, rebuild, and compare. And so what that does is it basically, if you have a strategy that you're interested in, you take that strategy and you run it. Let's say you have a 10-year period that you want to backtest it on, and perhaps you just run it over different random or more or less random 1-year periods within that 10-year period. And for each of those 1-year periods, you get a certain result. And you will end up, the more you do that, with a distribution of results. So, for example, a P&L distribution from all the different strategies, from all those different 1-year periods. And so you could, it's maybe a bit difficult to imagine. So you're not just starting then at year 0 to year 1, and then you go from year 1 to year 2, but you start at random points in your 10-year cycle and just run that strategy for this 1 year in any of the given points. And what happens is you end up with a P&L distribution, and this distribution has a mean. And that mean of that P&L distribution is usually, obviously you need to adjust it for the fact that you deal with shorter time periods, but given that you've done that, that mean will usually be a bit smaller. There will be a shortfall between that and the overall mean of the strategy you've been running for the whole 10-year period. And quite often, when you look at the shortfall from what you ran during the 10-year period to your distribution of the 1-year period and a mean of that, you get a sense of what will be the shortfall of your strategy going forward. So that's one of the ways you can look at robustness of your strategies. Again, it's somewhere referred to as the BRAC, build, rebuild, and compare test. So does that make sense?
It does make sense, actually. It seems like quite a clever way to look at a back test, like an alternative way.
Yes. You can obviously combine this also with what I said previously. So
okay,
you can put them in conjunction as well.
So I know you explained this just then, but just so we're really clear on it, what extra insight are you going to get from doing that, rather than just looking at, a 10-year back test? Let's say you're back testing over a 10-year period. Instead, you might be looking at 10 1-year periods, all kind of randomized.
Yes.
What extra information or insight is that going to give you? You said, I know, Archie, it's coming back to me. You mentioned it's going to show you some of the shortfalls of that strategy. What might be an example, some shortfalls that you might discover?
So let's say you do this and you get a shortfall of 25% going forward, and then you start running your strategy and it goes okay, and then you end up in a drawdown that is a lot larger than what you expect, you might want to consider switching off your strategy, because there might be something wrong with it. So one of the things that this test can give you is a sort of metric of what would be an acceptable shortfall going forward, or when it would be time to switch off the strategy and to actually go back to the drawing board and go, what's really, is there something happening here that I don't understand?
And on the topic of robustness, I think you've written a little bit about using Monte Carlo. Can you tell us a little bit about how you use Monte Carlo for strategy development?
So Monte Carlo is like a really broad term. It basically, all that means is you use somehow randomized parameters or randomized something. So for example, when I just explained the Brecht test, and I could effectively have a randomized entry point for my 1 year period. So I could say I start at day 3,426 of my strategy. So that would be effectively a Monte Carlo approach, just randomizing the time periods that I test. Another Monte Carlo approach would be when you do a parameter sweep. So let's say you have 3 or 4 strategy parameters, and you want to somehow do a test. Quite often what happens is if you have enough parameters, there is no way in the world you can actually cover all of those parameters. So meaning you can run through all the strategy parameters. Your backtest would probably run a few years. So what you could do is you could randomize the selection of those parameters. And what happens is in Monte Carlo, it gives you a relatively homogeneous coverage of your parameter space. So instead of just covering them with a rectangular grid, so to speak, you just choose random points, so where you have parameter A, B, C, D randomly, and so you get a decent homogeneous coverage of your parameter space. I mean, there are some clusters there, but it's overall relatively homogeneous. And one of the advantages that has as well is that if you were to use or run through all the parameters that you have, say you have 4 parameters and each one goes from 0 to, or say from 1 to 10. You start with 1, 1, 1, 1, then you do 1, 1, 1, 2, 1, 1, 1, 3, and so on. Over time, you end up with some sort of cube that keeps expanding and growing into your parameter space. Now, let's assume the time for all those backtests takes far too long. You would have to switch it off. Then your whole parameter sweep backtest would have only covered a small cube. If you use a Monte Carlo method, you could cover that space more evenly, more quickly, and you even if you have to terminate your whole parameter sweep early, you would still get a lot more information out of it than if you did that in a more structured, strict way where you just sweep through the parameters from the smallest to the largest.
Right. Okay. Yeah, I mean, we're starting to get a little bit technical here, I think. But,
yes. But it's technical in some ways, but it's also quite practical, because if you do this, you just end up getting faster results, really. So it's just a better way to do it and to get really quick results rather than trying to go through everything and wait for a long time at the end to terminate it because it takes too long.
Are you ever worried about data mining when you're developing strategies? Like, is that something that ever crosses your mind?
Absolutely, yes. I mean, it's really one of the big problems, and that's very much exactly why I'm doing the techniques that I've described to you. So they will really help to get to grips with data mining bias. Of course, you can never fully eliminate all data mining biases. You can only try to make sure as much as you possibly can to reduce it. So it's always a worry in the back of the mind. And when you finally run strategies, you can never be 100% sure that you have fully eliminated data mining bias, unless you do something like not use any parameters, or you just randomly pick a parameter set in the hope that it'll work. But other than that, it's very, very difficult to do this. And of course, there's this thought that, you should just come up with something that makes sense and test it a little bit and then run it. That also, in my opinion, has a lot of merit. Since I come more from a physics background, I'm always more interested to drill into these things a bit deeper and try to understand them deeper. That's why I choose the approach that I choose, basically.
Yeah, actually, that's something I wanted to ask you because, all the things you describe in here, it's very scientific, it's very quantitative. Why do you think that you've pursued this path as a trader? Like, back, I think it was around 2000, you said you were doing a little bit of hand trading and intraday day trading. But, your career, through your career, you've pursued quantitative and algorithmic trading. Why do you think that is? Do you think it's just something which best fits your nature? Do you not like the characteristics of discretionary trading?
Yeah, I quite enjoyed discretionary trading when I did it, but actually, when I'm honest, I'm just equally interested in technologies and how you can use scientific ideas to get something out of a trading strategy. And I guess in some ways I'm also interested very much always in future technologies. So I was always really fascinated by how you could possibly use some of those scientific methods to extract viable trading strategies. And it's definitely not always an easy approach. In fact, quite often, a trader with a good intuition will have often quite an edge over a discretionary trader over someone who does things in that sort of more quantitative way. But both of these things have their own merits and their own characteristics, and they are both in some ways valid in the market. So I'm just simply more interested in that. And then I have to say, I have this inherent fascination with seeing some of those strategies move in the market completely autonomous, and wondering sometimes why they are doing the things they're doing.
Yeah, and I'm glad you mentioned that you're interested in new technologies and that sort of thing. I know one of those things which you may have been referring to there is artificial intelligence and quantum computing. I'd love to spend a few minutes talking about those subjects. It's not something we've spent a great deal of time discussing on this podcast in the past, so I think it might be interesting to make the most of this opportunity as you know a bit about those things.
Sure.
What's piqued your interest in artificial intelligence? Like, what involvement do you have in it? Is it something that you work on and implement, or how have you got interested in it?
It's definitely something that I got more and more interested in recent years, simply because it's just something that is really one of the big up-and-coming technologies, and it's already been used very successfully in many other fields. And particularly if we look at the Googles and the Facebooks and face recognition, the Siris, voice recognition, and so on. Now, a lot of people in the space of machine learning and AI think that all we need to do is get a whole lot of data and then apply them to our machine learning system, and then we can predict the stock market. But unfortunately, that's not quite the case, because unlike, for example, if you do face recognition, the dynamics of the stock markets change, whereas the dynamics of human faces may change over hundreds of thousands of years, but definitely not over hours or minutes. So in that sense, using machine learning for financial data sets is a much, much harder problem. And there is probably, I'm not aware of many systems that actually use pure artificial intelligence to actually make full trading decisions. I know there is some of it out there that is running and that probably produces some decent results. But considering all the hype that's out there, I think we've still got quite a long way to go until we really see fully fledged AI systems actually running automated trading strategies. So that's something fairly futuristic still.
Yeah, I mean, there's certainly a lot of hype around artificial intelligence, but it kind of seems like that hype is really just that. It's a lot of hype. I mean, I don't know enough about the subject to really comment on it properly, but that's the kind of impression that I get, that there is a lot of hype around it. But like you said, you don't really know of anyone or any places that are using pure artificial intelligence to run automated trading systems.
I know of some systems that do this, but I think ultimately underlying most strategies, there's still some economic rationale of some sort, and they're not purely mostly not purely driven by artificial intelligence. But having said that, those systems get smarter and smarter, and people come up with new ideas, and I definitely would not rule out that those systems are soon coming to rule the markets. So I have a very strong feeling that sooner or later these systems will definitely come in, and they will actually make trading decisions on a regular basis.
When you say sooner or later, what sort of time frame are you talking about? I know this is very difficult to predict, but like, are we talking maybe the next 2 to 5 years, or are we talking about 10 to 20 years sort of thing?
I would say in 10 years you will see a lot of it. But that obviously is just my personal guess.
Of course,
which has no real basis other than guessing.
And what's that going to mean for your regular trader? Like, is it something we need to care about, like, or is it just going to be business as usual?
I think that the markets will definitely become a lot more efficient through it. It will definitely become a bit of a robot wars. However, I think, there's also always, where there's difficulties, there's opportunities. And I can see that perhaps there will be a point where, you start people using robots and perhaps a lot of them using the same more or less dumb robots. And there comes a point where humans can see patterns again that weren't there before because they're caused by the robots. And then a savvy trader will find new opportunities in that market to deal with the robots somehow. It's not something that I can say for sure, but I could see this happening, definitely.
Yeah. I mean, that sort of thing kind of already happens in some ways, doesn't it? Like, I know there's, some traders, especially order book traders and guys like that can, I don't know, try to sniff out like the HFT algos and that sort of thing and trade around them, try and trick them and play those games.
And I mean, a lot of it that we see now is not particularly sophisticated. And at the moment, I'm quite interested in looking at cryptocurrencies. And you see because it's so easy to hook up an algo to cryptocurrency, there's a lot of those games happening. And, you can see even in the last year or so, from what I've seen, the ways people run their algos on crypto currency trading, they have become quite a bit more sophisticated. And I guess the other thing that is still there at the moment is that there's not many rules to play by. So people can come up with all sorts of things that probably would be highly legal in any other stock market. But they're still quite acceptable in cryptocurrency trading. So I think we're going to see a lot of interesting movement in that space in the near future.
Okay. And the other thing I mentioned that you had an interest in was quantum computing. What is quantum computing? Like, what are we even talking about when we bring that up?
It's interesting. It really started that with my meetup group, which is Cyber Traders. We decided to organize the world's first quantum computing hackathon, or quackathon as we called it. So basically a quantum computer is a new type of system where you have you can imagine it's a very highly parallelized computing system. So in a normal computer, you deal with zeros and ones at the very lowest level, where, if you wanted to make a calculation, you have to feed it as zeros and ones sequentially. In a quantum computer, it's a bit different because of quantum physics. Zeros and ones are what you call superimposed, and so you can build these really large sets of numbers that all exist at the same time. So, for example, if you have one quantum bit, which is the equivalent perhaps of a transistor in a classical computer, you would have a 0 and a 1 at the same time. And if you have 2 qubits, you would have 2 zeros and 2 ones at the same time, which is already makes up 4 numbers. It's 2 to the power of 2. But if you have 10 of them, you already have 2 to the power of 10 numbers, which is a lot more. And if you imagine that you have 500 of them, you have basically parallel computing power that exceeds anything that is currently imaginable. Now, quantum computers are still extremely in its infant state, and there have been a few attempts to commercialize them. One notable one is called D-Wave from Canada, but also at the moment IBM open sourced one of their 5-bit quantum computers, so you can actually submit your quantum computing problems as a normal person to IBM on this 5-bit computer, and they're gonna solve them for you on their quantum machine. Again, this is still really new, but this is a up and coming technology, and it's moving with a surprising speed. So obviously, as a physicist, I'm very interested in that. Now, for most of us, we won't have to worry about quantum computers taking over yet, but again, in a couple of years, we will see more and more of that coming along and solving difficult problems. One of the things that quantum computers particularly good at is solving a specific type of optimization problem, and probably for most people that will be a little bit too over the head. It's called NP-hard, but it's a problem which is quite common. So, for example, there's this called the traveling salesman problem, where you effectively try to find the shortest path for a salesman between many different cities. And this problem is actually incredibly difficult to solve. If you have something like 20 cities, it takes you more than the age of the universe already to solve that exactly. But a quantum computer could do that really fast.
Why does it take so long to solve?
It's one of those problems where you have when you have enough cities, for example, you have an enormous number of different possibilities, and there is no specific algorithm to solve this. So you would have to really, if you wanted to solve this exactly, you would have to run through a whole lot of trial and error, and that would take a long time. But interestingly, problems like this also appear in finance. So for example, if you wanted to do, say you had 10 assets and you wanted to do an arbitrage where you move money from one asset to the next, to the next, to the next, and you wanted to see whether you come out with a positive P&L. That's also another version of the traveling salesman problem. And that could be solved quite efficiently with a quantum computer. Yeah, then difficult portfolio optimization problems as well. So one of the things that isn't really solvable is a multi-time frame portfolio optimization. It's very, very hard to solve problems like this computationally. And again, quantum computers could really speed this process up very easily. We're not there yet, but we're not that far off, I would say.
Yeah, okay. So these hackathons that you're running, or that you have run in Sydney there, how are you doing that? Like, how do you have access to quantum computers?
So we were lucky to team up with a company that runs at the time when we ran it, the only available quantum computer was called a D-Wave. And it was a quantum computer that was situated in the US at Lockheed Martin. So we obviously wouldn't be able, we wouldn't bring the whole quantum computer over to Sydney, but we would just have access to it through a link. Now, for the sake of our hackathon, whilst we did actually have access to this quantum computer, most of the assessment that we did in order to find the winner was through simple or through actual classical computer models. So we were running people's submissions through these models rather than through the actual quantum computer. And it was more really about learning how do you program some machine like this. We had a few experts there, some guy who wrote his PhD on a specific algorithm that he programmed. And so we had mostly few people from universities, also some from finance, all trying to build those little programs and come up with something that actually works. It was very, very interesting. And what you realize is that it's not easy. We definitely need a new type of programmers to understand these systems really well in the future.
Yeah, I bet. And that D-Wave you're talking about, how big is that?
It's about the size of a garage.
Wow, okay.
So at the moment, they're not small, mostly because the actual chip is just as big as a normal computer chip, but all the periphery to cool it down is very big. So what happens is these chips, in order to operate, they need to operate close to absolute zero, and all the periphery that makes up the garage size is basically to cool down the chip and keep it cool and stable, and also isolate the chip from cosmic rays and other interferences, so it can actually operate properly. So most of the quantum computer is actually not the quantum computer, but all the systems that sit around it.
Right. That's really interesting.
Yeah, it is fascinating.
So what happens when we start to pair artificial intelligence with quantum computing? What happens then?
This is definitely something that is going to happen, because when you look at artificial intelligence, a lot of it in its core, so if you look at neural networks and so on, in its core there lies a optimization problem. So you have so-called weights in those artificial intelligence nodes, and what you want to do is to minimize certain errors in those. Now, at the moment, this is done mostly with methods called stochastic gradient descent, but you can see that there is actually there's actually room for this new quantum technology to make that far more efficient and much faster, and also parallel. So once people are starting to combine the two technologies, I can't even imagine what we're going to see. I don't think anyone at the moment can imagine what the future will bring when those technologies actually start to come into our lives.
Yeah, it's pretty incredible.
They will definitely change finance a lot as well.
All right, well, let's wind things down. Thomas, I just want to ask you one last question. Just going back to algorithmic trading for a moment. Just one last question to take us out here. Through all the years you've been working in the field and working with others, and even the little bit of consulting that you've started to do now, is there anything you've noticed which less experienced algorithmic traders tend to often miss or neglect?
I think what's important is, that's my finding, to really find out your own style. That there's so many different ways you can do things, and I think it's important to find your own style. So what I'm doing is not necessarily suitable for most people. They probably wouldn't find it particularly interesting. And I think when you go on that path of building machines that trade on the stock market, what you really should do is see what really suits you. Whether you like more simple models, but do them really well, or you use really complex data analysis tools. Figure out what really makes you interested and what makes you happy and keeps you going, and do that rather than trying to do things that might not appeal to you. There's so many ways to make this work, but find your own style.
Totally, yeah, and I mean that's become just incredibly apparent to myself as well from doing this podcast. Just it's hard for me to say that any two traders on this podcast trade the same way. I mean, yeah, I'm sure there's a lot of similarities, and there are traders who trade in similar ways, but everyone does things a little bit differently. Just what feels right for them. So, I appreciate you coming on the podcast, Thomas. It's been
thank you for having me.
An awesome conversation. Where can listeners go if they want to find out a little bit more about you? I mentioned your website earlier, AAAQuants.com. Are you also on Twitter or LinkedIn or anything like that?
I'm on LinkedIn. My name just Tom Stark. I also have AAA Quants on Twitter. So you could follow that if you would like to. Other than that, I'm not overly present on social media, but you could always contact me through my website. There's also a GitHub page called AAA Quants. So if you go github.com/AAA Quants, you find a few interesting bits and pieces there if you're interested. And yeah, that's pretty much it. Okay.
No, good. So, everyone listening to this, as you know, I'll dig up all these links and put them in the show notes.
Perhaps one last thing. I'm also running workshops for Quantopian. At the moment, mostly in Sydney. So I've been recently running the advanced Quantopian workshop and also the basic ones. So if you're interested in coming to one of those, we usually give a lot of value there. So look out for them, and they're often quite good fun as well.
Okay, I know you just had one of those recently. Is there another one coming up?
There's probably another one coming up. We haven't planned it yet, but that's basically because I've been very busy. Oh, finally, as I mentioned, we also have a meetup group called Cyber Traders Sydney. So we meet in slightly irregular intervals, but usually every few weeks. So if you would like to say hello, also please come by, and you're more than welcome. It's usually run at Fishburners, a co-working space, and they're normally good fun. We have interesting speakers, and often we meet and socialize afterwards. So
okay, cool. Now those Quantopian workshops, whereabouts is there like a page of upcoming events on the? Is it on the Quantopian website, or are they best to check your website?
yes, the best way to look is on the Quantopian website. They usually have a page of upcoming events, and so those events will probably be advertised there. So if you wanted to see whether there's one coming, please have a look at the Quantopian website.
Very good. Very good.
Okay.
All right, Thomas, let's wrap that up there and enjoy your weekend. We'll talk soon.
Thank you. You too. Thank you. Bye.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's going on, folks? It's nice to have you with me. I know I say that quite frequently, but I do mean it. It's great to have you here. This is episode 148 with my guest, John Grady. John is an independent futures trader who primarily trades treasury bonds. He lives in Florida. His trading is purely discretionary based upon his read of order flow. Essentially, he's a scalper. So let me share with you the reason why I asked John to come on the podcast. And I'm a little bit embarrassed to say this, but it's only recently. Okay, let me rephrase that. Until recently, I'd never really taken the time to understand the order book or watch and make sense of order flow, etc. Sure, I understood the order book at its most basic level, but really not much beyond that point. Through this exercise of learning more, I came across a few videos of John's, which did a brilliant job of explaining things and were very helpful, for me at least, to grasp things on a deeper level. So I kind of have this view, or I'm fairly convinced, whether you use the order book as a part of your trading decisions or not, it's valuable as a trader to at least understand what's going on there. And that's why I brought John here to share some of his insight and experience with you, okay? So throughout this episode, we go over the basics, the value of the order book, some of John's trading methods, order types and managing positions, how to build skill at actually reading order flow, as well as the impact of high-frequency trading and what's commonly known as spoofing. So with that being said, let's cut to my chat with John Grady.
I'm pretty much open to talk about whatever you want, dude. So, I mean, if you hit on a topic that I'm not, I'll tell you. But feel free to ask any questions, and then you can obviously edit it as you see fit for your podcast.
Excellent, man. Cool. Well, let's get this going. I mean, we'll probably run for around about 60 minutes or so. But let's start with a little bit about how you got into trading. I mean, we probably won't spend too much time on this because there's a whole lot of things I want to ask you surrounding the order book and related topics. But how did you get into trading, and also when did you get into trading?
Okay, so I'll give you the short version. I discovered trading when I was 12 years old. I met a guy who was a stockbroker and retired at 35. And this is the joke that I share with people. I made the mistake of wanting to become a trader and not a stockbroker. Which it wasn't a mistake for me, but I joke about that because he wasn't a trader, he was a broker, and he made a lot of money doing that. But it piqued my curiosity in the markets. So I actually started studying the markets literally when I was 12, 13 years old. I discovered futures when I was about 16. My grandfather had a bit of an interest in them. He didn't really trade. He certainly didn't day trade. We're going back many years. I'm 41, so I mean, we're going back to the 1980s. And ultimately, the interest in it led me to open some accounts. I, of course, lost money like everybody else did, or everybody else does when they first start trading. And so I started pursuing jobs. I landed a job at an equities firm briefly in Colorado, and it was right around the NASDAQ boom and bust. And unfortunately for me, they started this prop firm, and it was right at the beginning of the bust. So they brought in some guys who had been trading the boom aspect of it. And what I didn't know then, which I know now, is pretty much all of these guys were order flow traders. They all watched level 2. They all watched the time in sales and the size. And it didn't make much sense to me because I'd only been studying technical analysis, as retail traders are prone to do. So the market started to tank, and some of these guys got out of the business, and that prop firm didn't last very long. The guys that started it weren't really prepared to invest much money in it. But I did learn a little something, certainly a little something about level 2 and order flow from a guy that befriended me there. He was a very good trader. And that was my first real exposure to, okay, I kind of see how, when 20,000 shares move, it moves the market 10 cents or 12 cents or 15 cents. And then I landed a job at a prop firm in Chicago, and they traded primarily Treasury futures. They did have some people trading European futures, and eventually they put some people on grains and energies. A little something your listeners might like to know is that there was no department for stock indexes. So you're talking about a group of professional traders that started a prop firm, backed it with several $1 million, and they had their traders on fixed income or grains or energies, and nobody was allowed to trade stock indexes. That doesn't mean there aren't opportunities in stock indexes or in the S&P 500, but basically they knew even then that you tend to find better opportunities in like fixed income products like the U.S. Treasuries or maybe the Bund Babel. So in a nutshell, I started working for them. That was the first time I'd ever seen a depth of market for futures. I'd obviously seen level 2 for stocks, but I'd never seen a depth of market for futures. And I was there for a little while, and I figured it out on my own for the most part, but I figured it out because I was able to watch some other guys and kind of see what they were doing, just because I could see their screens, one guy in particular. And then it all just kind of came together and made sense. And once I understood what was happening, and I had actually talked to a couple floor traders as well, and they began explaining, how you look for big orders, essentially. And a lot of people don't know this, particularly retail traders. Guys on the floor are not geniuses, and it's not a guarantee that you're going to make money, but what they can spot, or what they were able to spot at the time, were inefficiencies. So it'd be a big pit, and they might see that the market is bid 12 on one side of the pit, and offer 14 on the other side of the pit. And they could take advantage of that, maybe buy 13s and sell 14s right away and work with a partner, or they would befriend a broker, and the broker would let them know when a big order was coming in. That's technically illegal, but it happened. And a big bank's about to sell 10,000 contracts, you go short. They sell 10,000 contracts, the market breaks, a couple of ticks, you cover. It's free money, essentially. So that's why a lot of those guys complained when the floors disappeared. So after that, I eventually left the office, mainly just due to politics. It wasn't, I didn't do poorly or lose my money. It wasn't a good deal after a while. And from that point, I went on my own, and then eventually started, no BS day trading as a way to try to educate some traders out there in the world about the realities of trading.
Okay. And how long have you been out on your own now?
Quite some time. Over 10 years.
Okay. Excellent. So let's get straight into it. Let's talk about the order book. So I just want to ask you a few really basic questions just to begin with, just so that, because I'd hate to lose someone right at the beginning and then they're just lost for the rest of the episode. So just to make sure we don't lose anyone, I just want to ask you a few really basic, quick questions. So first of all, when we talk about the order book, what are we talking about? And are there other names for it as well?
There are other names. It is technically the order book, but these days you would also refer to it as a depth of market, a depth in sales, or when people say the order flow, it means they're watching order flow within the order book. And what the book is, it shows 10 bids and 10 offers, right? So if the current price of the market is at 5, you will see offers at 6, 7, 8, 9, 10, all the way up through 15. And you'll see the bids from 5 all the way down to even, and then, the next below even, whatever. Depends on what product you're trading, obviously. So you get to see 10 bids, 10 offers all the way out in the inside market, which is where the price currently is, right? So when someone says it's 5 by 6, what they mean is there's a bid to buy at 5 and there's an offer to sell at 6. And eventually for the market to move, or for price to move, somebody either has to be willing to buy at 6 or sell at 5.
Okay. And just to be clear, when you're talking about a bid or also an ask, you're talking about someone who's willing to buy at that price, and then an offer is someone willing to sell, correct?
That is correct.
Okay. And probably one other thing we should just be clear on is the difference between a market order and a limit order.
Sure. As a matter of fact, I have not to plug this, but I do have a video on YouTube, free video. It's order flow basics and what are you seeing on the DOM, and it covers this in great detail, like the most basic detail of all. But basically, a limit order means, let's say you and I are participants in the market, and I say I'm willing to buy one contract for a price of 5, okay, and you say you're willing to sell one contract at a price of 6. We're both currently working limit orders, which means we're only willing to do a transaction at those prices. I'm only willing to buy at 5, and you're only willing to sell at 6. Now, if I step up and say, you know what? Okay, fine. I will buy from you at 6. I have now used a market order to hit your limit order at 6, and then the transaction is conducted at 6.
Okay, so limit orders are visible in the order book and market orders are not.
Well, market orders become visible once the transaction is created, right? So the limit orders are what are visible in the order book, and then when someone hits a limit order, that is a market order. So the limit order is being hit by a market order.
Yeah, so you see it in the time and sales.
Time and sales, that is correct.
Yes, but not in the actual order book itself. You only see it sort of being taken out.
Right, you'll see the transaction occur, and you'll see the bid and offer change as a result of those contracts trading. But yeah, you obviously don't see a market order because it doesn't happen until someone decides to initiate it. So it's not like, I mean, I can sit there all day and work a limit order at 5, but you're not going to see my market order until I actually step up and hit your offer at 6. And that's part of the poker aspect of it, is that, you know, I'm hiding my intent and intentionally don't want to let you know I'm willing to buy at 6 until I do, you know, and then you're surprised by it, or not surprised, but that's how it works.
Yeah. So maybe explain to us why the order book is important for you in your trading. Like, what's the value of the order book?
The value is that it lets you know where supply and demand is, and that is ultimately what changes price. So if there is more money interested in buying than in selling, price will move higher. If there's more money interested in selling than buying, price will move lower. What do I mean by that? Let's say, and I'll use, because I primarily trade treasuries, the 10-year note for an example. Let's just say I'm looking at the order book and I'm thinking about selling. And right now the price is 2 by 2.5. So there's a bid at 2 and offer at 2.5. But the bid at the price of 2 is for 3,000 contracts. And the offer at the price of 2.5 is for 300 contracts. So clearly there's far more interest right now in buying at 2, right? And so if I wanted to sell, I'm going to place a limit order at 2.5, because almost guaranteed contracts are going to continue to trade at 2.5 until the bid and the offer even out a bit. So if it's 3,000 bid by 300 offer, buyers are naturally going to gravitate towards the 300 offer, thinking that the market's going to move higher. If it's, then changes so that it's now 1,500 bid by 1,500 offer, now we're back on a level playing field where it appears you have an equal amount of buyers and sellers on both sides, and that changes. So from a scalping perspective, and scalping doesn't necessarily mean for one tick, by the way, let me clear that up. It can be for 5 ticks, 8 ticks. Just scalping means you're looking for, opportunity in the moment based on order flow. From a scalping perspective, the order flow allows you to see at times when one side clearly has control, because the bids, the buyers and the market orders on the buy side are clearly overwhelming the sell side, or the sellers and the sell market orders are clearly overpowering the buy side. So if you're watching the order book and price is 10 by 11, and suddenly market orders sell everything at 10, they sell everything at 9, they sell everything at 8, right? And they're just wiping out bids. There's no point in going against that. You either stick with the sell side and you go short yourself, or you stay on the sidelines. But when you can actively see market orders wiping out limit orders, that means, someone's moving size, and that's what moves price.
And just to break this down a step further, what are you seeing by looking at the order flow or the order book? What are you seeing that other traders who are not looking at this are not seeing?
For starters, volume. That would be most important. So let's say you have your typical guy who looks at a chart, right? And the market's moving down a bit. And so let's say the market has moved from 10 to 9 to 8 to 7. Okay. And now he's looking at a price of 6 as possibly taking a long trade. Okay. Because let's say it's a technical support level. If he's just watching his chart, all that he can see is the market's move from 10 to 9 to 8 to 7. Okay. But if he's watching the order book, he can see how much volume has traded on the way down, and he can also see what actually trades at 6. So it makes a very big difference if the volume that trades at 6 is 500 or 10,000. All right. And that might seem like a big number for people who don't watch liquid products, but that's, again, a treasury number. If someone's only willing to buy 500 contracts at 6, there's a very good likelihood that the market will now drop to 5 and 4. But if someone's willing to buy 10,000 contracts at 6, there's a very good likelihood that the market will now go from 6 back up to 7 and 8. So the actual volume is the most important aspect because it shows you where there's a lot of interest versus not much interest in defending prices.
And when you speak about volume, you're talking about, I guess, volume before it's actually traded, right?
No, when it's traded. So not, yeah, because there might be, as I showed you in that example, there might be a limit order of 1,000, but when the market gets there, the entire thing is a spoof order and only 100 contracts trade. Okay, so you actually are watching the transactions which go off in the order book, so you can see when it trades at that price of 6, whether or not 100 contracts trade there or 10,000 contracts trade there. Okay, and you can see how the market responds to that. So certainly you do watch the limit orders as well, right? The bids and asks, because sometimes that is a clue. But some of those orders end up being canceled. Some of them are spoof orders. They change. So the really important volume to watch is the actual amount of contracts which are trading at each price. And that happens after the transaction takes place, obviously.
And you're watching all this on the recent trades, time and sales.
Yeah, well, I watch it on the depth of market. The depth of market I use, I don't know if you want to even plug, it's Jigsaw, but you can cut that out if you don't want it in there. The depth of market that I use, and most decent depth of market platforms show you the volume trading on the platform itself. So it makes it very efficient. All you got to do is watch the order book, and you can see the volume trading in the order book, and then you can place your orders directly in the order book as well.
I'm with you. Yeah. Now, you said a couple of times that you trade treasuries. What's your preference for trading treasuries? And you made a comment a little earlier as well about when you were working with a prop firm about how they were mostly focused on treasuries and also some commodities as well. But what's your preference for trading treasuries, and which treasuries are you trading?
I watch the 10-year notes, the 5-year notes, the treasury bonds, and the ultra bond. And there's also a couple of others. There's 2-year, 3-year, and 7-year, but those don't have that much action or volatility. In a way, I'm a bit lucky, that I even landed a job at the firm. That's why I know what I know. And of course, I became biased because that's what I was told to trade, was treasuries. So that certainly played a role in it, and played a role in me learning those markets. But once I started to trade them, and over the years I began to realize why they chose those products, they ebb and flow in a way which is very logical, and they're not too subject to really erratic behavior. So, for example, the problem with oil, let's say, trading crude, not that it can't be done, but the problem with it in my mind is that it's a market that's very thin. And if BP wants to step up and smack 700 contracts, they can, no problem, because they're BP and they can do whatever they want to do. And so the thinner markets are far more easily manipulated. And not to say that somebody couldn't buy 700 contracts, but basically you can maneuver in those markets really easily, and you can push them around very easily. And so it can become more difficult to figure out where there's only going to be 15 contracts and where there's going to be 700 contracts that BP is going to trade. So you tend to have a bit more erratic behavior, and you have a lot of spike movement. With the treasuries, you have a group of products. They're all being traded primarily by banks. The banks are trading spreads, and they're trading the yield curve in those products. I don't want us to go beyond people's heads and have them shut down. But in a nutshell, you have a group of products, and there is an interplay between them. So you're actually able to watch 4 different products and get a feel for the interplay. And the products are very liquid. So they're not subject to nasty spikes and reversals. they tend to move with a bit more sanity, I guess, for lack of a better word. And not that you can't, make mistakes or make bad reads, but the amount of volume that trades lends itself to really being able to pinpoint prices sometimes. So for example, I can sometimes peg a reversal literally to the tick in treasuries, which is something I could never do in the S&P 500, or very rarely do on the S&P 500. And you can only do that because of the way treasuries behave. So it's an excellent product for scalping and going for kind of short-term plays. And you can move a lot of size too. That's another thing, is that if you become proficient trading gold, you can't really ramp up your size. I mean, the most you can trade is 10, 20 contracts. If you become proficient trading treasuries, you can literally trade 100, 200 contracts, the same way you trade a 10 lot for the most part. So if you do become proficient at it, there's no really cap on your potential.
Right. And you yourself, are you trading directional outright, or are you spreading as well?
I trade outrights. I'm familiar with spreading, and I watch the spreads, and I teach people how to keep track of that stuff. But I prefer, this is more preference, I prefer outrights because I like to get paid when I'm right. So I don't mind taking a little bit more risk when I'm wrong, so that when I am right, if the market moves 12 ticks, I get 12 ticks. I don't only end up making a tick and a half on the spread. And
because you're a directional trader, do you have a bias going into each session? Even though you're very much focused on the order flow, do you still have an underlying bias for where you think the market might go at the beginning of the day?
It varies from day to day, and that touches on the topic of what I call context. Context is, what I mean by context is simply the conditions surrounding the situation. So, for example, on non-farm Friday, right, the first Friday of every month, they release the employment numbers for the U.S. When you go into non-farm Friday, that at 8:30 a.m. when those numbers are released, the market's going to go haywire. It just is. It's a given. Typically on a Monday with no news whatsoever, the market's going to be very slow, and there might be opportunity, but it's going to be, slower and more methodical. So the way you approach each one of those days has to be different, right? So, I do some days have a bias when I turn on the screen, and some days I don't have any bias whatsoever. And much of that depends on what happened the previous day and what happened in the overnight action and what I'm currently seeing. So, yeah, I certainly don't base it on charts or a day chart, but I do base it upon what happened in the overnight action and how the market seems to be behaving going into the opening hours.
Okay. And I presume you'd be fairly willing to let go of that bias if order flow wasn't confirming with what you were anticipating?
Immediately. Yes. That's one of the keys or one of the upsides to being an order flow trader is assuming you're doing it right and you don't allow your ego to take hold, which, everyone can succumb to that at times. But the beauty of order flow is you have an idea in your head of what should be happening if you're right. And if the order flow is not confirming your opinion, you just get out. You don't have to sit there and let the market move 5 ticks against you. You can take a shot and realize this thing is not doing what I thought it was going to be doing, and just immediately turn around and get out for break even. So yeah, I'm willing to change my opinion very quickly if I'm being proven wrong, or if it's not adhering to what I think should be happening.
Sure. And how many trades would you take on any given day? Just generally speaking, average numbers.
Generally, again, that completely depends upon the day. On a day like today, I took 2 trades. 3 trades, excuse me. It was so stupidly slow. And on a non-farm Friday, I might take 20 trades, 22 trades. I don't normally get much beyond 20 or maybe 25. That's pushing it. And that's only on a really volatile day when there are a lot of opportunities. So in general, probably on average, 3 to 10. That might seem kind of wide, but it's not.
I imagine as an order flow trader, taking 3 trades in a session must be very difficult to sit on your hands.
It's extraordinarily boring. It is. It really is, yes. But that is what makes... that's how you gain consistency. That's the only way that you get ahead in this business is you must develop discipline and patience. It is extremely boring. It does require a tremendous amount of patience, but that's the job and that's the discipline. And, the days that I lose are almost always days where I force bad trades. And what I mean by force a bad trade is I sit there for an hour and a half or whatever, and I don't see anything that I want to see. It doesn't mean the market's not moving or there's not opportunities, but nothing falls into my parameters, and I take a trade anyway, and inevitably it's a loser, right? So you have to wait till you see something tends to work. Some trigger that lets you know, oh man, I've seen that 100 times. Typically the market goes up in this situation. Let me take a long trade, and then at least how to handle the trade. That if it goes through you have a set stop loss and you're okay with the trade. But yeah, it's pretty brutal, and it's brutal for people that trade from home because you're isolated. So at least in the office, you can sometimes banter. Although people are usually quiet in offices too for a while, but you can take a break, go to lunch, maybe have a conversation if the market's not moving. When you're sitting at your house, it requires 5 times as much discipline.
Yeah, because you just want to be in on that action, and you need that self-control, right?
You want to be in on the action for something to do, but you can't be in on the action just to be in on it. You have to have a reasoning behind it, and so that's the problem with it. Or it's so stupidly slow, and you're just bored and you start surfing the net. And of course, the instant that you start surfing the net is the instant that you miss seeing something that would have been a trigger, and you missed the only trade you see all day, and then you jump over and now you want to trade it suddenly, but you've missed your entry price. And now the market's 4 ticks away from your ideal entry price, right? And then you chase. And of course, that's where it turns around and comes right back. So that's how you mess up.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
You said earlier that you're not necessarily just scalping for one tick. How long are you holding positions for, I guess, generally in time, and also how many ticks are you trying to take out? I know it probably varies quite a lot, but can you give us some sort of insight to how you do that?
Sure. Again, that depends on context. So I might spot a trade where I think, let's say, we're at an area where the market's going to hold in a 2-tick range for maybe 5-6 minutes. And I will take a quick trade and hopefully just grab 2 ticks in a matter of, 30 seconds to maybe 2 minutes, right? That would be sort of a short-term trade. Sometimes maybe even seconds. Sometimes if I'm on the wrong side, I step up and I'm immediately on, it's against me. I just blow out in a matter of 10 seconds, depending on the situation. Other times, if I think that maybe direction is shifting, or if I'm sitting in a trade expecting a move to occur, but maybe not for a little bit, I might sit in a trade for 10, 12, 18 minutes. Hopefully it moves within that time in my direction, so I at least have a little bit of an edge in terms of, maybe the market's at least 2 ticks in my favor, so worst case scenario, I can scratch the trade. And now I have a look at seeing whether it goes or doesn't go. So I would say on average, probably have to sit in a trade between 2.5 minutes to maybe 12 minutes, depending on the context. I'll sit in a trade for 30 minutes if it's going my way, and there's just no sign that it's stopping. I'll just continue to hold and move my stock closer and closer and look for the best exit price. But on average, I would say probably 3 minutes to 12 minutes.
Okay. Now, here's a question which I'm quite keen to ask you. As you use order flow to enter the market, do you also use order flow or your read of order flow to exit the market either for a profit and for a loss?
Absolutely. So that's another issue that a lot of retail traders face, is they fall into the trap of believing that you get in a trade, it moves in your favor, and now you just start bringing a trailing stop down, and then you wait for the market to turn around and hit your trailing stop. And they often give back so much money doing that. When if they were watching the order flow, they could sometimes clearly see the market's just stopping. And there's no reason to let it come back 2, 3, 4 ticks, just take it off right there. So yes, I use the order flow to enter, and I try to always pinpoint the best possible exit. It doesn't always happen by any means, but I'm trying actively to do that. And another issue with the mindset of a scalper is there's no problem immediately getting right back in if I think I'm out too early. So let's say I buy at 5 and I take the profit at 8, and suddenly they go 9, and I'm like, I don't think they're done yet. They're going to go 9, 10, 11. I'll buy 9 and try to take it at 10, 11 and get out again, and that's what programs are doing also all day long. So using a trailing stop really, you want to drag it down to make sure you don't get caught in some weird reversal. You kind of keep dragging it down as an emergency stop, but people should really spend some time trying to focus on taking the best possible exit prices and not just automatically using a trailing stop.
Can we just go into that a little further? So do you have a predetermined amount that you're risking prior to going into the trade? Like, do you think that through? Because I know, you're obviously trading at very quick speeds. Like, do you know exactly how much you're going to be risking on that trade, like in a dollar amount?
I do. Well, I do within a tick, let's say. So I don't really look at it from dollar amount so much as tick amounts. I'll figure out what size I want to trade, based on the situation. And then I'll completely adjust based upon the situation. So as an example, let's say the market is grinding upwards, grinding higher. And I think that maybe it's going to run out of steam and I'm going to take a fade trade. I'm going to go short, right? When I get in that short trade, usually I pick a spot where I know it should not go through me by more than 1 tick. And if it goes 2 ticks against me, I just blow out. Okay. And that might seem like a very tight stop, but in that scenario, it makes sense because if it goes 2 ticks against me, it might go 7 ticks against me, right? So I might as well get out, take the loss, sit back, wait. Let's see what happens. Maybe try another short trade, or you know what? Maybe turn around and go long, realizing that I had the wrong idea there. So I do know where I want to be out on every trade. Where that is depends upon the trade itself. So some trades I might actually be looking to enter in the hopes that basically it moves a tick or two in my favor, and worst case I scratch. In some cases, I might be out with a 1 tick loss, believe it or not, because I just know that, they shouldn't take this order out. If they take this order out, I'm on the wrong side. And there are other situations where I know I'm kind of in an area where it might chop a little bit, and I have to give those trades maybe 3, 4, 5 ticks. 5 is a little bit excessive with a 10-year, but 3 to 4, definitely. And you just have to give it that leeway to see whether or not your prediction is correct. So you just adapt based on the scenario, but absolutely, before I enter the trade, I do know where I'm most likely wrong, and I already have that stop loss planned, and I don't deviate from it. That's also what kills a lot of people. When you deviate from your stop loss and you begin moving it, that's how, what should have been a 3 tick loss becomes an 8 tick loss.
Just going back to that first scenario you explained, so the market's grinding up, and you think it's probably going to turn around, and you fade it, so you go short. You're trying to enter your short position at a point where you think the market shouldn't go a tick or two above that. Okay. What if...
Correct.
What if it does start moving against you, so the market continues to rise, you're short, it goes 2 ticks above where you got in, but you begin to see a lot of offers coming into the order book, a lot of people selling a few ticks higher. How do you react in that scenario?
It depends very much on the scenario. And I know what you're asking. There are times when I know I might be a little bit early, and I'll hold through that. So yeah, the market might tick up 2 ticks, and then suddenly I see just a flood of sell orders come back in, and now it's only 1 tick against me instead of 2, right? Or they're sitting, and it's 2 ticks against me technically, but there's a huge offer sitting at the second tick, right? So in a scenario like that, I might give it 3, and just kind of wait and see if they hold it. But then you start to get into dangerous territory if you begin to give it more than that, because now you end up talking yourself into thinking you're right. But realistically, if you're right, when that next wave of sell orders comes in 2 ticks higher, it should bring the market back to your entry price. So if I'm in a trade and I'm short and the market's 2 ticks against me, and again, we're not talking about crude, obviously, we're talking about a liquid market like the treasuries or even the ES. If sellers aren't able to get the market back to my entry price relatively quickly, it means there's still a tremendous amount of buy side pressure. And so frequently the best thing to do there is just cut it at a loss. 1 tick, 2 tick, just cut it, let it go. And you know what? If it does come back to my entry price, sometimes that's just trading. And now I wait and then maybe get in another trade, a few minutes later and get the 2 ticks back. But you can't question it too much if it doesn't snap back on your price.
Okay. The stops that you're using, do you have a limit order sitting in the book?
I do. I have a market order actually. So I'm typically always manually exit a trade. But what I have is, when I enter a trade, I'll immediately place an emergency stop, like 4 ticks off my price, maybe 5. That is, or maybe 3, depends on the scenario. But that's my stop in case the market sweeps very quickly against me. Like I'm clearly on the wrong side. It shouldn't jump that far that fast. So I'll enter the trade. I'll immediately put an emergency stop in, say 3 to 5 ticks away. And then I will manually figure out the exit point. So, and you can do that with treasuries because they go back and forth and they're very liquid. You can't really do that with thinner products. You almost always need to just mark it, out. But sometimes in the treasuries, I know I want to be out But rather than hitting out immediately with a market order for 3 ticks, if I'm a little bit patient, I might be able to take a 2 tick loss or even a 1 tick loss, you know. But worst case, I have the other stop in and you know, I'll lose 3 or 4 ticks. So and that's a market order, because what you don't want to have happen is the market blows through that and you don't get, you know, hit out at all. It becomes a limit order, but it goes so fast that your limit order misses due to slippage. And now you're looking at an 8 tick loss instead of a 4 tick loss. You can set a stop limit order. So in other words, let's say the market is currently trading 5 by 6. I could set a stop buy order at 8. But what that means is if the market trades 8, the buy order triggers, but it's a buy order to only buy at 8, not to buy at 9. So it's not a stop market order, it's a stop limit order. If I have a stop market order, as soon as the market trades 8, I will get the next best price, whether it's 8, 9, or 10. So the reason you want the emergency to be a stop market order is in case the market moves so fast in one direction due to some event you can't foresee, you do get out of the trade, you know, and it doesn't become a 30 tick loss in some crazy situation. If it's a stop limit order and they eat through those orders really quickly, your order may not be filled, and now it's a limit order just sitting there at 8 and the market's trading 12. Makes sense? Yeah.
Yeah, makes sense. Yeah, I'm with you. So just to the second part of the question though, so your stop is visible in the order book?
No, the stop's not visible. The stop doesn't trigger until the market trades that price.
Okay. Yeah. Got it. Yep. Okay. I'm with you. Now, what order types are you normally using to enter the market and also exit as well when you have a profit?
Be, again, dependent upon the scenario. Sometimes I always want to use a limit order if I think I can get the limit fill. So again, back to that first example, if it's 3,000 on the bid by 300 on the offer and I want to sell, I'm obviously going to put a sell limit order with the 300, you know, because I'm likely to be filled on that order because there's such a discrepancy between the bid and the offer. But let's go the other way. Let's say it's 3,000 bid by 300 on the offer and I want to buy. Well, my odds of getting filled with a 3,000 bid underneath me are almost none. So then I'll use a market order and buy into the offer of 300. So I'm always trying to get a limit fill, but realistically, sometimes you just have to pay up the next price and take the market order, use the market order and get the fill, or otherwise you miss it altogether.
And with your entries, I know we're kind of jumping between entries, exits, bit of all over the place, but with your entries, are you getting in your full size at one position, or are you kind of spreading it across a few different price levels?
It's almost always full size at one spot. That's my particular style. I'm usually all in, all out. There's some reasonings for that. I take a little bit of time to explain, but it tends to be best for most people. When you start scaling, frequently people get themselves into a situation where they're inversing their risk to reward. And what I mean by that is they end up risking, like 5 ticks on their full size, and then they scale out when the market moves in their favor and they don't capitalize and get the full payoff on full size. That's when it wins. When they lose and they average in, well, they're averaging into losers. And that in and of itself is an indication that you were on the wrong side in the first place, and you're probably on the wrong side now. So you're just doubling down into a bad situation. And it just doesn't work for most people. So what I tell people is if you can become successful at going all in, all out, then eventually you can learn if there are areas where you might want to scale a little bit, But for me, for the most of the time, it is an all in, all out scenario.
Okay, right. Now, I guess just going back to some more general questions about the actual order book in itself and not so much about your specific way of trading the order book. You obviously do quite well at reading the order book in treasuries. Is it a case of if you can read one order book well, you can read any order book, or are there really big differences between different markets?
I believe there are very big differences, very, very big differences. I actually did a presentation one time about choosing the right market to trade, and it was solely dedicated to this topic. It's on Futures.io if you want to watch it sometime. The concepts are the same. So supply and demand does move markets. So if you have more money going one way, it's going to move the market. But the problem is, in today's day and age, if you want to trade the DAX, for example, you almost have to be working a program that can trigger orders at certain prices, and you can't really take much time to think about it. So in other words, let's say you wanted to play a breakout. You already have to have the order working to play the breakout, and you really already need to have an idea of where you want to be out, and those orders need to be in the book. And because what you can't do is, you can't buy evens in the DAX and then sit there and watch it go 1, 2, 2, 3, 3, 2, 3, 4, 4, 3, and get a feel kind of for where it's stopping. It can spike in such a way that if you don't take advantage of that one momentum move, the market may completely reverse and come back on your entry price in a matter of a few seconds. So if you're trading thin markets such as the DAX or gold, I think you can't trade those effectively without using a lot of market orders that are already placed, or having an automatic strategy so that if your orders hit, you have an automatic trailing stop that comes in behind it. And you can do that with most software these days, right? So you execute it even. You use a 3-tick trailing stop. The market goes from even to 3. Your trailing stop comes to break even. The market goes from 3 to 6. Your trailing stop is moved to 3. You locked in 3 ticks of profit, so on and so forth. I think you have to use those kind of strategies in a thinner market. In a more liquid market like the Treasuries and the S&P 500 or the Bobble or the Euro stocks, there you can use a little bit more discretion and manually adjust orders and get a little bit of a better feel for what's happening. So I guess the short answer is, I think there's a huge difference. And I don't think I could attain the same results in crude oil as I can attain trading treasuries. I think the concepts need to be known, and people need to understand what they're seeing and why they're seeing what they're seeing with regards to volume and in the book, and develop methods based upon that information. But the implementation of it is far different.
Now, someone who might be new to looking at order flow, they might pull up the order book and it probably just looks like a whole lot of numbers flashing on a screen rapidly. Like there's a lot of changes every single second. How do you begin to take valuable information from that? How do you build skill and actually being able to read the order flow? And are there any tricks that you use to because I presume you'd have to be fairly good at doing some quick sums.
There are. You don't have to be good at doing sums because the sums are shown for you in the platforms if you have the profile column and the transaction column. But where you start is you start by understanding what you're seeing and the impact that it has, particularly the impact that larger orders have. Then you start looking at the inside. What I mean by the inside is the market's currently 5 bid, buy 6 offer. That's where you focus your attention at first. And you start to notice how, when they buy 6 and now it goes 6 bid, offer 7, that applies some pressure and that creates a little bit of a chain reaction. And now it goes 7 bid, offer 8. And that's how price changes. And as a new person looking at the book, that's what they want to watch in the beginning. They want to start noticing when price is moving and how it's moving, and notice how the next price goes bid, 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 and then boom, they hit this spot where they can't go bid the next price. So it goes 6, 7, 8, 9, and then they hit 10. Nobody can bid 10. Now it goes back offer at 9. Now it's bid 8, offer 9. So between 5 and 10, there wasn't any resistance, but now there's resistance at 10 and 9. Okay? And that's what they want to focus on at first, because if you're trying to watch all the changes in the bids and the asks, I mean, that's not possible because there's so many small orders adjusting. But you were trying to watch the total amount of contracts trading at each price, and then you want to watch how the market reacts to that. So kind of what you said earlier, where let's say you see the market going up, I took a short trade, the market goes 2 ticks against me, but then suddenly a lot of sellers come in 2 ticks higher, right? Just take notice of that. Take notice of how volume is influencing price. And that's where it starts. And once you get a feel for that, then you can start to pull your vision out a bit and look at the bigger picture and say, okay, now we've traded from 5 to 10. They're stalling at 10, 9, 10, 9, 10, 9. Based on what I know about this market now, is it likely that it'll go 9, 10, 11, 12? Or is it likely that the sellers will be able to hold here and the market will fall back in 9, 8, 7, 6? And that's something that can really only be acquired with experience. And it's one of the reasons that I tell people to specialize in one market, particularly when they start. If you want to branch out to other markets when you get better, that's fine. But don't watch the euro and gold and oil and the S&P and try to make trades in all of them. You will fail almost guaranteed. Specialize in one market, learn the behavior of that market. And the reason for that is because the same people play in these markets every day, and they don't cross markets, a lot of them. So what you want to learn is how the major players who move volume tend to behave on a daily basis in one specific market. And if you can get a grasp on that, then you can start to see the bigger picture and incorporate it with the smaller picture of 6 bid by 7, 7 bid by 8, and kind of make a best educated guess.
Do you ever suggest, or is it a worthwhile exercise to record your screen? Because if you're very new to order flow and reading the order book, like I said, it can look like a lot of numbers changing rapidly. It's very fast moving. To record your screen and just slow it right down and look at, orders being taken out and put into the order book and that type of thing. Is that something worthwhile doing?
Absolutely. Absolutely. I tell all of my webinar participants to record their trading. It is the fastest way to learn. Either record it or, some brokerages offer market replay features. So market replay is also great. However you do it. You want to go back through, pause, stop, rewind, fast forward, take particular note around turning points. Just kind of see how the market was behaving, what kind of volume was trading, how did the market behave up to that point, how did it behave when it was pausing, how did it behave on the reversal. And if you'll record your trading and record the action and study it, you'll learn more from that in a month than you'll learn from journaling your trades in a year. I definitely recommend that.
How would you suggest that a newer trader, someone who wants to be active in trading the order book, how do you suggest they go about actually identifying or trying to seek out high probability, low risk trades?
A lot of study and screen time. I recommend that people begin. The first thing you want to do is you have to make sure that you do have a decent depth of market platform, whatever one you choose. There's really only 3 in the neighborhood, okay? Jigsaw is one, and the key to Jigsaw is that it has these inside columns that show the uptick, downtick splits. No other platform does that unless it's a homegrown platform. And it's $50 a month to place orders through it, and you don't even have to do that if you're not trading live. So for the cost, it's stupid, ridiculous cheap. Okay. But there's Jigsaw, there's TT's X Trader, which is more expensive, and there's CQG. There are some others on the market, but I don't really recommend them. Those are the three that give you the most information. Okay. So you need to have a very good depth of market so that you can actually see the order book, see the trades, see the volume profile. That's where it starts. You have to kick down a little bit of money to get connected to those and get connected to a data feed so you can actually see what's taking place. Then if you want to sim trade or paper trade, that's fine. It's not realistic. You're not going to make the same decisions as you will in real life, but you can watch market replay, watch your videos, and just start doing that every day for a couple hours a day. And it's time consuming, but there's no substitute for screen time. And if you will watch the action for, the first 2 to 3 hours of every day, not all day, but, first 2 to 3 hours after the open, you'll be surprised at how fast you start to identify just certain situations where you can see clearly that they're just not going through this price. It's just not happening. No matter how many times they hit the price, they can't get through it. So if that's the case, then I'll just join that side, and they may get through it eventually, but everything right now is pointing towards them not getting through it, and therefore I'm going to go with that side of the money and hopefully get paid as it comes off that price. And that's what I recommend. I mean, then ultimately, if you feel comfortable, you open a live account and trade a one lot, and that's where you really get your trial by fire, so to speak.
Yeah. With the order book, is it of value to anyone who's not a scalper? Like, what about someone who might be trading, they might place their trades after the market closes. They might be more of a swing trader, let's say. Or maybe even someone who's trading a little bit more actively, but certainly not a scalper, like someone who might be trading a 60-minute bar chart or something like that. Is the order book of any value to someone like that?
No, it's really not, if that's your take on it. Let me give two answers to that. So my two responses. My first response is, unless. Okay, let me
don't hold back
up. Two responses. My first response is swing trading is not a good idea for most people, and here's why. Too many things can happen overnight or over the course of an hour or 2 hours, and one of those things is a simple chain reaction that takes place as a result of large orders hitting the market. So here's what I mean by that. Let's say you have a guy who's a swing trader and he's watching the S&P 500. And to him, there's support at 25.50. So his idea is, I'm going to buy 25.50s and I'm going to sit in this trade all day long, and I'm going to see if it goes back to 25.60. Okay. And if it doesn't, I'll get taken out at 25.45. Right. So he looks at it as, I got a 2-to-1 risk to reward, or reward to risk. And that's his strategy. What he's not acknowledging is the fact that when the market hits 25.50, if there's not a predetermined fate set in the universe that's taking that market back up or down. What it is a combination. It is a combination of orders feeding on orders. And so you will have literally hundreds of HFT programs that are now flat, and they're watching the bids and offers at 25.50 and 25, 49.75, 49.50, right? 49.25, and on the upside. And they don't jump into the market until they see something happen. So when the market cracks 25.50 and goes to 25.49, that triggers an HFT, which goes 25, 48.75, and then that triggers 10 other HFTs that hit the next bids, the next, and the next. And so it spikes the market down, and it's this domino effect that takes place. And that one domino effect can affect so that domino effect can affect the rest of the day and what happens over the rest of the day. So concept that a person can think he knows where the market's going to be in 2 hours is, in my personal opinion, is delusional. I know there are people that argue against that, but that's my personal opinion. You're just delusional, because I've seen this, you see it every day, just situations where markets only move because a couple big orders hit and then suddenly it goes. If those big orders weren't there, it would never go. And there's no way to know that ahead of time until you see the big orders. Okay, so that's my first response. Fundamentally is different if you're, a fund manager. So there's a very big difference between day trading and position trading from a much longer time span. That's different if you think you know a company and you know fundamentals and you know earnings reports, right? Or if you play the news, or if you're in the cattle business and you know something about the cattle prices and you have you're pretty sure 3 months from now cattle prices are going to be higher. That's a different type of trading altogether. I think swing trading is the worst. It's just crazy to me that people do it, but they do. So that's why, really, no. The book, a lot of people that do make a little bit longer term trades do incorporate my ideas. I get guys that call me about it all the time. But what I'm able to do is usually show them, look, man, you might be thinking, looking at the 60-minute bar chart, but you have to understand right here, can you see how if this order gets taken out, it's going to cause a chain reaction? And the guy will say, yeah. And I said, okay, well, if you know that ahead of time, there's no point in you sitting in that trade for 2 hours. You need to blow out of the trade, take the loss, and look for a better entry point, lower. So if a person's willing to adjust their strategies a bit and react in the moment to what they're seeing, then yes, it can be helpful. If you're a straight up chart trader who's going to sit in trades for a few hours, then honestly, no, it doesn't make any difference.
Okay. I was expecting an answer like that.
Not, and I know how it comes across. I never try to come across as being arrogant, or that I'm 100% right, but I've been around a long time, and I can tell you I've never met a successful swing trader. I mean, it's maybe if you have a lot of capital and you sort of have an inside look into the industry or whatever, sector you're studying in stocks, maybe something like that, but just looking at charts and thinking that you can know where the market's going to be in 2 hours is delusional. Trust me on that.
Well, I don't think it's about knowing where the market is going to be. Like, no one knows where the market's going to be. I mean, even someone like yourself, you don't know where the market's going to be, over the next minute, I mean, you probably have a pretty good idea from your read of the order book, but...
That's true, and here's my response to that. It's a lot easier to predict what will happen in the next 6 minutes than in the next 60 minutes. And that holds true in every aspect of your life. You can, sitting right here, tell me with not 100% certainty, because I may hang up, without saying goodbye to you, which I'm not going to, but you can predict that for the next 6 minutes, you're going to be conducting a podcast with me. But over the next 60 minutes, you kind of know what you're going to do. But you're not, you might have this to eat, you might have that to eat. You may go here for lunch, you may go there for lunch, right? And now extend that out a little bit farther, what you're going to be doing tomorrow at 11 a.m. if you don't have an appointment made, right? So the same thing happens in trading. There are moments when it's far easier to predict what's going to happen in the next 5 to 10 minutes than it is to predict what's going to happen in the next hour. So I appreciate that comment of, you're right. I don't know with 100% certainty what will happen in the next minute, but what I do know frequently is the market's not going to move more than 2 ticks one way or the other in the next minute.